Welcome back. You're watching Power Breakfast on CNBC-TV18. Let's focus in on some earnings then. Axis Bank disappointed in the first quarter. Asset quality deteriorated, dragged profits lower. Gaurav is here with the fine print. Gaurav?
Well, as when it comes to Axis Bank, a weak set of numbers is what we have seen for first quarter, and I'll explain you why weak. When it comes to net interest margins, 17 basis point of fall is what we have seen in the first quarter. The street was expecting 10 to 12 basis point. Now, bank has broken up these the net interest margin fall. 4 basis point fall from the interest reversal and 30 basis point fall from the repricing. Other than that, another negative surprise was the credit cost. Now, it has inched up very much. When we talk about the normal business, it is at 1.1%, which is again higher than what the street was expecting. There was also one-off impact. There was a technical impact in this quarter worth 620 crore rupees, which has impacted PAT. When it comes to provision, the technical impact is worth 820 crore rupees. It has also impacted the gross slippages somewhere in the tune of 2,800 crore rupees. And as a result, the slippages have went up almost to 3.1%, and credit cost also went up to 1.4%. Even if we exclude this, again, credit cost is higher than what the street was expecting, and as a result, profitability has also declined almost by 4% on a year-on-year basis. Now, what is actually concerning for the street is that this one-off technical impact is coming up at a cost of the book, because ROAs have come down almost by 15 basis point, and ROEs also got impacted almost by 1.4% because of this technical impact. That is what the concern is. When we talk about management commentary, what they are saying is that the slippages will remain muted in the coming quarters, and at the same time, they are also confident that because of the higher recoveries, the slippages will come down, and as a result, credit cost will also come down. But on the back of that, we are seeing brokerages are also being a little bearish now. We are seeing brokerages like Investec have cut their target price, so definitely a negative impact is what we are expected in the stock price today. And as of now, bad set of numbers from Axis Bank for quarter one.
Thanks so much for that, Gaurav. So not a great set coming in from Axis Bank. The ADR yesterday was also down and out in trade today, yesterday. But let's take a look at Wipro. The company has met muted estimates in the first quarter. Revenue contracted 2% on a constant currency basis. Margins also contracted sequentially, but more or less in line with what the street was anticipating. My colleague Reema Tendulkar is here with more details. Reema, how were the numbers?
Thanks so much for that. So as you rightly pointed out, Q1 was in line with muted expectations. But I'm going to see I see some silver linings. For starters, Q2 guidance suggests to an improvement versus Q1, and the deal bookings are very, very strong, up on an average 50% on a sequential basis. But let's get to the numbers first. Now, constant currency revenue growth has declined by 2% quarter on quarter. This is within the company's own guidance. They're guided for -1.5% to -3.5%. So within the guidance, margins have come in at 17.3%. But the Q2 guidance, next quarter's guidance, is at -1% to +1%, which means that if the company achieves the middle point of its guidance, that 0%, it would be an improvement. Even if things deteriorate and the company does, at the lower end of its guidance, -1%, that's still an improvement compared to -2% that they've done in Q1. That said, Q2 is typically a seasonally stronger quarter for Wipro, so generally things do improve for the company. So just to quickly, some more numbers, this -2% would mark the second consecutive quarter of a revenue decline, and we've seen revenue declines across all the large cap peers. So whether it's TCS with a -3.3% decline or an HCL Tech with a -0.8%. So basically, large cap IT companies have reported a revenue drop this time, and it's no different for Wipro. The deal wins have been particularly very, very strong. So the total deal bookings have come in at $4.9 billion, which is an uptick of 24% quarter on quarter, 50% on a year-on-year basis. The company's also signed 16 large deals, which includes 2 mega deals. And if you just look at the pure large deal wins, that is up 50%. So Q1 weak, but Q2 points to an improvement versus Q1. Sequentially, it should be better in Q2, and the deal bookings are very strong. Other numbers like attrition is ticking up very marginally, headcount is down by a bit, but I think the deal bookings and the quarterly guidance would be the key parameters, the KPIs to track for Wipro.
Well, thanks so much for that, Reema. In fact, don't forget to tune in to our chat with the management of Wipro at 8:35 a.m. today. Well, let's now put the focus on key earnings expected today. Reliance Industries is set to report its June quarter numbers. The company is expected to see a 16% growth in profit, while margin may expand. My colleague Sonal brings us the details. Sonal?
Well, a good quarter is expected from Reliance Industries this time around. Remember, the stock is already up 21% this year so far. In terms of revenues, expecting a decline of 8% on a sequential basis. That is because raw material prices have come down, but EBITDA will see good growth, 3% in terms of absolute number. But in terms of margins, it will be a 200 basis points increase to come in at 18.7%. Profits also expected to go higher by 16% on a quarter-on-quarter basis. What will drive growth for Reliance this time around? It will be the O2C, digital and retail business which will drive growth. However, it will be offset by some weakness that we'll see in the oil and gas business. For O2C specifically, it's a 19% YOY increase expected in EBITDA this time, 3% on a sequential basis, which will partly be offset by refinery shutdowns that the company took. For Jio, the ARPU is expected to increase by 1% on a sequential basis. And for the retail business, the expansion will be on the back of JioMart scale-up, operating leverage and increasing footfalls as well. So watching out for these numbers, expecting to be a good quarter where EBITDA will be at a 5-quarter high this time around, continuously seeing an improvement.
It's a good quarter expected from Reliance Industries. Thanks so much for that, Sonat. But let's slip into a very short break. Up next, we get you cues from the commodities market, so stay tuned. Welcome back. You're watching Power Breakfast on CNBC TV18. Let me take you through what happened in the US market. Wall Street ended Thursday's trading session higher. The Dow added 230 points while the S&P 500 rose to a new closing record after gaining a little more than 0.5%. The tech-heavy index, the Nasdaq, added 155 points at close. CNBC's Pippa Stevens gets us a wrap of all the action on Wall Street.
U.S. markets were up across the major indexes in Thursday trading on the strength of corporate earnings and new economic data. The Dow was up 230 points. The S&P, which closed at a record high, gained 34 points. And the tech-heavy Nasdaq, which also hit a new record, added 154 points. Retail sales rebounded more than expected in June, but experts say the increase could be due to tariff-driven price hikes rather than an increase in volume. According to the Commerce Department Thursday, sales rose by 0.6% last month. Economists expected to see the measure only increase by 0.1%. And shares in Lucid soaring in Thursday trading after Uber announced a partnership with the electric vehicle maker, where at least 20,000 Lucid vehicles will be deployed as robo-taxis over the next 6 years. Under the agreement, Uber will invest $300 million in Lucid and will use driverless technology from startup Nuro. Nuro is backed by Google and the SoftBank Vision Fund. That's what's happening here in the U.S. Back to you in Mumbai.
Well, thanks so much for that, Deepa. But staying with the news from the United States, the Federal Reserve Chair Jerome Powell responded to criticism regarding the central bank's $2.5 billion renovation. In a letter to White House Budget Chief Russ Vought, Powell said, "We take seriously the responsibility to be good stewards of public resources as we fulfill the duties given to U.S. by Congress on behalf of the American people." On that note, let's listen in to Ellen Zettner of Morgan Stanley with Wealth Management explaining why Powell would not back down on his own.
I think that Powell, in his DNA, he is a civil servant. And so he is not going to leave the Fed unless there is a clear directive and clear legal way to remove him from the Fed. And, you know, if you believe in U.S. exceptionalism, if you think a stable dollar is important, and if you believe that fully functioning financial markets is ideal, then join me in supporting central bank independence, because that is what you lose if you take away independence from the central bank.
Well, let's also listen in to more views coming in on the Federal Reserve's independence.
The latest from the White House was that they're not likely to pursue that path. I think most market participants appreciate that there are decades of research and a lot of historical experience showing the importance of central bank independence for achieving good economic outcomes, especially low and stable inflation. There's always probably a bit of a political push to go easier on monetary policy. If you give that to every politician, you're going to wind up with an inflation problem. I think both theory and experience bear that out. Economists all over the world have embraced that logic, and that's why the shift towards central bank independence has been a global one, not just one in the U.S. So I think markets would worry about that a lot if it did seem under threat, but I'm not that worried about it after what we heard yesterday.
This is about whether this institutional arrangement we've had in this country is going to continue. There's no law that says the Fed is protected in this way. We don't even know how a court would rule. So this is about the administration trying to put more pressure on the Fed and really win not in a court of law, but in a court of public opinion. And buildings are salient. I mean, it's something I think it's breaking through. Everybody understands that. I get text messages saying, is the Fed really doing this? How did this happen? But, you know, so this is really about just a maximum pressure campaign. Maybe it gives them a pretext to try to remove him if that's something the president wants to do. Obviously, what the president's doing here is putting the next Fed chair in a very difficult position, right? They're going to have to prove to the market that they're not what everybody thinks they are. But you still have 11 other people who are going to vote on monetary policy.
Well, moving on then, my colleague Manisha Gupta is joining us with all the updates from the world of commodities. Manisha, good morning. What are you watching out for?
Thank you for that, Varma. Well, I'm looking at the crude oil prices, which have gained yet again. We saw 1.5% of a surge come in for the crude oil prices. Remember, we've been talking about tight supplies and improved demand outlook, but what also seems to be supporting is the drone attacks in Iraq, Kurdistan for a fourth straight day. And now this has led to output cut by 150,000 barrels per day. So there are supply concerns emerging yet again in the Middle East supporting prices. The ongoing Israel attacks in Syria is something that the street will watch out for as well. And in any case, because we are looking at stronger U.S. economic data, better than expected China GDP numbers, that in turn also has supported crude oil prices and many of these metals as well. Interestingly, silver also has seen support come back. It's trading back above $38 an ounce. Platinum is trading at near 14-year highs right now. We've seen copper prices gain in the overnight market. Rubber is trading at a 1-month high. So a lot of commodities actually doing quite well on the last day of the week.
Well, thanks so much for that comprehensive roundup, Manisha. But moving on, the U.S. House passed landmark cryptocurrency bills delivering on the Trump administration's embrace of the once controversial industry. U.S. lawmakers easily passed the Clarity Act, which establishes a clearer regulatory framework for cryptocurrencies and other digital assets. House legislators also passed the Genius Act, which codifies the use of stablecoins. Well, that's all we have on this edition of Power Breakfast. Don't go anywhere. Pasar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's Friday, finally Friday. We are coming to you from the CNBC-TV18 Motilal Oswal studios. Slightly brighter smiles, I noticed. Surabhi and Nigel. Morning.
Yeah.
Absolutely. It's a Friday. That's reason in itself, right, for bright smiles. Not that the market has really found its direction. It's just been a full week of consolidation. But as always, plenty of earnings, news, updates to handle.
Well, it's going to be earnings from here on. And we're getting a mixed picture out of there. And next week, I think we go full throttle out there. So enjoy the Friday, enjoy the long weekend, and come back for more. Prashant, let's get
throttle into what?
Into earnings.
He's already talking about next week. I mean, I don't know. Is optimism, pessimism, what?
That's what.
That's the right philosophy. You know, just look through the weekend. It doesn't exist. Then it feels better.
No. I'm in my pink polka dots. I differ from both of you guys.
All right. Well, U.S. markets had a positive session last night, and you basically have the S&P. Actually, markets are inching back towards all-time highs, led by, of course, what happened on the Russell 2000. The Russell was the best performing index. That's a small cap index, 1.25%. But look at the other changes. NASDAQ, 0.75%. The S&P, about 0.5% gain as well. I mean, this rally essentially on the back of this kind of sort of almost, and I hate to use the term, but well, it kind of fits this time, is the Goldilocks macro environment. What is that environment? There you go. It's basically strong US retail sales. Actually, there are about 4 data points. I'm only mentioning 2, the most important. But strong US retail sales, one. And the second one, low weekly jobless claims. Essentially tells you that the US consumer is looking pretty good. And the US economy is pretty good. So, when we kind of ask this question, why is trade uncertainty, trade-related headlines, tariff-related headlines and uncertainties at all-time high, but you also have the S&P, which is at all-time high, so it doesn't square. I think the answer lies here. The economy is so solid in the US. So far, it's been able to absorb these higher tariff rates, whatever has happened so far, that it's not showing up. And that's the reason why markets are not paying attention to all these sort of, headlines as well. The 10-year was unchanged. The yields were unchanged, about 4.46. Dollar index up a little bit, but nothing very much, 98.5. I've been saying that oil prices have been bouncing around 66, 68 to about 70. So they were up about 1.5% back to about $69.5. There was one report which came through as US markets were in the last 2 hours of trade that US is set to impose a 93.5% tariff on Chinese imports of graphite. But a final decision, a final ruling should be announced by the 5th of December. So we'll see if this does go through. But you've got a couple of graphite listed stocks here, HEG, graphite, etc. So we can talk about this in a bit. Reports of a potential Scott Bessent, US Treasury Secretary, and Japanese PM meeting that is on Friday. And by the way, President Trump essentially said that he thinks there are about 5 or 6 deals which are still in the works. Guess what? Which perhaps should be done before the 1st of August deadline. And India and South Korea are top of the list in that sense. He's basically specifically called out India, saying that we're very, very close. This was Wednesday evening. So we're still in wait-and-watch mode, but it could come. We'll see. The levels don't change very much. Yesterday, you had a down day. The Nifty was down 0.4%, as you can see up on your screen. But the low, I would still sort of say, which we've been saying is the low over the last 4-5 days, 25,001. That did not get breached, and that remains a support. I've just included one more resistance because the market's been down, which is the recent high of 25,255 and then 25,400, which is the 61.8% retracement. For the Bank Nifty, you've got the resistance levels again, just added since the market's been slipping a little bit, 56,937, recent high, and then the retracement, which is 57,628. Support here comes in at 56,594, which does not change. The lower levels, lower bounds have not broken yet, which we saw over the last 4-5 days. And I think only then you'd kind of sort of start to project slightly more downish kind of levels. GIFT Nifty, I think, is indicating a flattish start and should give you a quick sense. 10 points this Friday morning. Surabhi.
Well, absolutely, Prashant. I guess, markets have managed to look so well through all the tariff headlines noise and the political noise. By the way, the Jeffrey Epstein file, the reports that they finally might be released. So there's a huge amount of political noise as well in the US. But the market has completely looked past that because of solid earnings in this week, whether it's the big banks like JP Morgan, Goldman Sachs, etc., or, a lot of other names as well. We've got pretty solid earnings that have come through. Now, Asia is tracking a lot of that Wall Street optimism this morning. Actually, most markets are in positive territory. Taiwan, Hong Kong, mainland China. The Australian market hit a fresh high today. Japan is flashing a little bit of red. It started positive, but there's some profit booking that's come in. Though actually the inflation data in Japan is pretty good. Because the headline inflation has come down, the core inflation has come down. Headline has come down from 3.5% in May to 3.3%. Core has come down from 3.7% in May to 3.3%. So inflation is generally softer, but we're seeing some profit booking out there. So the short point is global markets are holding up, but we've had an India-specific issue. It's been a complete consolidation this week so far. If you look at the last five trading sessions, the Nifty has been grappling with a 0.5% to about a 1% decline. If you look at the last 1 month itself, it's not just a 4 or 5 day odd consolidation patch. Then at the headline index level, we just haven't moved about 1% higher. I want to point out the FPI flows for the first time so far this year, or actually not for the first time since we had the rally, since the April lows, flows have turned negative. So far in July, net inflows are down 2,660 odd crores. And that shows up on the daily data that we talk about. Even yesterday, for instance, we had a decent amount of FPI selling, almost 3,700 crores of FPI selling in the cash market. It was offset to an extent by 2,800 crores of DII buying. So the lack of foreign flows is definitely a bit of a hurdle. that we've been facing. As usual, it's all about earnings, and we'll talk about this as we go forward as well. Today, Axis Bank is going to be in very, very sharp focus. Now, this technical impact that the bank is speaking about, will the market take it as a positive that the bank is showing extreme prudence? Not that the regulation required it, but it itself is looking at a tighter way of recognizing NPAs. We'll have to see how that debate plays out. But that surge in slippages, 8,200 crores of slippages, it came out of the blue. The bank is also saying that this is a 1 quarter off. They've recognized everything with this new phenomena in this quarter, the entire book. So let's see if the market is willing to give Axis Bank the benefit of doubt. But otherwise, the numbers are really, really disappointing. Even growth, even margins, everything's come under pressure. Wipro has been a mixed quarter. Constant currency growth is down 2%. But again, the good thing with Wipro is that the deal pipeline is looking very, very strong. Their deal win track record is very strong for the quarter. So again, it's a nice debate whether the bulls will have it or the bears will have it on Wipro. LTI Mindtree at least has some growth. I mean, one company that's reported at least 0.8% constant currency growth. So LTI Mindtree is actually not that bad. And Indian Hotels is doing so well. So even in this, earnings cloud, you have bright sparks like Indian Hotels. I mean, look at this, profit up 20%, revenues up 31%, EBITDA's higher in a quarter where we had a lot of geopolitical tensions, Operation Sindoor, flight disruptions, but yet they've managed a pretty decent show. So, by the way, today's result calendar, let's not forget, today's Reliance Industries, JSW Steel, there's L&T Finance, Bandhan Bank, Hindustan Zinc, just a few names, the long, long list. So, yeah, Nigel, I completely concur with you. It's going to be earnings, and more earnings.
Well, that's right. Earnings going to pick up the next 1 month or so. It's going to be action-packed. And, the markets, it seems, we're missing that positive trigger. Because in the month of July itself, the Indian markets actually have underperformed. If you compare the Nifty with the Shanghai market, that's just for the month of July itself. We're relative underperformers. Even if you compare to the US markets, well, we're relatively underperforming. Nothing really to worry. The problem is we're lacking that positive trigger. And since everyone's bracing for these weakish, subdued first quarter earnings and then looking at quarter two to see a pickup, I guess the market's lacking that positive trigger, which could very well start playing out from August itself. But July so far has been a bit of a dampener. But I say I'm not too worried. And that's because if there was fear in the system, you would have seen the VIX that would have spiked up. Now, though we have seen a bit of a pullback, the VIX still, on a day-to-day basis, it doesn't move that much. So that's the volatility index, that's the fear index, and that's not very concerning as we speak. What are the FIs doing yesterday's trading session? What they've been doing in the past. They went ahead, they added 8,000 short contracts. So the swing factor out there is close to around 10,000 contracts because they unwound some longs, they added shorts. The short positioning is at around 83%. And from the start of the series, when we started off the series, I recall saying this market is missing out on those shorts in the system. Now those FIs, from being net short by only around 35,000 contracts, it's 1,35,000 contracts. So in the series so far, the FI short positions have gone up by close to under lakh contracts. And the clients, well, they were marginally net long. Now, in fact, they've added their long positions. It's gone to around 86,000 contracts on the long side. This combination is something that the street normally likes. FIs net short, clients net long. Now, since we are starting off the new weekly expiry, well, we have two strikes that were fairly active. So the 25,200 call, fair bit of open interest built up out there. There is writing being seen at this particular level. However, in case the markets get that positive trigger, there is some kind of buying that we're seeing at around the 25,500 call. It could be maybe a trade deal with the United States, maybe a couple of earnings that surprise positively as well. So there appears there is buying out here, there is writing on this particular strike. While on the put side, there is writing that we're seeing at around the 25,100 put out mark. And the 25,000 level becomes extremely important. It's the recent low. It's where the options data suggesting there is support. And also, the 50 DMA comes in that vicinity. So the crucial support is in this vicinity. 20 DMA, that's the line in the sand. You want to somehow get past that mark. So 25,325 will be the near-term resistance level. In yesterday's trading session, we had the Nifty Bank actually that broke the 20 DMA. Now it's pat in the middle of the 50 as well as the 20 DMA. You'll want it somehow to go back above the 20 DMA. That's going to be important. And Axis Bank is going to be the stock in focus. Yes, the numbers are disappointing, even X of those technical write-offs. However, in the last 1 month or so, it seems the street was sniffing this because it's done a stark underperformance. If you compare what the Nifty Bank has done, you compare what Axis Bank has done, and sometimes on days like these, you mark the first hour low and you see whether or not there is a recovery. So I'll keep an eye out on Axis Bank. Though the numbers are disappointing, the street is very well prepared for that. And one stock that you spoke about is Indian Hotels. Management sounded very, very confident in their call. The stock actually has seen a fair bit of a correction from the recent peak. Valuation basis, well, there's a lot of support out there. And if you saw, there is delivery-based buying as well that we saw in yesterday's trading session and for the last few sessions. So Taj GVK is the one that I'm going to be keeping on the radar because of delivery-based buying. Stock has seen a correction, and valuation-wise, there is support on this one.
All right, Nigel, thanks very much for that. Prashant Paroda is now with us. He's Portfolio Manager, Emerging Markets at Allspring Global Investments. Prashant, good morning. Great to have you with us here. Thank you very much for joining us. You know, that lack of trigger that we've been sort of referring to, could an India-US trade deal be that trigger? He's President Trump. Of course, I mean, you know, you can always say that when all this started, he kept talking about India, and the deal never came, but he's now once again saying that, well, maybe there are a few countries, India is very close.
Yes, I think we are getting very close, and he hinted to whether the deal would be similar to the Indonesia terms. So hopefully we can get across the line this time, and you know, we can put this behind us. From a clarity perspective, from a company's perspective, it makes sense to kind of move along now.
And will that spur markets, Prashant?
I think some of it depends on what the number actually comes out at, right? If it's closer to what the Indonesia terms are, I think that's pretty much priced in with some of the markets. Again, a lot has changed in Trump 1.0 versus Trump 2.0 right now, right? If you look back in Trump 1.0, there was a lot of transshipment that went along, and a lot of that has been curbed in this Trump 2.0 trade deals. So with regards to that, I think India is pretty positively placed. And companies need to understand that, you know, transshipment is not your competitive edge. Your competitive edge is your unit cost. And it will all come down to that once this tariff picture gets out of the way.
Prashant, hi, morning. You know, on the US and just the overall sentiment, the fact is that evidence on ground, whether it's corporate earnings, whether it's retail sales, even inflation for that matter, everything has been solid and in the market's favor, which explains what the market's been doing, right? Do you expect this to continue in the next few months and quarters as well?
So I think the CPI data just came out, right, for June, and there was an increase in the year-on-year CPI. So a lot of the tariffs are not really affecting price right now because a lot of companies have built 3 or 4 months of inventory. And I think as you go down third quarter and fourth quarter, it will become clearer, especially from a Fed's perspective, whether you know, inflation is under check or rising a bit. But we do expect some of these price hikes to impact those CPI numbers over the next 3 to 4 months.
Hi, Prashant. Good morning. Good to see you. Last time we chatted, India and I think Korea were the two indices you liked from two markets you liked from the emerging market pack. Do you stick to that? And also within the Indian markets, what are you doing? What are the sectors, the themes that you still like out here?
Yeah, so I think with India, we have to be very selective. I mentioned the banks right now. You know, some banks are kind of reporting subdued numbers. Other banks might do a little bit better. So I think within banks, we have to be very selective with, you know, which companies are actually continuing to grow in market share and have provisions under check. Within cement, I like cement as well. I think the price war that was happening over the last, 18 months, it seems to have abated and there's more price discipline. So some of those sectors are doing well as well. And telecom, of course, it's a 2.5 player market. So within that, we think the larger players will continue to do well.
Financials, cement, and telecom.
Yes.
Okay, got that. And as you're getting money, you're allocating to these sectors more, or?
Yes,
that question?
yes, selectively we are, and I think Prashant, I think it will also come down to we'll be closely watching the commentary that these companies give as well. I mean, you might have a bad quarter last quarter, but the commentary going forward will be very essential for us to make bets from a 12 to 18-month perspective.
Prashant, I don't know, since you like financials, do you like Axis Bank? If you can, and if you can't talk about an individual name, that in general, I mean, the market will deal with this debate today that it's, they say it's extreme prudence, and now they're the most prudent bank on the street with this change in the way that they recognize bad loans. But it's led to a huge drop in asset quality. So just general thoughts?
Yeah, I mean, obviously, the drop is probably a surprise for many people on the street. But I think longer term, if this is a one-off issue, I think, people will overlook it besides maybe some negative sentiment going into this quarter. But I think the question is on a Q-on-Q basis going forward, if we see this as a one-off issue, then I think people will overlook it.
So in financials, I mean, I don't know. So do you own Axis Bank? What about other banks, mid-size? What do you like in financials?
We continue to have a position in large private sector banks. And I think they have, last few years, they haven't, except barring a few, they haven't really worked as well. So this is sort of some catch-up here for a lot of them, where consensus estimates are relatively benign, and we think they're going to meet or sort of beat those estimates. So we continue to rely on large private sector banks in this space.
And the RBI is trying to rev up growth, Prashant. This is a question which is, of course, playing out in both in India and the US. In the US, of course, in a more prominent way, President Trump attacking renewables, right? There is, I think, some news report which suggests that they're considering some dumping, anti-dumping for specific countries, and we'll put that in context. But is that a space you like? I mean, there are a few listed options in India, or are valuations a problem? Is this all this news flow also a headwind?
Well, renewables, I guess, to the extent you're catering to the Indian market, I think there's a strong demand for that. To the extent that you're exporting to the US markets, I think it will kind of depend on kind of policy constraints on the US side. So I think if your market is sort of export focused, you might face a little bit of headwinds from the US side.
Prashant, Vari and Premier is like an optionality. There's enough demand locally so far, but that perhaps is an opportunity in the future. Thank you very much for joining us. It's always a pleasure. And we'll speak again. Thanks once again. We'll take a quick commercial break, but before that, let's just quickly run you through the interactions which are lined up here in the program. At 8:35, you'll hear from the Wipro management. We talk about their first quarter numbers. 9 o'clock, you'll have Ajit Kumar, JM Financial Institutional Securities, earnings, bank earnings and focus, Axis in particular. 9:20, Priti Gupta of Kotak Equities talks to us about sectors, themes he likes. Real estate is a big focus at 9:30, so we'll have someone from Cushman and Wakefield and Equitas Capital to talk about trends in the real estate space. And of course, REITs perhaps is also something we put the spotlight on. Tata Communications on their first quarter numbers, that's coming up at 9:40. 9:50, we'll have Elara Securities joining us to talk about expectations from the FMCG space. That's quarter se quarter thak today. And Lata gets chatting with the Indian Hotels Management, Puneet Chatwal, for their fourth quarter numbers.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you. We get to that in just a bit. For the time being, I give you a sneak peek into the list, our special top 10 segment. Wipro, Indian Hotels, LTI Mindtree, Shopper Stop, Nuvoco Vistas, all of them will be reacting to positive news flow. Add to the list, Sterling and Wilson Renewables. On the flip side, Axis Bank, Tata Communications, CEAT, and Veranda Learning will be reacting to negative news flow. Take that break, come back. We'll get into further detail on all of these names.
Welcome back. So cues across Asia are actually pretty okay. Some of the regional markets like Hong Kong, etc., are running away 1% higher, but not, typically that's not really necessarily meant a 1:1 correlation for us here in India. We have been dragging our feet last couple of days. Anyhow, let's bring up the implied open and see what it is indicating. So far, the market's down about 0.5% for the week. 16 points higher. That is how the start could at least be. Let's get to stocks because there's a lot of very interesting stock-specific action that we need to go over. And we have our colleague standing by with a list of top stocks to watch. Rima, let's start with Wipro. Now, is it a glass half full or half empty?
I'd go with a glass half full, and even the ADR is pointing to a positive start, a gain of close to about 3.4%. Now, Q1 was muted, but it was muted on expected lines. Where does the positivity lie? The Q2 guidance says -1 to +1%, which means at the midpoint, we have no growth, 0%. But this is a 200 basis points improvement to the Q1 performance of -2%. So basically, Q2 is signaling an improvement, and the management said H2 is going to be stronger than H1. So that's reason number one. And two, this is underpinned by very strong deal wins that the companies enjoy. The total deal wins have come in close to $5 billion, up 24% quarter on quarter and up 50% on a year-on-year basis. So which is why I'm going to go with green for Wipro, because the Q2 guidance suggests an improvement, H2 likely to be better than H1, and deal wins are very strong this time.
Okay, all right, Rima, thanks for that. In fact, we'll get the management at around 8:35 a.m. later today, and we'll hear out what they have to say. So Wipro is a hint of positivity out there, but Axis Bank, those numbers were disappointing. As we mentioned earlier, the street was bracing for them. Gaurav joins us to explain that to us. Gaurav, numbers disappointing, but there's a technical factor at play. Please explain it to us.
Well, yes, as you said, disappointment seen from Axis Bank in first quarter. First was that the net interest margins have declined almost by 17 basis points. So the street was factoring in a fall of around 10 to 12 basis points. Bank has said that the 13 basis point fall was from repricing and 4 basis point because of the interest reversal. But what was something which was not anticipated by the street was the credit cost. Now it has gone up almost to 1.4%. Slippages have also gone up to 3.1%, and this is because of the technical impact that the bank has suggested. They have said that the technical impact has costed the bank at around 620 crore rupees on PAT level and 800 crore rupees on the provisional level. Now, that is the reason why we are seeing these elevated slippage cost and credit cost. Banks said that these will come down because there will be some recoveries from the quarters going ahead, and that is the reason why they are optimistic. But what they have done is that they have actually changed their provisioning policies, and that is the reason this technical impact was seen. Now, what is actually impacting and what is actually factoring in by the street is that this is actually at the cost of your book, because ROAs have gone down almost by 10 to 12 basis point. ROEs have gone down almost by 1.4% because of this technical impact, and that is something which will weigh on the stock. As a result, when we talk about brokerages, they have also cut down their stock target price. In the likes of Investec, they have cut down their target price. So definitely a negative impact is what we may see on the stock price, and a bad set of numbers for Q1 from Axis Bank.
All right, this is the big one, right, as we've been discussing, and we'll see how the trade starts and how this goes through the course of the day. Gaurav, thanks very much for that. LTI, Mindtree and Tata Communications, two other names. Rima, back to you.
Well, LTI Mindtree, a decent quarter in line with expectations. The company's revenue has grown by 0.8% on a quarter-on-quarter basis. EBIT margins continue to expand as the company is implementing a Fit for Future program whereby they're looking to improve their margins. So margins at 14.3%. And the company spoke about being reasonably confident about growth momentum continuing into Q2 and also about margin improvement. Well, they too have not taken a decision on wage hikes yet. Now, for Tata Communication, on the other hand, it was sort of a subdued sort of a quarter. No fireworks. Revenues are down 0.5% on a quarter-on-quarter basis. On a year-on-year basis, revenue growth is just up 5.8%. EBITDA margins have expanded to 19.1% sequentially, but it's still lower than the FY25 average level of 19.8%. And profit, you will see a very sharp 80% decline quarter on quarter, but that's because last quarter had a big exceptional gain. Net debt for the company has also gone up.
Okay. In fact, all right, Rima, thanks a lot for that. In fact, we'll have the management of Tata Communications joining in at 9:40 a.m. to detail their Q1 earnings. Well, let's get to more interesting stuff then. It's a Friday morning, and in fact, Mangalam joins us to tell us about Indian hotels as well as Shopper Stop. Hey, Mangalam, morning.
Morning. So I'll be the harbinger of good news this result season, hopefully so far. So Indian hotels, good numbers coming in, and this despite the resilience or rather the headwinds that we saw. So resilient performance despite the headwinds. The hotel segment grew 14%. The new businesses of the company grew 27%. On a consolidated basis, the numbers look a lot better. That's largely because of, the amalgamation of the air catering business, Taj Sats, that is. So reported numbers, 31% revenue growth, 28% EBITDA growth. Net profit grew by 36%. And this despite the company saying that 2 to 2.5% of the growth was impacted by Operation Sindoor and flight disruptions, etc. And 11 crore increase was on account of preponement of their increments for this year. So all of that, if you add back, it looks like a lot better set. The outlook for the second quarter looks good, and as does the entire year, where they maintain their double-digit growth outlook. The hospitality sector doing extremely well. Similar is the case for Shopper Stop as well. On a reported basis, yes, the numbers grew by about 8.5% on the top line, but good operational performance, 14.8% margins. The company reported a net loss, but that's largely reported numbers because the depreciation element, which is a non-cash expense, is a lot higher for Shopper Stop. What's good for them is that they found their new engines of growth. One of them is beauty distribution, which grew over 100%. And the second one is their value fashion business, which is Intune, which also grew 100% year on year.
Okay, all right. So good news coming in for Indian hotels and Shopper Stop shareholders, I guess. And of course, you'll hear more from Mr. Chatwal. 10:15 a.m. He'll talk about the business and how the rest of the year looks like. Let's move on then. Thanks, Mangalam, for that. Let's move on and bring in Sud, who's looking at a bunch of other earnings that came in post-market hours yesterday. So, Darshan, morning.
Morning, Surabhi. So first, I'll start with CEAT. Results were largely below estimates, mainly because of increasing input costs that impacted both EBITDA margin and gross margin. EBITDA margin has slipped more than 100 basis points, and gross margin was down by 250 basis points. Revenue, though, came in largely in line with estimates, aided by OEM and replacement cost. Company has also announced expansion to the Chennai unit with an investment of around 450 crores. So I'm going with red for CEAT. Next stock is Nuvoco Vistas. Stocks earnings were largely higher than estimates. Cement volume has increased by 6%. EBITDA per ton has seen a sharp rise. It was up 43%. Even debt has fallen both sequentially as well as year on year. So I'm going with green for Nuvoco Vistas. Same for Sterling and Wilson. Here also company has reported a healthy set of earnings. Profit was aided by favorable operating leverage and lower cost, and that's the reason revenue was up 93%. Margin has increased to 4.9% against 2.7%. And one of the important orders that company is waiting to sign it, that is the Nigeria order, and company has commented that procedural steps are still underway and awaiting the final contract signing. So I'm going with green for Sterling and Wilson.
Okay, all right. Thanks a lot for that, Sid. Let's hop across to Vivek. He's here to tell us about Veranda Learning. Vivek, bang on. You said they're going to raise some money, and that's what they've said officially. Tell us more.
Well, that's right. So Veranda Learning Solutions is in focus, a large fundraise, especially when you're comparing the quantum of the fundraise to the actual market cap of the company. Along the lines of what we reported day before yesterday, the company has launched a QIP for the fundraise. The total issue size is at 380 crore, where the base size is 350 crore, with an upsize option of an additional 30 crore. The issue price is at a steep discount to yesterday's close. We understand the issue price is at 225.2 rupees per equity share, indicating an over 15% discount to yesterday's close. What is the usage of the proceeds? Like we had highlighted, the company intends to go ahead and prepay some of the long-term debt that they had. This is a higher finance cost long-term debt. So after the QIP, they will be able to go ahead and get significant savings as far as interest cost is concerned. This is of the subsidiary Vedanta Excel Learning Solutions Private Limited, and along with that, they also intend to use a certain proportion of the QIP proceeds for general corporate purposes.
All right. No, absolutely. It's a small name, but Vivek, congratulations. And there's a large fundraise for Veranda. Here's a quick recap of our top stocks with positive and negative news flow. So on the positive side, Wipro, Indian Hotels, LTI, Mindtree, Shopper Stop, Nuvoco Vistas, and Sterling and Wilson Renewable. Stocks with negative news flow, Axis Bank, Tata Communications, CEAT, and Veranda. All right, so those are stocks, commodities. What's on the table? Manisha is here with that. Manisha, morning.
Morning, Prashant. Thank you for that. I'll start with the crude oil prices because it's a fourth straight day of drone attacks in Iraq's Kurdistan, and we do understand that this has now led to an output cut by 150,000 barrels per day. So immediate supply concerns, in any case, we are looking at tighter supplies, improved demand outlook, better economic data from US and better than expected China GDP numbers. So all of these factors in turn have been supportive for the crude oil prices. The ongoing Israel strikes in Syria also have led to some support coming in for prices. And it's not just crude. If you look at the precious metal prices, there is some safe haven buying returning here. Gold is trading in the positive. Silver is back above $38 an ounce. Platinum has gained yet again to a new 14-year high at around $1,460 an ounce. We're also looking at some support continuing in case of many of these soft commodities. So whether it's sugar, rubber, cocoa, coffee, well, almost everything in the Asian markets right now seems to be trading in the positive.
All right, Manisha, thank you very much for that. So that's the commodities picture, rubber on Manisha's mind. We'll take a quick commercial break here. We're going to come back with the management of Wipro and we discuss first quarter numbers with them. Stay tuned.
Welcome back. So like we've been telling you, most markets across Asia are actually doing pretty well. But the indication that we have from the implied open is that we'll have a slightly more muted start. Look at that. Many of those markets are doing very well, including Australia as well, Singapore. All are higher. But for us, once again, just about 9 odd points. So a little more quieter. Let's keep it with corporate earnings then, because the market is going to be very, very stock specific today. And let's look at Wipro. The company reported what was a slightly muted set of numbers for the first quarter. The top line did contract. Constant currency revenue was down 2%. The margin saw a little bit of a nick as well. But that was in line with expectations. However, the company is sounding very optimistic on the second half of the year and on their deal pipeline. In fact, Rima caught up with the Wipro CEO Srini Pallia and CFO Aparna Iyer, as well as the CHRO of the company, Saurav Govil, and began by asking them about the second quarter guidance.
If you look at our quarter one performance, specifically around bookings, $5 billion, two large deal wins that we had, $2.75 billion, out of which two are mega deals and one is likely to be a mega deal. So there is this very strong deal momentum that we have had in quarter one, which we trying to carry to quarter two. Of course, some of these deals will take its own time before we start ramping up.
But my question is, will this improvement continue For instance, can Q3 be better than Q2, Q4 be better than Q3 X of seasonality? Because your Phoenix deal also ramps up in the second half of the year. So how is H2 going to be, to your mind? And can FY26 then be better than FY25?
So as far as we are concerned, we don't give a guidance for the full year. But having said that, specific to your question, second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
Okay. And FY26 vis-a-vis FY25, Srini?
I think net overall, I think it should be better than FY25.
Okay, got that. Aparna, are you confident of holding on to 17% margins at least at the baseline, given that, there is still, pressure at the top line?
We're very, very excited about the bookings that we've had in the first quarter of the financial year. Along with Phoenix, a lot of these deals will begin to ramp up. But for those deals to really translate into revenues, it will require upfront investments. There will be pressure on costs. You know that large deals typically come at lower margins. And there will be some pressures that we will have to offset. You've tracked our operating margin performance over the last 8 quarters. We've consistently improved. We will go back to that muscle of operational excellence that we will continue to drive. And those are the puts and takes on margins. We don't guide for margins, Rima, but we are happy with our performance in Q1, an 80 basis points improvement. And from there, we will take it.
But you have in the past spoken about keeping margins within a very narrow band. And that narrow band for you has been 17.5%. So are you confident with that holding for the next 3 quarters, given the puts and takes?
I'm not giving a guidance here. I've spoken about that there are going to be certain pressures in ramping up some of these large deals, and growth will be our number one priority. And we will continue to work on the levers that we have to offset some of those pressures.
Okay, so we can't rule out a margin decline from here on.
We're happy with what we've performed for Q1. We don't guide. And Rima have shared the puts and takes. And we will have to really execute on Q2 well. And from there, we will take it, like I said.
Aparna, Europe has deteriorated for you even further. Other than macros, have you been losing market share? I mean, what's happening, when it comes to Europe?
I think in Europe, we've had, for the last 4 quarters, we've not performed as well as we ought to have. It has been a combination of the macroeconomic environment, lower discretionary spends, but also certain client-specific issues that have played out. We believe we are very, very close to bottoming out. We have a large deal win that we've secured, and also some very good deals that we've also secured in Q1. Our pipeline is good, strong. So we are very, very hopeful of Europe bottoming out and coming back into performance starting second half.
That's helpful. Saurabh, when are you giving a wage hike?
Surima, we had given a wage hike last year in September. We haven't decided what's the plan now. We'll review it closer to the date, based on the macro environment, demand situation, what's happening, and we'll take a call. So nothing, as soon as we decide, we'll let everybody know where we stand.
Saurabh, in the last 4 quarters, last 12 months that is, your headcount is down by 1,200. I mean, what does that signal, and what are you planning with respect to hiring? Is it because AI is doing a lot of the coding that you don't need to hire that many?
So, the direct correlation, and Srini alluded to it earlier in the press conference also, for AI and hiring, I think it's still time for us. Evolving is the right word. But for us, the environment has been there. The demand situation has been tough for us. We haven't, seen this quarter, we degrew the previous quarter. So if you look at that environment, I think we have been really flattish on our headcount. And the hiring continues. We have gone to campuses last year. We continue to went this quarter as well. We continue to hire in wherever there is demand. We are, as we have built up these large deals, we are gearing up to deploy people. Our actually year-on-year Attrition has come down because we have put people ready so that we can quickly deploy these people as we move into the execution of these deals. So net, depending on the demand environment, depending on the macro situation, our hiring will be there. Only thing I can say is that the supply side is well geared up to manage any demand environment. So that should not be a challenge from us. Be it look at hiring, attrition, utilization. If I put all these three things together, I don't see a challenge.
But do you think there is a possibility that you don't give wage hikes as you did in September this time around, given the macros?
As a HR person, I would love to give everybody a wage hike, but as I said, the business demands, the macro environment, the demand situation, we all will want to do the right thing. We'll let you know, how it pans out,
All right, well, interesting conversation there. Let's go get a fundamental view. Sid Khemka, Head of Research, Wealth Management, Motilal Oswal joins us on the show. Hi, Sid. Hope you're feeling rocking this morning. It's a Friday. Markets have been a little bit range-bound, but stocks will do a thing of their own, as would be the case with Wipro. How are you feeling about Wipro's numbers? And, from the tech pack itself, what's the top pick?
Good morning, Nigel. Good day to be on Friday morning. So I think if you look at Wipro, kind of mixed bags on the deals front, they did deliver. Going forward, I think the conversion will be a key monitorable. So the start to FY26 has been weak. The numbers are there for us to see. The IT services revenue has fallen 2% Q on Q on CC terms. However, what is positive that the deal wins have surged 26%, including 2 mega deals. Near term, I think Q2 will remain sluggish. The guidance is a flat -1 to +1 in terms of revenue growth. In terms of key positives, as I said, strong deal wins. Europe's showing some sign of stability. Margins likely to stay in a range as services EBIT margins stood at 17.3%, down 20 basis points for the quarter. But the expansion is limited going forward due to upfronting of costs of large deal ramps, plus what we heard from the management. Some of these large deals comes at a lower margins. So despite a minor upward revision and some of these positives, we kind of remain neutral on the stock right now. We'll see once Q2 numbers are there, when we'll get to closer to that Q3 quarter where things should start looking up. But as of now, remain neutral on Wipro.
Okay, neutral on Wipro. Now let's get to the big story of the morning, and that is Axis Bank. Just to revisit this, Axis Bank disappointed in terms of asset quality in the first quarter. What has essentially happened is the manner in which the bank is recognizing its NPAs, it has decided to change that to make things more prudent. Axis, in fact, is saying that now it is the most prudent bank on the street. This was not a diktat from the RBI. It's just the way they're recognizing bad loans and how quickly they're recognizing. And that has led to what they're calling a technical impact. This has led to a surge in slippages. Slippages have crossed over 8,000 crores. But the bank also says that it is quite confident about growing faster than the industry. And it explains how it feels that this technical impact has played out in Q1 and should not impact the upcoming quarters. Take a look at what the management had to say.
NPA classification happens on days past due criteria, and then there is qualitative criteria which each is agnostic of days past due. We have not changed any day past due parameters because they are driven by regulation. The qualitative parameters, as we have previously indicated, we benchmark to most prudent in market on an annual basis. That benchmarking exercise happens for us in the period of Feb and March, and the implementation of that happens from the next fiscal. The purpose of the benchmarking is to make sure that our balance sheet is resilient and can withstand any credit cycle that comes our way, therefore giving you a robust, credible outcome when growth comes back. So roughly, if you look at what we do is Q1 and Q3 are cyclical, and the way I would request you to think about it is in Q1 and Q3, about 25% or thereabouts of slippages are from the agri portfolio. So you could apply the maths to 5,400 crores, and roughly about 25% or thereabouts would be agri. The percentage would be broadly similar for last year's rupee crore number. The rest of the 75% is coming entirely from the unsecured business. We are very clear in making a call out saying we do not see stress in the secured part of our retail book as on date.
When Rajiv retires in August, as per expectations of RBI, we need to have MD CEO and 3 EDs. Our NRC is actively looking at who and when we appoint a third person as executive director of the bank. When we're ready to do that, we'll be very happy to do it. But you should expect announcement of ED appointment as Rajiv retires. So that's the answer to one of your questions. Second question, I thought I answered in detail in the response to the first question, which was, yes, credit growth is where it is, but our confidence about what we can do the rest of the year and in the medium term, given where our platform is high. We are expecting to grow faster than the industry. I mean, obviously, that's an expectation, but we are quite driven towards ensuring that we can deliver that output.
Okay, so two separate events. One is this whole technical issue with the NPAs, and then Mr. Rajiv Anand, very, very well-known Indian banker, finally retiring. And the critical question is, where is he going next? Is he going to IndusInd Bank? But that for another time. Siddharth, let's focus on the whole NPA issue with Axis Bank. Are you convinced with what the management has said, that this was technical, they are being extra prudent, and it will not slip over into next quarters?
If you look at, I think very difficult to say that the bank has been consistently reporting weak numbers, and irrespective of what the management is saying, I think if you look at the other core business data as well, that is also showing signs of weakness. Loan book growth was muted at about 8% growth. Deposit base shrank about 1% on a sequential basis, raising the CD ratio to 91%. So I think while the management might sound prudent, the overall picture doesn't look that good. Margin continues to remain under pressure, elevated credit costs, higher slippages, definitely because of the internal loan reclassification. We have not heard that from any other bank, given that RBI has been scrutinizing the entire street, right from the largest to the smallest banks. So it's a bit difficult to digest that such stricter norms only apply to Axis and not to others. So we do see near-term headwinds, and I think it's better to stay away from such numbers until we see some stability. Even the other issue of the management, I think a big name there retiring, and they would need to hire some good credible name to bring the streets confidence. So overall, our rating remains neutral on Axis Bank.
So neutral on Axis Bank. So that's the Motilal view. And the street is really divided on this one. Nuvama has, for instance, downgraded the stock. JM Financial is retaining their buy. So it's a split house on Axis Bank. And we'll see. The market will give its verdict soon enough, guys. So promises to be definitely perhaps the stock of the morning, purely from a news and earnings flow.
All right, let's talk about a couple of good earnings then. Sid, Nuvoco's numbers came out and they looked quite good, actually. I'll tell you what, the problem is they've gone ahead and they've done that Vadraj acquisition. So that's why the street will get a little bit skeptical on. They need to come up with money. Otherwise, the numbers look good. Realizations are up. Profitability is at around 1,000 rupees per ton. And they've been reducing debt as promised. It took a little bit of time, but now they've got their act together. The stock, though, has already run up 10% in the last 30 days or so. Your view on the stock?
Nigel, unfortunately, we don't have coverage on Nuvoco, but overall, I think cement companies have been reporting good numbers, and we are expecting a strong quarter from cement in this quarter.
Okay, all right. Siddharth, stay with us. More questions coming your way. We have to take a quick commercial break, though. There's 11 minutes to go for the pre-open session. And we are also going to be back with Srikanth and Mitesh with their technical trading ideas. Stay tuned. Okay, welcome back. 9 minutes to go for the pre-open session to kick off. 18 points higher as far as the GIFT Nifty is concerned. Shrikant, Mitesh, good morning. Great to have both of you here. Mitesh, how are things looking? A flat open once again, but yesterday the market slid a little bit.
Morning, Prashant. So I think the structure in the short term isn't very positive. Getting past 25,300, 320, which is where the falling gap was, I think, and still is, I think is an important level. Till that happens, I think you will see the market facing supply at higher levels. And on the downside, key supports are now coming around 24,900, 24,880 zone. In case you break below that, then we'll look for a decline. But otherwise, it's a market which is tapped between two levels of 24,900 broadly and 25,300.
Okay, all right, got that. Shrikant, what about you? How are you feeling about the markets? The Nifty has been a relative underperformer in comparison to the global markets. We're still in a bit of a band. One would say that maybe it's a blessing that you have so many FI shots in the system, more than 1.3 lakh contracts. Your take?
Good morning, Nigel. Good morning, everyone. See, for Nifty, the important level was around 25,500 levels. But now, based on the statistics, the resistance have shifted from 25,500, 550 to 25,300, 250 levels. So till the market is not crossing 25,255, to be very precise, we are going to see range-bound sort of activity in the market. And in case if there is any correction close to 24,900, then there we should look for taking some contra bets of going long. But at these levels, it is in between. And today, below 25,100, we are expecting further more weakness. So broadly, I am of the view that we need to be more stock specific. And in case if there is any correction, then there we should look for taking some contra bets of going long.
Got it. All right. Contra bets, or contra call is what Shrikant has. Mitesh, coming across to you, individual stocks, what's the view?
Morning, Nigel. I have a mix of buy and sell, slightly more biased towards the long side. The first stock is Jindal Steel and Power, which I would recommend buying with a stop below 939 for targets of 975. Sona System is another one, which is a buy with a stop below 475 for targets of 510. After a long time, some signs of profit booking on Indigo. So that's a sell with a stop at 58.40 for targets of around 57.20. And Godrej Consumer is a conditional buy. It's just trading below that supply pivot of 1285. So, if it clears that, buy with a stop at 1269. Look for a first target of 1320.
Okay, and Shrikant, what about you?
Yeah, I would like to go with PSU banks. There we are seeing a good amount of strength. Especially State Bank of India has crossed its immediate resistance level and it is sustaining well above that. But if we consider other mid-sized banks, then there also we are seeing equal amount of strength. In that specifically, we like Punjab National Bank based on its technical formation. It is around 113, 114 levels. But we can again see the levels of 120, 122 in the near term. That's my view. And we can keep a stop loss at 110 for the same. The other stock which we like is Nuvama, which is around 7,820. There also I am expecting stock to surpass its previous high of 8,500 based on its technical formation. It is again rebounding after hitting the lows of 7,500. So at this level, it's a buy with a stop loss close to 7,700.
Okay. We'll take a quick commercial break here, but Mitesh and Shrikant, we're going to reconnect at 9:10 for some more trading ideas. We'll take a quick commercial break here. We'll come back with a pre-open session. We'll have Ajit Kumar of JM Financial Institutional Securities to discuss bank earnings and, of course, Axis in some detail.
Welcome back. Well, in a few minutes, we'll get the pre-open rates. But for the time being, let's continue our fundamental analysis. Sid Khemka is in conversation with us. Sid, what about Indian hotels? You know, the numbers are expected to be a little bit softish. But, you know, Mr. Chatwal is sounding very, very optimistic about the way ahead. And the hotel industry itself is poised for better times. What is your view on the stock and what's the pick of the pack?
Definitely, Nigel. I think while this expectation was not that strong for the hotel sector for this quarter, I think Indian hotels and earlier ITC hotels both came out with strong numbers. The commentary also looks pretty strong. So overall, I think even for the quarter, the numbers were pretty strong for Indian hotels. Revenue grew 32%. We have seen healthy RevPAR growth of 11%, and the company is maintaining a double-digit revenue growth guidance for FY26, favorable demand-supply dynamics. So I think one biggest concern was that with the strong upcycle in the hospitality space, is supply catching up? And what we understand from the management is that supply is still lagging demand, and hence the upcycle in the hotel industry could continue. We continue to like Indian hotels, which is our preferred pick in the hospitality space. It is our top pick. We have a buy rating and a target price of 900. Giving an upside potential of 19%. The second stock that we like in the space is Lemon Tree in the mid-tier space, consistently expanding into newer territories, mainly targeting your business, religious tourism, tier 2, tier 3 towns. With the development of many new airports now flying to many of these tier 2 towns in India, as well as religious places, have become pretty easy and is driving the tourism growth. So overall, very positive view on the hospitality space. Top pick there being Indian hotels. We continue to like it for the strong growth, healthy traction in the core business, as well as some of its new business that they are driving.
Any view on Taj GVK? Have you looked at that company?
Unfortunately, not looked at that.
Got
All right. Thanks very much for joining us. As always, Sid, good speaking with you. Axis Bank is the one that we want to focus on. Disappointed in the first quarter. Asset quality deteriorated, which dragged profits. Came as a surprise. Let's just put the numbers out first, and then we'll bring in the analyst. Gaurav, take it away.
Well, yes, Axis Bank actually reported weak set of numbers. It was actually expected to report weak set of numbers, but the numbers that they reported were weaker than what the expectations were. Now, first, let's talk about numbers. Net interest margins declined almost by 17 basis points. Now, the street was expecting this decline somewhere in the range of 10 to 12 basis points. Another disappointment was the asset quality. Now, Axis Bank has actually upgraded their provisioning norms, and that is the reason there is a technical impact in this quarter. But this technical impact costed almost 620 crore rupees on its profitability. So when it comes to provisioning, around 800 crores of impact is what we have seen because of this technical changes that the Axis Bank has done. And that is the reason why we talk about credit cost that has also gone up almost to 1.4%. Same trend was seen in slippages as well. Slippages came in at around 8,200 crore rupees. And if we exclude this technical impact, slippages would have been around 5,400 crore rupees. So a huge impact is what we saw in slippages as well. As a result, profitability came down almost by 4% on a year-on-year basis. Now, bank highlighted that there was a 600 crores of impact on profitability because of this technical impact. At the same time, if we quantify this impact, ROAs declined almost by 15 basis points and ROEs declined almost by 1.4%. So without these technical impacts, the ROAs would have been better almost by 15 basis points. Another point to highlight is that the loan book growth has been slowing down now. Management is saying that the loan book growth will pick up and it will be higher than the industry in the medium term. On the other hand, they are also saying that the slippages are likely to come down because there will be recoveries in the coming quarters. So they expect slippages to remain muted for the next 3 or 4 quarters, and the recoveries will actually help credit cost to come down. But what Street is also penciling in and what analysts are also saying is that the slowdown is going to be there in the loan book. They're expecting 10 to 12% growth in the loan, and at the same time, because of the valuation comfort, they are actually maintaining their buy. But we are seeing the price target price cut across the brokerages. We have seen Investec, IIFL cutting down their target price. So definitely a negative impact is what we're expecting on the target, on the share price as well. And weak set of number is what we have seen in Q1 from Axis Bank.
Okay, all right. Thanks a lot for joining in, Gaurav, and explaining that very, very crisply to us. Let's get a view then coming in. We have Ajit Kumar, lead BFSI research analyst at JM Financial, who joins us on the show. Hi, Ajit. Good morning. Thanks a lot for joining in this Friday morning. Axis Bank, things not looking too good, for shareholders out there. But the stock as it is has underperformed in the last 1 month. It's as it is down close to 5%, while the Nifty Bank is up 2%. And now we're bracing for another 4-5% cut. Do you think the street will look through this technical write-off, or do you think there are other reasons to be concerned out here? Your view.
Good morning, everyone. Thanks for having me. So yes, Axis Bank has given a disappointing set of numbers in 1Q26. But just 2 to 3 things I wanted to highlight here. On the operational side, everything was broadly in line. So like, for example, loan growth of 12% YOY, NIM decline of 12-13 basis point adjusting for the interest income reversal. Both of these were in line with our estimates. In fact, operating profit, PPOP, was 4% above our estimate due to higher treasury gain. So operational side, things were in line with the estimates. Yes, on the asset quality side, there were additional slippages of around 2,500 crores due to the accounting change done by them. But here we have to remember that more than 80% of these additional slippages are secured in nature. And since it is secured in nature, we will see some bit of recovery coming out of these additional slippages in the later part of the year. So yes, these additional slippages are negative in nature, but at the same time, we need to remember that since more than 80% is secured in nature, recoveries are going to happen in the second part of the, second half of the year. The other point I wanted to highlight here is, if you look at the valuation of Axis Bank, right, currently it is trading at 1 standard deviation below historical mean, right? And if you compare Axis Bank with some of the other banks on all the operating matrices, despite the soft quarter, is actually much, much better. So while, this is a, disappointing quarter, but having said that, this is not the end of the road. We continue to like the name. We remain, buy with unchanged target price of 1,000.
Yeah. So you would be looking to buy the dip today?
Yeah, correct.
Okay. Ajay, just curious. Hi, morning, Surabhi here. Just curious. Wonder why the bank moved to do this. I know their explanation is that they are just being extremely prudent. But had they indicated this to the analyst community in earlier calls, that they're going to change their NPA recognition practice?
Not much, Surabhi, but having said that, there are few other lenders who are actually tightening their, recognition criteria, whether it is bank, whether it is NBFC. We have seen, 2 or 3, lenders doing the similar stuff in last 1 or 2 quarters. So it's on a prudent line. While it is disappointing in the near term, but I believe, over a longer period of time, this is a prudent move.
It's a healthy. Okay, so fine. I take your point, and that's exactly the argument the bank is making, that it's just a cleaner, healthier book over the long term. And they've realized all the impact one shot in the first quarter. So let's move beyond the NPA conversation. But even then, margins, look at the margin fall. I think 17 bips thereabouts, a little more than what the street had in mind. Loan growth is about 8%. Again, not really lighting up the charts. What about those parameters, margins and growth?
Well, Subhi, the numbers are soft, but this is going to be the trend across the, financials in this quarter. When the sector loan growth itself is 9.5%, we can't expect, the large banks to outperform them, materially. And these numbers were broadly in line with the estimate. So loan growth of 12% YOY was exactly in line with, our numbers. Yes, there is a margin decline of 17 basis point, which is higher than, let's say, 12-13 basis point that the street was penciling in. But at the same time, we have to remember that within that 17 basis point Q&Q decline, there are impact of interest reversals. So if you exclude that, because there were additional slippages, right, in this quarter, and due to that, there were interest income reversal that happened. If you exclude that, the margin decline was roughly 12 to 13 basis point Q&Q, which was again in line with the estimate. So I'm not that much disappointed with the operational numbers. But yes, on the asset quality side, there is some bit of disappointment as far as these additional slippages are concerned.
Ajit, let me ask you this for our viewers, right? Earnings are still coming in. Anything you'd like to position yourself for where, in terms of tactically speaking, where you think numbers could be, could surprise one way or the other out of your coverage universe?
Yeah. So, in such kind of scenario where loan growth is not there at the sectoral level itself, as I said, 9.5% credit growth, asset quality is not completely out of woods, and there are margin pressure which is coming through. In such kind of scenario, our preference is more towards the larger names, more safer bets, whether it is banks, whether it is NBFC, and that is why we stick to larger private sector bank or even SBI for that matter in the banking side. And in the NBFC side, our preference is more toward the larger name again, Bajaj Finance. So yeah, when the macro environment is not that great, our preference is more towards the safer bets rather than going into the, going down to the curve and let's say going into tier 2, tier 3 names.
Okay, I just want to have a follow-up question that, Ajit, give us a second. We should look at rates as well, the pre-open. So Axis is taking a knock of about 7.5% in pre-open. Let's get the rates up. We should look at Wipro as well. Remember the question I asked Rima was, with Wipro, is the glass half full or half empty? And Rima said it's a glass half full, Surabhi. And that's what the stock is indicating right now, because the deal wins and the commentary for the second half are very, very promising, though the first quarter has been slightly soft. So Wipro is looking good. And Axis is still down about 6.5%. Just to complete that point, Ajit, you said that you will not go down the curve too much, looking for tier 2, tier 3 lenders. Just expand on that, because a section of the market is doing precisely this. Yeah. And, stocks like whether it's a Bank of Maharashtra, look at the institutional buying in RBL Bank, names like AU Small Finance Bank. So there almost seems to be a race to find a mid-cap or a small-cap financial stock that can give you super returns, because the big banks are not moving. Why do you think that this is not the right way to go? And is there anything that you like in tier 2 financials?
No, so we have few, preferences at tier 2, tier 2, tier 3 financials. The only common thread in our picks is we are preferring, players where there are not much asset quality concerns. Growth and margin is actually second or third variable that we are looking at. It's the first asset quality that trend that we are focusing on, and in that regard, City Union Bank in mid cap, we prefer. DCB Bank we prefer in the banking side. In NBFC side, our preference is to more toward the housing finance company like such as PNB Housing Finance, Aadhar Housing in let's say affordable housing players. And as I said, the common thread among all of them is the asset quality concerns are not there that much. As compared to some of the other riskier name. While market is chasing growth, and that is why getting into all those tier 2, tier 3 names. But my sense is in FY26, credit cost for all the lenders is going to be much higher than the expectation, and even more so for the tier 2, tier 3 names who are exposed highly toward this unsecured loan and let's say, MFI loans. And that is why even in tier 2, tier 3, we remain highly selective.
Oh, okay, that's a different view. Haven't heard that too frequently in the marketplace, that this could be a year where we need to watch for credit costs. Interesting one, Ajit. We'll remember that for sure. Just to wrap it up, a quick call on SBI. Mega fundraising exercise underway. What's your call?
So we like the name. So while 25,000 crore looks, high in terms of the absolute quantum, but looking at the balance sheet size, it's a minuscule for them, to be honest. I mean, there's not much impact on the CET ratio. Hardly 15-20 basis point positive impact is there on CET ratio. But capital raise or no capital raise, we do like this bank from longer term perspective. Yes, there is a margin pressure which is going to come for SBI as well. But all said and done, the entity is printing more than let's say 15-16% ROE. And anybody who is having, let's say, longer time horizon of 2 to 3 years, SBI is one of the more safer and preferred bet.
Okay, all right, got it. So stick to big banks. That's the advice coming in from JM Financials. Good conversation this morning, Ajit. Thanks very much for joining in. Well, with that, let's turn our focus back to the market. The index is flat. It's all about individual stocks, as the case has been. Look at the Nifty, just 3 points lower. Now let's look at stocks. So I pointed out, obviously, the sharp moves on Axis and Wipro. Axis still down 6, Wipro is up about 3. Look at Indian hotels. I mean, stellar performances being met by stellar reactions as well. And yesterday was Ixigo. Indian hotels also has been looking fairly solid this morning. It's cooled off a little bit. It was when it opened up in the pre-open, it was even higher. Nuvoco is the other one. Nuvoco in the pre-open is popping almost 7%. So let's watch for this. On the other hand, Shoppers Stop. Manglam was telling us the operational performance is better, and it is better. But at the net level, there is still a loss. And that loss year on year is looking bigger. So that could be one reason why the market is a little disappointed in terms of Shoppers Stop. So that's how it's playing out, all about individual stocks that are catching the eye. I think we've got Mitesh with us. Mitesh, of course, we want your 9-10 call. And also just give us a view on Axis Bank specifically. If it opens down 6-7%, what would you do?
See, Axis Bank, the chart has been weak for the last 2 days. In fact, if you look at State Bank of India, it's made a new high, getting past 825, 830, while Axis Bank, after registering a high of 1250, was down to about 1150. And with this gap down, I think we might see the stock, get below levels of 1100 and head towards 1,040, which is where the next supports come in. These structures do, so I will not even want to buy it then. Maybe you get a bounce back, but not keen to buy.
Okay. Yeah.
Yeah, your 9-10 call,
please.
yes.
For 9-10 call, I'll go with a buy from Jindal Steel Power. Look for targets of around 975 to about 980.
Okay, JSPL on your radar. Cut that. Thanks a lot for that, Mitesh. Well, let's hop across to Vamakshi. She's here to tell us about 361 VAM. Vamakshi?
Well, Nigel, the AUM growth out here was quite good, up almost 14% quarter on quarter as far as the total AUM is concerned. And this was largely driven by the wealth management AUM, which saw an uptick of almost 15% sequentially. ARR flows were boosted by mainly completion of the BNK acquisition. Keep in mind that the revenue growth, on the other hand, was up only 2% quarter on quarter. It did not mirror the gains that we saw in the AUM, and that is because we saw the yields on ARR AUM declined by 4 basis points and the yield on TBR AUM also declined by around 2 basis points. Total operating costs grew at a faster pace as compared to the growth that we saw in the revenues. Resultantly, the cost to income ratio spiked up by 171 basis points and the operating profit declined by 2% on a sequential basis. The net profit though came in almost 15% higher quarter on quarter, and that is mainly on account of the growth that we saw in other income. Now, there was a conference call that was held yesterday, and the commentary that came through from the management sounded quite optimistic. They're targeting ARR net flows of 20 to 25,000 crores from wealth management and 8,000 to 10,000 crores from asset management. They believe that the flows could remain subdued in the near term on account of RM attrition, but however, they're expecting to recover over the rest of the year. ET Money's cash burn has also meaningfully reduced, and as integration synergies begin to materialize, scale bids up, they expect to see gradual improvement in cost efficiency as well. So that is how 361 VAM's numbers shaped up this time around.
Got it. Thanks a lot for that, Vamakshi. Well, Nuvoco Vista, surprise, surprise, delivered a very, very good set of numbers. Volume growth was average at around 6%, more or less in line with what the industry did. The revenue was up by close to 9%, telling you there was some realization gain. On a sequential basis, in fact, the realizations were up by close to 5% quarter on quarter, and that led the way because the operating profit came in at around 520 crores, which is one of the best we've seen on a quarterly run rate. Margins were at around 18%, but the EBITDA per ton, I've calculated that came in at around 1,000 rupees, which is a sharp improvement on a sequential basis as well as on a year-on-year basis. The net debt number, that's the cherry on the cake, that as well has come down. So put everything together, realizations up, cost under control. They are guiding that cost will come down by another 50 rupees per ton, valuations in favor, and net debt comes down. Good set of numbers. The stock is still a far cry away from its IPO price, but for the time being, the street will like what they saw.
All right, I think we've got market open coming up in just a couple of seconds now. I mean, once again, as flat as they come. Maybe not as flat, but yeah. You got the Nifty, which is flat. Yeah, nothing, unchanged. 25,118. The Nifty Bank is down about a 0.33%, 56,640. So that's a more decisive, and I think Axis has got something to do with it. It'll come up on your screens, but 0.4% lower on Nifty Bank straight off the bat. Axis is down 5%, as you can see, and I think outsized sort of pressure on the Bank Nifty. Mid-cap index is flat. The small-cap index, perhaps, I think, coming up should come up flat as well. And the Nifty heat map will give you a quick sense of how we are starting, but it's all about stocks, so we want to get to stocks very, very quickly. What do we have on your screens? 25 odd names are higher, and about not 25, 35 names are higher. About 15 stocks are in the on the downside, but Axis really is putting pressure. Surbhi.
It's a classic bull versus bear on Axis. I mean, the bulls will say that in longer term it's actually good. It's a sign of strong prudential management. But the bears will say, hey, Q1 was bad and we weren't prepped for it. 4.5% down on the stock as we speak, but it's cutting its losses from a 6% gap down. So let's see how this plays out. What else is weak? Bharti Airtel, Kotak Mahindra Bank, SBI, SBI Life, Bajaj Finance. In general, financials are weak. And the knock on Axis has taken the Bank Nifty down 0.5% as well. ICICI Bank is also a little weak. And the others are not able to offer much of a counterweight. I mean, HDFC Bank is just 6 rupees higher. SBI is also on the lower side. So banks are weak, short point. Let's look at Wipro. Wipro is a bright spark on the Nifty this morning, 3.5% up. Remember, the first quarter was soft, but deal wins are looking very good. Commentary for the second half is strong, and the market likes that. So 3.5% up. Jio Financial reported numbers. Growth is picking up. 1.25% higher on Jio Financial as well. Other gainers on the Nifty. Once again, the metal stocks are continuing their shining ways from yesterday. So Tata Steel, JSW Steel, maybe global risk on mode. Global markets have been holding up as well. That seems to be working for this part of the market. Even Hindalco is up 0.5% higher. So metals are shining bright. Aside of that, then it just completely flattens out. Some buying on Infosys, some buying on L&T. Let's look at Reliance finally before we move to mid-caps. Reliance ahead of numbers, very quiet. Just about 2 rupees on the higher side. Nifty down 17 at this point. Nigel?
Well, a few stocks that are catching your eye from the broader markets. Novoco, the numbers were good. I'll be interested to see whether or not it can sustain this 8% gain because, the IPO came at more than 500 rupees, but they're doing the right things. If it wasn't for Vardaj asset that they've taken into their books, because now we'll have to wait by to see how they turn that around in the next 2 years or so. But no worries with the numbers. Realizations up, cost under control, debts reduced, and they have valuation comfort as well. So let's see whether or not it can build onto those gains. For the time being, an 8% pop, I think, factors in the good set of numbers that we have seen. The other one I'm looking at is Afcon's Infra. Well, that's up close on 4.5%. They won a large order. So that's why the street likes that. That one, 4.5%. Good going out there. Wipro continues its winning ways. And SmartWorks co-working listed yesterday, good gains out there, building onto the gains today as well. So SmartWorks, in fact, up close to around 2% as we speak. Lurch Avenues Tech, that stock in fact was much higher in yesterday's trading session. It ended at the circuit. Today there is some cooling off. There is an Anand Rathi note that I'm looking at. They find valuations a bit stretched at around 68 times forward earnings. Hence, they initiate coverage with a hold rating on the stock. 230 rupees is the target price. Some cooling off after the big run that we've seen on that one. And Navkar Corp as well, I think that came out of a set of numbers. Large volumes today. It's down close to around 1% or thereabouts. So, though we have the headline index, it's more or less flattish. Stocks in the broader markets doing a thing of their own, bouncing around.
Well, 0.07% change on the Nifty at this point. So large cap, the Nifty index not doing very much at all at this point in time. Let's welcome in Prateek Gupta, who's with us, CEO and co-head at Kotak Institutional Equities. Prateek, great to have you with us here on the program as always. Thanks for your time. Do you think one of the reasons, sort of almost primary reasons, of course, earnings have been tepid, etc. We all know that, but there's so much supply, right, which is constantly hitting the market. Just take SBI's 25,000 crore round, and so many others who are kind of sort of coming to the market and quietly raising money, successfully raising money. There's a fair bit of supply, so money is getting sucked out of the system. What is your sense, on balance? Because very, very evenly, almost sort of, these levels, at least at the index level, things are pinned to the board, not moving very much, very tight band.
Yeah, good morning, Prashant. I was actually just discussing with someone earlier this morning that our market seems to be, if you remember the old Ajit Mona Darling jokes, like in a liquid oxygen state. Pretty much range bound. You've got on one hand, you've got the very weak earnings outlook, as you mentioned, valuations which are expensive. Nifty is trading at almost 22 times 1 year forward, and you've got a huge paper supply pipeline. We had SPI yesterday, many other large IPOs and a lot of blocks and QIPs in the pipeline. So that's going to sort of cap the upside. And on the downside, there's a lot of support from continuing local flows because your alternatives in fixed income property are no longer that attractive. You have the prospects of a much stronger second half. So there's hope that earnings will recover in the second half. And then you've got the US dollar weakness, which will hopefully trigger EM inflows as we go along in the next 3 to 6 months. So sort of stuck in a range-bound mode for the short term and pinned to the wall, as you said. So it's pretty frustrating for a lot of investors who are either waiting for a market correction to buy or waiting for a market rally to sell. So pretty subdued activity for the time being.
That line, Prateek, I was hoping that when you started with the Mona Darling line, I thought you'd say it. मोना डार्लिंग इसको लिक्विड ऑक्सीजन में डाल दो लिक्विड इसको मरने नहीं देगा ऑक्सीजन इसको जीने नहीं देगा that's the line.
Gentlemen, out of the park this morning. I went to Google immediately. Ajit Mona Darling.
How can you, Nigel? You're not that young. This is
now it feels like a Friday. Actually, thanks for that, Prateek.
But have heard about this?
Old movie, playing in the house at some point in time.
Surabhi, come on.
This is not 90s. We're like 90s kids and all.
This is iconic.
No, but okay, to bring this back to the market, Prateek, please elaborate. Now, who is the Mona darling? Which sector? What is the liquid oxygen? Is it the liquid flows? Please elaborate on this very, very interesting analogy that you picked up this Friday morning. Because if you're talking about flows, then that liquid oxygen is not even there. Where are the FPI flows? Half the year is gone. We thought there'll be plenty of liquid oxygen, but it's not coming.
No, in the joke, the liquid is the thing that prevents, will kill the guy, and the oxygen is what will give him the support to live.
Okay.
So the liquid in this case, what will kill the guy is really the valuations which we are at 22 times. Very few stocks are at attractive valuations. Earnings growth, as Prashant was saying, is pretty pathetic. If you look at the large sectors, you look at IT services, consumer, banks, you'll get, at best single-digit earnings growth this year. So that's sort of what's capping the upside. And in terms of the downside support, you've got local flows because, like I said, money is not going anywhere else. It's coming into equities, risk capital, that is. And you have prospects from, for example, you could see the impact of the rate cuts by the RBI and potentially even more rate cuts given the very low inflation print we saw in June. You could see, finally these things feeding through into the economy and the long sort of, and you could see government capex coming through in the second half. Post monsoons, we could see a rural recovery. All of these factors should come together in the second half. So therefore, it's sort of pretty range bound at the index level. Obviously, individual stocks are doing their own things, but at the broader market level, tough to see this market moving out of the sort of range.
Now it makes full sense, Prashant. So liquid ise jeene nahi dega is the valuation and the earnings, but oxygen marne nahi dega. That's the retail money flow. Now we understand.
I remember the dialogue, but you got to go with Ajit's delivery. I mean,
you nailed it.
I can do it, but I don't want to do it.
Over it, Prashant.
And you should try it.
Yeah.
On popular demand.
Lights, camera, action.
Prashant. I'm not going to do it. Go on. By the way, just to take that point forward, Ramdevji was on, right? And I don't know if you watched that conversation, Prateek. This liquid oxygen, basically he put it another way. This is, of course, but Ramdevji said cap and floor. The cap, according to him, is all the supply which is coming in, and the floor is all the supply, all the sort of money which is coming in.
The retail money, yeah.
So, and that's the liquid oxygen, which I think that's another way to describe liquid oxygen.
All right, interesting Friday morning, Prateek. We started off, we had our top 10, and Surbhi was asking Reema, the glass is full or half full. It's a Friday morning, so I was just wondering what's going on. And now we have a slew of jokes as the markets open. Let's get back to earnings. We spoke to Mahesh of Jefferies last week, and he said quarter one is going to be weak, but he's breaking for a very strong bounce back in quarter two earnings. And the rationale he gave us, that it's going to be on a softer base. Some part of this liquidity that's released into the market will start picking up. And since we are hit by early monsoons, maybe the monsoons recede as well earlier. And besides that, the most important is Diwali is relatively earlier. So spends will pick up in September. Are you in that camp that believes that we'll see a good earnings recovery in quarter two? And for the year, you're still sticking to that 12% earnings growth?
So yes, Nigel, we also believe that the earnings growth outlook will be much better in the second half. For the June quarter, our projection is at Kotak that the Nifty earnings, for example, will be growing only by about 4.5% YOY. Whereas for the full year, we are projecting about 11% for FY26. So clearly that means in the next 3 quarters, we should see a much stronger earnings growth. Having said that, a lot of it is priced in already, both the negative news as well as the second half recovery, negative news of the first quarter and the second half recovery. Just look at the valuations of where all the stocks are trading at. You, like I said, you look at the consumer stocks, the IT stocks, the bank stocks. They're already sort of, I don't think there's going to be a major surprise, barring a few odd stocks here and there, that broadly almost every investor is expecting a very weak set of earnings from the first quarter and a pickup in the second quarter. I think the main market moving events will be something other than what's already going on, all this second half recovery. It could be things like you get a favorable trade deal with the US, for example, or perhaps on the downside, an unfavorable trade deal. So that could be one. Second, you could see some government action in the form of, say, perhaps petrol and diesel price cuts at the retail level, that could pump some money back into the economy. GST, we think there'll be just some minor tweaks, but perhaps there could be something more over there. But I think the real big trigger will have to be things like government capex coming in a big way in the second half. And that's always a bit tricky to project how much of it will be driven by the center, by the states, the PSUs. So that's really where we are. So we are sort of expecting a much better second half, but it's sort of priced in. So to break out, you need something else happening, which at least at this point in time, there's nothing going on.
Okay, so all right, Prateek, let's sum it up then with what should be done. I mean, you described the situation really well, and I think this is the reason why we're not getting that deluge of foreign flows. We started the year expecting that US exceptionalism will end, and it has, but it's Korea and China where the money seems to be going. So in this context, what should investors be doing? Where do you see some prospects of growth and some valuation sanity? Leave us with the top ideas. I think defense is something you've always liked. What else?
So firstly, on the foreign investor side, I'd just like to highlight that most global investors are still neutral to largely underweight India, just given the expensive valuations. India has underperformed the MSCI EM index. You mentioned Korea. Korea is up 32% this year in local currency terms. Other markets like Hong Kong or Brazil and Mexico, they're up 15, 20%. So India is clearly underperforming. But even then, people are staying away. And you've seen the flows into the FPI flows into India last few weeks. We haven't seen that much coming in. Now, as far as the sector preferences are concerned, in this sort of a market environment, either you go with companies where you have strong earnings growth visibility or where valuations are in your favor. And that's a tough one to find. So we still like the banks and the NBFCs and the insurance companies where earnings growth is not that great, but at least valuations are somewhat reasonable. We still like the hospital space, the entire healthcare space, where, again, in this case, valuations are not supportive, but you have very strong earnings growth outlook for the next couple of years. Hotels is another area. Telecom is another area. So these are sort of the sectors we like. One general theme we would recommend investors, at least for the time being, to stay away from is export-oriented plays. These are like IT plays, the global auto ancillary plays, or the metals. We believe a global slowdown is in the works. The impact of the tariffs, etc. Already we're seeing this in China slowing down. US, we think, will slow down in the second half. So when two large engines of the global economy slow down, tough to see the overall global economy not slowing down. So overall, we would stay cautious on the global export plays, focus more on the domestic plays.
Okay. All right. Prateek, thank you very much. A great conversation as always. Insightful and, might I say, very entertaining. Brightened up our Friday morning. You have a great day and we look forward to connecting.
I hope you'll...
By the end of this day, you'll have to enact. If not on air, off air, for sure.
You'll give the idea to Sanjeev, Prateek. The research note titled Liquid Oxygen. I think it'll be a super hit.
Prateek, I'm sending you an invite for drinks later this evening and, we'll do all the enacting over there. All three of us and you.
Okay.
All right. Thank you very much, Prateek. Appreciate you joining us as always, and good chat. And look forward to the next one. Guys, the market is doing... let's just put the Nifty up for a quick bit, and then we'll just move on to our next discussion, which is, of course, another asset class, equities, real estate. Real estate is, of course... has been doing pretty well. 30 points lower on the Nifty. The real estate index is up about 1/3%. But so it'll be commercial, residential. What are we talking about?
Real estate, and most parts of it are, looking very, very good. We're putting the spotlight now on the office market. India's Office Real Estate Investment Trust, also known as, of course, REITs. Their outperformance to the realty index has been quite telling. In fact, we're talking about 15% capital appreciation in 1 year. The key driver has been the underlying strength of India's office real estate market, triggered by heightened demand from GCCs. To talk about this and more, we have with us Soumi Thomas, Executive Managing Director, Valuations and Co-Head at Capital Markets India at Cushman & Wakefield, and Vijay Agarwal, Managing Director at Aquarius Capital. Soumi and Vijay, thank you very much for being with us. REITs are definitely coming center stage. And I know that because, I'm looking at it from a personal finance angle, just the simple returns are becoming too interesting to ignore right now. But the question is that, is the cycle just starting? Can it continue to be so good? Because it's largely a play on the booming office market. So, Somi, why don't you lay out the ground for us first in terms of just how rentals are moving up? Is it pan-India or is it specific markets, say in Bengaluru, in Mumbai, which is where this office demand is coming in from?
Thanks, Surabhi. I think it's very important to note that most of the office markets across India is doing quite well. It is driven by the GCC demand, the global capability centers. There are headwinds on the IT sector, but we need to really look at the importance of the GCCs for India. So it is most of the GCC market, like you said, Bangalore, Pune, Hyderabad, Chennai, even Gurgaon for that matter, is doing quite well. So the underlying growth on rentals is more than a inflation-adjusted rental growth. So 7 to 8% rental growth we are seeing in most of the core markets of real estate, not necessarily across the outskirts as well, but the core markets. So the talent pool availability is a big factor for GCCs. So they're willing to pay more rental in the preferred micro markets to attract talent. And that's why the rental growth is doing well. And we can see that in the REIT performance, we have a 15% growth in the last 12 months across most of the REITs. And they're doing quite high in occupancy. We have close to 90% occupancy in all the 3 listed REIT office REITs. Of course, the retail REIT is doing phenomenally well. That's at 97% occupancy.
Somi, just to follow up on REIT returns, and correct me if I'm wrong, I looked at some data, but that was, I think, a month or 2 back. Average returns have been ranging in the mid-teens. And, net of tax, they're looking very attractive at a time when the equity market is barely giving you, 10% in a year. Is that sustainable? I mean, what is a realistic expectation to have in terms of IRR when it comes to REITs?
Absolutely. You said it correct. In the today's market, it's a sustainable returns. We are seeing that quite attractive returns because of 3 factors. Like I said, GCCs, supply constraint is still there in the market. The core of the markets, like, for example, BKC in Bombay or Goregaon, Powai, these kind of markets, it's difficult to create new supply. So existing tenants are renewing at higher rentals. Like I mentioned, it's very important for these companies to be in the right area to attract the good talent. So we are seeing a mid-teen returns for most of the REITs. And I think with the GCC demand picking up in India, it is quite sustainable.
Gentlemen, morning. Good to have both of you here. Somi, Prashant here. Somi, now, when you look at valuations, right? When should one buy these products? I'm assuming when interest rates are high, right? At the top of the cycle in that sense, right? Yields are high. So you get, there are better pickings. Is that the state we are in right now?
Interest rates obviously are an important factor to give returns, but it's also important to look at the underlying demand factors. We came off at COVID, which created headwinds around the return to office scenario. And even today, maybe some of the developed markets, even in Asia like Japan or Singapore, you probably don't have very good performance in the REIT market. But markets like India, where return to office has become a reality and people want them to come to office for all kinds of reasons, including the new headcount they're adding every year. And they have not met their managers, or they're not really bonded with their colleagues. And innovation and ideas will only happen when you come to office. So we are seeing quite a strong trend of return to offices and a huge demand from the GCC space. So interest rate is one function. Of course, we are already seeing the benefit of interest rates, already reduced by 50 basis points recently.
Somi is, and maybe Vijay can also come in on this if he wants to. It's an asset class which is just about taking off in India, right? I mean, there are 4 listed REITs, 3 are in the commercial space, 1 in the retail space. There is 1 more which is coming. I think Sattva is coming to the market. So it'll be 5, but total market value is $12.5 billion. In the US, for example, it's trillions of dollars. But AI, it's a slightly off-tangent question. If it increases productivity, reduces the need for as many employees, as many seats in the office, fundamentally, where does that leave? Where does it leave things? If either of you wants to take that question briefly.
I think I can take it. See, I think we have to look at the AI, how AI will impact the demand for office space. I think it can have an impact on the very lower level coding level, not broadly across the. We will not see that the AI will replace human being completely.
No, my point, Vijay, is of course it will not. But it's like a pyramid, right? Any organization.
Yeah.
I mean, as you go higher, there are lesser people. The vast majority is the lower end. But if the lower end, as you say, is essentially going to get disrupted, then you don't need as much office space.
Yeah. So we had seen these things when the banks were getting digitized. That time also we had a lot of concern about the manpower, what will happen to the manpower. And if we see our data for 30 years, the banks have increased their manpower strength. So looking at, I think Somi can also chip in here. We don't see.
I'll probably take it. I'll probably take that question in a different manner. Just look at the absorption that Nvidia is doing in India, or there are certain multiple examples of chip companies and AI-driven companies creating India as the most important base, right? So we have seen some of the other large cloud players also increasing their presence in India. So what is really happening, Prashant, from an Indian context is that India is the cornerstone of a strategy for AI for most of these companies.
Yeah.
The kind of work that is happening has moved completely beyond the call center, the BPO, the low-end coding that Vijay just mentioned. We are talking about doing very high-end R&D work in India.
Sure. So that point is very well taken, that there is demand. GCCs are booming. And, that's showing up in office demand as well. I have a very simple question to you, gentlemen, from an investor perspective. Now, you can either invest in REITs or you can simply buy the underlying stocks. And a lot of these companies have mixed developments. I mean, they've got office developments as well. What could be potentially a better bet, say, over a 3-year period? Vijay, what would you do? Buy the underlying real estate stocks or invest in REITs?
See, I will take it differently. How is your risk appetite, basically? See, if you see REITs are a very stable income product and it replaces your bond yields. And see, suppose if you are looking to invest in a stable return product like a bond, then I would suggest you invest in the REITs because REITs give you a much better return than bond. With the same security, because underlying you have a real estate and real estate value will never go down in India, definitely. So that's the underlying assumption. And you, instead of 7-8% and now 6% with the rate cards, here you are getting a 12-13% overall return. So I'll suggest to do that, invest in the rates. But if you have a risk appetite, probably you can go for a stock investments in the select real estate development companies which have a mixed portfolio. You can have a Phoenix also, and you can have a Oberoi Realty, and Lota is increasing. So you can play the game. But suppose if you want to buy and forget, then REITs will be the better option. If you see a Nexus REIT, it has given more than 25% return, yearly returns. So that's a fantastic return. You can't get in the stock. And the best part for REITs is that it doesn't go down like a stock market.
That's the thing, and investors are very savvy. They're hearing you say 35% return. They're very quick to, tweak their portfolios where they think there's perhaps other value. And I think REITs are going to become quite a defining product that people will at least look at in the years to come. Thank you very much, gentlemen, for joining in on what is an interesting conversation, a very, very interesting asset class. 35% return in last 1 year, Nigel.
Well, Somi and Vijay have given me some food for thought. We'll do some, analysis on this over the weekend. Thanks a lot, gentlemen, for joining in. Look forward to catching up with you all rather soon. Well, let's move to another corporate then. We have Tata Communications that's on our radar. We have Mr. Lakshmi Narayan, the MD and CEO at Tata Communications, who joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, in month of June, when you held your analyst meet, you deferred your ambition of doubling your data revenue to around 28,000 crores by FY28. That implies a CAGR of close to around 13%. Now, in Q1, the growth is around 6%. Do you think you get to double digits from next quarter onwards? And for the year, what kind of a number in terms of growth can you deliver? Double digit on the cards?
Yes. Hi, good morning. If you look at our data portfolio, the digital year on year has grown close to 17.4%. which is very good given the macro conditions that we are operating in. The data growth as well year on year has come in just shy of 10%. So we still believe that the macro conditions, there is an effect. There are pricing pressures. The core connectivity particularly has undergone some churn on pricing and some specific SAARC countries related issues that we have had. But these are, we think, are the blips that we have to encounter on the way. But talking about the long-term ambition that we set out, we still very firmly believe that the upsides are very much there, given the areas of investment that we're doing in the digital fabric.
So data revenue growth will return to double digit in the coming quarter?
No, we don't give any guidance. The only markers for us are, since we referred to the Investor Day, we called out that our relevance to our customers are increasing, where we said that our 10 million customers in the last 4 years had doubled. Right? So, and our BFSI segment, where we focused, again, almost doubled in the revenues. So our relevance certainly is increasing. The order book this quarter is better than the previous quarter.
Yes.
Even last year, I had called out both in Q1 and Q2 fairly good order book. That came on the back of some lumpy deals. And Q1 again, we have done quite well in terms of order booking. So and the funnel addition is another good indicator. We have had very good funnel additions both in India as well as in the international market. So I think we feel very, very good about the traction we are getting in the market, the relevance that we see of the portfolio that we have with our customers in their transition journey. These are the two more important factors to me. But the macro is something that we can't control, and therefore I won't be able to give you immediate forecasts on the quarter or the year ahead.
Right, but 28,000 by 2028, you're saying that's the ambition, and you don't think that'll get pushed?
That's very much intact.
Got it. Let's talk about the bright spot then. You mentioned, right, digital revenue, that's done well for you, 17% up, 17.4%. Now you want the share of digital and data revenue to go to 65%. Couple of questions on this front. What's giving you that confidence? When do you get there? And when you're talking about the 65% contribution, are you factoring in some inorganic growth?
No, all of this is organic. Organic, yeah.
Okay.
Over the years, all the components of our fabric has significantly strengthened for us, right? So I can talk about each of the fabric, but each of the fabric, whether it's network or the cloud and security or the interaction fabric and the IoT fabric, all of them we have significantly invested and strengthened. The cloud, network and security and the interaction has done very well in the last in this quarter and the last year. The IoT fabric is somewhat muted compared to the past, but all the fabrics, we have complete belief in that would do well. The second aspect of it is some of the new products, that we are working on, and we again called out as some of the strategic bets in our Investor Day. So for example, the whole cloud, the security, where we bundle all the capabilities of CDN, the firewalls, the next generation firewalls, the API security, and all of that. That we believe will be a big uplift. AI Cloud, again, is a big investment. And AI Cloud, particularly combined with our interaction fabric, where we have Kalera AI, where we think that inferencing is going to become more and more important as we go into agentic AI. Our combined value proposition of our own AI Cloud, combined with the agentic AI on top that we provide us in the interaction fabric, will be a great differentiator in the market. So these are some of the bets that we are investing in.
Yeah.
And we think that will get us to the ambition that we have stated.
Sure. So just walk us through what some of these investments and these bets, what they will mean for the margin profile of the company, say for the full year, stepping into next year. Because while in the quarter gone by, your margins improved sequentially, and you were at about 19 odd%. In the past, you were at higher margin levels. You were at 20% plus. So as these investments into AI, agentic AI, all of they continue, does it mean lower margins? I mean, as a trajectory?
Yeah. No, I think, again, in our ambition, we've stated that we will want to get the overall portfolios to be at least at 23%. Our range is 23 to 25. And there are two factors, here. One is in the core connectivity itself. There have been some pricing pressures, and the core connectivity has not grown as much as in the past. So our core connectivity, for the margins to do well, we said it should be in the mid-single digits or low to mid-single digits. That has not happened over the last 2 quarters for various reasons. And one of the primary reasons that we called out is issues in the SAARC countries, and that has muted the core connectivity growth. Now, that is one big contributor for the overall margin. The second is the overall digital portfolio is negative EBITDA at the moment, and each of the fabrics. So the next-gen connectivity does well. The cloud and security, there are early stages, so we think that will come back into contributing more positively. The interactive.
But by when, sir? So if you could give some time indication, you said your ambition is to get to 23% plus margin.
Right.
By when? And does it get worse before it gets better? I mean, can margins fall to sub 19 as well?
Yeah, the timelines, we again gave out is the medium term of 27-28. Our first goal in the digital portfolio is to get to an EBITDA neutral position. So today they are all negative. So I don't want to give a specific timeline again, whether it will happen. It will take a few quarters to get there, but the trajectory is the right trajectory that we are moving in.
Got that. Mr. Lakshminarayan, the other sort of question, of course, is every industry is in some way or the other getting more competition or technology disruption, et cetera, et cetera. Prashant here, sir. The news this morning, basically, which suggests that, and this is a story from CNBC, that companies like Meta, Google, et cetera, are laying out, basically subsea cables, tens of thousands of kilometers. I don't know if you've seen that story.
Yes.
That is, in a way, kind of sort of, directly in your line of business. How does it affect you, sir? Is it a bit of a threat?
No.
Competition? Go on.
I don't think it's a competition. It's, our customers who used to lease and buy from us are now investing in their own cable systems. And then this cycle is to be expected. So it is not a threat. We are also diversifying into other customers. So, these class of customers we call as the OTT customers who,
Mr. Lakshminarayan, these class of customers, the OTT ones, right? I mean, not what you describe. I mean, I think you describe internally them internally, Meta, Google, etc. as OTT.
Yes.
And this would be how large as a share of your numbers, sir?
No, we don't split that out, Prashant. Both the hyperscalers, the OTTs, and enterprise form the bulk of the core connectivity.
Yeah. So if they are starting to build out their own networks, yeah. I mean, that is essentially problematic, isn't it?
It's not a new phenomenon. It has been happening. Google, AWS, Microsoft, all of them have invested in their own submarine cable systems. It's not a new phenomenon. That has been happening for a while. They also, at the same time, buy from us because they do need diverse paths. The cables get cut under the sea. That's also a phenomenon that is increasing, and that causes resilience issues for these customers. So they do, while they build, they also buy extensively from other parties. So it is not that one is replacing, and their data needs are only growing. It is not coming down. Right?
No, that's the reason why I'm asking, right? I mean, this is the fastest growing part of the business. I mean, not for you, I'm saying generally, if you look at industries, hyper growth in these segments. So, but you're saying that this has been happening and it's not as if the pace of change is quickening. I mean, it's not if, There's no, we're not at a moment where suddenly is going to look very different a year, 2 years down the line.
Not really. I think this phenomenon has been, and the other counterweight to that is the enterprises, especially with their AI. I think their data need and the data growth is going to go exponential. And that also we see. And that is why our focus is on data center to data center connectivity in the enterprise space. And that has been growing very well as well. So I think these movements have always been there. I don't think this is of any particular concern as such. And that is why globally, Prashant, this, the entire area, while it's been coming down in terms of growth, while data growth has been there, pricing pressure brings overall revenue growth down. We have been doing fairly well in that segment with mid-single digit, and we think that we can keep up that growth for the next few years.
Mr. Lakshminarayan, thank you very much, sir. I think your investors would be happy and relieved with you laying that out. Appreciate you joining us here on CNBC-TV18 as always. Good luck. We take a quick commercial break here. We're going to focus on one sector, quarter se quarter tak, the next segment, and I think FMCG is in focus. So Mangalam will be here to lay it out for us, and we'll go across to Amit Purohit from Elara for some perspective. Okay, as promised, it's our special segment, Quarter Se Quarter Tak, where we get you earnings expectations from one sector a day. Mangalam is here with FMCG in the spotlight. Mangalam, morning.
Good morning. So remember the previous quarter, I said the tagline for the sector was same, yet different, because things were looking like they're improving. And this time we go with green shoots are coming. Why do I say that? Because, if you look at it, in the recent times, the stock moves itself showcase that belief. In the month of July so far, the FMCG index has actually outperformed the Nifty by 5%. Even some stocks have rallied in double digits, some for specific reasons and some for good performance. So what's expected this time around? Good rural growth that continues. Urban, which was under pressure, is now seeing gradual improvement, signs of life out there as well. Raw material prices, while they are volatile, the worst seems to be behind them, and staples may outperform discretionary. That's the big headline this time around. Summer products, some of the categories did get impacted by unseasonal rains and strong competition across categories. But we have a peep into what a lot of these companies are likely to report this time around. Godrej Consumer's India business delivered high single-digit value growth driven by mid-single-digit volume growth. Marico said its underlying volume growth in India has been at a multi-quarter high, led by their value-added hair oil business, which grew in low double digits, telling you consumer sentiment has improved because this segment wasn't doing too well for them. Dabur too witnessed sequential recovery in demand with uptick in volume growth in both home and personal care and healthcare. Their beverages portfolio was impacted. there was growth in discretionary. You saw 31% for Kalyan Jewellers, Trent about 20%, 18% for Titan, and V-Mart Retail for 13%. But these stocks actually saw a decline despite optically strong performance coming in the top line. Why? Because the pace of growth slowed down and valuations, they're catching up. So staples doing better than discretionary. Among all the companies that are likely to report numbers this time around, we expect some weakness to continue for Asian Paints, even as the environment for the paint sector is improving. HUL, Tata Consumer, Britannia, all of them likely to show incremental improvement. The one particular stock I'll be watching out for this time around, United Breweries, 10 to 12% revenue growth expected. Bears a summer product. The company has increased its focus on premium offerings with all the regulatory navigation that it has to do. That will be important to track. For the entire sector, speaking about strategy, the most important thing will be strategy of new leaders. We have a bevy of new leaders at HUL, Nestle, Pidilite, Titan, Bajaj Consumer, and many more. Further improvement in urban consumption will grow, and finally scaling up of the recent acquisitions, for instance HUL having bought Minimalist, etc. And finally the valuations, all of them pretty close to or slightly below their 5-year average, even after the outperformance that we've seen in July.
Finally, in that valuation table that Manglam has put up, there's nothing in the 70s. Otherwise, 70s and 80s used to be the norm for the sector. So at least from that standpoint, they've come down. Thank you for that, Manglam. Let's take the conversation forward. Amit Purohit, Vice President at Elara Securities, is with us to give us how, his whole perspective. Amit, the market is squarely focused on FMCG, bottom of the pyramid consumption, growing, volumes growing. Do you think it can happen in a sustained way? Is this that milestone turnaround quarter for FMCG?
So yeah, thank you for having me. So clearly, there are some signs which are there with respect to normal monsoon, base effects getting favorable for the sector. I remember last year, second half is when the things got worse, especially companies calling out that urban demand started to slow down quite significantly. And that impact would kind of annualize as we move ahead in the second half of this quarter. This financial year. The second part is obviously the overall hope and expectations of a better monsoon, which will aid into better income growth for the rural and rural growth, which has been talked about, that rural has been growing ahead of urban. That momentum should continue as we expect a normal monsoon this year. And that would ensure that there is no significant downside risk, hopefully, as we move into the second half.
So let's talk some numbers as well. In terms of just the best-in-class growth, like Manglam was just telling us, watch for maybe companies like United Breweries or even Lever, at least mid-single-digit growth. In terms of best growth, what would be the top 2-3 companies that you'll look out for?
So our process is simple. We look at companies where these segments are building growth for the future. So maybe over a 3 to 4 year perspective, companies who are investing toward that. So these there are 3 important companies which are kind of building up for the future, which I would say. One is Marico, Godrej Consumer, and Tata Consumer. Each of these companies have shown some product innovation or building acquisitions or inorganic growth to build up the growth levers beyond their core categories. So, and most of them, especially like a Marico or a Tata Consumer, a good 25 to 30% of their portfolio will become the growth portfolio, which is growing anywhere between 15 to 20% or even higher. And that would actually provide the necessary engine for growth. So our preference remains on these kind of names. And obviously the other names where the trajectory or the growth has been good, although this quarter seasonally things were not favorable.
Amit, sorry. I'm just going to go focus on the names again. You said Tata Consumer, Marico, and Godrej.
Yes.
On a full-year basis, what is the growth you're expecting them to deliver? Whether we can talk volume growth or we can talk top-line growth as well?
Sure. So Marico would largely be around high single-digit volume growth with double-digit revenue growth, largely driven by price increases that copra increase in copra prices forcing Marico to take that. This quarter as well, Marico is likely to report 20% plus kind of a growth. For GCPL as well, there is a mid-single digit volume growth this quarter, and for the full year also we are expecting a mid to high single digit volume growth with overall growth closer to high to double digit, low double digit revenue growth. Tata Consumer again will be a good double-digit revenue growth for this quarter as well as the full financial year effort.
All right. Hi, Amit. Good to see you in. If you have to look for that one earnings surprise this quarter, what would you think? Which stock could that be? Because you have a bit of a cheat sheet that comes out, right? So some part of the results are already known a little bit ahead. But which could be that number that we should really look out for?
So yeah, you're right. I mean, some of the quarterly updates are already out. And I think now more than the revenue growth, the surprise could come somewhere around the margin side is what our sense is, that to some extent Marico or a GCPL, probably if there is any surprise or better than our expectation of the margins, there could be some positive surprise in that. And some outlooks from the companies like Tata Consumer on their growth portfolio or HUVR talking about the outlook going forward, and with the recent management change. Some cues on that would probably be some surprises which will play out in the quarterly numbers.
So the thing is, the stocks have also moved higher. I mean, the market's now started positioning for this recovery. So now the final question then, now we've spoken about growth, you map the valuations and the stock run up with it, then which would be your top picks? For instance, if I look at Marico, where you're expecting strong growth, stocks up about 6% so far this month. So again, marry growth and valuations together, and then what are your top picks?
So, I mean, our premise has been for quite some time that companies in FMCG which grow double digit are the ones which will be preferred more over the companies which will have challenges with respect to top line growth. And in that context, I think if I look at Marico, reasonably valued at 46 times FY27, could probably, as we go along and the confidence built up, you would see that this inching up further with respect to the multiples as well is what our sense is. Similar is the story if I look at Godrej Consumer, where the multiple is closer to around 46 times based on our estimate on FY27 basis. And hence, I think these are the companies where you have some uptake in one, the revenue growth trajectory, and second, as well as some comfort on the valuation as well.
Okay. All right, Amit, interesting conversation. And let's see, because actually these stocks, the Nifty is up hardly 6-7% this year. But some of these stocks where there is a promise or a hope of growth building, they're up. Look at Tata Consumer. I mean, this year it's up almost 20%. Marico is up 13-14%, all outpacing the Nifty already. So interesting times for the consumer space. We'll quickly move on to our 10 a.m. calls. We've got Mitesh back with us. Mitesh, so how do you look at the market now? Again, dealing with a bit of a decline. What are the trades?
So actually, sir, I've been advocating that we might have a stronger chance of heading towards the lower levels, closer to about 24,900 zones. With today's tick, I think the support levels have moved slightly up to about 24,900. I think that's an area where I would explore some long positions on the index. But for the time being, the structure is negative, despite the fact that a lot of stocks are doing good. The advanced decline is also not too bad. What is interesting is that the bank Nifty is showing first signs of weakness. It opened gap down with that Axis Bank numbers possibly. And since then, the gap has not been filled, and we are now heading towards the low of the day. So the bank Nifty could head towards 156,400, which we are not very far away from. But more realistic target would be around 55,900, which could be tested. So in that sense, a slight negative view on the bank Nifty could suggest that the Nifty could also be in decline.
Okay, all right. Couple of stocks?
Yeah. I have a buy on Manappuram with a stop at about 270 or maybe 269.5, and look for targets of around 285 over here. And on the sell side is Max Health. People stop at about levels of 1240 and look for targets of around 1185.
Got it. All right. Thanks a lot for that. Mitesh, just a quick word on Nuvoco. In the first tick itself, we said the stock has run up 10% and it already gained close to around 8%. So maybe bulk of the good news is in the price. Now the stock is up only around 2%. So just keep an eye out on Nuvoco. While the South-based companies, KCP, Sagar, there is that buzz that could be some consolidation out there. probably with the Deccan Cement. We don't have any confirmation on that. But KCP as well as Sagar Cement, both of them buzzing on very, very high volumes for the first hour of trade. Time to slip into a short break. On the other side, Manisha Gupta will be joining in to help us out with what's going on in the commodity space.
Welcome back. By the way, the equity market's looking a little tentative. We are at the lowest point of the recent trading range. I mean, we've not, in the last many sessions, the Nifty's not breached 25,000, but it's precariously close to that. And it's also fiddling with the 50 DMA as we're speaking. Anyway, let's shift focus to commodities and see if there are brighter headlines over there. Manisha is joining in. Manisha, some of the other commodities always sparkling and bright. Right. So you tell us, what's the news?
Oh, well, yes. Overnight, it clearly has been about platinum and silver. So platinum is trading at a new 14-year highs, but it is silver, and I want to talk about that because this one really seems to be holding quite well. There's a lot of interest into this as well in the Indian markets and globally as well. So we have the prices moving towards $38 an ounce. Since the time it has broken above 30 and 32, we've been looking at it making higher highs into the market. It has been in this week itself that we have seen silver hit a $39 per ounce as a level as well. Remember, this is a fifth straight year of deficit in case of silver. And yes, silver has hit $50 an ounce a couple of times earlier as well. But what really seems to be coming together this time around in sense of fundamentals is very, very strong. So in last 1 month, we've seen prices gain up by 5%. And in this year until now, we are up by nearly 32% in sense of prices there. Also, when you look at the global demand and supply numbers for this year, that tells you that the mismatch itself has been quite supportive. Remember, it's a fifth year of deficit. And in this year as well, we're looking at a demand of 1.05 billion and supplies at 1.2. So you are looking at some concerns coming in there as well. Apart from that, when you look at the overall fundamentals, there is strong investment demand. The ETF demand has been picking up, and the physical buying in sense of bricks and coins also has been on the stronger side. It also has been about strong industrial demand. If there's a switch that goes on and off, there is silver in it. Solar, electronics, electrification, EVs, AIs, semiconductors, you talk about it, laptops, phones, aircrafts, silver usage is only going higher. And the markets do believe that by the time it's 2050, it would be semiconductors and photovoltaic, which would be 55% of overall silver demand. Another interesting point is that there is no resale happening. People are not getting their silver into the market thinking that they can make use of this because they believe that the prices will go higher from here. There is almost absent in sense of profit taking as well, and that has been keeping the prices supportive. This is the other thing, which is the gold and silver ratio. We did hit 101 at the beginning of this year. We are trading at around 87, 85 at this point in time, and that tells you that the silver still has an upside to go. The jewelry used in silver, because the gold prices are trading at an all-time highs, so silver as a substitute there as well seems to be doing quite well. So everywhere that you see, we are looking at stronger fundamentals. Tariffs, geopolitics, gold prices going high, safe haven buying, all of that in turn also has been supportive. And then interestingly, since Russia has said in September 2024 that they are looking to add silver to State Reserve Fund, I mean, this is the first central bank that really seems to be doing that. We've heard of central banks adding gold, but Russia is adding silver to its kitty as well. That has been supportive. And finally, the split tells you on what the markets are believing on where the silver prices could go moving forward from here. JP Morgan talks about 39, a level that we have seen, but they talk about 39 as an average price, so we still have an upside to go. Bank of America, UBS, Standard Chartered, Saxo Bank, everybody has talked about $40 an ounce of a possibility, and as early as the month of August. Interesting report coming in from Citi, where they believe that $40 an ounce for silver will come in 3 months, and they are anticipating $43 in the next 6 to 12 months as well. So bullish cues coming in across from banks and brokerages as well, and fundamentals in any case are quite bullish.
Okay, all right.
Okay, all right, Manisha, thank you very much for that. Well, with that, we do have to take another quick break. On the other side, Lata is in conversation with Mr. Puneet Chhatwal of Indian Hotels. The company's come out with a very, very solid set of numbers for the first quarter. We get an outlook for the rest of the year in just a bit. Welcome to Corporate Radar. Indian Hotels' first quarter revenue growth has been about 32%. Profit has grown even better by 36.4%. Though these numbers, I must say, are higher partly due to the consolidation of TajSATS. Now, margins at 28.2% also remain very impressive, even if this is a bit less than a year ago, which was at 29%. Also, the company has aggressive expansion plans. And on that note, let me welcome Managing Director and CEO of the company, Mr. Puneet Chhatwal. Mr. Chhatwal, thank you very much indeed for your time, and many congratulations on a day when the market is down, the stock is up, and it's been doing very well. Give us an idea of what is pushing this growth at a time when one would have thought it's a difficult quarter because of Sindoor. You would have lost business in Kashmir. The plane tragedy. In spite of that, it's a good number that you have done, even unconsolidated. What were the top 3 reasons that's working for you?
So, thank you, Lata. The first important reason is the strength of our brandscape. we are not anymore dependent on just one business or one brand. So the diversification of the brandscape and the diversification of the top line is a consequence of that. Number two is our asset management initiatives, which we have undertaken since several years. It's an ongoing thing that helps us to drive operating leverage in our capital heavy portfolio, which is today 40% of the total. And finally, very important are not like for like growth on capital light model. So our management fee income increase, if you see for the quarter, the number that we have used to be the number for the full year 5 years ago. So what we are doing as a management fee income, despite whatever you said, Operation Sindoor, geopolitical tensions, airline tragedy, etc., helps you to drive margins. And the little dip that is in the margin is because of a one-time adjustment we have made in the salary increases. We are giving it as of this year from 1st of April versus 1st of July. So in Q2, Q3, Q4, the increase will be a little lower because it's now divided over a 12-month period.
Okay, actually, your answer is throwing up a lot more questions. I intended to go in a sequence of margins and number of hotels growth. But you spoke about this management light concept or practice. You know, in the investors, after the results, you also spoke about the new Tata Sons platform for investment in select assets. Is that more of the same? That Tata Sons does the construction, you become asset light and earn more management fees? Is that how it will work?
Yes, they would be the owner of the asset, and we would have. We prefer, unless it's a Taj branded property, if it's a Ginger or a Vivanta, we would go for a revenue share model. So we also own the business. And I think it's really geared towards the new businesses and how to support that as another source of capital. And we are very pleased that it's finally happened, this platform, with the first asset coming at the Kolkata airport.
Okay. Well, then let me come to the here and now and then go back to your longer strategy questions. Q2 normally is a weak quarter, isn't it? At least in my community, we don't perform marriages during Ashad. So how is Q2 likely to perform? Can we again get this headline in your press release, 14th consecutive quarter? Will it be like that or will it be different?
We want it to be like that. We don't want that kind of formula to change. So we would like to come back and say this was the best ever Q2. Not just that, what you said, Q4 is the third strongest. We are coming from a sequential basis. And if we look at the weakest, it's always been Q2 in that order. So Q3 is the strongest, Q4 is the second strongest, then you have Q1 and then you have Q2. But the way things are going, there is nothing that makes me feel nervous about Q2 not working out well. On the contrary, I actually feel that again in Q2, especially the international contribution would be very positive, like it has been in Q1 from US and from London. And these are pretty big assets or big sources of revenue. So we remain fairly optimistic about the performance of Q2 also.
Okay. Well, let me come to expansions. You told us in the press release you opened 6 new hotels and signed 12 for this quarter. That would make your portfolio, what, 392, is it?
Absolutely right, Lata. It's impressive.
Okay, no, I just did the numbers now. Now, does this look like then that your 2030 goal will be achieved earlier? You did that with that Avahan, if I remember right. You know, you all did it a year earlier. So your 2030 goals also may happen earlier?
You know, we always say, I can only keep repeating that we promise, we deliver, and in an ideal world, we deliver a bit more than we promised and a little earlier than the deadline that we have given. It has happened twice with Aspiration 2022 and Avant 2025. In an ideal world, Accelerate 2030 should do the same.
Okay.
Well, let me come to these other businesses you spoke about. Lately, Taj is not hotels. You all are defining yourselves as, shall I call it, the hospitality ecosystem. You have Amas, you have J Wellness, many, many innovative ideas. Would there be more? Are you all thinking, not for this quarter, not for necessarily only this year, but are there any such concepts that you have in mind?
Absolutely. There are many others that we could do, which have not even come in a significant way in India. One of those, based on my past experience in Europe, is, something like all-inclusive, where you go, you buy a ticket for a flight, and your transfer from home to airport to the hotel and a 1 week stay with the family and coming back has just one price for a family of, let's say, 4. We haven't even gone anywhere close to that as a company, but also as a sector in India. And I think in a few years from now, this will come. Similarly, extended stay is a very important component. It's at a very, very infancy phase in India. So a lot of these new concepts, new businesses, service departments, etc., will come also in a big way as India continues to grow. And becomes the 4th largest, or has become the 4th largest economy, and will become the 3rd largest. So all these concepts will also come. And we, being at the forefront of this sector, will obviously try to develop these concepts. Also, belonging to a group that has significant other businesses and can be assisted through whether it's getting, the cars or getting the planes, we stand to benefit a lot from the synergies that a group can offer. So we will always remain open, and any idea that makes sense and is scalable. Very important, we will not do a one-off and stop there. Any idea that is scalable, related to wellness, related to extended stay, related to all-inclusive, and continuous innovation of what you already have, we will try to execute on that relentlessly.
Okay. Well, now let me come to the tougher part of the business. So many hotels, so many ideas would mean rapid training of staff. Are you seeing that as a challenge, both in terms of numbers and cost? Will that be something that will take away from margins or take away from quality?
Firstly, I'm very glad you asked this question. So quality, the test is with institutions that are neutral. I'm sure you read it. Taj was again rated as world's strongest hotel brand and India's strongest brand across all sectors. This is the 4th year in a row, and world's strongest, twice. We have had it in succession, and before that also twice in succession. So that is the proof in terms of the quality. But when it comes to training, it's a very important factor for us. And since last 3 years, we embarked on the journey of upskilling our people at all levels, from an apprentice to management trainee to middle management to the top management, absolute people in the executive committee of the company. We are spending a lot of money in doing that. And more importantly, under our ESG Plus program called Pathya, which just celebrated its 3rd anniversary, we have committed to skill 100,000 people by 2030. And we have achieved the number of 31,000. We've opened 52 skilling centers as part of our CSR contribution, plus our work with Tata Strive. To contribute towards nation building, to contribute towards skill building. And I think all in all, not just for us, we are doing our utmost to contribute to the sector at large, but also the younger population in India, taking them from their rural sectors and skilling them rapidly and making them fit for working in our sector so that they can benefit from our businesses.
Okay. Now, I'll tell you, there are some of your very elite customers who have a different kind of complaint. Because the general upper middle class, the rate of growth of that class is high, its consumption proclivity is probably high. Look at your occupancy. I mean, 75% year after year, quarter after quarter. And I guess in TMPT, in Taj Mahal Towers, you You may be going at over 90%. There are your elite customers who say it sometimes looks like a bus stop. It's just that the number of rich are more. So do you even think of a super brand?
Yes and no. So we are always looking at brands, but the Taj Mahal Palace Tower is not just the flagship of the Taj brand, is not just the temple of hospitality, as we affectionately call it. It's a national monument. People who come to Gateway of India just come in there and just to see the lobby, take their pictures with the flower arrangements. And that's something we have to learn to live with. We cannot just close our doors to the national population, because when there is also something bad happening, like the terror attack is also called the attack on the Taj, right? So it comes with both positives and this kind of challenges. But we are all in all very pleased with such an iconic asset. And the more the people come, the better it is. And some who don't like, we will create a new entrance for them from the back so that they can avoid the traffic if they so want to. These were closed because of that terror attack. It's not that those entrances did not exist before. All the planters that you see in front of the property and the other entrances that were closed were done for security reasons. And we are in conversations with the city and the police to slowly start opening on those.
Okay. No, actually, this is an extremely humane, so very Tata reply that you are giving. I mean, it's something to be appreciated. But actually, I was not referring only to the Taj Mahal Palace and Tower. I mean, generally, there are your very, very elite customers. We get a lot of CEOs. Our daily job is to meet some of the super rich. There is a feeling that, there is a crowd of upper middle class which is now there, and the exclusivity, therefore, in some of your other hotels is lost to them, to this very small sliver. But that discussion another day, out of time, numbers very impressive, and all the very best for the next quarter, Mr. Chhatwal.
Thank you, Lata. Thank you for having me.
Well, that's the word. At least we end on a high note in terms of a company, its performance and its stock price in the green. But otherwise, it's a lot of red on the markets today. Chartbusters will take the action forward after the break.
Axis Bank is the top Nifty loser, trades with cuts of over 4% as slippages rise sharply in the first quarter. Management attributes this deterioration to technical factors and expects slippages to remain muted going ahead.
Wipro is the top Nifty gainer, up nearly 3% after the first quarter numbers meet estimates. The management also tells CNBC-TV18 that they're seeing strong deal momentum and that they expect the second half of the year to be even stronger.
Shares of Tata Communications gains after reporting first quarter earnings. The margins expand sequentially. The management tells CNBC-TV18 order book position is stronger than last year.
Nuvoco Vistas trades high after the profitability recovers in the first quarter, driven by focus on cost as well as sequential jump up in realization by around 5%. They also go ahead and reduce their debt. Overall, the stock is trading high with a gain of 3%.
Shares of Clean Science fall over 6%, 7% now as the management expresses caution on meeting its EBITDA growth guidance of 18 to 20%.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you can see at the top of our screens, well, the markets are under pressure. The Nifty is now down closer under 170 points. We're at a very, very crucial juncture because now the Nifty has gone below that 50 DMA. We have broken that 25,000 odd mark. Remember, that's a 50% retracement of the recent bounce that we saw. It's the recent low. It's where the 50 DMA is at as well. So this range of around 24,950 to 25,000. By the time we wind up, you'll want the market to get past those levels. The problem today is the Nifty Bank. That's down more than 500 points. Axis Bank's numbers were weakish. But to be fair, that one is holding above the day's low. So the first hour lows, it's defended out there. But the other larger banks, in fact, have come in for some profit taking. So the markets need to reverse. It has to be reversed from this sort of a zone because that's where the important support lies in it.
Absolutely. A lot of put writers at 25,000 as well, Nigel. The important part, however, for the Nifty Bank is that yesterday, after a very long time, it broke below its 20-day moving average. So let's see whether that weakness sustains or not. And even despite the up move that we're seeing on Wipro, the IT index, the other IT heavyweights are not supporting the cause of that index. So both the heavyweights, both the Nifty Bank as well as the IT index, currently at the low point of trade. So we have the IT index lower despite the Wipro stock being higher by about 2.5%. Broader markets not doing well. In fact, straight off the bat, we have 1,800 stocks which are declining for about 700 stocks which are advancing. So the red and green lines far wide apart and makes your portfolio look a little weak on this Friday morning. Take a short break. In fact, as we do that, we'll get you some ideas for profit coming in from our colleagues at Money Control Pro. Jitendra Gupta joins in with a stock that he's tracking.
We think Bharat Electronics is one of the few structural growth stories riding on the defense spending, supported by its market share and capabilities. Moreover, fundamentals are improving now on the back of strong order inflows and execution. In Q4, if you look at BEL posted a healthy 6.8% jump in revenue. EBITDA surged by almost 23% on a year-on-year basis, and margins expanded by around 400 basis points, led by higher, led by favorable revenue mix. The company's order book now stands at around 72,000 crore, which is nearly 3 times its annual revenue. With fresh orders from the naval indigenization, S-400 system and BrahMos subsystem, BEL is building strong revenue visibility for the next 2-3 years. The management has guided 15 to 17% revenue growth this year, and it is targeting 20% annual growth after for the next 4 to 5 years. The company is doubling its R&D expenditure, expanding its capacities, and exploring global defense market, including Europe, where we have seen some uptake in defense budget. On the valuation front, stock is trading at 45 times its fiscal FY27 estimated earnings, which is good considering strong earnings visibility and increasing opportunities in the defense.
Welcome back. You're watching us here on Chartbusters on CNBC-TV18. See it. That's the stock on our radar. The company reported its numbers where revenues were below expectations, margins were under pressure, and we had the raw material costs which spiked as well. The company announced a 450 crore rupee capacity expansion plan for its Chennai plant. Arnab Banerjee, who's the managing director and CEO of the company, now joins in. The stock lower by about 1.5%. Arnab, remember having this conversation with you just about a fortnight ago, where you said that there are some challenges when it comes to raw material, and you see expectations coming by only, expectations of an increase coming by only post the second quarter. Was this magnitude of impact expected? Because no one on the street was working with this number. And how much worse can things get before they get better? And by when do you expect them to get better?
Yeah, good morning. Pleasure to be here. We expected about 0 to 1% kind of benefit in raw material, which has not come through. It is flat, more or less, because of the inventories that we carry. Our growth has been pretty robust. If you have seen 11.5%, so that we will continue to grow in double digit right through this year and maybe accelerate from here. So that part is sorted. Domestic growth has happened very, very well, both OEM and replacement. International business is where we had a flat growth. There were headwinds in almost all the markets because of geopolitical uncertainties, tariff uncertainties. The trade was not stocking up because of these uncertainties. And now looking at the future, the international business where we had headwinds is going to be slightly better in quarter 2 because we have view of the order book that we have, the seasonal order book of quarter 2, especially from Europe has all come in. So we expect quarter 2 to be better in international. Domestic growth in OEM as well as replacement is going to be robust. As far as margins are concerned, quarter 2, definitely there will be a flow through because the inventory consumption has happened with 11.5% growth in quarter 1. So we expect much more benign and lower raw material cost in quarter 2. And we expect to hold our pricing. So the margin outlook is better.
So what is the outlook?
Well, it all depends on many things, right? Exactly how much the raw material cost will come down by. We have maintained that we don't want wild swings in margin. So our margin in the last 2 quarters have been 11.5 and 11 roughly at EBITDA level. So the change in whichever way will also be not a very big quantum jump. It will be in a narrow band, but it will improve.
Okay, all right. Hi, Mr. Banerjee. Good morning and good to see you, Ben. Couple of quick questions. So double-digit revenue growth for the year is on the cards, right?
Should happen.
All right. Exports are going to recover. What about on the domestic front? How is demand shaping up? Because last time we chatted, you were talking about it being a little bit tepid. And though things have been a little bit subdued, have you gained market share?
Yes, we have gained market share in replacement in quarter 1 in both motorcycle, scooter, as well as in passenger car tires. In passenger car tires, we have been gaining pretty good in the premium end of the passenger car tire as well. Truck bus radial has been a steady performer. Coming to the demand side, in OEM first, you have seen YOY, there's a growth in MHCV. Though QOQ, they have degrown, but that happens always. Passenger is growing at low single digit, and the growth rate of two-wheelers is also coming down, especially motorcycle. That's the OEM part. We are maintaining our share of business and growing massively in passenger because the approvals are now coming through in the higher rim sizes. So we will continue to grow well by increasing share of business in OEMs. Replacement, the demand of truck bus segment is about mid-single digits. Here we are going steady. The passenger is subdued in replacement because of lower growth in the urban segment. That demand softness continues and will continue for some more time. Two-wheeler backed by rural and scooter growth is pretty robust, and we have gained market share here. So overall, I think between OEM and replacement across these 3 segments, we expect to have double-digit growth in the coming 3 quarters as well.
All right, double-digit growth in domestic business. What about international? That's about a fifth of your revenues. Are we out of the woods there?
We can't say right now because after August 1, we'll have to see what is the tariff for India as well as the relative tariff of India vis-a-vis the other companies, other countries. That relates to our growth prospect in the US. As far as Europe is concerned, I think the uncertainty has lessened a little bit because our order book for Q2 is very good. But we don't have very good visibility of Q3 and Q4 at this point of time. Q2 definitely is going to be better than Q1.
All right. And what about, the incremental capacity addition that you're doing? Because I remember you going down this huge CapEx plan, wanting to invest 10% every year for growth or invest for 10% growth every year, but not at the cost of your ROCE. We have seen an improvement in your ROCE over what it was, say, 3 years ago. But because of this incremental CapEx, that would be compromised for a bit, right? So what are the lower levels here, and by when do you expect them to improve?
Our ROCE's post-tax is still in double digit, and it is going to improve. This CapEx is going to improve that because we do CapEx in very, very small quantities so that ramp up of capacity is fast. We have very clear view of the demand. This is going to aid the premium end of the passenger car tires market in domestic OEM as well as replacement. And we are seeing market share gains positively in this segment. Our capacity utilizations are 90% plus. So, and this is very, very bite-sized, 450 crores, which will not really impact a company of our size to any significant impact on ROCE. And the international business, whenever the bounce back happens, let's say even if it happens after 2-3 quarters, it's going to add to the margins in this particular segments of passenger car tires.
Well, that, Mr. Banerjee. Final question before we let you go. We've enjoyed a lot of your advertising lately, especially the ones with the wordplay, Slippery Road and Girija Chowk, etc. How much more are you going to spend on ads this year versus what you did last year?
Well, Q1 has been heavy because of our IPL presence also, the strategic timeout, and this advertising is working well. We expect to maintain a 2.1, 2.2 to 2.5 kind of ratio as percentage of sale. If you see, we would like to maintain and this ratio right through the year.
All right, Mr. Banerjee, we'll take a strategic timeout with you now. Wish you good luck for the remainder of this year and hope things improve. We have next management as well.
Well, that's right. Let's focus on Polycab. The numbers have actually been resilient, though government capex is yet to pick up and there is signs of slowdown, but their growth has continued, which is heartening from a shareholder's perspective. We're now joined by the CMD, Mr. Inder Jainsinghani, and also Mr. Tongya, who joins in on the show. Hi, gentlemen. Good morning. Good to see you all in. And congratulations actually on yet another solid showing. Though there's a slowdown in government capex, there's a high base as well, yet your cables and wires business is delivering double-digit growth with stable margins. So good to hear. Let's get a couple of factors out of the way. What was the volume growth for the past quarter? And if you could help us out between the mix, cables as well as wires for the past quarter.
Good morning and thank you so much for having us. You're right, this was perhaps the best quarter as far as the first quarter is concerned. On your specific question on the volume growth, cable and wire business, which contributes 85% to our top line, registered a mid-20s volume growth. Within that, cable grew at a level slightly more than that, late 20s, and wires grew in early 20s. So overall, it was a mid-20s volume growth.
And what is the mix? Mix between cables and wires?
Broadly same, around 70% is cable, 30% is wire.
Okay. All right. So that's about this quarter. Was wondering whether, you will continue this sort of growth going forward as well, because your long-term guidance is mid-teens in cables and wires. So that's the point that I wanted some clarity on. And the standout performance for the last couple of quarters has been FMEG. This despite, uncertain summers, etc., the fans business taking a bit of a hit. Your solar pumps business has done extremely well. So an outlook on both cables and wires volume going forward and the FMEG business with operational performance there.
Absolutely. So you're right. There is a bit of a mixed bag, but we gave our guidance in Jan this year for the next 5 years, wherein we believe we'll continue to grow at 1.5x of industry growth in cable and wire sector. And as far as FMEG is concerned, perhaps a 2x of the industry growth rate is what we would probably anticipate and aim for. On solar, you're right. There is a fair amount of favorable macros there. The government spend is there. We do solar panels and other than the solar as well, the FMEG business has registered a fair amount of growth, right from lighting, fans, switches and switchgear. On that, we believe the profitability will continue to grow. It was around 2% this quarter, break even in the previous quarter, and between now and 2030, we should be able to get to almost 10% of EBITDA margin in FMEG business.
Okay, all right. Let's talk about margins. You have reported a margin improvement of close to around 200 basis points. How sustainable is this number? If you can help us out with that.
I'll probably take you back to 2030 guidance, wherein we have suggested that FMEG will improve its profitability from 2% thereabout to almost 10%. And in cable and wire, historically, we have been guiding for 11 to 13%. There were a few quarters wherein the numbers were better than that particular range. We believe that we should continue to aim for a similar guidance of 11 to 13%. There are some upsides possible. For example, exports business, if it improves meaningfully in years to come, it's quite possible that we are able to beat our own guidance.
Now, exports, there's been a good improvement actually on a year-on-year basis, but on a sequential basis, there's been a bit of a dip. I know your guidance is to get to that 10% odd mark, but for this year, how much will exports contribute? And are you seeing a fair bit of traction? Because, with competition heating on the domestic front, all eyes are on exports as well. Not in the near term, but in the next few years, that could be a big driver as well. Tell us more.
Absolutely, you're right. Exports is going to be a good driver for us as well as for the industry. We already have a presence in 80 plus countries. We have many international approvals, for example, for the geographies like US, Australia, Middle East, and EU. You're right. We are aiming to get to 10% of top line contribution from exports business. And generally, we are of the view that every year we should be able to improve on it. We are hovering around 5%. Every year there should be some improvement.
All right. Every year there should be some improvement in exports. Domestic, obviously, by the announcement of large players entering this space, everyone's wondering how the situation will play out. But we leave that for a longer term discussion as and when, they enter the marketplace and products are out for everyone to see. But Mr. Jaisinghani, I wanted your thoughts, in particular on the BharatNet opportunity. Time and again, we see news pieces of you bidding for that, you getting some more opportunities. What is the total addressable market here, and what is your opportunity possible here over the next, say, 1 or 2 years?
This is basically a long-term project, which is a government one that every village has to be Wi-Fi connected. So, which is a project we are taking has to be complete within 3 years. And again, new tenders will come. So already we got Karnataka and 2 states. I think so 1 or 2 states will take more, and we'll see that how best we can do. Our full team is ready for that, and already work is started in Bihar and Karnataka both.
But how big can this business be? Gandharv, if you could throw in some numbers here, what is your current orders coming in from BharatNet, orders on hand, and what is the addressable opportunity here? How much can you get over the next 3 years?
Basically, around about 8 to 10,000 crore already we got the order, which is we have to complete within 3 years, and which we are going to start from October onward. But again, we can think that we can take 5,000-6,000 more, because it has to be complete within 3 years. It cannot be prolonged.
Okay, 8 to 10,000 crores is what you have already. You can expect to get around 6,000 crores more worth orders.
Yeah.
Has to be completed over the next 3 years. Is this at a lower margin than the other businesses? And what are the receivable days on this?
Reasonable margin. Payments are very good. Once milestone you are completing, you will get the payment. So it is on milestone system. And again, we have to do the maintenance services for the year also.
And margins are in line, right? Receivable days in line, both are in line.
Yeah, both are in line.
Okay, got it. If you could also tell us, your market share, you'll have been outgrowing the market. In the past quarter as well, according to your numbers, according to your calculations, have you all gained market share?
So I'll probably take you back to March numbers, wherein we believe our market share of the organized cable and wire market is around 27%. Directionally, we believe we would have gained some additional market share in this quarter, but I think we'll have to wait and watch for the other companies to declare the results. As you know, we are the first as of now in the industry to declare our Q1 results. Okay. We'll wait for them, and then perhaps in the next quarter, we can talk about the market share gain.
What about advertising expenditure? It's not too large a number, but that's come down by more than 35%. If you could tell us, what should the rough ad spend be as a percentage of sales, and will it pick up from here on?
You're right. It's an important expense line item for us, particularly for the B2C business. We believe in the second half of the current fiscal, we should be able to meaningfully improve. Directionally, it should be in the range of 3 to 5% of our B2C revenue. B2C, as of now, is almost 1/3 of our company's revenue. So that is how we can, think about the B2C advertisement spend in years to come.
And you have a aspirational target of B2C versus B2B sort of business, right? I think it was half and half.
I don't know whether we actually gave that guidance externally. I don't know the source of your half and half information.
I just bowled a googly. Please tell us your guidance.
Yeah. Internally, what we believe is we'll have to continue to grow at the industry level. We'll probably aim for growing at a rate which is going to be significantly better than industry growth rate and gain more market share. As of now, government capex is positive, which is helping us in growing our B2B business. We are trying our level best to make some inroads on the B2C side of it, both on the retail buyer and.
But half and half, give us the mix. Give us the mix. You know,
coming to that. Both the businesses continue to grow. It's difficult to imagine that we would be able to get to 50-50. We are hovering around 70-30. Hopefully, we would be able to improve a bit on the B2C side, but B2B business is doing tremendously.
All right, and CNW and FMEG, do you have a target there in terms of optimal mix?
Yeah, that is already what I was mentioning. The cable and wire and FMEG both put together is aiming for industry-leading growth. Whatever current ratios we have is quite possible over the period we are able to tilt more towards B2C business, but B2B business is doing a tremendous job. So it's going to be a good fun to watch.
And, we have been enjoying our interactions with y'all, as you all moved into profitability on the FMEG side of things and now profitable at some scale. Demerger is something that you all would look at?
I think this is a thought which friends like you have shared with us over the last few years. We have not...
we can share all the thoughts, Gandhar, but y'all are the executors. So,
we have not deliberated on it. At the right time, probably board will discuss, deliberate and see what are the pros and cons and accordingly take decisions. As of now, there is no current proposal.
Inder, Gandharv, thank you so much for joining in. We've been bowling googlies at you time and again, and you've either decided to leave it or just defend it out here and say that, okay, we will probably go ahead and do things as and when the time comes. Thank you so much. Thank you for joining in.
And solid form today. And thanks a lot, gentlemen. Numbers speak louder. So thanks a lot. And looking forward to chatting up with you as the year progresses. For the time being, slip into a short break, come back, focus on markets and stock-specific action.
Even as the market's lower right now, 160 points on the Nifty at the lower end of today's trading range for the frontline indices, all of them. We have Indian hotels that opened mildly in the green, saw a bit of a dip, and from there it's moved higher as well. The management continues to believe that things are looking good for the hospitality sector from here on. Over 3,000 crores of cash on their books. With that, we'll wrap up on this edition of Chartbusters. Thank you so much for watching. The team of Trading Art comes up after this short break.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormis Fatakia and Reema Tendulkar. It's a Friday, so happy Friday first up, guys. Finally, the week is ending, but it's going to be a long day. But nevertheless, for the Nifty right now, we are seeing some stress come by. So Nifty is at the lows of the day as we speak. Of 170-point cut is what we are looking at right now. It's actually further accelerated, so it's almost a 200-point cut right now. It's the private banking index which is putting some pressure. Financials overall are not doing so well. We had Axis Bank's results which were reported yesterday. We'll discuss that in greater detail. For now, of course, that is one stock which is putting some pressure right now. And all the sectoral indices, they are in the red right now, barring Nifty Media. But yes, major pressure coming in from across the board. So we'll be watching out for whether this pressure continues or not. Wipro, though, is doing well after the numbers that the company reported. Reema, of course, will analyze those numbers in greater detail. We'll get the management commentary as well. But all in all, the start has been on the back foot. We'll have to see whether that continues through the day or not, because we do have a lot of earnings trigger which will come by.
Three big ones, right? Post-market hours. So Reliance, ICICI, HDFC Bank. So that will set the tone for Monday. So it's a big week in terms of, I mean, the next 12 hours is going to be big in terms of earnings, 24 hours. By the way, for the Nifty, we've breached the 25,000 mark as the Nifty is down 170 points at the day's low right now. Sensex is below the 82,000 mark, 600 points lower. Benchmark indices in percentage terms have dropped close to about 0.6%. And I think this is the lowest level. For the first, we breached the 25,000 mark for the first time in about a month.
Yeah, 24th of June was the last day when we did that. And yeah, 3 stocks, a third of the Nifty in the next 12 hours. So important results that are lined up as well for the Nifty going forward. And 165 points down. As of now, we started today's trading session just 40 points down for the week. There was still some hope that the weakness in Axis Bank could be offset by some of the other names, but unfortunately that's not been the case. Axis Bank, though, is still holding on to losses of around 4.5%, but Wipro on the flip side, though, is doing fairly well for itself in today's session. There are some of the stocks that are bucking the trend in today's session. Saregama is one of them, 6% higher on that stock. They announced some content acquisition yesterday, and so a good move on that stock today. Motherson Sumi Wiring is the other one, not Samvardhana Motherson Sumi Wiring, the demerged entity, 44 rupees on that stock, 3% higher there. The stock trading ex bonus today is yet to adjust for it. So that's the adjustment for the bonus issue. Anand Rathi Wealth is the other one. Anand Rathi Wealth is the top performer on the Nifty 500 this week, is up 20% this week, so 2.25% higher, strong results, and is building on to those gains. So a lot of stock specific action in today's session, as well as has been the case all through the week as the index has been consolidating, and now it's seen one big down move towards the close of the week. But the stock in focus, though, has been Axis Bank, and the results have been much talked about all through last evening and this morning as well. It was a disappointing quarter. Asset quality deteriorated, profits that dragged profits, and provisions were high, slippages were high. Gaurav is here with the fine print of that. Gaurav. When it comes to Axis Bank number, we saw a weakness, and this was specifically because of the asset quality. So let's understand the numbers first. First disappointment was in net interest margins. Now they declined almost by 17 basis points on a quarter-on-quarter basis. Bank has suggested that 4 basis points was basically because of the interest rate reversal, and that is the reason they have attributed this 4 basis point to this and 13 basis point to repricing. Another disappointment, the big one, is the asset quality. Now what they have done is that they have actually changed their provisioning norms. They have actually made it more stringent, and as a result profitability impact was somewhere in the range of 620 crore rupees. So let's understand these numbers as well. Because of these stringent provisioning policies, provisioning increased almost by 800 crore rupees in this quarter. Other than that, gross slippages came at around 8,200 crores. Now, if we exclude this provisioning and the technical impact, the gross slippages would have been at around 5,900 crores. Now, that is another impact, and as a result, we saw credit cost and slippage ratio specifically increasing sharply. Now, because of this, when we talk about the ROAs and ROEs, these ratios were also impacted. ROAs got impacted almost in the range of 15 basis point, and we saw ROA impact of 1.4%. So definitely what was disappointing is that these provisioning, the stringent provisioning norms are actually taking a toll on balance sheet. on the back of this, now management is saying is that slippages are likely to come down because now the recoveries will come, and that is the reason for the quarters coming ahead, slippages will be muted, and because of the recoveries, credit costs will come down. On the other hand, loan book growth was at around 8%, and now management believes that this will actually pick up. They believe that Axis Bank can actually grow at a pace higher than the industry. So that is something which was optimistic commentary from the management. But overall, in terms of number, weakness is what we saw, and as a result, we are also seeing some weakness in the share price as well.
Okay, yes, 4% lower on Axis Bank. Thank you for explaining that to us, Gaurav. In fact, the management in the conference call said that they are confident about growing faster than the industry, and also they spoke about technical impact. Listen in to what they had to say.
NPA classification happens on days past due criteria, and then there is qualitative criteria which is agnostic of days past due. We have not changed any day past due parameters because they are driven by regulation. The qualitative parameters, as we have previously indicated, we benchmark to most prudent in market on an annual basis. That benchmarking exercise happens for us in the period of Feb and March, and the implementation of that happens from the next fiscal. The purpose of the benchmarking is to make sure that our balance sheet is resilient and can withstand any credit cycle that comes our way, therefore giving you a robust, credible outcome when growth comes back. So roughly, if you look at what we do is Q1 and Q3 are cyclical, and the way I would request you to think about it is in Q1 and Q3, about 25% or thereabouts of slippages are from the agri portfolio. So you could apply the maths to 5,400 crores, and roughly about 25% or thereabouts would be agri. The percentage would be broadly similar for last year's rupee crore number. The rest of the 75% is coming entirely from the unsecured business. We are very clear in making a call out saying we do not see stress in the secured part of our retail book as on date.
When Rajiv retires in August, as per expectations of RBI, we need to have MD, CEO and 3 EDs. Our NRC is actively looking at who and when we appoint a third person as executive director of the bank. When we're ready to do that, we'll be very happy to do it, but you should expect announcement of ED appointment as Rajiv retires. So that's the answer to one of your questions. Second question, I thought I answered in detail in the response to the first question, which was, yes, credit growth is where it is, but our confidence about what we can do the rest of the year and in the medium term, given where our platform is high. We are expecting to grow faster than the industry. I mean, obviously that's an expectation, but we are quite driven towards ensuring that we can deliver that output.
The management there of Axis Bank after their quarterly results, of course, there were a lot of things that needed to be explained, and they did so during the earnings call. But the other one that was reporting results yesterday was Wipro. Are there any hopes of improvement going forward? At least the guidance seemed to suggest so.
Indeed. So in Q1, the company reported a -2% growth. The Q2 guidance is -1% to +1%. Now, assuming the company meets the middle of the guidance, we're talking about zero growth, which means it's a 200 basis points improvement in Q2 versus Q1. And typically, Wipro meets the guidance. They've roughly, on an average, achieved the midpoint. So that points to Q2 being better than Q1 by about 200 basis points. Then the company said that given the large deal wins in the pipeline, they're confident that H2 is going to be better than H1. And they also said that when asked that do you think FY26 will be better than FY25, he said, I think so. So it's possible, right? The second positive is, or which underpins this entire confidence, is the deal wins. Deal wins were very strong for the company. The deal wins came in at nearly $5 billion, $4.97 billion, up 24% quarter on quarter and up 50% on a year-on-year basis in constant currency terms. This also includes a lot of large deal wins. What the company said is that these deal wins, because they're in cost optimization or vendor consolidation, they're fiercely fought. They're competitive. So there is going to be pressure on pricing. There is going to be upfront investments which the company needs to make, but they are looking to offset that with operational rigor and excellence and all the levers that they have, and try and perhaps, in the past at least, they've spoken about maintaining margins in a tight band. They didn't say so this time, but we'll have to watch the way the margins go. But at least in terms of a top line, their priority is growth. Listen in to the management.
So there is this very strong deal momentum that we have had in Q1, which we trying to carry to Q2. Of course, some of these deals will take its own time before we start ramping up. Second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
For those deals to really translate into revenues, it will require upfront investments. There will be pressure on costs. That large deals typically come at lower margins, and there will be some pressures that we will have to offset. We will go back to that muscle of operational excellence that we will continue to drive. And those are the puts and takes on margins. We don't guide for margins, but we are happy with our performance in Q1, an 80 basis points improvement. And from there, we will take it. I think in Europe, we've had, for the last 4 quarters, we've not performed as well as we ought to have. It has been a combination of the macroeconomic environment, lower discretionary spends, but also certain client-specific issues that have played out. We believe we are very, very close to bottoming out. We have a large deal win that we've secured, and also some very good deals that we've also secured in Q1. Our pipeline is good, strong. So we are very, very hopeful of Europe bottoming out and coming back into performance starting second half.
We had given a wage hike last year in September. We haven't decided what's the plan now. We'll review it closer to the date based on the macro environment, demand situation, what's happening, and we'll take a call. So nothing, as soon as we decide, we'll let everybody know where we stand.
Okay, we'll slip into a break on that note. We'll come back and discuss what's buzzing in the commodity space. Manisha Gupta joins in on the other side.
Welcome back. Still 150 points lower on the index. Shifting focus now to the commodity side. Manisha is here. to talk about cryptocurrencies, and Bitcoin is back near their all-time highs, just continues to move higher, does it, Manisha?
Well, it does. The way it has been going and the way we're looking at very positive news coming in from US clearly tells you that there is more support or steam left in case of cryptocurrencies there. So when you look at Bitcoin, well, yes, $120,000 is back onto this one. All-time high has been at around 123. So not too far away from those kind of levels. And if you've been tracking Bitcoin, you do know that it moves very fast when it comes to that. So in the last month, we've seen Bitcoin gain up by 15%. But it's not just about Bitcoin. If you look at the altcoins, Ethereum for that matter, is gained up by 44% in the same time. Well, just let me tell you that there are at least 5 to 15,000 cryptos that are perhaps launched on a daily basis. And that's how they get lost as well. But it is 2,000 cryptos which are actually strong, active, have a very strong market capital as well. And within this as well, 50 is something that you will need to perhaps keep an eye on, follow, watch as well, if you were looking to invest in cryptos as well. But what I want to talk about today is, it's the crypto week right now, this one. And we have seen a lot of deliberations go through in the US ahead of that. And what we finally do understand is that the 3 laws have been passed by Senate onto this one. One is Genius. Remember, we've been talking about that. It is the guiding and establishing national innovation for US stablecoins. This is something that there has seen a lot of push come in as well. The second one is Clarity. Now, this is about establishing a stronger market structure, a friendlier one when it comes to many of those cryptos. And the third one is Anti-CBDC Surveillance State Act. What we also do understand is that Clarity is something that you could be looking at the US, rather, Genius is something as an act which the US president perhaps could sign on in today itself. And the other two, Clarity and Anti-CBDC bills, will go in for further discussions if there is an amendment or not. And then it would land into the White House for further signing as well. So it does seem to be moving pretty fast. And this is exactly what is giving a lot of comfort and support in sense of the pricing there.
Okay, makes sense. Thank you so much for explaining that to us, Manisha. That's about the crypto world. But it's a good time to get a technical check on the markets as well. Mitesh Thakkar is joining us now. Mitesh, we have broken that 25,000 mark. That's been the case for a while now, today at least. Can you explain what are the next levels to watch out for on the Nifty? Seeing that sharp cut that we are seeing today, the lowest levels that we've seen in a month almost.
On the Nifty, I've been advocating a test of possibly 24,900. We got a low around 24,985. So in that sense, we have reduced our short exposure. I'm still looking out if this level of 24,900 holds. In case there's a lower, then we'll cut an exit or shorts and even explore longs. But in case we start breaking below that, we'll get back into adding into short position. So that's the way we are approaching the index.
What about specific stocks, Mitesh?
Since we are believing that we are close to support levels, I have a buy on NMDC with a stop at about 69 for targets of around 74, and Oil India is another one, a buy as well. Keep the stop just below levels of around 443 and for targets of 465.
Okay, thank you very much for that, Mitesh. We'll slip into a break. On the other side, Ravi Chakar from All Cargo Group will join in to discuss their FY26 outlook and much more. Stay tuned.
about that.
Welcome back. You're still tuned into Trading Hour on CNBC TV18. All Cargo Group is in focus on the back of its restructuring process, the recent capacity expansion in the group companies, and a lot more as well. To discuss this, we are now joined by Ravi Jakar, the Director of Strategy and Group CFO of the group, joining in now. Mr. Jakar, good morning. Thank you for joining in. Well, there have been a lot of updates with the group recently, but let me first speak to you about the capacity build-up and setting up of new container freight stations, or ICDs, as well. What kind of capacity expansion are you planning? What is the capex that you'll be putting in, and how will you fund that?
It's a pleasure to be on your show. Let me start with the all cargo terminals business. That's where we have all our container freight stations and ICDs. So primarily in that business, we are the largest CFS operator in the country, and the business has been doing good. We've been running close to full capacity across facilities across the country. What we intend to do is we intend to add capacity in JNPT, in Chennai, and we have been speaking about an ICD North, which is also now progressing well. The land acquisition part, which is in a group company, has been going on well too, and we would be in a position to start developments on that property within this year. So we believe that we can set up a couple of new CFSs and the ICD. In terms of funding, we believe there are multiple opportunities. To begin with, the board has recently approved an issuance of preferential allotment to the promoter group, which has been concluded and is now will be subject to the shareholders' approval. We would evaluate other opportunities for fundraise, but in that business, it's a very strong operating cash flow generating business. So we believe internal accruals will also pave way for the growth required in the coming years. But we see there's a strong opportunity for us to grow because with the addition of new facilities and new capacities, our constraints on growth will be removed and we can continue to outgrow the market on the CFS side. On the ICD side, it's almost like a new product for us. While we have a CFS in the Container Corporation joint venture that we have in Dadri, this would be a much larger standalone ICD that we're developing in NCR, in the heart of NCR industrial area. So we expect that it would still take about a couple of years to fully operationalize, but that's the long lead development in terms of setting up infrastructure and all the approvals, etc. But these are the key plans to expand capacity on both CFS and on the ICD side as well.
So you will be expanding capacity, but what will the capex number be?
So it would be a combination of asset light and asset heavy, in the sense that, we would try to get into some of the operating leases. Like in JNPT, we are looking at expanding capacity by almost 30% with the addition of new facility, but that will be on an asset light model. In Chennai, we are evaluating both models right now. In ICD, there'll be some capex required. So we estimate that the total capex requirement over the next 3 years could range anywhere from about 150-200 crores to about 350-400 crores, depending on the final dynamics of our strategy, whether we go asset light or asset heavy, because both options exist. But it would be a reasonable investment in terms of capacity and in terms of capex, also from the company's standpoint on all cargo terminals.
What will this mean for all cargo terminals' overall top line? I mean, you ended last year with a top line of about 750 crore rupees, and I think in Q4 there was a loss also. With so much capex coming on stream, in 3 years, what do you think your top line would look like, and what would it do to your margins? I mean, what's the big picture here?
Yeah, so I would say, with the new capacity addition, we believe that over the next 3 to 4 years, there should be an opportunity for the company to grow in the range of 15 to 20% kind of a compounded annual growth rate. That's the broad target around which it is being planned. And in terms of return on capital employed as well as for the new projects, these are all significantly higher than our weighted average cost of capital. So these all will be financially value accretive from that standpoint. And speaking of the performance on the operating cash flows, the operating cash flows have remained positive for last several quarters. There could have been, one-off depreciation line items that you were possibly referring to on goodwill depreciation or around the brand, etc., on some past acquisitions, which potentially leads to, a decline on the bottom line. But from a business standpoint, the operating cash flows have remained steady and consistently positive over last many quarters, and would continue to remain positive and also grow from here on, because we don't see any negative, headwinds for the business.
Ravi, good morning. Thank you for joining in. You mentioned about all cargo terminals. Shifting to the logistics business then. Well, how has the quarter been? If you could tell us that first, the quarter that just ended in June. What are the trends that you are currently witnessing? And based on those trends, what are the kind of volumes that you're likely to deliver both on the full container load and the less than container load businesses for the full financial year? If you could share a number on that front.
Like always, we'll have to refrain from material guidance on the numbers, but I can give you a flavor. We have been updating the numbers on a monthly basis. The June quarter has remained subdued on the international business. We have not seen any momentum until the June quarter. It is also very customary for May and June months to be low, and typically it's the month of July from which the trade pickup happens globally. This time, while there was a bit of a confusion around the tariffs, and that led to a volatility within the months of April and May, now that we are into almost third week of July, we are seeing the momentum come in on the international trade like every year. And we believe that going by the trends of the first 3 weeks, what we have seen, and also some of the inquiries into the next couple of months, we believe we should see some momentum in terms of the international trade picking up over the next 3 to 4 months, which is the shipping cycle. On the domestic side, again, we have seen volumes picking up ahead of the festive season. So I would say April to June quarter, subdued on both domestic and the international business, and a good momentum from July onwards.
Got it. Thank you so much, Mr. Jakar, for joining in and telling us what's happening with the group overall. That's the word coming in from All Cargo Group. With that, we'll quickly take a look at what the markets are doing, because there's been that fall that we've been talking about. Still that cut on the Nifty below that 25,000 mark. It did see a recovery from those levels. So it's very close to that 25,000 mark. But nevertheless, we are seeing those cuts in the benchmark index as of now. From the Nifty pack, the movers, let's talk about that first up. HDFC Life, that stock is at the day's low. We also have Maruti Suzuki, which is putting some pressure. Though it is flat, it is still at the day's low as we speak. The Sun Pharma, Asian Paints, Titan. Reliance Industries is the other one. That stock remains in focus. We have the numbers coming in from Reliance Industries today. The company will be reporting numbers. It's post-market hours, but it is expected to be a good quarter for Reliance Industries. We'll discuss that in greater detail in just a bit. Wipro continues to do well. We had Tata Communications as well that spoke to us today. That stock is up around 2.5%. Delivery is the other one which is doing well in trade. That one is up around 1% right now. A lot of earnings reactions that we are looking at. For instance, Clean Science is down 7% as we speak. We have Nugent Software, which reported numbers yesterday during market hours. It was down around 6%. Additional 5% gone today in trade as we speak. So it's a very stock-specific market. The mid-caps continue to see a bigger cut. The advanced decline ratio absolutely in favor of the declines right now. So we'll keep tracking market moves for you. There is a recovery, a swift recovery from the lows. We'll have to say whether we build onto that or not.
There's one more company, Route Mobile, and I think that's also slipping in trade. That's down nearly 4%. It's reacting to its numbers, and it was a weak set of numbers. The company's revenues declined both quarter-on-quarter and on a year-on-year basis. Route Mobile, this is a company which, it's a CPaaS provider. It basically, every time you make a transaction, for instance, you're buying something on Myntra or Flipkart, all the SMSs that happen between Flipkart, your bank, and you are routed via Route Mobile. They provide that platform and the service. And 10% decline in revenues quarter-on-quarter. Year-on-year revenues were down 5%. Margins came down to single digit. And the company said the international business is struggling. The domestic business is doing okay, but here the realizations are lower. And then the company also, terminated certain low margin kind of contracts. So that stock is down close to about 4%. Get into a break. On the other side, market fundamentals with Mukul Kochar from Investec Capital lined up. Welcome back. Let's now find out the big movers and shakers of the day. Hormus has now moved over to the big wall. Hormus?
There's been significant movement in the broader markets all through the week, even though if the index has been consolidating. But you start off with some of the top losers then, and there have been significant ones in reaction to news flow, in reaction to earnings. And Nugent Software is one of them. It came out with results yesterday, and since then the stock has been on a bit of a downtrend. The stock ended 6% lower yesterday. The results were weak, and in fact the stock has now declined in 7 out of the last 8 weeks now, and the stock is now set for its worst weekly performance. This 10% drop is the worst week it has had since January of this year. A star of the earlier days, defense stocks continue to see profit booking, and take a look at this. Bharat Dynamics is down 9. Garden Reach down 7, Cochin Shipyard down 6% this week, and a lot of the other names too have seen losses of anywhere between 2 to 5%. You take a look at them individually. Bharat Dynamics, this 9% fall that we have seen is the worst that the stock would have had since July of 2024. So it shows the kind of moves that defense stocks have seen over the last 12 months. You take a look at Garden Reach as well, 7% lower this week. The last 4 weeks, 3 of them, the stock has ended lower. This Cochin Shipyard and Garden Reach, of course, down 6% this week, and that too is the 4th straight weekly loss, and from those levels it has declined 21% in the last 4 weeks. Some of the one other significant mover on the downside this week is Inox Wind, and in fact the stock had seen some very significant uptick in volumes over the course of this week, and the 2nd straight weekly loss, and this would be the worst week since March of 2025, this 7% loss that Inox Wind has had. Of course, there are some names that have bucked the trend, and Anand Rathi Wealth is among the top gainers this week, 20% higher for the stock. The 7th straight weekly advance for the stock. The results were strong, and since then it's continued to build on those gains, and this is turning out to be the best week that the stock has had since it listed in 2021. Some of the other movers, Newland Laboratories is the other one, 18% higher this week, and this is the best week that the stock has had since October of 2024. But despite this up move, the stock is still down 20% from its 52-week high, which was well above 18,000 rupees. The stock currently trading around 14,500. And so the other gainer that we have to talk about are the wires and cables companies. Both KEI Industries and RR Kabel have done well this week. RR Kabel, in fact, has gained all 5 days this week. This is the best week for RR Kabel since May this year. And for KEI Industries, it's the best week since the start of January. A big trigger, of course, Polycab's results that came out yesterday. The convincing beat on expectations, and now that has resulted in expectations going higher that the industry is likely to see a strong quarter this time around. So extremes on both sides. It's been a week to forget, you'd say, for the market so far.
Okay, all right. Interesting list there. Thank you so much for joining us, Hormus, with that top list of movers this week. With that, let's move on and get some fundamental conversation going. Mukul Kochar, the head equities at Investec Capital, is joining in now. Mukul, good morning. Thank you so much for joining in. We have seen earnings downgrades in past couple of quarters. How long before we see a pause to that? What kind of growth are you expecting for Nifty this time around in FY26? And this is happening in a backdrop where we are also seeing rate cuts. So what do you make of that?
Yeah, so broadly, if you look at the next 2 years and the next year also, we are expecting Nifty and BSE 500 to do roughly double digit, close to 10% sales growth. Net, we expect earnings to be 1 or 2% here or there of that. What you need to sort of take into account is that over the last 10 years, inflation in India has averaged roughly 5%. This inflation number is down below 3% today. So of course, with lower inflation, you will have some impact on sales and earnings growth. It's natural, very natural to expect that. But the offsetting feature of that is that interest rates also are down because of lower inflation. And also another factor is that demand of money from the government itself is down. They've been consolidating their fiscal. So net, while adjusted for inflation, sales growth is actually the same or higher than the last 10 years. Interest rates are lower. So this is something that's very important that investors should keep in mind. A lower nominal inflation, lower interest rates naturally imply that returns from markets will be lower, but adjusted for inflation, we think that the market will still give you, reasonable returns. Overall returns should be in line with sales and earnings growth, 10 to 12%. Given that interest rates are declining and deposit rates that clients get, which is the opportunity cost of capital, will also be lower. We think the market's actually priced for fairly reasonable return, and investors should be actually investing today.
Mukul, I remember from our earlier conversations, you'd once spoken about how you're overweight financials, particularly large private sector banks. Was Axis Bank one of the companies that you liked, and what have you made of the negative surprise, this big jump in their provisions, the technical provisions? I mean, how should investors read this? Because the stock is down today, even if you don't own it or you're not recommended it. But tell us the thinking behind this as a investor.
So we are restricted from talking about individual stocks, but I'll give you some idea. Broadly, we expect the asset quality cycle in the banking sector to get better. And that is because bank balance sheets are in an exceptional space, and we believe that unsecured stress that had built up in the system should also get better. In that, we are positioning some of the cheaper banks, which have not had a good run so far, as an investment case, that given that your overall environment is getting better, these some of the cheaper banks should outperform. Now, what happens in that is you do get quarterly sort of aberrations here and there. In some banks, naturally, we weren't expecting a surprise, but we did get one. But this is also a valuation call where you should see that some banks are trading, or the larger banks, maybe trading at a low enough valuation given where we think the sustainable ROA is going to be. So in the large banks, while we have some consistent compounders, on one side, and on some of them we are taking a little bit more aggressive call based on valuation.
Mukul, good morning. Thank you for joining in. The wires and cable space is been in the spotlight after Polycab's results yesterday. Unlike the paints segment where competition has led to a bit of a valuation derating for the incumbents, here the incumbents are continuing to defy expectations and continuing to post strong numbers, as was evident from Polycab yesterday. Where do you see yourself in this space? Do you still continue to find value despite the increasing competition, or do you believe that the stocks are a little stretched as of now and you would wait for a better entry point?
So wires and cables, is a sector that's positioned very well for the infrastructure cycle. Specifically the power cycle in that infrastructure cycle. Even if you look at the internals of what the companies report, the strength actually comes from the cables business, which is heavily levered to the infrastructure cycle. The second part is even on the wire side, as electrification takes place, given that electricity itself is becoming a very sort of compelling proposition versus other sources of energy. As electrification increases, you have more demand for wires as well. But right now, the bigger demand is coming from the cable side, which is related to increasing electrification, increasing electric infrastructure. That is a trend we expect to continue, because electricity is used not just for electrification, let's say, of something that's very obvious, which is EV. A lot of wiring and cables is actually used in data centers, which is firmly in the center of what the next 10-year or 15-year theme is going to be, which is data analytics and AI. And this is a global trend. We did speak about FTA on your channel in the past. Within wires and cables, we expect exports also to do very well, especially if we sign some reasonable trade treaties.
Take that point. Mukul, while we are talking about some of these newer or bigger themes, renewables, for instance, India is going big on renewables. A lot of these PSU majors are being asked to put capex there. While the US is doing something opposite right now, there has been a sudden change in policy. Do you think renewable as a theme would give as much return to a business as the traditional energy gives? And what would it mean for the investors of these PSU companies, be it the oil and gas majors or power majors?
See, that's again, there's a slight bit of nuance there. So first of all, first part is adoption of renewable. Yeah, there's very little doubt that adoption of renewable will be very strong because economics have started working. In the first stage, renewables have been adopted without a storage solution, but the next stage will be when the storage also becomes economical, and overall, time shift of demand can take place, time shift of supply, sorry, can take place, and that will be another leg for renewable. So we expect from the demand side and supply side, renewable to be a very firm trend because economics is on the side. For returns, from companies, there are many other factors, which is the level of competition that is going on, how companies are bidding for these contracts. And there, the picture is less clear. There could be a, situation of oversupply where returns for the companies involved in the supply chain are less. And there again, you have capital equipment suppliers, EPC suppliers, and power producers. On the power producer side, there's actually sort of, we see a little bit of compression in return, but, that is also acceptable given that what I said before, that interest rates themselves are lower. So power producers should be okay, but the rest of the supply chain will depend upon the level of competition. But renewables is a very, very firm trend globally based on economics.
Well put. Thank you, Mukul, for joining in. Just to quickly address the flashes which were there on the screen a while back, where sources are telling CNBC-TV18 that, on the rare earth magnet crisis, because it is deepening, and now we understand that the PMO is going to step in. He's going to hold a key meeting today to address the ongoing shortage, because so far, at least, there hasn't been a breakthrough, and the industry is clearly a bit worried, particularly, the auto industry has been a bit worried. So the PMO is now stepping in, and they will be holding a key meeting. And I think auto companies particularly have cautioned that, if this isn't resolved, there is a risk that production might just get impacted. Not today, but, we need a breakthrough or a resolution on this in the future. So that's what we picked up on, from our sources, and this meeting will be we'll wait for what comes out of this meeting very closely. Okay, let's get into a break then.
Yes, let's do that. While we do that, also remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour. Well, from the broader markets, Clean Science Technology, that is one stock which is under pressure. The numbers on a YOY basis look decent. Quarter on quarter, there was a fall. So if you look at the YOY numbers, revenues were up 8%. There was a 5% growth in EBITDA. Margins came in at 41.7% and profits were up 6% as well. The company, its investor presentation indicated that they got 25% of their revenue contribution coming in from new launches, and the EBITDA margins also remained at that 41% mark. They have seen domestic market share gains. They have seen industry growth as well. However, it was the management commentary that has pushed the stock lower. One, they said that they're cautious on that 18 to 20% EBITDA growth guidance, which they had given earlier. It could be in the range of 15 to 18% now, but they are not sure yet. There will be clarity only after Q2. They also said that they are upbeat on the second half, particularly fourth quarter of this fiscal. However, the cautious commentary on EBITDA growth is something that the street does not like. Secondly, 3 promoters and promoter group members are evaluating the possibility of sale or divestment of minority stake to support family estate or planning and management. So currently the stake is around 74.97%, and after divestment they say it will continue to remain above 50%. But there's an overhang that the street is watching out for, because there's no clarity when it will happen, how it will happen, who they will sell it to. So that promoter stake sale overhang is also pushing the stock lower. So weak commentary and that stake sale overhang has pushed the stock lower by 7.5% as we speak.
Indeed, not very good going for Clean Sciences. Remember, IPO price of around 900 rupees. So since then, the stock did move higher, but now in a bit of a correction mode from the 52-week high. The other positive earnings surprise that came about, though, was from Nuvoco Vistas, and that is resulted in a lot of other cement stocks also moving higher. Now, you take a look at the numbers. Well, revenues were higher on a year-on-year basis, as was the operating profit. The bigger improvement, though, came in the margin. You take a look at the margins, it was almost a 500 basis point improvement that came in for the margins, which are almost at 18% now compared to 13% last year. And the profitability, of course, that was also a major improvement that was seen on a year-on-year basis. But the lot of this was also courtesy of lower finance costs. Finance costs, if you take a look at them, the power and fuel costs have remained almost constant. Other income, though, has improved, and that also contributed to better profitability. But it was the lower finance costs that contributed to the improvements in margins. And power and fuel costs, although they've remained stagnant, but they haven't gone higher, and that too is a positive. The other positive is the EBITDA per ton that the company reported. And if you take a look at that figure, almost 1,000 rupees plus now on the EBITDA per ton front, and that is compared to 700 rupees in the same quarter last year. And even on a sequential basis there is an improvement, because it was at 968, so it was already heading towards that 1,000 rupee mark, and now it has crossed that 1,000 rupee mark this time around. And the other positive for the results was the decline in debt. And every time there is a reduction in debt, of course, the street takes it positively, as it has for Nuvoco Vistas as well. So from almost 4,400 crore in the previous quarter, the number has gone down to less than 3,500 crores. So it's almost a 900 crore debt reduction that you have seen this time around. And even on a year-on-year basis, that number is lower compared to that 3,640 crore in the base quarter. So overall, it was a strong performance from Nuvoco Vistas. Better margins, debt coming down, the operating performance was strong. Street taking it well, 4.5% higher now on that stock, and that as a result of which Ultratech and some of the other names that report results over the weekend and going forward as well, they are doing fairly well for themselves, Reema.
The stock has hit a fresh 52-week high. The earlier one was in December, 385. But today, with this 13 rupee up move, Nuvoco is at a fresh high. Though in the last 5 years, the stock has declined by close to about 26%. But it's time now for a special segment, Quarter Se Quarter Tak. And we'll get you earnings expectations from each sector. And today, it's over to Mangalam now to give us a lowdown on the FMCG sector.
Previous quarter, I said the tagline for the sector was same, yet different, because things were looking like they're improving. And this time we go with green shoots are coming. Why do I say that? Because, you know, if you look at it, in the recent times, the stock moves itself showcase that belief. In the month of July so far, the FMCG index has actually outperformed the Nifty by 5%. Even some stocks have rallied in double digits, some for specific reasons and some for good performance. So what's expected this time around? Good rural growth that continues. Urban, which was under pressure, is now seeing gradual improvement, signs of life out there as well. Raw material prices, while they are volatile, the worst seems to be behind them, and staples may outperform discretionary. That's the big headline this time around. Summer products, some of the categories did get impacted by unseasonal rains and strong competition across categories. But we have a peep into what a lot of these companies are likely to report this time around. Godrej Consumer's India business delivered high single-digit value growth driven by mid-single-digit volume growth. Marico said its underlying volume growth in India has been at a multi-quarter high, led by their value-added hair oil business, which grew in low double digits, telling you consumer sentiment has improved because this segment wasn't doing too well for them. Dabur too witnessed sequential recovery in demand with uptick in volume growth in both home and personal care and healthcare. Their beverages portfolio was impacted. There was growth in discretionary. You saw 31% for Kalyan Jewellers, Trent about 20%, 18% for Titan, and V-Mart Retail for 13%. But these stocks actually saw a decline despite optically strong performance coming in the top line. Why? Because the pace of growth slowed down and valuations, they're catching up. So staples doing better than discretionary. Among all the companies that are likely to report numbers this time around, we expect some weakness to continue for Asian Paints, even as the environment for the paint sector is improving. HUL, Tata Consumer, Britannia, all of them likely to show incremental improvement. The one particular stock I'll be watching out for this time around, United Breweries, 10 to 12% revenue growth expected. Bears a summer product. The company has increased its focus on premium offerings with all the regulatory navigation that it has to do. That will be important to track. For the entire sector, speaking about strategy, the most important thing will be strategy of new leaders. We have a bevy of new leaders at HUL, Nestle, Pidilite, Titan, Bajaj Consumer, and many more. Further improvement in urban consumption will grow, and finally scaling up of the recent acquisitions, for instance HUL having bought Minimalist, etc. And finally the valuations, all of them pretty close to or slightly below their 5-year average, even after the outperformance that we've seen in July.
Mangalam, thank you for that comprehensive wrap-up of what to anticipate in the FMCG space. You take a short break, you put the spotlight on some of the key expectations from the big boy, Reliance Industries, that reports results later this evening. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Well, the big boy Reliance Industries set to report its numbers post-market hours today. Remember, the stock is already up 21% this year so far, trades at 23 times FY27 EPS. In terms of numbers, expecting a good set on a sequential basis this time. Revenues, yes, they will decline 8%. That's because raw material prices, some of the raw materials, the prices were lower this time. EBITDA, however, expected to grow by 3% to come in at 44,965 crore rupees. Margins at 18.7%. And profits are expected to increase by 16% to come in at 22,024 crore rupees. Now, what are the internals? What will they look like? Oil to chemicals, geo and retail, all three of them will perform very well this time. However, some pressure will be seen in the oil and gas business this time because of lower production. So O2C, that's where the expectation is that it will increase 19% YOY in terms of EBITDA, 3.5% on a sequential basis as well. However, there was a shutdown that the company took in the quarter gone by. Geo ARPU expected to increase 1% on a sequential basis, and retail business, the EBITDA is expected to see an expansion on the back of JioMart scale-up, operating leverage and increasing footfalls as well. So their EBITDA that has been consistently increasing will see a further increase this time, 44,965 crore rupees, which will be at a 5-quarter high. So that is what we're expecting from Reliance today.
Interesting. Keep an eye out on the Nifty Big Boy. Earlier numbers out this evening. We take a leave on this edition of a Trading Hour. Leave you with the Nifty at 24,950 from Reema, Sonal, me and the team that put this show together. Thank you so much for watching. Halftime report on the other side.
Stocks fall on a disappointing start to the earnings season. Financials and industrials are the big drags, while metals remain a bright spot. Mid-caps relatively fare better.
Axis Bank reports a sharp jump in provisions in a big surprise for investors, while the technical provisions against secured assets strengthens the book for the future. An uptick in regular credit costs as well, that is something that is tracking the stock.
Wipro's Q1 performance is largely in line and nothing to crow about, but some big deal wins offer some optimism for the future. The stock books up.
And Clean Science Tech skids after it trims margin guidance and points to likely stake sale by promoters. But Nuvoco Vistas climbs on a sharp jump in operating profits and significant reduction in debt.
Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra. With me is Vinny Motiwala. Well, it's turning out to be a session which is weak at this point in time. So we have the Nifty, which is down around 0.6% as we speak. We have the Bank Nifty, which is under pressure. And really the star point of today's trading session, considering that the street is disappointed with what they saw on Axis. Axis, that stock is down around 4% at this point. Top loser on the Nifty as we speak. We do have a lot of earnings to reckon with over the next 2 odd days. In fact, Saturday is going to be quite important in terms of numbers. We do have the likes of HDFC Bank, which will be releasing numbers tomorrow. So that'll be something to watch out for, along with ICICI, Yes Bank. A couple of those stocks would be in focus. We have Reliance Industries today, so that would be the other big one to watch out for. Overall, pressured day for the markets, led by the banking stocks.
Absolutely. Hi, Ekta. Good afternoon. And banking, that's what is dragging the market as well. All these private banks today with the Axis Bank are falling in trade. We're waiting out for their numbers tomorrow as well, like Ekta was mentioning. Today, in terms of sectors also, most of the sectors are trading in the red. We have some bit of a bright spot today coming in from the IT side. So Nifty IT is holding on to a very marginal gain. We have metals as well as media among the other sectors, which are holding on to some bit of a gain in today's trading session. A lot of movers and coming in on the back of numbers as well. Tata.com, Nuvoco Vista, Wipro, Suntech Realty are some of the movers on the back of earnings on the positive side, while on the flip side, Shoppers Stop, Route Mobile, CEAT are the other ones which are falling in trade on the back of news flows as well as earnings. So that's what we are keeping an eye out on. Banks are going to be the key focus as well. But South Indian Bank, that is the bank, and that is the first management that we'll be talking to on the show as well today. The bank's net interest margins have declined 18 basis point quarter-on-quarter basis. Also, in terms of provisions, that have risen by 111.8%. This is on a year-on-year basis again. Now, talk to us about the earnings. What are we expecting from the management going forward? What should we be watching out from the bank going forward? We have PR Sheshadri, who's the Managing Director and CEO at South Indian Bank, joining in with us to talk to us about just that. Mr. Sheshadri, thank you so much. Good afternoon. Let's start by talking a bit in terms of the numbers for the company, right? So what I want to start by talking about is in terms of NIMs that we're mentioning right now as well, that 18 basis point quarter-on-quarter basis decline is what we're seeing. Now, how much of the rate cut is passed during this quarter, and by when are you expecting your NIMs to start stabilizing now?
Thank you very much for having me on the show. We are actually reasonably pleased with the quarter that just went by. Our revenues grew 13%. Our expenses were flat. Pre-provisioning operating profit was up 32% and profits are up 10%. We were aided by treasury income that offset some of the NIM pressure that you mentioned. I think we are not alone in having problems as far as NIMs are concerned. This is essentially because our assets are repricing faster than our deposits. The pressure is not by all means over. I think it will continue into the second quarter. And if RBI were to reduce repo rates again, it perhaps would carry on into the third quarter as well. We are trying to address that by changing our asset mix. But that does take a little bit of time. We are underrepresented in retail and MSME, and these are areas where we now have a reasonable outlook for growth. More importantly, our asset structure has changed. Our slippage for the quarter was only 20 basis points, which puts us amongst the best in the street when it comes to portfolio quality. And therefore, it gives us a little bit of leeway in terms of the risks that we can run as we go forward. And consequently, we think that this is a year of growth for South Indian Bank. And we are hoping that growth will be significantly higher than that street.
Mr. Sheshadri, you're mentioning, right, like your NIMs may see some bit of a pressure coming in Q2 as well, right? Last time in Q4, you couldn't give us a guidance. It was too early to talk about anything. But then what could we be expecting in terms of NIMs? Any near-term guidance that we're watching out for, as well as an FY26 guidance, if you could give us that as well?
Our 40% of our book is linked to external benchmarks. And that has dropped by 100 basis points. So if you do a simple math, which is multiply 40% by 100 basis points, you get a number. the outcome for us is lower than what the number is showing. It should ideally, you should say it's about a 40 basis points impact that you would expect. But we are taking action to stop that from happening. So we've had 18 basis points flow through, but there is a little bit more that is likely to happen as we go forward. The exact number is very hard to predict because, there are so many moving parts. But the point that needs to be made is the fact that the NIM pressure is by no means over as we go forward.
Okay. All right. Mr. Seshadri, I heard you mention that asset quality has actually been one of the best in class. Just tell us what the absolute amount was in terms of slippages this quarter.
It was about 189 crores.
Okay.
So it was very low. It's 20 basis points in total. We provided in excess because we have a historical book which had high gross NPA. And our aim was to ensure that the gross and net NPAs are brought in line with what the street currently has. So that's the reason why there is additional provisions that have been made during this quarter.
Okay. Give us a sense in terms of, it doesn't look like you've had maybe too much of a problem in most segments, but the personal segment showed majority of the problem in terms of slippages. So if you could just provide some color in terms of what's taking place in the personal segment, and if you could give us an idea in terms of guidance on slippages as well. Are you expecting it to probably be in this range of 180 odd crores in the next couple of quarters? Do you expect it to be lesser? Do you expect it to be more?
On the personal segment, we have a small credit card stroke personal loan book. Majority of the losses are coming from that. On aggregate, the loss rate on both of these put together is in the neighborhood of about 3 to 4% annualized. And given the spreads that we have on these products, they're very, very profitable. So we're not very worried about that. The underlying portfolio, to the best of our knowledge, is sound, and we do not expect the loss rates to materially change as we go forward. So we expect slippages to be in the same ballpark as we go into the next quarter as well.
Right, Mr. Seshadri, you made a point earlier as well that, treasury income, that was something that was supporting the overall profitability and operating profits for the company this time in this quarter. Now, this is something that is a positive there, but will this net interest income actually sustain going forward? What are we watching out for?
That is the area of concern for us as well. And that is why we are working doubly hard to change the portfolio mix. This is something that has been occasioned by the change in the external benchmarks. Unfortunately, there is very limited leeway for us in terms of, and so we are trying to do as much as we can to build an alternate structure within the bank to originate higher yielding assets so that the impact of this is minimized. It is a challenging environment for us to work on, and it is something that we are cognizant of and we're addressing.
Okay. Just two questions before we let you go, sir. One was on your gold loan book. It's up just by around 7% year on year. The RBI has now allowed reclassification of agri gold loans as PSL. So is that a segment that you would probably look to incrementally increase in terms of loans? One. And two, just wanted your view in terms of branch addition, because, in FY25, we understand that the branch count declined. So is there any kind of strategy when it comes to branch addition, and why are you holding back?
Okay. With respect to gold, our approximately a fifth of our portfolio is gold, and we are keen to grow this. And we think that as we go through this year, that will become more like 22-23% of our total book. There will, of course, come a point in time where prudence will, have us, not grow that more aggressively. But at this point in time, we intend to grow this reasonably aggressively. With respect to branch rollout, we took an intentional pause as an institution, we had higher costs, relative to our peers, and we wanted to actually address that so that our profitability could be maintained. So as a consequence, we've had revenues growing at 13% and costs being flat, which is what has helped our pre-provisioning operating profit. And now that as revenues grow, it gives us the flexibility to start adding branches, which we intend to do in our core markets, which is largely peninsular India, Maharashtra, Gujarat, and the National Capital Region.
Okay, Mr. Seshadri, thank you so much for joining in with us on the show and giving us an understanding of what we could be watching out from the bank going forward as well. Thank you so much for that. But on that note, we'll slip into a very short break, and after the break, we'll get you more on markets and focus on Axis Bank, Wipro, individual stocks, what's happening there as well. Welcome back to Halftime Report on CNBC-TV18. Like you can see today, the favor is more in the terms of declines versus advances, and even on the Nifty, most of the stocks are trading in the red versus what is trading in the green. Some of the names coming in on the IT pack, which are managing to hold on to green. So you have Wipro and Infosys, which is managing to hold on to the green side. And other than that, some bit of these auto names like Tata Motors as well as Bajaj Auto, which are managing to hold on to green, but a lot of action that's happening in terms of moves because of the earnings season as well. So obviously in just the last few minutes as well, what we're seeing a fall coming in is for DP Realty. That's under pressure as well. Clean Sciences, I mentioned before, that's also under pressure. We have Nugent Software that's under pressure because its numbers were reported yesterday. Con call didn't seem to be that exciting. So that is something that we'll watch out for. Root Mobile, Sterling and Wilson, among some of the other names that are in focus and trading on the red side today as well. But the main focus today is going to be banks, because Axis Bank, that reported its numbers. And with Axis Bank falling, we're seeing even HDFC Bank, ICICI Bank, that's not doing anything great in today's trading session. Now, Axis Bank has disappointed in this Q1 FY26. Asset quality, that also saw a deterioration, dragging the profits lower. Gaurav is joining in with us to give us a fine print in terms of what happened in Axis Bank and what a brokerage is saying as well. Gaurav, over to you.
Well, yes, when it comes to Axis Bank, the biggest pain point remained asset quality in first quarter, and let me tell you why. When we talk about net interest margins, they have declined almost by 17 basis points on a quarter-on-quarter basis. Now, Street is expecting 10 to 12 basis points, and the bank has attributed around 13 basis points of fall because of the repricing. But what remained as a negative surprise is provisioning. Now, bank has changed their provisioning norm. They have made it more stringent, and as a result, we saw a sharp rise in credit cost. Provisioning has gone up almost by 800 crores in this quarter itself. When it comes to slippages, now fresh slippages stands at around 800 and 200 crores, which was as low as 5,400 crores if we exclude the technical impact that the bank has reported in this quarter. As a result, credit cost has gone up almost to 1.4%, which was anticipated somewhere in the range of 1%, and slippages have gone up almost to 3%, which was anticipated somewhere in the range of 2%. Now, that was a negative surprise which is driving the stock price right now. This impact was seen on profitability as well. We have seen an impact of around 620 crore rupees on the profitability. As a result, ROAs have gone down almost by 15 basis points, and ROEs also took a hit of 1.4% when it comes to the technical impact. Now, what management is saying is that in coming quarters, slippages are likely to stay stable, and the reason being that there will be higher recovery, and that is the reason they believe that credit cost is also likely to come down. In FY27, we may see credit cost normalization. On the other front, when it comes to loan book growth, it has grown almost at 8%, and now management believes that they have an ability to increase their loan book higher than the industry. So that is something where we are seeing an optimistic commentary coming up from the management. But overall, in terms of disappointment, in terms of the numbers from provisioning, we are seeing a sharp fall. Axis Bank, as we speak, it is down more than 3%.
Okay, yes, absolutely. Thanks very much for that, Gaurav. So that's Axis. The management in the conference call said that they are confident about growing faster than the industry. Listen in.
So roughly, if you look at what we do is quarter one and quarter three are cyclical. And the way I would request you to think about it is, in quarter one and quarter three, about 25% or thereabouts of slippages are from the agri portfolio. So you could apply the maths to 5,400 crores, and roughly about 25% or thereabouts would be agri. The percentage would be broadly similar for last year's rupee crore number. The rest of the 75% is coming entirely from the unsecured business. We are very clear in making a call out saying we do not see stress in the secured part of our retail book as on date.
When Rajiv retires in August, as per expectations of RBI, we need to have MDCO and 3 EDs. Our NRC is actively looking at who and when we appoint a third person as executive director of the bank. When we're ready to do that, we'll be very happy to do it, but you should expect announcement of ED appointment as Rajiv retires. So that's the answer to one of your questions. Second question, I thought I answered in detail in the response to the first question, which was, yes, credit growth is where it is, but our confidence about what we can do the rest of the year and in the medium term, given where our platform is high. We are expecting to grow faster than the industry. I mean, obviously that's an expectation, but we are quite driven towards ensuring that we can deliver that output.
Okay, that's on Axis. Wipro has met muted estimates in the first quarter. Revenue contracted 2% on a constant currency basis. Margins also contracted sequentially, but largely in line with estimates. Reema's here with more details with regards to Wipro. Reema.
Thanks so much for that. So as you rightly pointed out, Q1 was in line with muted expectations. But I'm going to see I see some silver linings. For starters, Q2 guidance suggests to an improvement versus Q1, and the deal bookings are very, very strong, up on an average 50% on a sequential basis. But let's get to the numbers first. Now, constant currency revenue growth has declined by 2% quarter on quarter. This is within the company's own guidance. They had guided for -1.5% to -3.5%. So within the guidance, margins have come in at 17.3%. But the Q2 guidance, next quarter's guidance, is at -1% to +1%, which means that if the company achieves the middle point of its guidance, that's 0%, it would be an improvement. Even if things deteriorate and the company does, at the lower end of its guidance, -1%, that's still an improvement compared to -2% that they've done in Q1. That said, Q2 is typically a seasonally stronger quarter for Wipro, so generally things do improve for the company. So just to quickly, some more numbers, this -2% would mark the second consecutive quarter of a revenue decline, and we've seen revenue declines across all the large cap peers. So whether it's TCS with a -3.3% decline or an HCL Tech with a -0.8%. So basically large cap IT companies have reported a revenue drop this time, and it's no different for Wipro. The deal wins have been particularly very, very strong. So the total deal bookings have come in at $4.9 billion, which is an uptick of 24% quarter on quarter, 50% on a year-on-year basis. The company's also signed 16 large deals, which includes 2 mega deals. And if you just look at the pure large deal wins, that is up 50%. So Q1 weak, but Q2 points to an improvement versus Q1. Sequentially, it should be better in Q2, and the deal bookings are very strong. Other numbers like attrition is ticking up very marginally, headcount is down by a bit, but I think the deal bookings and the quarterly guidance would be the key parameters, the KPIs to track for Wipro.
Absolutely, but we also spoke to the management of the company. Listen into some excerpts of that conversation.
So there is this very strong deal momentum that we have had in Q1, which we tend to carry to Q2. Of course, some of these deals will take its own time before we start ramping up. Second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
For those deals to really translate into revenues, it will require upfront investments. There will be pressure on costs. You know that large deals typically come at lower margins, and there will be some pressures that we will have to offset. We will go back to that muscle of operational excellence that we will continue to drive. And those are the puts and takes on margins. We don't guide for margins, but we are happy with our performance in Q1, an 80 basis points improvement. And from there, we will take it.
Okay, on that note, we're going to slip into a very short break. After the break, we'll be joined by Manish Hathiramani from Deen Dayal Investments, who will join us to talk about his trading strategies and on the market on the other side. Welcome back to Halftime Report on CNBC-TV18. And now we have Manish Hathiramani, who is from Deen Dayal Investments, joining in with us to talk about his trading strategies. Manish, good afternoon. Thank you so much for joining in with us. Now, today, obviously, we're seeing a fall coming in for all the markets, and this week has been such, right? While there was some bit of a gain coming in for 1 2 days, but after that, it's more of a consolidation that we're seeing this week. 24,900 as of now is what the Nifty is at approximately. What are the levels we should keep an eye out on now?
Good afternoon to you and to all our viewers. Thank you so much for having me on the show. Well, last week on the same show, when I was discussing with Mangalam, we had discussed that we are in a range. And 25,300 was a good support and the lower end of the range. We broke that and we have tested 25,000 today. So I would be looking at this key level of 25,000 because it's technical and psychological. If we break 25,000 on a closing basis, I feel they're going to get weaker. And the next level to look out for would be 24,650. On the upside, currently 25,300, 25,400 is the resistance.
Okay, so you're expecting the markets to trend lower if in case they do break 25,000. Currently, the Nifty is at 24,941. So let's see where we close in today's trading session. But what do you think is probably going to be the key reason for the weakness? We're seeing it to be banks at this point in time. Do you think that's going to probably break the markets back?
Well, we do see large caps overall slipping downwards. Key support levels in the short term have broken down. It's too soon to say that is the overall trend change. The answer to that is no. We're talking about short-term pullback, short-term falls. Given that, I'm working with 2 sell calls. The first one is on an ICICI Bank, which is for a target of 1385, stop loss of 1440. After being sideways for a brief period of time, the stock has broken the lower end of the range, which was 1420. The second one is on Apollo Hospitals for a target of 7120, stop loss of 7420. We see a mild pullback after the stock broke the support of 7350. The risk reward being favorable as the stock is still languishing in a short-term downtrend.
Okay, Manish, thank you so much for joining in with us, talking to us about the markets as well as telling us which are the stocks that we should be keeping an eye out on as well. But on that note, we're going to sip into a short break. But as we are sipping into the break, we can see the numbers of IOB at the bottom of your screens as well. Net profit is up 76%, 1,111 crores versus just 633 crores last year. We'll keep an eye out on more internals in terms of the NII. How is the NPA doing as well? That is something we'll watch out for. We'll take you through that after the break. But, on the other side, we also have Manisha Gupta, who's joining in with us with Sachin Jain, Managing Director at World Gold Council. So stay tuned for that conversation.
Welcome back, and joining us on the show now is Sachin Jain. He's a Managing Director at World Gold Council. Sachin, hi, thank you so much for joining in. And the last couple of days or sessions clearly have been quite productive. I'll take it one by one. And the first one is from SEBI, which has released a consultation paper suggesting that the prices that we have on ETFs right now should perhaps be linked to the spot prices in the Indian markets rather than LBMA. How would you react to that?
So first and foremost, Manisha, thanks Siddhant for having me over. And yes, I think SEBI's issuance is, I think if you take a step back as to why it's coming, is that ETFs are becoming more and more proper, more sort of main stage. And there is a belief that there'll be a phenomenal growth coming in from the ETF, both in the world in terms of the AUMs, but also the interest of the investor, and not just very avid financial investors, but investors on the field, so on the ground, and really Indians and the Indians on the street. So I guess any stipulation from the SEBI's perspective is towards ensuring that there's more transparency, there's more confidence, and there is no gap or a lacuna in between. So as an industry, we welcome it. I think it only sort of refreshes what's happening right now. Can it be done better? And I think it's really a call to a future that'll be much more bigger.
And Sachin, the second one was from IRDAI, and as we know that as of now, the insurance companies are not allowed to invest in commodities. But with the way IRDAI proposal also comes in on how insurance companies may invest or may be allowed to invest in gold ETFs, also does support a lot of conversation that we've had earlier as well. As you said, ETFs really are here to stay, grow, and grow considerably. With the insurance company regulator also looking at that, what's your sense?
I think both regulators, like insurance regulators and also the provident fund regulators in our country today, do not permit any investment on gold. And I think there's been a lot of conversation globally and also in India, where as an investor, what you really bring on the table with some part of diversification gold is make your portfolio healthy. I mean, there could be a lot of debate about this current, when you look at a 20-year history of gold, and there'll be a lot of pushback to saying, if you delete the last 5 years, then perhaps the returns might not be as healthy as equities, which is perhaps a true fact. However, what gold does is a play in terms of liquidity. And when you look at specific zones of pressure in 2008, in COVID times and all, that's when the health of your portfolio dramatically improves. And I think the insurers, the regulators are acknowledging that fact. And I really foresee that it's not about gold getting pushed. It's about Indians' long-term investment via insurance companies and provident fund investors is healthy and is very long-term.
Sachin, I do understand that a lot of work on ETF is being done. I remember my previous conversations with you as well, that there was this conversation about ability to perhaps redeem ETFs going forward in more ways than cash. Have we moved any forward on that?
We have, Nisha, and I think that's been quite extensive work on that area, and thanks for bringing it up again. All the mutual fund suppliers have been quite proactive and giving us all the inputs around it. We've been working with the regulators around it, and the intent would be that we will be running a pilot with some select partners to see the nuts and bolts of it. And we all believe collectively that this will be the fungibility of ETF into the jewelry world will be a very, very good step, very healthy step. One, for usage of ETF, and secondly, more importantly, the awareness of ETF and what can do to an avid consumer.
And how soon do we see this pilot coming in? Is there a timeline that you're working with?
Around the corner, Manisha. So I foresee Q4, certainly we should be live, is what our earliest estimate would be.
Since we have you with us, Sachin, what's your sense also on the demand? Because the first half gone by does show us a very mixed picture. Of course, the returns are huge, but the kind of investment or the jewelry buying, especially that we have seen, has taken a hit.
So let's talk about what's happening globally and what really happened in the first half of the year. As you said, gold has performed at 26% return in the first half of the year, which has been historic and has been the best performing asset class, and purely driven by a sort of weakening dollar. We're talking about the geopolitics uncertainties that are happening, but a very robust investor demand and the continued central bank buying. Now, when you look at the next half of the year, there could be perhaps three scenarios. One, which we believe perhaps will be the most sort of obvious one, and that we think is a more consensus expectation, where there will be a relatively steady finish of gold to the end, and we believe a 0 to 5% upside with a slightly more stability on the various elements of things that we see. The other aspect could be that if we see a huge volatility and even increased geopolitics risks and uncertainties, even huge trade issues happening, then we could perhaps look at a gold getting to between 10 and 15% increase from here on. And on the third side, if everything normalizes, there's no trade issue, all countries start loving each other, then we think that gold might just get down to about 10 to 12%, which I think is a very bleak possibility. So that's the three scenarios in which what we think might happen. Now, to your point on the jewelry side, I think first 2 quarters, you certainly see a drop in jewelry, but it's important to also keep an eye that an Indian consumer who's buying jewelry is buying from the cash or the disposable money he has on his hands, and that sheer number has gone up. So volume might have come down, but the consumer's interest in how they're buying jewelry and gold has been up quarter by quarter. And what we've seen historically is that when the prices go up, the consumer's waiting for some stability, which I think we're very happy to say it's happened now. And as you get into the second half of the year, if the prices are stable and move up perhaps in a very sort of stable manner, then I'm a firm belief the Indian consumer is going to come back into the market buying jewelry. And we base that on our recent consumer surveys, where the obsession or the sort of interest on gold and gold jewelry is an all-time high. So, and I also see that industry doing some great work in terms of lightweight pieces, more affordable pieces, more creative pieces, attuned to lifestyle, and you see all of that in play in the second half of the year.
Oh, well, absolutely. The obsession to owning jewelry is actually on a high. Sachin, this last question to you is not as a World Gold Council, but as a personal question, really. What is your sense on where are the prices going? But otherwise, you won't answer this one because, the street really seems to be talking about 3,500 and 3,800 and 4,000 and thereabouts as well.
Well, I think even on a personal level, I don't see anything differently, Manisha. I really think that when you look at the peaks of gold prices that have absorbed a lot of these issues and shocks that are around the corner, some of them have been made a reality. But I think it'd be more stable from where we are upwards. And hence, there will be some sense of normalcy to saying, guys, this is the price. Now, should I consume or not consume it? And I think it certainly simplifies jewelry consumer. But as an investor, I personally, as you said, I have always looked at gold as a very long-term allocation of my portfolio. I'm very tiny portfolio, but very, very small allocation there. And I guess that from that long-term view, I think it's a perfect time.
Okay, all right, Manisha, thanks very much for that. So that's on the entire gold space. And Mini, you have some incremental information on that gold.
Because it's very interesting because gold ETF, like you were mentioning, right, it's picking up interest, and that is what we saw in July as well. It's back above that 2,000 mark, again. So
it was near record highs. And as Sachin says, and as the news has been, Vinny, that you have SEBI saying that the prices should be more, domestic. You have IRDAI saying that insurance companies can go into that. And as Sachin told us that now that you buy ETFs, you can redeem it into jewelry. I mean, what else do you want?
Nothing more than one should ask for.
India's love affair with gold will never end. All right, Manisha, thanks very much for that. Well, we need to take a short break, but remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. Well, managed workspace solutions company IndiCube Space's 700 crore IPO will open on the 23rd of July. The IPO comprises of a fresh issue of 650 crores and an OFS of around 50 crores. Our colleague Reema Tendulkar caught up with the top management of the company, began by asking about the IPO itself.
If you look at, we were following the IGAAP accounting standards till 2023. And then in the last 2 years, we have moved to the Ind AS accounting standard. And as per the IGAAP accounting standard for the FY23, we have reported a profit as per the income tax filings that we have done. And in 2024-25, because of the Ind AS accounting standard is where basically we are seeing losses. As you may have seen that our EBITDA margins look very, very promising, like 58% at the overall. Now, obvious question people ask is that from such a high EBITDA, how suddenly you are having losses? The thing is that whatever rental payouts that we do to our landlords, they are all capitalized and they are also treated as a liability from a payment perspective, and those do not factor in the EBITDA. So as a result, you see very, very high EBITDA margins.
So the lease rental is excluded from the EBITDA.
Yes.
It comes in below as
Correct.
line item.
Correct.
Okay.
So that is where you see extremely high EBITDA. Then when you move down, what happens is, since this has been treated as an asset and a liability at the same time, so there is a significant amount of depreciation and interest that is notionally computed as per accounting standard. Now that is way in excess of the actual rents or the actual depreciation that we have on our basically physical assets.
So given the recurring losses under the accounting standards, should investors assume that the company will continue to report losses, statutory losses, or will the company break even at the PAT level?
So if we look at the Ind AS accounting standard for any lease that has been capitalized, initially the impact of depreciation and interest tends to be higher for that, and over a period of time that impact starts reducing. So I think if we factor into that, and as business starts growing, at some stage this will turn.
Let's look at your cash EBIT. Your cash EBIT margin is at 10.8%. Is that the industry standard? And is there headroom to improve this number? And if yes, what would be the levers? Would it be operating scale? Would it be pricing?
So what we see is that if we were to give the past data, definitely we see that this number has improved. We believe that there is a lot of operating leverage that is available. Plus, we have made significant investments into green power. We have commissioned a 20 megawatt solar plant in Karnataka, out of which more than 50% is already operational over there. So we see a significant amount of savings should accrue to us on account of those investments as well.
So now just to understand and to summarize what we've spoken so far, under IGAAP, the company turned profitable in FY23. It's showing a loss purely on account of Ind AS accounting. The correct margins to look at would be the cash EBIT margins, which are at 10.8%, but there is scope for those, there is headroom for those cash EBIT margins to go up. I mean, you all have a fundraise of about 463 crore, which will be used for CAPEX, for increasing the pipeline. So your current AUM is 6.4 million square feet and the active stock is 6.3 million square feet. Explain to us what this pipeline will look like, the AUM that you will manage, say, once you deploy all the money.
So as you rightly said, the AUM is 8.4. So there's a headroom of 2.1. If you can see from 6.3 million square feet of active stock between 8.4, you have 2.1. And our capex cost is about 1,500 rupees per square feet. So for that, 2 million into 1,500 would amount to almost like average about 300 crores would be going to kind of cover that 2 million square feet. And the balance 150, we have actually kept the buffer for the growth. So that is how the whole 460 crores which you're seeing would be utilized in the capex.
Rishi, your revenues have practically doubled in 2 years. And I think the revenue CAGR is like close to 35%. So you've outpaced the industry. In this period, what was the industry growth rate and can you continue to outperform?
Yeah, so if you look at the CBRE data, the year that got over, the calendar year 2025, was done at about 100 million square feet of managed office space. This number was about 80 million a year back. And as per their forecast, in next 2 years, this number is likely to go to about 140 million. So the industry has grown and looks likely to grow at a very healthy growth rate, about 20%. And somebody who has a large presence pan-India in about 15 cities, we feel that we will be able to continue to do better than the industry average. And if historical data is any indication, I think that's how it looks like.
What percentage of your FY25 revenues, for instance, come in from global capability centers? And could you provide a segmental breakup of your revenues?
In terms of seats, if I have to go, it's a 63% comes from more than 300 seats. So we are pretty much practically, large customer, long stay customers. So more than 300, I said 63%. Out of that, 44% is GCC and 56% is your Indian MNCs, large conglomerates, also includes the startups of the world.
How is your business model different? There are so many companies. Like last week we had this week we had SmartWorks listing. WeWork is looking to file its papers. It's got the SEBI nod. How is your business model different? Very quickly.
So basically, we are the integrated workspace solutions company. So when we go to large enterprises, we do not say, okay, we have about 100 plus centers. Can you come to one of my buildings? Instead, we go with a solution-based approach. We ask them, what is your real estate needs? Where is your talent located? And accordingly, we do the solutions for them. So there are times when they say, okay, we do already have a center, but can you design and build for us, which is our bespoke model? Or can you give us the services, which is our one model?
Provide a lot of value-added services, which is your differentiating factor in terms of a business model, where you provide bespoke services, catering, transportation, whatever the company basically requires. That's about 12.7% of your revenues as of FY25. Does that number go up, and does it command higher margins?
So if we see, again, I will give the historical data that 3 years back, this number was about 9%. And it has been growing because what we have seen the trend is that once a customer comes to us, they like us, they start buying more and more services. A lot of B2B and B2C services is what they add. And that is where if you look at our multi-center client revenue has also grown substantially to about 44% over there.
What does that mean exactly?
It means that typically what happens when a customer comes to us, they take up space in one of the buildings or centers, and once they like, then they expect us to do more. They take more spaces either in our centers, or they expect us to provide services. Or
so 44% of your revenues come from clients who have offices in more than one space with you.
Multi-center.
Multi-center.
Multi-center we call it.
Who are your big investors right now in the company?
So we have one institutional investor, Westbridge, and they have invested 190 crores till date. And the promoters have invested about 125 crores. We have an individual investor, Ashish Gupta, who is on our cap table as well. And total equity raise has been only 325 crores.
Welcome back to Halftime Report on CNBC-TV18. Now, Reliance will be reporting its numbers today. So, later today, now Rima is joining with us to tell us the key expectations from Jio in Q1 FY26. Rima.
Expect a steady quarter from Reliance Jio this time. The CNBC-TV18 poll throws up a 3% increase in the company's revenues to 30,900 crore rupees. Now, this will be driven by one extra day in Q1 versus Q4 and also an increase in ARPU and subscriber. So ARPU expansion is anticipated to be 1%, while the subscriber increase is anticipated to be about 2%. We'll come to these numbers in greater detail, but these will be the drivers of the top line growth. Margins for Jio have been steady, and this quarter we're anticipating about 53.7%, driving a 5% on an average increase in the company's profitability. But now let's get in a little more detail in terms of the subscriber numbers and the ARPU numbers. Now, the trend that we've seen in the last couple of quarters is that Jio's net additions in subscribers have been greater than that of its closest peer, Airtel. So Jio has been gaining market share. So does that continue even this quarter? The number we're working with for subscribers, 497. For ARPU this time, it's been a steady expansion in the ARPU. Last quarter, it was 206. This time we're expecting 208 approximately, 208 rupees. And that's because, the last wage hike was about a year back. So that transmission is still taking place, but in a trickle. So the question from here on for Reliance Jio is, when can we see the tariff increase and can they pick up further pace in terms of subscriber addition to gain some lead over its peer, Bharti Airtel?
Okay, all right, Rima, thanks very much for that. Well, Sonal is now here to decode what to expect from the O2C business at Reliance.
Well, all to chemicals business for Reliance Industries will be a growth driver. Strong margin expansion is what we're expecting. However, the throughput will be lower because of some maintenance shutdowns. Remember, Singapore GRMs, they are up 81% sequentially, 60% on a YOY basis. And that is the reason the recovery in Singapore GRMs will drive margin improvement for the company this time around. However, throughput, that is expected to be lower, 3% sequentially and 1% on a YOY basis because of maintenance shutdowns that the company took in the month of April. Overall, Jefferies expects the oil-to-chemicals EBITDA to be up 13% on a YOY basis, however, down 2% on a sequential basis because of that shutdown. But still, it will be a decent number that we'll be watching out for. This is about oil to chemicals. Let's talk about the oil and gas business as well, where EBITDA is expected to fall because of natural decline in the KG-D6 production this time. And that's why Jefferies expects the EBITDA to decline 10% on a YOY basis and 1.2% on a sequential basis. If you look at the trend as well, it has been a continuous increase, but on a sequential basis, this time around, it will be a decline because production volumes, that will come down.
Okay, Sonal, thank you so much for that. But what are we expecting from the retail side of the business of Reliance? We have Mangalam joining in with us to give us those expectations.
For Reliance's retail vertical in the first quarter, the street expectations are fairly simple. Expecting operational improvement and good revenue growth. Put all these together, what is it that the numbers will show up? 16% revenue growth, closer to 88,000 crores on the top line, led by a slightly faster growth in the operational performance, 18% EBITDA growth, 6,700 crores on the EBITDA level as well, which would mean a marginal improvement in the margins from 7.5% to 7.6% itself. Remember, the company has been reporting margins in this band itself for the last few quarters. What is this growth likely to be aided by? One, a favorable base, and secondly, the completion of store expansion rationalization that Reliance has done. So that will further improve operating leverage, and we are expecting around 225 to 250 stores being added quarter on quarter, which is a slower pace than what we've seen in the past. The revenue per square feet, as a result of which, grows between 18 to 20% for Reliance Retail. The other important thing that the street will keep an eye out on, operating leverage and better revenue per square feet, which will lead margins better from here on itself and not just the first quarter. Reliance Consumer Brands, that's something that will be the cynosure of all eyes in this result. Why is that? Because in just its second year of operation, the company has gone ahead and crossed 11,450 crores in revenue. That's the fastest growing FMCG company that we've seen in the country. They've gone on aggressive footprint expansion by Campa, and some of their new verticals are doing extremely well, the likes of Tira, Ustar and Swadesh. So a good quarter all in all expected by Reliance Retail.
Okay, all right. So that's on Reliance Industries. Thanks, guys, for joining in and giving us what we can expect. For the markets, week Nifty down 170 odd points. The mid-cap index also down around 370 odd points. And the Bank Nifty showing a deep cut of around 1 odd %. It's a wrap on Halftime Report. Business Lunch up next.
Stocks fall after a disappointing start to the earnings season. Financials and industrials are the big drags, while metals remain a bright spot. Mid-caps are faring relatively better.
Axis Bank reports a sharp jump in provisions in a big surprise for investors, while the technical provisions against secured assets strengthen the books for the future. An uptick in regular credit costs as well tracks the stock.
Wipro's first quarter performance is largely in line and nothing to crow about, but some big deal wins offer some optimism for the future. The stock perks up.
The Prime Minister's office is likely to hold a meeting with key stakeholders on the rare earth crisis today, say sources. Discussions on alternative supply chains and an incentive scheme for rare earth magnets could be on the agenda.
And Clean Science Tech skids over 8% after it trims margin guidance and points to a likely stake sale by promoters. But Nuvoco Vistas climbs up on a sharp jump in operating profit and a significant reduction in debt. It is turning out to be an action-packed Friday, and just as we were about to say that the stocks are at the day's low, there has been a very, very swift recovery from those levels. It remains choppy, as choppy can be. You're watching Business Lunch live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me is Vamakshi Dhoria. Well, Vamakshi, the Bulls and the Bears both are ensuring that we go into the weekend huffing and puffing with no Friday chills, if you would like to call it that, or maybe even pun intended.
Well, absolutely no Friday cheer for the markets, Hormuz, and this is quite surprising given how the global markets have performed overnight. The handover from Wall Street was so good in terms of, they had seen some record highs. Even when you look at the progress that is being made on the India-US deal, President Donald Trump himself had hinted that the deal could be, likely it could be expected anytime soon. But despite that, the markets continue to consolidate. Today, they managed to slip below the 25,000 mark, and a large chunk of this downtick is being driven by the Nifty Bank, of course, after the numbers that came in from Axis Bank. But on the other hand, HDFC Bank as well as ICICI Bank are set to report their numbers tomorrow, that is over the weekend, and both of these counters are too down and out in trade today, and it is these very earnings that will drive the market sentiment on Monday as well. The broader markets, though, they continue to fall as well, and the fall, however, in the broader markets is slightly measured as compared to the fall that we're seeing in the benchmark indices. The advanced decline ratio largely in favor of the declines. In terms of stock-specific moves, take a look at Saregama. That stock is perched almost 5% higher in an otherwise weak session. EMS Limited is one other counter that is doing extremely well in trade today. On the back of numbers, Nuvoco Vistas is also flying high in trade today. But, let's focus in on numbers then and start with the one that is dragging the Nifty Bank lower, and that is Axis Bank. The asset quality worsened and slippages rose in the first quarter of FY26. The management in the conference call said that they are confident about growing faster than the industry and also talks about the technical impact. Let's listen in.
NPA classification happens on days past due criteria, and then there is qualitative criteria which is agnostic of days past due. We have not changed any day past due parameters because they are driven by regulation. The qualitative parameters, as we have previously indicated, we benchmark to most prudent in market on an annual basis. That benchmarking exercise happens for us in the period of Feb and March, and the implementation of that happens from the next fiscal. The purpose of the benchmarking is to make sure that our balance sheet is resilient and can withstand any credit cycle that comes our way, therefore giving you a robust, credible outcome when growth comes back. So roughly, if you look at what we do is quarter one and quarter three are cyclical, and the way I would request you to think about it is in quarter one and quarter three, about 25% or thereabouts of slippages are from the agri portfolio. So you could apply the maths to 5,400 crores, and roughly about 25% or thereabouts would be agri. The percentage would be broadly similar for last year's rupee crore number. The rest of the 75% is coming entirely from the unsecured business. We are very clear in making a call out saying we do not see stress in the secured part of our retail book as on date.
The management of Axis Bank, there a disappointing first quarter. The management explaining what caused the technical impact and what led to these elevated numbers that came in during the quarter. But Gaurav is here to explain the fine print because the street clearly is not convinced, Gaurav.
Well, yes, when we talk about Axis Bank, stringent provisioning is something which is not taken in a positive way by the street. And why I'm saying is that when we talk about this stringent provisioning, this has costed the bank almost 600 crores in this quarter, and that is the reason ROAs have come down, ROEs have come down. So it is taking a toll on its book. So let's understand the numbers first. Net interest margins have come down almost by 17 basis points. Now this was anticipated because the street was expecting around 12 to 13 basis points. And when we talk about Axis Bank, they are also saying that the 13 basis point of fall is coming up because of the repricing of assets. But on the other hand, credit cost was higher, and the main reason was they have made their provisioning norms more stringent. Now what they have done is that the provisioning, because of this stringent norms, provisioning has gone up almost by 800 crores in this quarter itself. Gross slippages have come to around 8,200 crores, which could have been at around 5,500 crores if we exclude this technical impact. And that is something which has impacted. Now credit cost comes at around 1.4%. Slippage ratio now comes at around 3.1% on a quarterly basis. Now, what is not also accepted by the street is that when we talk about credit cost, now let's exclude this impact of this technical write-off, then also the credit cost comes at around 1.1%. Street was expecting around 0.9 to 1% credit cost. It is still higher than the expectation, and as a result, profitability has gone down almost by 4% on a year-on-year basis. ROAs have been impacted almost by 15 basis points. ROE got impacted almost by 1.4%, and that is the reason when we talk about stock performance, it is actually struggling in trade. As we speak, it is down more than 3% today.
Well, thanks so much for that, Gaurav. From the top Nifty loser to the top gainer now, Wipro has gained in trade on the back of its June quarter earnings. The IT major reported a muted quarter in line with estimates. Constant currency revenue witnessed a nearly 2% downtick, but the stock trades higher as the company's Q2 guidance points to a 200 basis points improvement. Another key highlight this time around was in fact that the company's robust deal wins. Their total bookings saw an uptick of 2% sequentially and 50% year on year. We spoke to the management on the deal momentum and performance in Europe. Listen in to excerpts from that conversation.
So there is this very strong deal momentum that we have had in quarter one, which we trying to carry to quarter two. Of course, some of these deals will take its own time before we start ramping up. Second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
I think in Europe, we've had, for the last 4 quarters, we've not performed as well as we ought to have. It has been a combination of the macroeconomic environment, lower discretionary spends, but also certain client-specific issues that have played out. We believe we are very, very close to bottoming out. We have a large deal win that we have secured, and also some very good deals that we have also secured in Q1. Our pipeline is good, strong. So we are very, very hopeful of Europe bottoming out and coming back into performance starting second half.
The management of Wipro on the road ahead for the company. Shifting focus now to the rare earth crisis. Sources are telling CNBC-TV18 that the Prime Minister's office will hold a meeting today on the rare earth magnet crisis, which continues to plague automakers and other industries. The meeting is likely to be attended by key stakeholders, including the Department of Heavy Industries, Mining and Commerce Ministry officials. Ashmit is now joining in with more details on what the electronics industry is seeking from the government. Ashmit, tell us, what are your sources telling you on this very important development?
Well, the electronics industry has written to the government citing serious strategic risk to itself, to its export-led growth, to its competitiveness on account of what it calls Chinese informal restrictions. Informal because the electronics industry says there is no formal notification or direction that has been given. Instead, there are oral directions given to various Chinese companies, basis which such restrictions have been introduced. Now, what's important is that there are three critical chokeholds that the industry says the Chinese have identified. These three chokeholds are, number one, rare earth mineral exports. This, the electronics industry says, is not unique to the auto industry. The electronics industry, which also uses these magnets, is also impacted by this severely. Number two is recall of Chinese workers. This is something that the electronics industry says is going to come in the way of transfer of technology to Indian workers, to Indian companies. And number three, restriction on capital equipment. This is directly going to impact production going forward. This is something which is imported from China. Again, a big restriction being imposed. These three chokeholds, the industry says, appears to be very carefully calibrated. These are sequential in nature. There's an apprehension that they could be expanded to even other means of technologies and critical exports, which is what leads, in fact, the industry to seek intervention from the government, saying that going forward, the smartphone industry, which has been the poster boy of India's manufacturing story, the exports, which are expected to be north of 32 billion in FY26, are at serious risk if these restrictions continue. That is where the intervention from the government is sought. The industry clearly saying that the government needs to come in, the government needs to help, because if these issues are left unaddressed, it will have serious consequences to the recent momentum of electronics manufacturing in India.
Well, thanks so much for that, Ashmit. An important story that we will be following up on. But let's now put the focus on key earnings expected today. Reliance Industries is set to report its June quarter numbers. The company is expected to see a 16% growth in its profit, while margins may expand. Sonal brings in all the details. Sonal?
Well, a good quarter is expected from Reliance Industries this time around. Remember, the stock is already up 21% this year so far. In terms of revenues, expecting a decline of 8% on a sequential basis. That is because raw material prices have come down. But EBITDA will see good growth, 3% in terms of absolute number. But in terms of margins, it will be a 200 basis points increase to come in at 18.7%. Profits also expected to go higher by 16% on a quarter-on-quarter basis. What will drive growth for Reliance this time around? It will be the O2C, digital and retail business which will drive growth. However, it will be offset by some weakness that we'll see in the oil and gas business. For O2C specifically, it's a 19% YOY increase expected in EBITDA this time, 3% on a sequential basis, which will partly be offset by refinery shutdowns that the company took. For Jio, the ARPU is expected to increase by 1% on a sequential basis. And for the retail business, the expansion will be on the back of JioMart scale-up, operating leverage and increasing footfalls as well. So watching out for these numbers, expecting to be a good quarter where EBITDA will be at a 5-quarter high this time around, continuously seeing an improvement.
Sonal, thanks a lot for that update. Take a short break here on a business lunch. The Nifty now down 165 points as we speak. But remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at noon for the Global Reset, 1 p.m. for the Big C, and the Global Lens at 8:30 this evening.
Welcome back. You're watching Business Lunch on CNBC-TV18. Cryptos are buzzing in trade and is near an all-time high after the US passes 3 big bills that are expected to bring cryptos into the mainstream. My colleague Manisha Gupta joins us with more on this.
Very positive news coming in from US clearly tells you that there is more support or steam left in case of cryptocurrencies there. So when you look at Bitcoin, well, yes, $120,000 is back onto this one. All-time high has been at around 123. So not too far away from those kind of levels. And if you've been tracking Bitcoin, you do know that it moves very fast when it comes to that. So in the last month, we've seen Bitcoin gain up by 15%. But it's not just about Bitcoin. If you look at the altcoins, Ethereum for that matter, is gained up by 44% in the same time. Well, let me tell you that there are at least 5 to 15,000 cryptos that are perhaps launched on a daily basis, and that's how they get lost as well. But it is 2,000 cryptos which are actually strong, active, have a very strong market capital as well. And within this as well, 50 is something that you will need to perhaps keep an eye on, follow, watch as well if you were looking to invest in cryptos as well. But what I want to talk about today is, it's the crypto week right now, this one, and we have seen a lot of deliberations go through in the US ahead of that. And what we finally do understand is that the 3 laws have been passed by Senate onto this one. One is Genius. Remember, we've been talking about that. It is the guiding and establishing national innovation for US stablecoins. This is something that there has seen a lot of push come in as well. The second one is Clarity. Now, this is about establishing a stronger market structure, a friendlier one when it comes to many of those cryptos. And the third one is Anti-CBDC Surveillance State Act. What we also do understand is that Clarity is something that you could be looking at the US, rather, Genius is something as an act which the US president perhaps could sign on in today itself. And the other two, Clarity and Anti-CBDC bills, will go in for further discussions if there is an amendment or not. And then it would land into the White House for further signing as well. So it does seem to be moving pretty fast. And this is exactly what is giving a lot of comfort and support in sense of the pricing there.
Well, nothing bit about the Bitcoin. Yes, Manisha, thank you for that update. Nearing record highs is the cryptocurrency. Well, the National Stock Exchange has launched its new monthly electricity futures contract with the aim of helping market participants with a robust platform to hedge against price volatility in the power sector. Now, speaking at the launch event, SEBI Chairman Tuhinkant Pandey said that the upcoming electricity derivatives market will be backed by regulatory safeguards to ensure stable pricing for the participants. Listen.
India has made significant progress in strengthening its energy sector in recent years. The country is successfully balancing the twin goals of meeting rising electricity demand and promoting sustainability. According to the International Energy Agency, 85% of the increase in global electricity demand over the next 3 years will come from emerging and developing economies. India's energy demand, driven by sustained economic growth, is expected to grow rapidly. Consequently, India's share in global primary energy consumption is projected to double by 2035. The Ministry of Power and both regulators, SEBI and CERC, have worked together to facilitate electricity derivatives in India. Electricity derivatives, starting with monthly futures, will provide market participants a transparent and regulated platform to hedge against price volatility. These contracts will complement physical power trading by adding a layer of financial flexibility. Electricity derivatives will help participants plan more effectively by managing price uncertainty, mitigate revenue risks, and attract investments in the power sector.
Well, shifting focus then, the Supreme Court transfers public interest litigations against opinion trading across various high courts to Supreme Court itself. The Supreme Court says these litigations across high courts should be heard by the top court. There have been public interest litigations against opinion trading filed in the Bombay, Chhattisgarh and Gujarat high courts. Opinion trading platform Probo Technologies had approached the Bombay High Court seeking a transfer of all the public interest litigations. A viewer alert, opinion trading applications like Probo allow users to wager money on future outcome of sports, economy, politics and markets.
Interesting developments there. Time to take a short break. But just as we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC TV18's all-new app, where you get breaking news, in-depth articles, financial world updates, all of it at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen. We'll take a short break. Back on the other side. Welcome back. In some big news coming in from the Silicon Valley, investors of Meta and CEO Mark Zuckerberg have reached a settlement to end the $8 billion trial over Facebook users' privacy. The trial, which began on Wednesday, now stands adjourned. The case, which began in 2018 after revelations that data from millions of Facebook users was accessed by Cambridge Analytica, which played a big role in Donald Trump's 2016 presidential campaign. Zuckerberg and other officials of the social media giant have agreed for a settlement, but the finer details of the deal are yet to be known.
Well, moving from the US to the UK then, the UK government plans to lower voting age to 16 in a major electoral reform. The government argued that this change will align UK's voting age with that of Scotland and Wales. According to the UK Parliament research, 16-year-olds are more likely to vote than 18-year-olds when they are eligible.
Now, in what could be considered a win for India's diplomacy, the US State Department has designated the Resistance Front as a foreign terrorist organization and specially designated global terrorist organization. The TRF is considered a Lashkar-e-Toiba proxy. It is this outfit that claimed the responsibility for the Pahalgam attack, which killed 26 civilians. The TRF has also claimed responsibilities for several attacks against Indian security forces.
Well, moving on to a path-breaking development in medical science, doctors at Newcastle University have released a study showing that a new IVF technique has helped stop genetic diseases from spreading across generations. The next report tells you more about the process.
The technique, which is banned in the United States, transfers pieces from inside the mother's fertilized egg, its nucleus plus the nucleus of the father's sperm, into a healthy egg provided by an anonymous donor.
For example, rapid heart failure, sudden death, neurodegenerative diseases.
That's Newcastle University's Doug Turnbull.
In some families that we've looked after for many years, it's clearly running through the families. This disease is running through the families. And therefore, what we're trying to do is prevent that transmission. So in effect, you've got the nuclear DNA that makes us all us, and then the mitochondria from a donor woman. That egg is then transferred back, that embryo is then transferred back to the mother, and then she has the baby.
8 children whose mothers underwent this procedure were all healthy at birth, with blood tests showing no or low levels of mitochondrial gene mutations, scientists reported in the New England Journal of Medicine. All have made normal developmental progress, they said. One of the 8 children is now 2 years old.
Some path-breaking developments indeed. We take your leave on this edition of Business Lunch. Numbers of Atul flashing at the bottom of your screen. From Amakshi and me, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vivek Iyer. For the markets, continues to be a down day. It's a Friday which is turning out to be weak for the bulls for sure. But there's a lot to talk about, a lot of earnings and a lot of stock reaction.
That's right. So let's start straight away. We'll start off with the top headlines. Stocks fall and disappointing start to the earnings season. Financials and private banks are the big drags, while metals remain a bright spot. Midcaps fall in line with the Nifty and the Sensex.
Nuvoco Vistas trades higher after profit recovers in the first quarter, driven by a focus on cost and sequential realization growth of 5%.
News in software under pressure post-management commentary says revenue was hurt by delayed large deal closures and slow client decisions. Adds that they expect implementation and large deal closures to improve in the second half of FY26.
Clean Science Tech skids after trims margin guidance and points to likely stake sale by promoters. Okay, all right. Those are the top headlines. For the markets, we've been talking about that cut. Nifty is below the 25,000 mark. Mid-caps are falling in line with the benchmarks. But, you know, when we talk about movers, there's a lot that's happening in the mid-cap space.
That's right. A lot of stocks moving on the back of results, on the back of commentary in the conference call of management. And Hormuz is standing by the wall to encapsulate all of the top movers in the mid-cap space of the market. Hormuz, over to you.
Third straight down week coming in for the markets. So only apt that we start off with the losers then. And besides the news flow and earnings-driven names, there are stocks that are still trading with losses. Look at MPS now. It's down 15%. It's in a very sharp fall over the last few minutes. Veranda, after the CNBC-TV18 news break confirmation, is down almost 6.5%. And Goodyear India too, down around 5.5%. Take a look at some of the earnings reactions today. Newgen Software down another 6%. After yesterday's 6% fall, taking it possibly its worst week this year. Clean Sciences has now extended its losses down 8%. Root Mobile and Sterling and Wilson too, earnings reactions of around 4 to 4.5% each. You take a look at the defense names, they have not had a very good week either. You take a look at Bharat Dynamics, you get Data Patterns, Cochin Shipyard, all of them have declined anywhere up to 8 to 10% all through this week. So it's been a negative week for all of these defense names. So stocks that are bucking the trend, if you could call it that, on the volumes front as well. You take a look at GMDC at the very sharp spike here, 10.5% higher on that stock. Tatva Chintan Pharma, marquee investor, checking in the June quarter, so 7.5% higher here on very strong volumes. And lastly, in a wobbly market like this, there are still stocks that are at a 52-week high. Take a look at KIMS, Anand Rathi Wealth, of course, doing well for itself. KRBL is at a 52-week high, and a result reaction, Nuvoco Vista too, at a 52-week high today. Back to you guys.
Okay, all right. Thank you so much, Hormuz, for joining us with that list. It's a good time to welcome Hemeen Kapadia from DR Choksi Finserv for a technical check on the markets. Hemeen, good afternoon. Thank you so much for joining in. Can you quickly tell us what are the next important levels to watch out for on the Nifty and your individual picks as well?
A very good afternoon to you, Sonal. Thank you for having me on the show. It's always a pleasure. As far as the Nifty is concerned, I'll just take 30 seconds. 7 weeks between 24,500, 25,200. Gave a breakout, flopped, came back close below 25,200 week. So 25,212 is a level to take out now if we expect an upside. 25,000 was a near-term swing low, which has broken today. So now 24,792 and 24,492. These are the two levels on the downside. The VIX is 11.5, Sonal. I would be unpleasantly surprised if it goes too much below 24,792, because such a low VIX, expecting a bigger fall, seems slightly out of place. So I would say we are corrective, but I believe there's not too much of a downside the way I see it.
Hemeen, your individual picks as well?
Yeah, individually, I mean, bullish on PSU banks and real estate, but Godrej Properties has moved a bit. So it's a conditional buy. We moved up, let's say, $150 in the last 5 trading sessions. So we're currently at 23.57, Vivek. So a buy on Godrej Property at around 23.40. Stop loss of 22.90, target of 24.40. Risk reward ratio 1:2. The other stock which I like is Astral Limited. We've had a corrective phase. We've taken support. We formed a base, taken support on the 55-day exponential moving average. Things are improving on the weekly chart. Simply put, we've had a deep fall. We've had a bounce, a retracement. Now we are setting the stage for a move up again. So a buy on Astral at, once again, slightly lower. It's 1509. So buy at 1500. Stop loss of 1460. Target of 1580. Risk reward ratio 1:2 both. We're playing for a contra buy because I feel next week is where the market could be possibly bottoming out and turning. Vivek.
Okay, all right. Thank you so much for joining us with those picks. Have a great weekend ahead, Hemeen. But with that, we'll slip into a short break. Remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists, shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m.
Welcome back to Mid-Cap Radar. Well, in the broader end of the markets, what we've actually seen is we've seen a few companies that have delivered the results, and the results have been quite good. In fact, if you look at Shoppers Stop, that particular company, this particular quarter has seen a very strong operational improvement. And to discuss that, we are joined by Kavinder Mishra, who's the MD and CEO at Shoppers Stop. Thank you so much, Mr. Mishra, for joining us. First up, very strong operational improvement that we've seen, almost 8.6% revenue growth in Q1. Taking this into account, where do you expect to end FY26 at in terms of growth?
First of all, thank you for inviting us and representing Shoppers here. I think the numbers have been quite strong in Q1, and we expect that the similar trend will continue over the next few quarters. We are seeing a demand improvement, and I think there's a lot of stuff we are doing in terms of getting our brand love in play, creating brand IPs, which are very powerful. Our journey of premiumization, which is actually driving a lot of customer insights, driven on customer insights, driven on customer love. I think that's something which we are really pushing right now. And with this journey of premiumization and customer experience, we are very sure as a team that we would be continuing to lead this kind of a growth. We had a 5% like-for-like growth in our departmental store business in the month of in the first quarter, and very sure that this is something we'll continue driving. In fact, the best thing which has happened to us is that our premium and premium plus categories have done really well. They are growing around 9%, 8 to 9% like-for-like. And I think that's the journey which we are on in right now, and that's what we're trying to drive.
Okay. So, Mr. Mishra, you're saying whatever you've done in Q1 will continue for the rest of the fiscal as well?
I see. Let me talk about Q2 to start with. Q2, sure. We hope, and we are very sure that because a lot of this is driven by operational efficiency. So I see Q2 to continue to remain strong, and then Q3 comes in. While for the full year, it will be too early to comment on, but I see a strong number happening in Q2 as well.
So, while you say you see strong numbers coming in Q2 and the rest of the fiscal as well, you had earlier said that you aspire to grow double-digit in the beauty business. This time around, beauty business grew 2% ex distribution. Can you explain where the variance was? What is the target here?
Okay, so beauty is something which we want to drive at a double-digit number, as you rightly said. In Q1, we had some challenges in the entry price point of masstige brands, but our premium end of the merchandise has done well, and fragrances have actually shown a lot of growth. So we keep on investing on this business and keep on growing this as we move ahead.
So are you moderating your expectations from the beauty business for the rest of the year? You were targeting a double-digit growth. So end FY26, where do you expect this particular business to grow at?
No, we should be at a double-digit growth as we speak for the beauty business. It continues to be a area of growth and investment for us, and we continue to looking at driving this number strongly.
Okay. So, Mr. Mishra, while we're talking about an operational improvement in margins this time around, you have been investing in value fashions. There are plans for store additions as well. What kind of operational performance will you see going forward? Also, you're increasing contribution coming in from premium products. What does it do to your margins by the end of this year?
So so the premium product contribution right now is around at 67%. We expect this to be going up at least by 300 basis points for the full year. When we start selling premium brands, two things happen. One, the productivity goes up strongly. So I think it's a positive gross margin improvement. 1.2x is typically the gross margins for a premium product versus a popular one. So I think that's something which we'll keep on driving. Intune, which is our value business, we expect to open between 30 to 40 stores this year. We opened 2 in Q1, and we are looking at opening 7 to 8 in the coming quarter.
And what are the internal targets you've set for the Intune part of the business? How big is, or what is the TAM over there? And what is the aspiration that you've set for yourself in that particular segment?
It's very early, very, very early days for Intune. We want the baby to first crawl and then walk. But as a team, we are quite confident about this business. We'll continue to invest in it. And we see this business getting customers from unorganized to organized, which actually in a way fits into our ability to drive premiumization across the segment. So I think that's something we'll keep on driving. Very early days, but we see as a very large business and area of growth for us going forward.
Okay, so Intune is yet not crawling. What is your target here?
Baby's crawling. it will start walking. I think once we do once we create a 125 stores cluster, that's something where I think it starts getting critical. We are at around 80 odd stores right now, and we should be at around 120 number by end of the year.
Okay.
Okay, so especially when we are talking about the bottom line Q1, it continues to remain loss-making. End of FY26, could you leave us with a target of how exactly you expect to grow over FY25? And operational margin, what is the aspirational target you've set for yourself?
Too early to comment on that, but I think you will see a substantial improvement in FY26 over FY25.
So it'll be profits in FY26?
Sorry?
Will it be profits? Will you see profits in FY26 overall?
Yes.
Okay. All right. Take that point, Mr. Mishra. Thank you so much for joining in with your take on Q1 numbers. Most importantly, the outlook going forward. That's the word coming in from Shoppers Stop. With that, we'll slip into a short break. As we do that, here is some good news for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, and just scan the QR code on your screen. Welcome back. Let's address a recent news flow. European Union, they've reached an agreement on an 18 sanction package against Russia over its war in Ukraine, with a slew of measures aimed at dealing further blows to Russia's oil and energy industry. To understand the impact of all this on India, on Indian refineries, crude sourcing and a lot, we are joined by Mr. M.K. Surana, who is the former chairman and MD at HPCL. Mr. Surana, good afternoon. Thank you so much for joining in. Well, there are a number of sanctions which have been put out right now. One of them is lowering the cap on Russian crude sales to $50 per barrel versus $60 per barrel, and a lot of things with respect to containers which are used to ship this crude oil to the different parts of the world as well. Since India is a big importer of Russian crude, how do you think this will impact supplies? And do you think this is something which could disrupt the supplies overall?
Good afternoon, Sonal. So, as you already mentioned, that I think they have changed it to the dynamic adjustment in the crude price cap now. And it will be varied as per the market price of the crude. And right now it is being set somewhere between $45 to $50. It will be likely to be 15%.
I'm sorry, sir. We've just seemed to have lost the connection while we wait for Mr. Surana to rejoin us. This particular development in Sonal, you've been tracking this space quite closely. It's going to have serious implications, right?
It will, yes. So if we just take you through the points or the sanctions that have come about as well. First is fresh restrictions on companies linked to Nord Stream gas pipeline, which is the biggest pipeline for gas transportation. Russia is the big gas producer. The second would be lowering Russian crude sales to $50 per barrel versus $60 per barrel earlier. Mr. Surana was just explaining that to us. They will be cutting off SWIFT global payments to 22 Russian banks. They will also blacklist fleet transporting Russian oil to different parts of the country, different parts of the world actually, and on the export of equipments and materials that could be used in the Russian defense industry. Just for the oil and gas space, there will be Russian restrictions on Rosneft's 20 million tons per annum of refinery in India as well, and sanctions are likely to impact both crude sourcing and refinery exports from the plant. So what does it mean for oil marketing companies? Around 25% of crude is imported from Russia right now. That only means that that export could be impacted from Russia because now they are sanctioning fleet. They are also talking about lower cap on crude oil prices, and the cost could increase instead of staying the same despite global crude prices remaining range bound at these levels. So it has come in as a negative surprise considering how dependent we are on Russia right now.
And post this particular tweet that did come out from the EU, you did see a sharp spike, especially as far as the share price of ONGC was concerned. Oil marketing companies have been a little depressed, but ONGC, on the other hand, did surge to the day's highest point. The other important aspect, that we will need to ask Mr. Surana, once we are able to get him back on the line, is what will be the associated impact cost, especially as far as logistics are concerned. While there will be a cap as far as import of crude is concerned, there will, number one, they're speaking about vessels, and number two, the associated logistics cost. What will be the impact? Mr. Surana, I hope you can hear us. If you heard the question, what do you think would be the impact of this particular move?
Yeah, I can hear you. So basically, as I was mentioning, that the new 18th round of sanction, it basically relate to dynamic adjustment of the crude price cap, and it is expected somewhere between 45 to 50 to start with. It's likely to be 15% below the market price, and some additional sanctions on some of the shipping lines. Now, as far as supply part is concerned, the market is well supplied, and therefore I don't see there is any possibility of supply disruption. Rather, there is a oversupply in the market currently, and we may end up CY25 with a surplus of around over 1 million barrels per day of supplies. As far as demand is concerned, still tariff uncertainties are there, and energy transition is also slightly in uncharted territory to that extent, though the EV sales are increasing. So I think there are concerns on demand and there is no concerns on the supply. As far as pricing is concerned, then India has in the past taken from Russia, and they did a good tightrope walking on this diplomatic front, and I think India may continue to do so. I don't think as of today, America has supported that move of EU to reduce the price cap, and unless that is done, any effective implementation of a sanction may also be a difficulty. But overall, I don't think that it is going to be a major disruption, both price-wise as well as supply-wise in the market.
Okay.
As far as India
Yes. So as far as pricing is concerned for crude oil, it is not an impact. But the other part of this sanction also talks about restriction on operations of Rosneft's 20 million tons per annum refinery in India. How do you think that could impact things? Will it improve cracks? Will it reduce refining capacity? How do you look at that particular development?
No, Rosneft is a different case because they have got the Russian ownership as such, and that case is different than all other refineries in India. So coming back to that, Rosneft, as far as Niara or Rosneft refinery is concerned, they've got a different way of operations. Many times they sell off all of their products in the beginning of the year itself at a certain margin because they also had certain traders as their equity partners. So as far as India is concerned, we are well supplied even as far as products are concerned. And though some of the oil marketing companies have been taking the products from them, but as such, I don't see any issue irrespective of the operation of Niara on the Indian supply condition, because in diesel we are anyway surplus. MS also we are well supplied, and the newer capacities are also coming in the system now. So I don't see much of impact on the Indian market as such because of that as well.
Right. Mr. Surana, you've watched this space for a very long time. You've been closely involved. What we want to understand is we understand that India was actually importing crude at almost $2 to $3 discount compared to the current price from Russia. So how does the sanctions actually change the oil bill? Number one, for India, do you think India will now go ahead and renegotiate the entire situation with EU? And also China being a big importer, how does it impact them?
So it is a basic, it is a part of the economics, which is a combination of the crude price, what you and me know, the discount on that, the freight cost, insurance cost, and also what we call is the gross product value of the crude. So not all the crude has got the same product value, and the refineries do evaluate different types of crude depending on whatever the configuration they have. So that economics will continue to play, and Indian refineries will buy which crude suits them the best economically and technically. So if with a lower price cap, I assume that the Russian crude will be available at more discount to India, and in that case, it may become more profitable for Indian refineries to buy that. But at the same time, the crude is a global commodity, and when one part of the supply line is changing, alternative part of the supply line has to make up for that. So Europe has to buy from somewhere, and otherwise it gets adjusted over a period of time.
So are you slightly surprised that crude prices aren't reacting in a sharper manner? The street actually would have expected crude prices to spike up significantly. Is there still
a supply demand? It should not also. There is no reason for crude price to hike. Rather, I won't be surprised it drops. Because the supply is surplus, the demand is not picking up. There is a possibility of getting the crude at a lower price. So what is the reason for the crude price to hike?
Yes.
If it happens, it will be only speculation, in my opinion.
Totally take that point. That's coming from a person who's seen the market for over various cycles. So we take that point. Thank you so much for joining us with your insights, Mr. Surana. Always a pleasure speaking with you. But with that, we'll do one thing. We'll take your leave on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, a day a bit more of consolidation that we're seeing coming in on the last day of the week as well. And today we're trading below the 25,000 mark. So as of now, the Nifty is down almost 0.5% in today's trading session. 24,959 approximately is where the Nifty is trading at, down 0.6%. Now, we've not seen any sort of a sharp recovery that's come in also, so let's keep an eye on that. Broader end of the market, that's not doing well. And pull up the advance decline ratio today, clearly in the favor of declines versus advances is what we're seeing coming in terms of the advance decline ratio as well. So that's why the broader end of the market also not seeing anything great, and advance decline ratio, like you can see, in the favor of declines versus advances, 1,757 stocks declining as of now. Now, banks is something that is leading the fall as well today. So banks is down almost 1% in trade today. Axis Bank, obviously, numbers were not great, commentary not great. That's keeping the stock under pressure. And other than that, we're watching out for a whole host of earnings that'll be tomorrow. So private banks, we have ICICI Bank, HDFC Bank. Other than that, we'll have RBL Bank, Yes Bank, AU Small Finance, a lot of financial names. And that is why we're seeing, that Nifty Bank today is also leading the fall, waiting and watching out for what's going to be happening with, these two other big private banks also will be key to watch out for. But this is a show where we solve all your stock-related queries, and we will be doing that with our experts for today. Shaina Mukaddam, who's an independent market expert, as well as Vaishali Parekh, Vice President, Technical Research at Prabhudas Leeladhar, joining in with us. Shaina, as well as Vaishali, good afternoon, and thank you so much for joining in with us. So Friday is not seeming to be that exciting, Vaishali. Today levels below 25,000. If we keep seeing this fall coming in, is that something we should watch out for actually in terms of a fall on the Nifty? Is that what we're watching out for, or do you think it's going to be getting a support level somewhere at 24,800?
Very good afternoon, Vinny. Yes, so market, in fact, the whole week has been pretty much sluggish as far as the index is concerned. And today, well, there is a confirmation we are sustaining below 25,000 levels. So yes, as you rightly said, we could look for a target of 24,800 to 24,600 to start with, and it should halt there. But beyond that, it's going to be a little bit of a more corrective move. So till then, I would say very, very small range bound, 24,700 as support.
Okay, keep an eye out on those levels. Rain bound is what we're watching out for. But let's get started with those stock-related queries. And the first query for today is coming in from Subramanian, who's writing to us from Bangalore. He was actually allotted 45 shares of Suryodaya Small Finance Bank during the IPO, and that was at around 305. Wants to know the long-term view for Suryodaya Small Finance Bank because they're making a loss on this one. Shaina, your view coming in for this one because they're holding it for a while now. So what should they be watching out for?
Yeah, so the stock price has not actually given any return. In fact, it's half from its issue price, the IPO price, which was, I think, almost 3, 4, 5 years back. While the overall book is going up, it's got about 10,000 crores of its book. But in terms of numbers, it's really not showing too much of performance. And I would believe that, it is better to switch from Suryodaya to some other bank. You could book your losses and move. So I don't see too much happening over here. There are other banks which are available, small finance banks which are available at better valuations. Valuations over here, despite, the stock not having performed, is still 0.8 times book. So I would say switch.
Okay, Shali. Switch is the word coming in here on the fundamentals. On the technicals also, Vaishali, is switch a better option for them now?
Well, I would say not in a hurry. Wait for some bit of a bounce because it is showing some signs of a bounce back. So I would say keep a range of 130. If he's held on for so long, you may as well hold till 130 as support. And if this stock gets into a momentum, it can go towards 160, 170, and then perhaps switch to, these PSU banks because those are the ones, because even the frontline private sector banks have already done its bit of momentum. So I would rather wait for a dip in private banks, but PSU look attractive. So if one needs to switch, I would look at PSU banks.
Okay, keeping an eye out on PSU banks also is something there, but just wait out for a bit. That's a word coming in from Vaishali. Next query for today is coming from Mihir Sharma, who's writing to us from Mumbai. He's holding 100 shares of Bajaj Auto. Price is 3,100 rupees per share. Wants to know if he should add more. of Bajaj Auto. Shaina, your view coming in on this one?
Yeah, so Vinny, I would say that he should continue to hold. He can hold. It's like a fundamentally long-term strong stock. At the same time, I think to add, it's better to wait for the quarter numbers that will be announced on 6th of August. And there we'll have some bit of management commentary. I think that is important because, the components, like based on the based on some magnets that the companies use, especially for EVs, which is imported from China. There is some issue out there. And also, if you see in terms of the domestic numbers, Bajaj Auto sales in the last month that we saw, auto numbers have been subdued. Exports is doing well for them, but I think we need to wait and see, whether there will be any production cuts or anything, depending on the availability of the important components. So some of their new launches are doing well, but at the same time, I think everything is there in the valuations as of now. Price to book about 6 times, EV by EBITDA about 18 times. So I would say do not add now. Wait for the commentary and decide later.
Okay, do not add now. Wait for the commentary and then maybe you can decide on it. As of now, everything is in the price. Vaishali, on the charts and technicals, what's the story that's playing out, right? Because they are making good profit on this one, but they want to add more. Does it merit adding at this point, or are there any levels that they can look to add if the stock falls?
So actually, if you go to see the long-term chart, I mean, right from 12,500 to now at around 8,000 levels. So, there is a long consolidation band of, say, 7,800 to 8,500. So I would say accumulate from here on, because exact bottom fishing is really not possible. So accumulate from here on, keep 7,800 as your good support baseline, and add furthermore if the stock goes above 9,000, because that is when you are really getting into a trend. So right now I would say accumulate, but I think conviction comes about 9,000.
Okay. Keep an eye out on those levels over there for Bajaj Auto. Next query for today coming from Gaurang Shah, who's writing to us from Rajasthan. He's holding 200 shares of KPIT Tech at a price of 550 rupees per share. They're making a profit on this one. Wants to know if he should continue to hold, look to add more, or exit this one. Shaina, what are you watching out for this time from KPIT Tech as well? Given IT numbers so far, TCS Infosys was not that exciting, but LTI, Mindtree, Wipro, we are seeing that some bit of that commentary is also coming for Wipro. Maybe H2 is expected to be better for most of these companies. So then KPIT Tech, those mid-cap IT names, does it merit here?
Well, KPIT is also in a similar boat, I think, like Wipro. First quarter numbers, which are expected soon, next week. There, I believe it is going to be subdued. They are facing some issues in terms of their overall growth. I think both revenues as well as EBITDA could be subdued. But I think over the next, second half will be better. So it is a similar story. So, and I think valuations, while the stock has corrected substantially, if you see last couple of quarters, but at the same time, I think even at current levels, valuations are not cheap. So I would say you could, but it's a good stock for the long term. So you could actually hold, but book part of the profits. So hold some, book some profits, and hold the rest for long term.
Hold some, book some profits, hold the rest for, profits is what we could watch out for. On the technical front, KPIT Tech, because they are also saying that they're ready to hold, buy, or just completely exit. Vaishali, what's your view here?
In my view, of course, see, the stock inherent strength is there. Right from 1900, it has taken the support of a 200 period at around 1100 levels. So the tech stocks being a bit corrective right now, this can retest 1100 levels, and that would be a very good level to add more. So in my opinion, for long-term perspective, definitely add, look at 1100 levels as support.
Okay. Watch out for those levels over there for KPIT Tech. Next query for today coming from Naman Kapoor, who's writing to us from New Delhi, holding 100 shares of Suzlon Energy. Price is 20 rupees per share. He's a long-term investor and wants to know whether he should remain invested in Suzlon Energy. Shaina, your view?
He's gotten at such an attractive price. So he can hold part of it, in my view. Continue to hold. And actually, the performance also is pretty strong. If we saw FY25, 69% growth in revenues, good growth, doubling, profits doubled actually. And management commentary also for FY26 is very strong. They're talking of 60% growth in revenues. Definitely profits also will be up in a good percentage. So I would say you can hold part, but valuations here also are pretty expensive despite, the good performance. If you see EV by EBITDA 30 times, 1 year forward, I'm talking of FY27, and price to book 10 times. So stock is doing well, but I would say take some money off the table.
Okay, that can take some money off the table for Suzlon Energy. As of now, though, overall also they have done well in terms of fundamentals, but some money is what you could book out right now. Vaishali, on the technicals?
Well, technical level, the trend is intact. There's nothing really happening for now. It's getting into a consolidation mode. So, according to me, it should be a hold and look for a higher target of 85.90 once the stock gets into momentum and a rally, because it is showing upside projections. And I think in long term, it will give higher returns.
Okay, keep an eye out on the levels over there also for Suzlon Energy. But on that note, we're going to sip into a very short break. But remember, you can tune into CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to your stocks in CNBC TV18. We still have with us Shaina Mukaddam as well as Vaishali Parekh to solve all your stock-related queries. Let's move on to the next query for today. We have Tejvita, who's writing to us from Bangalore. This is an investment query. Now, they're asking if they can invest in GSK Pharma at the current level. Shaina?
Well, GSK Pharma is a steady growth stock. So you can invest in it, but not at current levels. I would prefer if he could buy it somewhere close to maybe 2,800. I sort of looked at the numbers and their valuations, if you look, are not, too expensive for a multinational like GSK, Glaxo. But at 45 times P, I still think that, it is going to, consolidate slowly and then move up again. While the parent has, Glaxo has been launching some of its parent's new products into the Indian market and cutting costs. So it has been able to protect its margins. At the same time, I think in pharmaceuticals, it is better to have a portfolio of stocks. And here I would add some of the Indian stocks, like the Indian pharma stocks, something like maybe a Biocon, Arbindo. I think these stocks he can add to his portfolio. I would prefer them. In fact, over Glaxo, if you're taking a 3 to 5 year investment perspective and create a portfolio.
Okay, surely. So that is what you can do. Obviously, GSK, yes, but not at the current levels. And Shaina prefers maybe something like an Aurobindo or a Biocon. That would be greater for the long-term 3 to 5 year time of story. Vaishali, what's your view coming in for GSK Pharma? Because 6 months, in the 6 months, you're seeing it move up from around 2,000 levels to 3,000, about 3,000. Now, just in the last 1 month, specifically, you again started seeing that bit of a decline coming in, right? So what are we watching out for technically? Is it a good level to enter GSK Pharma right now? Or maybe they could look at some of these other pharma names.
I would say yes. My view matches with Shaina's because we have seen a one-way rally. So let it retrace a bit. So technically, I would say the retracement ideal level is 27,800 too. So I guess wait for this level and then get into the stock because overall we are seeing good growth trajectory in this, but might as well wait for a dip and then get into the stock.
Okay, let's move on to the next query then. This query is coming from Bala Subramanian, who's writing to us from Bangalore. He's holding 200 shares of ICICI Prudential Life Insurance at a price of 334 rupees. What should he be doing with the stock now? Shaina, we had the numbers also come in for them as well. What are we watching out for now?
Yeah, so the numbers were a bit subdued, but the commentary was good. So here also, again, you can advise to, the investor to take part profits, hold the remaining for long term. Because while the first quarter was a bit subdued in terms of AP, I believe the management is talking of at least a 12% type of growth over the next 2 years, or at least that is what the market is expecting. And in terms of in terms of the commentary, they were pretty, they have management has resolved its commitment to actually grow the VNB business also strongly over the FY26. Persistent ratio is good. There's strong solvency ratio of 212%. So I think overall you can hold part Pru for the longer term, take some profit off the table.
Okay. Let's also get the check on the technical front for ICICI Pru, Vaishali.
Overall, this sector has been doing well and should continue to do well. And in my opinion, if you're looking at a long-term trajectory, this stock looks all set to go towards 750 and higher. So according to me, it should be a buy at every decline.
Buy at every decline. That's the word coming in on the technical front for ICICI Pru. Next query for today, we have Ravi, who is writing to us from Hyderabad. 30 shares of Vijaya Diagnostics he's holding at a price of 531 rupees per share, making a profit on this one. Should he continue to hold, book profits, and maybe look to purchase Laurus Labs at current levels? Shaina, your view?
I would say he should continue to remain invested in Vijaya. I prefer Vijaya over Laurus. While we have seen some bit of softness in the last quarter numbers that were, say, fourth quarter of last year. But I believe that they are expanding, they're setting up new hubs and expanding their capacity. So I would say in terms of valuation also, it is not cheap, but I think there is an upside from here for Vijaya. So I would prefer Vijaya over a Laurus. So remain invested in my view.
Okay, remain invested in Vijaya on the fundamental fronts is the view coming in from Vaishali. I beg your pardon, Shaina. Vaishali, what's your view coming in for Vijaya?
Well, I would not have any view for this because right now it's just consolidating. So, I think Shaina is a better person to take a call on this.
Would you want to say anything on Laurus Labs levels?
I would say, well, I am also looking at Alchem Lab. Those are the stocks which would do well. So yes, I would prefer an Alchem or a Laurus. Laurus has already done its bit, but well, Alchem looks good at these levels.
Okay, surely keeping an eye out on that. Next query for today is coming from Kunal, who's writing to us from Dehradun. He's holding 145 shares of Lakshmi Organics. This is at a price of 458 rupees per share. He's been holding it for a while, clearly making a significant loss here, Shaina. So he wants to know when is the right time now to sell the stock, because the loss is already, the stock is halved from the levels of what they've purchased, right? It's around 200. Shaina, what should they do now?
Yeah, so now it becomes, after this big correction, it becomes difficult actually to see a sell, because now valuations have started, if you look at historical earnings, started looking pretty good. It's a small cap, but, and if you see valuations now, just to finish that point, are not expensive at just about 1.5 times sales. So it is not expensive in terms of your numbers. But at the same time, it's a small cap, and you could relook at it after some time. Sell at a bounce, because the management has got huge plans for growth. They're talking of 1,100 crores of investments in new plant. They're talking of a tie-up with Hitachi Energy. So they have got good plans. The stock has corrected so substantially and it is consolidating. So I would say keep a stop loss and review it some months down the line.
But does it merit even adding some more, maybe averaging it out? Would that be helpful, or just hold on to it and maybe wait for a bounce?
I would not say to add any, because it's not something I would add to my portfolio.
Okay. So just wait for a bounce before you look to sell it. So yes, wait out for that. On Vaishali, on the technical front?
I have a slightly different view, because actually, if you go to see most of the chemical stocks, these organic stocks, they have shown signs of revival. And talking about Lakshmi Organic per se specifically, I think it's on a road to recovery. The worst is already done. It's purely on technical terms, it is taking higher bottom. So now I would say 190 acts as a very good consolidation level. And gradually the stock can go towards 240, 250. I would take the risk of adding more at this level, because it would make it a favorable risk reward. Keep a stop loss below 190. And if this view goes right, if we see a trend setting in this, you may probably get a better rate of your entry and come towards 240, 250 to start with.
Okay, that's going to be interesting. So different views coming in there, but yes, pick your bet, then whatever you all like as well. Do your research, that is important as well. But that's the view coming in on the fundamental as well as technical front here for Lakshmi Organics. Next query coming in is on Eternal or Zomato as we know it. Mayank Khurana is writing to us from Delhi. He is holding 100 shares of Eternal at a price of 230 rupees per share. He's asking if she should continue to hold or look to sell at the current levels. Shaina, Eternal, it's a two-player market. Not much to worry there, but are there any glitches that we should watch out for? And should the viewer continue to hold this?
Between the two, Eternal is, I would prefer Eternal to be invested in. But at the same time, competition is really getting strong in terms of even new entrants that could, listed entrants that could, give you more options to invest. Having said that, at current levels, I would stay invested in Eternal. The Q1 numbers are expected to be pretty strong on all parameters. So, remain invested.
Remain invested is your view coming in. And on the technical front also, Eternal, remain invested or maybe book out of the stock right now?
So depending on your time horizon, right now it is into a little bit of a profit booking. So if you're a trader, 255 acts as a stop loss. But if you're a long-term investor, then please continue holding. This can show 300, 320 in times to come.
Okay, keep an eye out on those levels over there for Eternal. But on that note, ladies, we're absolutely out of time on this edition of Your Stocks in CNBC-TV18. So thank you so much, Shaina, as well as Vaishali, for joining in with us as always. And hope you'll have a great weekend. And viewers, thank you so much for joining in with us and watching us on this edition of Your Stocks. Thank you so much for tuning in. Up next, you have Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Kospi is also down almost 0.5% in today's trading session.
25,255 and then 25,400, which is the 61.8% retracement.
Very strong deal momentum that we have had in Q1.
25,118. The Nifty Bank is down about a third of a percent, 56,640.
Nifty right now, we are seeing some stress come by. So Nifty is at the lows of the day as we speak.
We benchmark to most prudent in market on an annual basis.
The electronics industry, which also uses these magnets, is also impacted by this severely.
For the markets, we've been talking about that cut. Nifty is below the 25,000 mark.
Well, that is the day so far, and it has been subdued. 500 lower on the Sensex, Nifty down about 140, 150 odd points. So it's kind of ending how it started this Friday as compared to the Monday trading session. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Surabhi. Guys, good afternoon.
Hi, and we've been below the 25,000 mark for a greater part. I think it's only in the morning for the first 1 hour that we were above that level. And there hasn't been much recovery from the lows.
But at least, guys, we were almost threatening to break 24,900 also at one point. So at least from there's some kind of, semblance of stability that's come in. But there's no denying it. It's been a weak day and it's been a weak week as well, at least as far as the headline index is concerned.
No, absolutely. And I think if you just look at the Nifty, which is around 125, I think 50 index points is just Axis Bank and ICICI Bank. 25, 20, 25 in that. I mean, the index changes will give you that plate will tell you exactly the split. And actually IT is pulling the other side. IT has been down all this week, but IT, for what it's worth, is up a little bit. I mean, a bunch of large cap IT stocks, but it's banking, which is really, there you go. The IT index is flat, in the green at least, but it's banking, which is the majority of the cut, which is coming. So it's, one thing or the other. It's IT, now it's banking. HDFC Bank numbers are there tomorrow. I don't think it's numbers really. Numbers are expected to be pretty okay. But, I think after Axis Bank, there is a bit of nervousness, which we're seeing across the board. So 25,001, right? That was the low, that was the low so far. That low is gone now. And if we close under it in a substantial way, in a convincing way, and I think then we'll have to kind of sort of look at lower levels really, which kind of start to come into play. The assumption was that this level will hold, the low will hold, and then maybe the market consolidates a little bit. So the close today, weekly closes are always important in any case. The mid and small cap indices, I think they're also maybe not doing very much. Advanced decline, the last I checked, was negative. But it's not as if there aren't buzzing stocks with volumes. There is a fairly long list which is active in that sense as well. Guys, I just want to quickly put out the, what's coming up on the show in terms of stocks, etc. This is what we're going to talk about, right, on the show over the next 60 minutes or so. The big movers. Axis Bank is trading with deep cuts, so that's coming up in some detail with our research analyst. It's the top Nifty losers, of course, loser after sharp deterioration in asset quality. Wipro is the other one. Reema is going to talk about this. So it's up after management guided for a much stronger performance in the second half. There are some upgrades as well. LTI Mindtree is the other one, which is still... which is, of course, on the show as well. The management will be speaking with us. So that's another company, a stock, which we will focus on. And, of course, we're watching out for numbers from Reliance Industries. That is later today. That is a big one. And that has the potential to move markets. So we'll be sort of getting you expectations from there as well. HDFC Bank, ICICI Bank over the weekend, as always, on Saturday. So it's a busy weekend. We'll get you previews going there. So that's all of which what is coming up here in Closing Bell over the next 60 minutes or so.
Yeah. So ICICI Bank, HDFC Bank and Reliance, the three of them, that's 30% of the Nifty weight. Yeah. And that outcome is going to be decided in the next 24 hours. And you spoke about, IT. It's actually just Wipro, and Wipro's weightage in the Nifty is sub 1%. So unfortunately, although it's up, it's higher by, I think, about 2.5%. It's not really moving the needle too much. I think 0.65% to be precise is Wipro's weightage.
No, that's right. So it's not doing too much. But another point to note is that so far, this week, the broader market was outperforming. The mid-cap index was up 1.5%, small-cap index was up almost 2%. But today, a lot of that is also changing. And today, you have the mid-cap index down. The advanced decline ratio is very negative. So that sense of, forget about the index, keep looking at stocks, that is under a bit of a question mark as we speak. I just want to point out one or two quick names before we move on. There is some profit-taking in defense stocks that's very, very clear today. So look at a Bharat Dynamics, a Data Patterns, a BEML, Astra Micro. All these stocks are down between 2, 3, 4%. That's the Nifty Defense Index, losing about 2%. On the flip side, I mean, if you want to look at gainers, then I want to point out one stock actually, and that would be GMDC. Now, the rare earths buzz is back. There are indications that there could be a high-level meeting, perhaps chaired at the PMO level itself, that could be looking at the whole rare earth issue, the crisis, and how India can offer a counter. And GMDC is known to be, a company that could have significant operations here in terms of not just mining, but further processing rare earth elements as well. And that buzz has led to this move on the stock today. So keep it in mind. We'll discuss it with our colleagues, with our experts and our guests as we go forward. Let's get started. Then Ashish Kayal is with us on the show. So let's get some trading strategies going. Ashish, hi. How have you read the market's weakness? And what are the trading calls now?
Hi, Surbhi, and afternoon to all the viewers as well. See, if you look at the market weakness, yes, we have moved down below that 25,000 mark. But if you look at the overall OI data, that suggests that both the call sides and the put sellers are still active on both sides of the tail. So which means that it's still expected to be a range bound movement with a minor support at 24,920, a major hurdle at around 25,080, and I think around 24,920 and 25,080, that's the range we can now expect markets to move. There is some kind of a short-term attempt to move back on the upside, but 25,080 has to be broken for any kind of a meaningful upside movement. This major dragger has been Axis Bank post the results, but Bank Nifty has also moved on the downside. Having said that, there has been stock-specific action that has continued, and I think the first stock pick over here can be NMDC. We can clearly see a very smart bounce back in today's session. The stock was consolidating over past few days, managed to move back on the upside today, breaking out there, and we can expect a target of around 75 on NMDC. On the downside, one can maintain a stop loss in this stock at around 69. And the next stock on the buy side is going to be Ambuja Cement. It has been slowly and steadily inching higher and is about to start the third wave on the upside, which looks to should be a strong momentum picking up in the coming week. And one can expect a target of around 630 in Ambuja Cement. On the downside, maintain a stop loss of around 588 levels.
Got that. By the way, some large financials are moving. So Bajaj Finance has moved to the day's high. It's 2% up, crossed the 50-day moving average. And the other one is ICICI Bank. ICICI Bank is up close to about 2/3 of a percentage point. From the day's low, it's a recovery of 1.5%. Look at that spike on ICICI Bank in the last hour of trade going into its numbers tomorrow. But the big gainer on the Nifty today from the word go has been Wipro, so holding out with a gain of about 2.5%. Now here Q1 was muted on expected lines. There was no negative surprise, but no positive surprise on revenues or margins. But what did the street like? Just two things. One, the company is guiding for improvement. For Q2, the company's guidance is -1 to +1%, which means at the midpoint, it's 0%. This is an improvement compared to -2% in Q1. So on quarter-on-quarter basis, assuming the macro doesn't deteriorate in an extraordinary fashion, Q2 should be better than Q1 by approximately 200 basis points. Then the company in our interview said that H2 should also be better than H1, should be stronger. They're quite optimistic about it. And when asked whether this translates into FY26 being better than FY25, they said, I think so. What's underpinning this confidence is the deal wins. Deal wins for the company have been very strong. Large deal wins are almost touching that $5 billion mark. The deal pipeline continues to remain strong. The total deal wins are $5 billion, close to that. Large deal wins, 16 large deals won in the quarter gone by. So that's giving the company a lot of confidence into the next couple of quarters. In fact, we spoke with the management, listening to excerpts from that conversation on growth, margins, and how they see the environment.
So there is this very strong deal momentum that we have had in Q1, which we tend to carry to Q2. Of course, some of these deals will take its own time before we start ramping up. Second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
For those deals to really translate into revenues, it will require upfront investments. There will be pressure on costs. You know that large deals typically come at lower margins, and there will be some pressures that we will have to offset. We will go back to that muscle of operational excellence that we will continue to drive. And those are the puts and takes on margins. We don't guide for margins, but we are happy with our performance in Q1, an 80 basis points improvement. And from there, we will take it. I think in Europe, we've had, for the last 4 quarters, we've not performed as well as we ought to have. It has been a combination of the macroeconomic environment, lower discretionary spends, but also certain client-specific issues that have played out. We believe we are very, very close to bottoming out. We have a large deal win that we have secured, and also some very good deals that we have also secured in Q1. Our pipeline is good, strong. So we are very, very hopeful of Europe bottoming out and coming back into performance starting second half.
Okay, that is Wipro, and the stock's been holding up. We have Sudeep Bandyopadhyay joining us on the show this afternoon. Sudeep, great to have you on. So let's start right there. Finally, an IT company where it's not a complete washout, at least. The market is keeping the faith, keeping the hope on the second half being stronger. Are you convinced?
I think definitely it's a significant improvement compared to the others. Look, what I liked is the confidence of the management about the second half of the current fiscal. The CEO, MD CEO, very emphatically answered to you guys that second half will be much better than first half. While explaining, the CFO as well kind of agreed to that. So this is interesting, and this shows that their deal pipeline is strong, and they are not waiting for something new to happen to ensure that the second half will be good. They're already it's already in the bag. They know second half is going to be good. Future improvements will only add to that. So yes, I think Wipro definitely has shown that there are green shoots visible in their performance and in their earnings going forward.
Okay, that's the word coming in on Wipro. Let's talk about LTIMindtree. Q1 numbers were in line with estimates, but the stock is under pressure today. Kotak downgraded the stock, saying that it trades at full valuations of about 27 times forward multiple, plus the stock had gone up 24% in the last 3 months, and therefore they downgraded it, which perhaps explains why the stock is a bit muted today. We caught up with Venu Lambu, the Chief Executive Officer, Managing Director of LTIMindtree. Venu, thank you very much for joining in. Was Q1 largely in line with your estimates, and what can you guide for Q2?
Look, yes, the Q1 was in line with expectation. We grew 2% quarter on quarter on US dollar terms, and we expanded our margin as well. In line with the overall strategy that we have to double our revenue to $10 billion over the next 5 to 6 years, I think we've made a very promising start in that journey, right? And which is really an exciting period. And with regard to the momentum continuing into the subsequent quarters, absolutely. I find no reason why we can't continue the same growth momentum, and fairly confident about expanding our margin as well in the subsequent quarters.
Okay, so Q2 will be better, but what about the second half of the year being better than H1? Are you optimistic or confident about that?
Look, in second half, I'm actually, expecting that at some time in second half, we will have almost close to double-digit year-on-year growth, right? So we announced a very large deal at the beginning of the Q1, and we're almost at the final stages of announcing a couple of very large deals, and one of them can beat the record of a previous last deal that we announced. So all this momentum will carry, it forward towards the H2. And sometime in H2, we will have a year-on-year growth of closer to the double digit.
Okay, got that. Mr. Lambu, what has been the margin benefit so far under the Fit for Future? How much more do you think, what's your elbow room? How much more can you expand margins by?
Look, from Q4 to Q1, we actually increased our EBIT margin by 100 basis points, right? So if there was no one-off cost that we incurred, related to the visa and other things, we would have got the full benefit. But I'm sure part of that benefit will follow into the Q2 anyways. So we expanded it by 50 basis points in Q1. And I expect, over the next couple of quarters, we will at least achieve a 100 basis point margin outlook, in our business. So the Fit for Future is going very well, not just on the cost aspect of it, agility, transparency, that we can bring in the processes, agentic adoption into our internal business models, and most importantly, how do we enhance our competitiveness in the marketplace by rebaselining the cost and increasing the agility in our, the way we respond to our client demand and so on. So with that, I'm fairly confident that we'll continue to improve our margin at the minimum of 100 basis points over the next couple of quarters.
Okay, so confident about growth, confident about margins improving. Some analysts yesterday thought you sounded a bit cautious on BFSI. Is that the case?
Look, I don't know what gave an impression of being cautious. I've been very optimistic about how our business overall, especially in the context of our $10 billion journey and doubling our revenue in the next 5 to 6 years. If there is a seasonal weakness of in a particular quarter and year, it doesn't give any directional indication towards the growth of our business in the BFS, right? I mean, we have a very strong relationship with the BFS space. We support all the global banks and regional banks across different aspects of the financial services institution. So, there may be, a quarter here and there in our journey of, $10 billion where we might have some seasonally weakness quarter on some project coming up too early and so on. But otherwise, I don't see any material impact in the structure of the business that will slow down what we want to do.
What makes you confident about hitting this double-digit revenue growth at some point in H2? Because your peers are still talking about low, mid-single digit kind of revenue growth. Is it purely, does your confidence stem from the deals that you won that are in the pipeline, or are you anticipating a turn in the macros?
Firstly, when we talk about the order booking, I spoke about that we are almost in the final stages of announcing a couple of large deals. So that gives me confidence that we will continue the momentum of the ordering flow of the same range of $1.6 billion at least that we have been delivering over the last few quarters, that to continue. That's number one. And, number two is that, at some point off in the second half, our aspiration is to get into the double-digit growth in a year-on-year basis is at the back of these last deals. And also, the three big transformational initiatives that we're driving within the organization, right? So we are transforming our sales organization, with new capabilities and our ability to win deals, right from sourcing to the ability to close the deals. The second is our pivot to the AI-centric organization. We launched Blueverse, which is our agentic ecosystem for AI, and that has already gained traction. We actually have, got the first deal within 30 days of our launch on Blueverse. All right, and the third one aspect is that the Fit for Future program. The Fit for Future program actually makes us more competitive, makes us more agile, and we rebaseline the cost and our ability to win large deals and still continue a profitable journey is possible as part of these initiatives. So there's a bigger picture that we have, and we're on that journey.
Final question then. You started this interview by saying that you're on track to achieve the $10 billion revenue aspiration, 5 to 6 years, which means about FY 30-31. What's the roadmap? Are you looking at any sort of acquisitions, anything imminent right now?
Well, acquisitions, is something that you don't make it as a part of the strategy. If it comes out, in your transformation journey, you evaluate it based on the value it offers to the clients and to our capabilities. So, and in the near time, there is no, such situation emerging, but we're always on the lookout for, potential companies which can bring a good synergy for us. But overall, as part of the $10 billion plan, we're working on our next 5-year strategic plan. I'll be able to share more updates, probably at the end of second quarter, on the strategic plan beyond this year.
Thank you very much for that. Sudeep, you heard the management of LTIMindtree He's sounding a lot more confident. Growth will continue in Q2. In H2, at some point, double-digit revenue growth year-on-year. There are large deals which are close to being finalized in the pipeline right now. The margin improvement will continue, at least a minimum of 100 basis points. He said that twice. So it's ticking all the boxes. Is it just the valuation which is making investors skittish right now, or something else?
No, it's absolutely just the valuation. I think there is nothing to read negative from the management interview, or the margin improvement is being confirmed repeatedly that at least 100 basis point margin improvement will happen. The deal pipeline, they seem to be confident. So I think they're ticking all the boxes. You're absolutely right. But obviously the valuation is something which is not at a very comfortable level, considering the overall macro situation globally. They must be, and I'm sure will do all the right things, but we'll have to wait for the macro to support also. The valuation at this stage from a company of this size is not giving comfort. I would rather look at the big four, Wipro or even HCL Tech at this stage to kind of take fresh position if I have to buy in IT, rather than getting into some of these names.
Okay. All right, so that's IT, got that point. Let's move on to the other big story that's coming in, obviously, from the banking space, and we're talking about Axis Bank. The stock has been under pressure. It's been down almost 4-5% right from the morning as the street digests, obviously, what has been a technical issue that's impacted asset quality. Now, the bank has also seen a number of high-level management changes in the past couple of years, along with key personnel leaving the bank in just the last 2 years alone. Over the same period, Axis Bank has seen strong deceleration in retail advances. Loan growth has lagged the industry, and deposit growth has also remained weak. The board has approved the appointment of Neeraj Gambhir as the executive director starting August. That's a development that's happened just today itself. And Ritu is here to put all of this in context for us. Ritu, I mean, it seems to be a bit of a crossroads, or should I say inflection point. This kind of change in NPA recognition norms, the exits that you described. So, how should investors digest all of it and put it together?
Well, Surbhi, it certainly is concerning for the street, and especially this top 11 churn that is underway that you were referring to at Axis Bank. Of course, the latest news is Neeraj Gambhir, who's the group executive at Treasury, Markets and Wholesale Banking, being elevated to a whole-time director role, designated ED for a 3-year term. And that's, of course, because Rajiv Anand, who we know the long-serving DMD and whole-time director, is stepping down. But, the problem is this is not an isolated shift, really in the top management. Over the past 2 years, there's as many as 6 top executives that have exited or are in the process of exiting the bank. And the latest, of course, announced today itself is Arjun Chaudhary, who is the group executive for affluent banking, cards, payment and retail lending, who's put in his papers. Rajiv Anand, as we already know, is going to retire in August. And prior to them, you've had key group executives who've been heading retail, liabilities, audit, wholesale banking, all stepping away from the bank. And these changes are coming at a time when the bank is already facing some fresh operational headwinds, particularly when you look at asset quality in the numbers that the bank has just reported yesterday. That shocker of a slippage, 8,200 crores of fresh bad loans, nearly double the 2-year average. Even adjusting, for this technical impact, so-called, it's still quite high. Gross NPAs highest in 6 quarters. Credit costs remain higher than peers, more than twice of its peers like HDFC or ICICI Bank, despite having a very similar loan mix to them. So that is triggering some concern on the street. I was reading a note from the likes of Suresh Ganpati of Macquarie on the street asking some very pointed questions. There have been these kind of technical credit costs and adjustments done in the past. If they are truly technical adjustments, where are the recoveries? Why do it now? Why not earlier? Could there be an underwriting or collection issue in the retail book? So these are the kind of questions that are being raised. And even beyond the asset quality, growth metrics seem to have weakened. If you look at the loan growth and the deposit growth, they've now been lagging the system average for multiple quarters. In the first quarter, we saw the credit growth was just about 8%, deposit just about 9%, again, underperforming peers. But perhaps, if you look at the numbers, the most dramatic reversal really has been in retail lending, which once was Axis Bank's key growth engine. If you look at the retail loan chart, if our producers could pick it up, from 27% kind of peaks in the third quarter of FY24 to just 6% in the latest quarter. So to just sum up, this long sort of description that I've been giving, there is operational stress, there is growth deceleration, and all this is coming in with a spate of senior level exits. So that does put the bank in an uncomfortable comfortable spot. So there are bound to be questions on what comes next.
All right, very well explained to us. Thank you for that. Important to keep that context in mind, including, of course, the churn at the management level. Thanks for that, Ritu. Let's ask Sudeep. Sudeep, what do you think? I mean, it depends. The bank has been saying that they're just being extremely prudent. In fact, it's good prudential practice that they're following, and it's a one-quarter issue. But like Ritu described, I mean, there are other issues. Even this quarter, look at the NPAs, look at the NIMs. They've fallen more than expected. Growth is a problem. How would you look at Axis Bank, and is it an isolated issue when it comes to private banking, only restricted to Axis?
I think, let's divide it into two parts. If it's a question of loan growth, I think this is not an isolated issue. Pretty much everybody is on the same boat. And, the reason is somewhere the retail lending has been slowed down by most of these banks. And that has definitely hit the overall growth numbers. The corporate investment, capital investment hasn't picked up in the economy yet. And that, again, is not supporting the slowdown which is happening in the retail lending. It's not compensating, actually. So overall, there is a deceleration in credit growth. And that definitely does hurt a bank like Axis, which was supposed to be, a challenger bank, rather, trying to catch up with the big boys, which is ICICI and HDFC. So that is one area which is a bit of a concern. The other area which I don't think is a concern is the provision. They have taken a one-off hit. They have changed the methodology, taken a hit, tried to be extremely conservative. Maybe we can call it one-time cleanup of the book, whichever way we want to describe it. I think they have done that, and I won't be too worried about that. And on the balance, the other numbers of the results which came out, I don't kind of have too much of issues with the other set of numbers. Growth, loan growth, definitely slow. Write-off, we know they have given explanation. So on the balance, I think if you are a bit aggressive, I think it's a good opportunity to accumulate Axis Bank at this stage. That's my view.
Got that. But banking is about people business, right? And Surbhi, and as Ritu said, the retail side, the retail head is gone. Retail is typically very templated lending, right? I mean, it's not easier to do, but it's templated. I mean, the form, you put address and name and income bracket, etc. But corporate lending is the one where you need experienced people who've seen cycles. And there, if you remember I think till about last year, maybe a year and a half back, Mr. Ganesh Sankaran, who was the head of wholesale banking, which is corporate lending, there was a buzz that he's going to get, there's a line of sight for him right at the top. But I think that maybe there is that issue as well, which is, and the other thing which Ritu, we won't know is each of these people has teams and trusted people under them, right? So when a person like that moves, it's not just him or her. I mean, there are that set of people which also kind of starts to, perhaps potentially move away as well. So we'll see, but in a way, I mean, personal-wise, tough times as far as Axis goes. We'll take a quick commercial break here. We're going to come back. Rajesh Bhatia is going to be with us from ITI on the other side. We'll talk markets.
fully.
Welcome back. Rajesh Bhatia is now with us of ITI. Rajesh, great to have you with us here. Thank you for your time and good to speak with you as always. Just a quick word, Rajesh, on the Axis story, numbers, and will viewers who are watching, and I mean, the view generally is, I mean, from here, perhaps you will make money buying the name. I mean, that seems to be the general overall view, even though the stock is down about 5%. What is your sense here?
So not that I can comment on specific stocks, but I think the disillusionment with some of the private sector banks, including the one which you talk about, is that the NPAs have come up in spite of very low growth in loan. So it's not as if your loan growth was galloping and you make mistakes. Those are kind of acceptable. But I think with slow loan growth, you still have a credit cost which is kind of elevated and different from what other private banks are kind of registering. As you point out, there's still optimism, and I think that's based on two factors. One is that basically the valuations still are quite low compared to, for a private sector bank, relative to the other large private sector banks. And the second is the ingredients. I think the ability to make an ROE like other private banks are there. Just that there is an issue of this credit cost which keeps coming up, because of which I think there is some disillusionment in the short term. Having said that, I think it was fairly expected that most banks will see pressure in the first half because of the interest cost decline, which is impacting their NIMs and a low credit growth. We all know growth in the system has been very weak. We are in a slowed economy. And to be expected that second half onwards is when the NIMs will kind of bounce back for banks. So it's all expected as far as credit growth and NIM is concerned. In this particular case, there has also been disappointment as to the credit cost.
Rajesh, I mean, any trend that you spotted from the IT numbers so far? We've got 4 out of the 5 large cap IT companies reporting their numbers. And are you getting a sense that, you know, margins could be the next big thing to get hit? Growth was already hit over the last 2 years, but now margins are increasingly looking weak. HCL Tech lowered its guidance by 100 basis points. Companies are deferring their wage hikes. No one yet has announced a wage hike for FY26. They're all saying we're going to take a call based on the macros. So clearly there is some sort of margin pressure. Maybe it's AI-led deflation, or it just could be slower, you know, a weaker top line. But first, any trend? And to your thoughts on if margins could be weak for IT going forward?
Yeah, so I think as far as large cap IT is concerned, I think we are gravitating towards a low growth environment. Of course, the US economy is doing quite well. So I don't think there are any challenges there. Nobody is really talking about a recession in America. But decision making for IT companies is getting deferred. And one of the common reasons which we hear from IT companies is that this uncertainty regarding tariffs. Once there is greater clarity on tariffs, a lot of decision making as far as spends will actually accelerate as we move forward. Even on AI, I think what we are hearing from these companies is that while there is deflation as far as AI is concerned, it's not as if the dollar budgets are getting squeezed. The dollar savings are translating to other spends. And therefore, it's not as if the dollar revenue growth will kind of decline because of the deflation in AI. Having said that, the growth will probably accelerate once there is greater certainty on tariffs. Second is look at how these companies have already deflated as far as valuation is concerned. I mean, the top tier IT company is probably at 4% dividend yield and 21 times earnings. It used to be 30 plus times earnings. So there has already been a good deflation in the valuation. Now, these are still going to be marginal growth companies, and therefore the dividend will not accelerate to 7 or 8%. Let's say like a coal company does, or a lube oil company, where there was very little growth expectation. These are still companies which will grow and have massive free cash flows. So to that extent, 4% dividend yield and 21 PE is, I would say, closer to the bottom in terms of valuation. But the analogy there would be look at how this has deflated relative to consumer companies. So the consumer staple companies have similar growth rates, but their valuations are probably twice or more than the IT companies. In fact, I would say the second pocket, which is the consumer staples, are probably something that could be derated, over the longer run, if that is the kind of trajectory that they see. But as far as IT is concerned, I think the large caps are already reflecting the deflated valuations.
Okay. That's, how some of these larger sectors are shaping up. So, talking about the strategy from here on, in terms of preferred sectors, preferred, bigger bets that you would take, where you deploy additional money, Rajesh, where would it go? Because even for financials, I mean, now with Axis Bank, everything's become a bit of an issue. And we're seeing that reflect in banking stocks today.
So you have to widen your gaze. I think it was fairly expected that the first half is, you look at GST collections, you look at auto numbers, you look at credit growth. Not surprising that the results are weak. I think the results for the first 2 quarters are expected to be weak. But look at the RBI stimulus, right? How determined RBI is to get growth back on track. So my sense is that the 100 basis point decrease in interest rates will spur growth in the second half of the year, and therefore, there should be an expectation that earnings will for 26 second half and 27 will accelerate from the current levels that you have. So to be expected that the first half will be disappointing, but I would say elongate that gaze, and I think you'll probably find that there is room for optimism, and therefore, my sense is the downside to this market is going to be relatively low, but given the absence of triggers on earnings, it is going to be a bit of a range-bound market.
Okay, Rajesh, thank you for joining us. Range-bound market, that's the verdict coming in from you. Appreciate you joining us as always here on CNBC-TV18. Let's get a sense of what is buzzing around, right? I mean, in the broader markets, we've discussed the big names, and we continue to talk about some previews coming up as well. But really, what's happening beneath the surface? Hormuz is standing by on the wall. Hormuz, over to you.
Well, there are plenty of stocks beneath the surface that are also making some noise in the broader markets today, and MPS is one of them. Results came out just a few minutes ago, and the stock almost down 17% at one point, and on very heavy volumes as well. It was the core business that led to a drag in its revenues this time around, and the core business contributes to almost 60% of their top line, and they've also announced a restructuring of their European subsidiary, and that is what is causing the drag on the stock today. Almost 3 lakh shares, almost 3.5 lakh shares now traded, a 14-day average, a 20-day average of only 14,500. So that is one of the movers on very strong volumes. The other one, though, is GMDC. And every time a conversation on rare earth props up, it is GMDC that is always in the thick of things. 13.5% higher. Sources, of course, have told CNBC-TV18 that the PMO is going to hold a meeting today on the rare earth magnets issue. And that is what is keeping the stock buzzing. And on very high volumes, look at that, 2.5 crore shares already traded, a 20-day average of only 13 lakhs. And it is not only GMDC, but there is also an unknown stock called Permanent Magnets. Of course, taking the name a little too seriously. Magnets, the manufacturer of magnets, ores, alloys, 13.75% higher. At one point was up almost 20%. In today's trade as a slight cool off from the highs. Look at that, 80,000 shares have been traded, a 20-day average of only 7,500. And take a look at the market cap as well. A 900 crore market cap, does not have any major institutional holding, but a 1,000 rupee stock and 13% higher in today's session. Some of the others that are moving around today, Saregama, and that is of course after they announced yesterday that they are going to acquire the Haryanvi music catalog from a company. They signed the deal yesterday, and in a weak market like this, the stock is up 5%, and it snapped a 5-day losing streak yesterday itself, but on very, very strong volumes. 61 lakh shares already traded, a 20-day average of only 2 lakhs. So strong volume movers, all of these. And on the losing end, a usual suspect, but Bharat Dynamics was on the flip side of things when it comes to gainers, but 7 days of losses now for Bharat Dynamics, 4% lower today as well. They're poised for another weekly loss. It is the worst week that the stock is going to have since February of this year, and of course it is also declined in 4 out of the last 6 weeks. So defense not having a very good day. It hasn't had a very good month altogether, but there are a lot of other stock specific movers in the broader markets.
What an interesting list of movers. Hormus, thank you for highlighting that. Get into a break. On the other side, we'll get you a check on what our dealing rooms are saying in our segment D Street Chatter. Nimesh joins in and a few BTST calls.
Welcome back. Well, let's get to our favorite segment, D Street Chatter. As always, Nimesh has rounded up lots of buzz for us. And as we're going back to Nimesh, I mean, it's still a 150-point kind of a drop in the markets. It's not the best of afternoons. Nimesh, what's the sense? Range-bound week, but the bias has very clearly been down.
Oh, absolutely. And, I think today's drag is largely on back of disappointing results. Largely Axis Bank, that was a big drag for private banks. And now there are fresh fears of maybe, asset quality concerns for the bank. So that's something to look forward to. We have very large earnings over this weekend, right? So Reliance is a big number to watch out for today evening. Within the bank itself, HDFC Bank, ICICI Bank, AU Bank, some big numbers are going to come. And that will set the tone for our markets on Monday morning. So that's something to watch out for. And earning, as I said, has been a bit of a disappointment. And that's dragged the markets down overall in today's session. Even from a flow perspective, it's marginally on the negative side from the FI side. With the last couple of days in the cash market, so that's showing up in the numbers as well. As I said, earnings will be important, but looks like a bit of momentum is lost, especially on the back of disappointing earnings. So in that sense, the broader market outperformance is something to watch out for. They have really outperformed. First signs of profit booking there, but no panic as such. But I guess the large cap under pressure is largely on back of disappointing earnings.
Okay. Yeah, truly, I mean, that's really played out on sentiment today on several stocks as well. But speaking of stocks, what's the chatter? Where is the buzz?
Well, the first stock on my list is Tega Industries. We've seen of late, there is a bit of trend of M&As and, PE deals picking up. And Tega is buzzing on the back of on some hope of some large private equity deal in the company very soon. So that's a trigger there. We've seen a bit of an uptick in that stock in the last 1 week. And but again, for Tega, I'll just mention that the float is very less. The promoter holding is 75. The mutual fund owns 15% combined. So only 10% is the free float. So it can swing either ways. But the big buzz is that maybe there is a potential fundraising there. So that's the first name. The second stock is Natco Pharma. That's been buzzing in the last couple of days. The volumes also picked up. And again, in Natco, I guess the market is anticipating some corporate development, but there is some large HNI buying as well in the last couple of days. And the last name is GMR Airports. For second day running, I understand there are very strong buy flows. One leading FI fund seems to be a buyer of late. And there is also a hope of some price revision in the GMR Delhi Airport. And that could be a further trigger to watch out for in GMR Airport.
Well, GMR Airports, leading global FI active buyer of late. Lots of interest in this one, right? Actually, Nimish, not just GMR Airports, but the power business as well, right?
Yes. So even in GMR Power, well, there were a couple of large blocks last week. And since then, anyway, I think there is an enabling provision to raise funds. So maybe there is a fundraising lined up in GMR Power as well in the very near future.
Okay, Natco, GMR Airports, Tega, all in action. And Nimish is under the weather a little bit, but he's not out, very much there. And Nimish, hang in there.
Thank you.
Thank you very much for joining us with that. Well, Ashish Kayal is now joining us with what to buy or sell today for a reverse trade when we come back on Monday. Ashish, what do you have?
See, right now, I think we can look at Godrej Properties. The stock has been slowly and steadily inching up, and we can clearly see that over past 4 days, it's not forming a very big candle, but it's still bucking the trend. When there is broad market under pressure, it's moving up. So there is a possibility we can start seeing momentum as well. And we can expect a target of around 2,500, which is the previous swing high. And on the downside, one can maintain a stop loss of around 2,300 levels. That's the one stock. And the other stock also I have on the radar is Jubilant Pharma, giving a good breakout. Volumes are decent enough. Managed to bounce back from its 20 DMA. Looks like the third wave starting. So one can keep a watch on this for the targets of 1,300. Maintain a stop loss of 1,190.
Yeah, no, actually, lots of action there. Thanks very much for that, Ashish. We'll come back to you for more. There's about 15 minutes to go for close. Reliance will report numbers later today. First quarter, big one. Sonal is here with what to expect. Sonal, over to you.
Well, it is expected to be a good quarter for Reliance Industries. Remember, the stock is up 21% already this year so far. In terms of revenues, we're expecting a decline to come about by 8%, but it will be strong margin expansion that we'll see. So EBITDA expected to go higher by 3% and margins expected to see a 200 basis points increase, coming around at 18.7%. Profits accordingly will see an increase of 16% to come in at 22,024 crore rupees this quarter. If we talk about the internal details, what will drive this growth for the company this time? It will be O2C, digital and retail, which will see strong growth for the company. However, it will be offset by weakness that we'll see in the oil and gas business. O2C will see an increase of 19% YOY in terms of EBITDA and 3.5% on a sequential basis. However, refinery shutdown is something that could impact some of the profits this time around. Jio ARPU, that is expected to increase by 1% on a sequential basis. And retail business EBITDA, that will see an expansion on the back of JioMart scale-up, operating leverage and increasing footfalls as well. So in terms of EBITDA, we'll see that it has been continuously increasing. Last quarter was around 43,000 crore rupees. Before that, a similar number. And this time around, we'll be seeing a 5-quarter high EBITDA coming in for Reliance Industries. So good set is expected from the company this time around.
Thank you very much for that. And the other two, HDFC Bank, ICICI Bank, it's going to be a super Saturday tomorrow in terms of numbers. Gaurav is now joining in. Gaurav, let's start with HDFC Bank. Of course, everyone's watching out for their maiden bonus. But in terms of numbers, walk us through the expectations.
Well, yes, when it comes to HDFC Bank, we already know that loan book growth was at around 7% on a year-on-year basis. Deposit growth was at around 16%. And on back of this, now people are expecting single-digit growth in terms of profitability. So let's understand the numbers in detail. Net interest income is is expected to grow almost at a rate of 5%. Now there is an impact on net interest margin, and this is because of the rate cut. They are expecting impact anywhere between 15 to 16 basis point for HDFC Bank, and as a result, when we talk about the PPOP, we are likely to see the same trend going ahead as well. They are expecting around 8% growth in terms of the operating profit. Now, first quarter is usually weak for agri segment, and that is the reason why slippages may go up. But at the same time, Street is not expecting any kind of negative surprise in terms of credit cost. In fact, what they're expecting is that 0.5% of credit cost on a quarter-on-quarter basis is something that bank can deliver and maintain. And that is the reason profitability is likely to increase just by 6% on a year-on-year basis. Again, following the same trend as what we have seen in net interest income. Now, a key thing to watch out for is the loan book growth outlook, because earlier the management had said that in FY26, bank can grow at a pace of industry, and in FY27 they can outpace the industry. So that is something which is we are watching out for. Second is that commentary on net interest margins. Let's see how much of the rate cut has been passed on, what the management has to say in terms of net interest margins compression in the quarters coming ahead. And third is that the CD ratio. Now in this quarter specifically, HDFC Bank CD ratio has come down to 96.5%, but they had said that in the medium to long term, they will take it to 85 to 90% where they find comfort. So any kind of commentary around that is something, a crucial thing to watch out for. But as of now, steady state of number is what we're expecting from HDFC Bank in first quarter.
Okay, all right. So steady numbers from HDFC Bank, and the market will like that after the sudden surprise from Axis. But Gaurav, not just HDFC Bank, it's also ICICI Bank. So fill us in on that one as well.
Yes, when it comes to ICICI Bank, now we have already seen for the last few quarters, ICICI Bank has shown a very strong growth in terms of loan book, specifically given the size of its loan book. But in this quarter, we are expecting some kind of slowdown. Again, it will be higher than the industry, but it will be somewhere in the range of 12% on a year-on-year basis, what the street is penciling in. On the deposits front, we may see 13.5% of growth, and as a result, again in this bank as well, we are expecting single-digit growth in terms of profitability. So for net interest income, we're expecting around 7% growth. There will be an impact on net interest margins of around 18 to 20 basis points. Now, the margin impact will be a little bit higher because here the expectations are that 50 basis point of the rate cut has been passed on to the customers, specifically because of the cycle that they follow, and that is the reason net interest margins may fall almost by 18 to 20 basis points. In this quarter specifically, OPEX may be a little higher, and at the same time, treasury income will also expected to be higher, and as a result, we are expecting around 7% growth in the operating profit. The same trend is likely to follow to profitability as well, but there comes again the asset quality segment. Now, slippages here as well, we are watching out on slippages. They are expected to go up almost by 20 basis points. We may see some uptick in credit costs as well, because there will be some kind of normalization in credit cost, and as a result, we are expecting around 0.5% of the credit cost from the bank this quarter, and as a result, again, profitability is likely to increase just by 6% on a year-on-year basis. We will be watching out on how the commentary is going to be on loan book growth, because again, we have already seen a very good pace of loan book growth. So let's see what management has to say in terms of loan book. Any kind of commentary on the asset quality is also going to be a key thing to watch out for, because so far we have seen this bank delivering a very good set of numbers in terms of asset quality, and any kind of commentary on margins here as well is something that we are likely to see and watch out for from the management.
Gaurav, so we'll keep an eye. Saturday for you. So thank you very much for taking us through expectations. We'll take a quick commercial break here. We're going to come back with more on the other side. There is just, 8 minutes to go for close.
Welcome back. Just counting down to today's trading session. Mayuresh Joshi is now joining in. Mayuresh, any play on this entire rare earth magnet, story, the episode? Lots of individual stocks are moving around. Any that you've looked at, tracked?
Absolutely, Rima. So nothing in specifics, because I think there is still this expectation that the government will do something in terms of incentivizing the entire sector as we speak. And therefore, I think how the entire play happens is going to be something to be watched out for, both at the global level as well as the domestic level as well. And therefore, I think our own take is that we are a tad bit better off in terms of still looking at players within the core OEM players. TVS Motor, as an example, is something that we continue holding. But yes, I think stocks like GMDC, as an example, is something that are reacting today in terms of all the moves that you're probably expecting. But what comes out in terms of the potential reserves and surpluses that they probably own, and how do they monetize that? I think that aspect is something to be watched.
Bought the dip on Axis Bank?
No. So I think we still remain bullish on ICICI Bank. I know the results are expected tomorrow, but our own expectation is a far more stable set that ICICI Bank might probably produce. And therefore, the expectation is that the loan growth, the expectation in terms of NIM compression will be as per street expectation. And therefore, I think both in our global and local portfolios, ICICI Bank is something that we remain accustomed to.
We have the earnings coming up, and we just want for our viewers want to tell them what's coming up, lined up in terms of earnings. And I'll come to you, Mayuresh, if you can have the graphics up. So next week, Monday, Tuesday, Wednesday, Thursday, Friday, because we'll really get into earnings out of this weekend, right? I mean, there's HDFC and ICICI, but after that, if we can quickly put this up. So 23rd, now I have to look at what
23rd is a Thursday. So let's start with Monday. And I think on Monday, we've got Eternal reporting numbers. So Eternal, Ultratech Cement, Oberoi Realty. Then let's get to Tuesday. That's July 22nd. I think we've got Paytm, M&M Financial, Dixon, Mahanagar Gas, United Breweries. And then I think Thursday is Tata Consumer, Infosys, Dr. Reddy's. 24th, SBI Life, Bajaj Finance, IEX. And 25th is Cipla, Bajaj Finserv, Loris.
Basically,
maybe I'm getting it's a busy week.
Well, anything interests you out of the? By the way, Coforge is next week, right?
Coforge should also be next week.
23rd, I think, Coforge. I mean, that's the one number, right? I mean,
the poster child for mid-cap IT growth.
Will it blow the lights out once again?
Yeah, let's see if it does that.
So that's going to be interesting. So Coforge is the other one. Mayuresh, any interest out of the names Rima mentioned?
Absolutely. No, I think Ultratech is something to be watched out for, because I think in the entire cement pack, what Nuvoco today delivered, I think the expectation largely is that the second half, the earnings should come back very, very strongly as we speak. And therefore, I think Ultratech is something that we'll definitely keep on our radar. Coforge, since you mentioned that, Prashant, I think this is one stock out of the mid-cap with persistent that we continue holding it in our global portfolios. And therefore, it's going to be a very interesting take in terms of how Coforge probably delivers numbers. And obviously, I think a whole host of pharma companies are coming out. So I think we are having our eyes peeled to probably look at Cipla and Dr. Reddy, both in terms of their earnings delivery.
Mayuresh, found anything so far this season that caught your fancy, that made you think about maybe a buy? I mean, I'm just taking case in point, this week's probably best earnings in terms of market reaction was Ixigo, right? Because the growth was good and the stock was just bursting higher. But did you find anything exciting this week?
So, Survi, I think we've got a couple of names that we have kept on our radar. So one of the names that we are watching out for within the fertilizer space is Make Money Organics. The ratings, rankings look superb as we see it in markets with India. But I think the mix that they've probably got in terms of the fertilizer segment having 74%, and obviously the specialty segment at 34%, the kind of numbers that they've probably delivered in the previous quarter, if they're able to replicate some part of that performance in Q1 and continue in the next few quarters, I think this is one stock that we've kept on our radar in terms of where earnings might actually hold up compared to the rest of the market. And the other one that we continue holding in our portfolios is Vishal Mega Mart. Our own sense in terms of discretionary spending coming back in a significant fashion. And therefore, I think the expectation that one has really in terms of the same sales store growth, Vishal obviously has an exposure in terms of 44%, which probably comes through retail apparel. And therefore, I think as that part of the market comes back very, very strongly, specifically in tier 2, tier 3 cities, I think this can be one of the plays along with other players like V-Mart Retail as well, that can do it. So I think these two names
Okay.
will keep it.
All right, Mahesh, thank you very much. Short chat today, but helpful one. Thanks for joining in. You have a great weekend, and we look forward to connecting again. Well, we're down to the last minute of the days and the week's trading action, and it's going to be a week close, 140 points lower on the Nifty. But hey, it could have been worse because at one point, the index was threatening to break the 24,900 mark as well. So where has the drag been? It's been banks and financials throughout. Axis Bank is ending with a cut of over 5%. There are more names like HDFC Bank ahead of numbers, down 1.5% as well. Kotak Mahindra Bank is losing almost 2%. ICICI Bank managed to buck the trend. There's some green there, 0.5% up on ICICI Bank ahead of the numbers. Other weak names included Eternal, HUL, Trent, Titan. So these consumer names couldn't really offer much support to the market today. Pretty much fizzled out over there. Apollo Hospitals, Dr. Reddy's, even some of the pharma and healthcare names are on the red side of the screen. What did work? Well, Wipro, the earnings were well received by the market. There was a little bit of buying in Tata Steel, which continued from yesterday, and some names like Infosys and HCL Tech, again, 5-6 rupees on each stock, not too much, but for what it's worth, there was a little bit of a green here and there. Reliance has ended absolutely flat ahead of earnings later this evening. Just very quickly wrapping out the action on the mid-cap side as well. Clean Science, I mean, numbers was one thing, but the promoters selling stake in the market, that was not taken well by the shareholders. 9% down on that stock. Sterling and Wilson, Shoppers Stop, these are all result reactions and reactions on the downside. Even LTI Mindtree, despite that positive commentary from the management, stock is ending down over 1.5%. Gainers, well, some interesting names. ITC Hotels, 5% up. PVR Inox, almost 4.5% higher. And then GMDC, the stock that we were discussing on the show earlier as well, with all eyes on this PMO meeting on rare earths and how to ensure supplies for Indian companies over here, rare earth magnets. So that stock's holding up, it's gone home with a gain of almost 15%. In all, the mid-cap index actually falling more than the Nifty today, and a very weak advanced decline ratio as well. So not the best end to what has been a range-bound week, and the range just challenged and broken slightly on the way down. 25,000 did not hold finally on the Nifty. Well, that's where we take your leave on this edition of Closing Bell. Many thanks for watching, but don't go anywhere because lots of market perspective is coming up. Just in the next couple of minutes, we have Editors Roundtable after this break.
The Wall Street falls for the third straight week. The Nifty and the Sensex fall 1 percentage point each. Financials, IT stocks fall the most. Mid-caps outperform the blue chips. On today's episode, we decode the week on the Wall Street. We put the spotlight on IT stocks in the first quarter earnings. So hello and welcome to this episode of Editors Roundtable. I'm Reema Tendulkar. With me are Nimesh and Prashant. And joining us here in the studio is Rahul Arora, CEO of Nirmal Bang Equities. Not studio, but newsroom. Rahul, hi.
Good afternoon. Thank you so much for having me.
Guys, I'm exhausted.
because
of
the IT earnings.
Nimesh's health to describe the market. So it's like Nimesh is a little down.
Even
not out.
So
he's still hanging in there. But he's feeling a little weak. He's not able
so
to
is market.
So we're going to ask him to say less. That's the state of the market. I mean, very much there, but
down but not out.
Sort of, down but not out.
Yeah.
So.
How would you feel? I mean, how did you feel? What were your key takeaways about this week?
No, I think it's a lot of the negatives and positives are already pretty much in the price. I think we're back to tracking earnings. I think both from a tariff and a geopolitical standpoint, Q1 has seen it all. Rate cuts, you've seen it. Crude is behaving, rupee is behaving. So I think both on the positive and negative side, I think the pre-result commentary as well, and apart from what you were saying in your headlines in terms of banks and IT, even something like a Trent or a DMart hasn't had the best of pre-result disclosure. So I think the market is now back to, I think for the next 3 or 4 weeks, squarely focusing on earnings. Hopefully we don't have incremental downgrades, but you never know.
But again, it's going to be a big week, right? I mean, this weekend is going to be quite big in terms of large cap numbers reporting. Reliance will report today evening. You have ICICI Bank, HDFC Bank reporting numbers. ICICI Axis was a bit of a shocker to you, Rahul, and can we read too much into other banking numbers as well?
Not really, Nimesh. In fact, as a brokerage house, we've actually been recommending a switch trade from Axis to SBI for quite some time now. I think that we've been recommending that trade for almost about 3.5 months now. I think the problem with Axis, Nimesh, was that the credit to deposit ratio is in excess of 91%. Yeah. Now, when you have that high of a CD ratio, you can't grow. You are at best grow between 5, 7, 8%. The problem with Axis was not only did growth not come, your NIMs compressed by 30 basis points, your asset quality deteriorated, you basically had everything,
Correct. The bigger doubt was the asset quality.
Exactly.
Which is why I'm asking, is this going to be a bank specific or you're going to read too much?
No, I don't think it will be across the board. I think you'll probably have it on a bank-to-bank basis, but I don't think you'll see similar commentary from HDFC, SBI or ICICI. I think if you look at Kotak also, Nimesh Bhai, it's the first time they've declared their provisional numbers and it was a blowout. I think, you've... now the valuations of Kotak are very similar to ICICI and HDFC, but it was relatively under-owned. So if you have a situation where Kotak and SBI deliver well, you have a situation where ICICI and SBI are already trading at 2.6, 2.7. You may actually find a tactical intra-sector shift more towards SBI and Kotak. But Axis, I think, has been a bit of an outlier. They'll have to raise deposits. I think at 91%, you are constraining growth dramatically. And the most important thing on Axis was on the calls, they did not call out saying that this is the end of the provisioning. Yeah. I think they've left it fairly open-ended. So the market is thinking, will there be some more in Q2? And it's not a cheap, bank. I mean, even going into results. So I think it's more an Axis-specific issue. But like I said, I think our preference at our brokerage house would be more towards SBI and Kotak, because ICICI and HDFC is pretty much a consensus buy, and Axis would probably be the lowest of the pecking lot in the large.
Anything in the mid-sized private banks, Rahul? Because RBL will announce the results tomorrow. There is a fundraising line up in RBL Bank. Interesting, there is this, the regulator approval is pending for the new CEO. Anything within that, in the small private bank that will...
City Union Bank, I think, would be our top pick. I think we recently hosted Mr. Kamakodi as well. Of course, he's in his last year as being the CEO of the bank. I think he's done a remarkable job in terms of, maintaining asset quality, keeping growth very balanced and maintaining his ROEs. I think it's a remarkable thing that he's achieved. Again, City Union is not the most expensive. I think Federal has always been something that's been more expensive than a City Union. But I think if you expand that to say housing finance companies, you could even look at something like a PNB Housing Finance. I think this is probably, if I take large cap banks, SBI top pick, mid cap banks, I think City Union Bank top pick, and if you look at housing finance, I think PNB Housing Finance could be interesting. I think gold has played out to a large extent, so Muthoot, Manappuram I wouldn't touch too much into right now. But these would probably be the three in the BFSI space.
Kotak is interesting because I've heard this from bankers that balance sheet size is about 6 lakh crores, 6, 7 lakh crores. If you look at the larger ones, HDFC Bank, ICICI Bank, they're like 20, 25 lakh crores. It's present in all segments, but growth has been lacking for the last few years. It's got a new management Your favorite theme, Nimish. New CEO at the helm. So, I mean, can something happen there? I mean, can it... and of course, you've got a regulator which really wants to kickstart another credit cycle. I mean, that's very, very clear. I mean, it's asking banks, what do you need from our side, right? I mean, you got to go out and lend. So, in that sense, maybe it's a reasonably large bank, but not really one of the mammoths like ICICI or HDFC Bank. So, could it be where those two were 3 or 4 years ago? I mean, I think that's a tempting question which many are confused.
Perfectly fair question. I think that's what I was alluding to when I was talking to Nimesh. I think it's tactically been relatively under-owned compared to ICICI and HDFC. So while valuations may be very similar, I think you could still find a bit of a trade going there. The other thing, Prashant, to note here is, when we talk about banks these days, you also have to look at an SOTP. So I think if you look at, if you look at the annual report of Kotak Life Insurance is doing very well. Yeah. It's got amazing VNB margins. It's got the best-in-class return on equities. If that entity lists on its own, my sense is you could get a 3-time price to enterprise value or price to EV straight up, embedded value. So that could be one. Mutual funds are listing, right? So I think Canara Robeco has got its approval. ICICI is doing
coming up.
Right. Most of the mutual funds in India would be operating at an ROE of about 30 to 40%.
Yeah. So first of the block would be ICICI Pru.
Sorry, I think Canara Robeco will probably be the first to list because I think they've already filed their issue. I think ICICI has just appointed the bankers, but I think it's not just about Kotak Mahindra, the bank. I think even the subsidiaries. I think even though they are, of course, the largest competitor we have on the institutional side, I think there's somebody that we all look up to.
When numbers come, we look at what? We look at standalone numbers, but the consolidated is
the entities are doing remarkably well. There's absolutely no issue there. So
all
I think
capital marketplace.
Like I said, so there's not too much comfort on valuations, but I think tactically it's been relatively under-owned. So I think in privates, because ICICI and HDFC are already trading where they are and they're over-owned, a little bit
housing finance, Rahul, you said Canfin.
PNB Housing. Canfin would probably be a number 2, I would say.
So if you want to look at none of the diversified NBFCs. I mean, PNB is, of course, housing finance.
Yeah.
But you got the bulk of the sector champions. I mean, that era is gone. Everybody wants to do everything, right? I mean, everyone wants to go like Shriram Finance or Chola or, for example, even IIFL. I mean, everybody does everything. There are very few sector champions in that sense left, which was the case 15, 20 years ago.
It reminds me a lot of consumer durables. I think if you go back a few years, I think if you looked at refrigerators and washing machine players, there were 3 or 4 people that had 80% of the market.
Yeah.
Now today, everyone's doing everything. Same thing with electricals.
Correct.
Havells had its own specialty, V-Guard had its own. Now everyone's doing everything. So obviously you have that. But I think if you want to play it through diversified financials, I wouldn't look much beyond Bajaj Finance, to be very honest, even today. I think it's been the bellwether. I think the first mover advantage it has in everything, including consumer lending. I think the only other person, only 1 or 2 people who have managed to compete with it are IDFC First and HDFC Bank. But I think the first mover advantage was so much for BFIN in the businesses that they've gotten into. Even today, they're growing at 25% plus in terms of customer acquisition, in terms of growing their top line. You don't hear of any issue in terms of growth. There is not a dire need for capital. Return on equity is best in class. So why would you look beyond? I think housing finance is a bit tempting because that, KK Mistry used to often say that, so one is, what the Prime Minister used to always say, that 65% of India...
But it's just that housing finance has been such a...
consensus trade.
Yeah, but it's not worked. And maybe that's the reason why maybe it'll work now. I mean, from here on.
I think if you look at growth rates, right? Let's take a look at Home First Finance as well. Take a look at Aavas. I think most of these are growing north of 20%. I mean, what else is growing 20% in the...
No, I'm saying stocks. I mean, I think that is also because with the private players, a lot of supply is coming, right? Aptors, all these Ps have been constant sellers.
Absolutely. I mean, even if you look at a stock that's not often spoken about, which we track, which is Housing Urban Development Corporation, HUDCO. I mean, the valuations are not cheap at about 2.5 times, but it's growing at 20-25 times. I mean, the ROEs are close to about 13-14%. ROAs are close to about 1.5-2%. I mean, what's wrong in there? Of course, the liquidity is an issue. But yeah, I think you're right. A lot of these have had supply come out, so they've got lapped.
I mean, HDB, for example, would just...
but their trailing also, Prashant, was about 3.5 times. So to make money on an HDB, I think anything that goes... And I think HDFC Bank and even Bajaj Finance, for that matter, has taught us that beyond a point in financials, you cannot
I remember Home First was trading at some 7 times at one point. I mean, 6-7 times. But it's all kind of sort of now, over the last 1.5-2 years, come off a little bit. Financials is one, that's one big pillar. The other is IT services. And Rima, is that a busy week and busy week ahead as well? Rima?
So I think one thing that stands out clearly is companies are struggling for growth. Yeah. And many analysts are pointing out that this could be a long drawn period when growth rates are going to be muted. But I think the more interesting thing is what's happening on the margin front. HCL Tech lowered the margin guidance by 100 basis points. TCS failed to show any meaningful expansion in their margins despite a lower contribution coming in from BSNL. And companies are taking steps to arrest this margin weakness, right? Look at the wage hikes. So far, no IT company has given a wage hike, right? TCS was the only one which used to always give 1st of April. The only time in their history when they didn't was during COVID. But this time they're not giving it. They've still, even after 3 months when we asked them, they're still saying we're waiting for the macros, to settle down to decide that. So clearly there's something happening on the cost front, right? You could say it's AI related, maybe AI is deflationary, maybe companies have overhired and they're still paying the price for it. HCL Tech also spoke about restructuring. They're yet to give out the details of the restructuring, but basically on one hand, they're going to cut back on their extra office space, maybe internationally, so they're going to optimize that. But they also said very specifically, there's going to be people-based restructuring. And there is a one-time exercise. So are they going to rationalize their overall headcount? So, and Ambit, in their note, they say, I think, it was post HCL Tech, but they're basically saying that will margins be the next casualty after growth in the sector? Even the hiring has been so muted. In the last 12 months, Wipro has cut close to about 1,100 employees. For Tech Mahindra and HCL Tech, the hiring has been very, very marginal in the last 12 months. And again, just to recap the growth numbers, all 4 IT companies have reported a constant currency revenue decline in Q1. Right on top in terms of worse off was TCS, minus 3.3%. But even the others, Wipro was down 2%, Tech Mahindra was down 1.5%. So, things have been tough on growth. We knew that. But I think this time, what's happened on the margin front, on the cost side, has been a little different from the past, and it's interesting. What is your own takeaway?
No, I think you've pretty much summarized it very well. I think the fact is the valuations weren't cheap going into the results. I think most of the frontline IT companies, bar Wipro and Tech M to some extent, were trading at anywhere between 22 to 25 times. And I think the margin for error is very low as you grow in. I think IT today is in a very similar position to where, say, consumer companies are, where you have to take a trade-off between growth and margins. And I think while you alluded to some of the frontline companies, I think if you throw in a Tata Elxsi and a Tata Technologies also into it, the margin performance was disastrous, especially from Tata Elxsi was an absolute shocker. I think it was almost 250 basis points lower than our expectations. So I think companies will have to take a call. Our own assessment is that frontline IT companies, if they're lucky, will grow at 8 to 9% CAGR between 25 and 27. That's not a very high rate of growth. If margin expansion doesn't happen in a material way, then you're looking at single-digit earnings growth as well. Now the question is, for single-digit top and bottom line growth on frontline IT companies, do you want to be paying north of 20 times? The question, if I was to answer it, I'd say relatively be underweight. And I think you're starting to see in a lot of the companies that you mentioned, auto, manufacturing, anything related to that, there have been kickbacks in spendings from the client side as well. So I don't think this entire issue of tariffs is played out in its entirety.
But even for instance, now if you have a choice between IT and consumer, both are giving you single-digit kind of growth, right? But consumer is still more expensive than IT.
It is, but I think on a relative basis, if you look at consumer, I still think there is a potential chance that you could get a double-digit growth in earnings. I think that is a bit of a challenge if you look at frontline IT companies. Now, where I will exclude is probably LTI Mindtree, where I think they'll probably land up doing 11-12% kind of growth. But if you look at, say, an HCL Tech, TCS, Infosys, HCL Tech, definitely not double-digit growth for the next 2 years. LTI Mindtree by the skin of its teeth, maybe. Infi has still not declared. But I think the ER&DS players is probably where the growth will be. So I think if you must, and there will be mid-cap companies that will do well. So if I was to buy one today in the entire IT services, frontline space, I'd buy Coforge, regardless of valuations, because at least I get some growth. And maybe a KPIT Cummins, because the initial evidence is not that good. Now, KPIT could also test you, because like we were saying, auto and manufacturing is not doing good in the US. But I wouldn't rush in to buy IT right now. I'd probably wait. There is no compulsion to buy. The other important part about consumer is crude has behaved itself, and they're trying to cut costs to the best they can. What if crude goes down to 60? Just a theoretical situation. You do have that lever of margin growth that you can get. So I think one of the main things that happened for Hindustan Lever in the last decade, say between 2013 13, 14 to about 24, 25 is they actually compounded their top line only by about 8 or 9%, but their margins went from 14 to 24%. Now, certain things like these have also happened in IT services, and TechM has been an outperformer on margins in that regard. So incrementally, if your margins are not going to come, valuations are going to come into question. So I would probably be maybe 100 to 150 basis points underweight IT if I was a portfolio manager, and I would probably look at buying more on the mid-cap IT space or ER&DS players rather than looking at buying frontline.
Prima, 23rd, Coforge.
Along with Infosys.
Along with Infosys. I mean, when was the last time you actually went into the third week of July and Infy hadn't declared? I mean, for a lot of people who've been in the market for like 25, 30 years.
It used to be first.
It used to be first.
And then TCS started.
They used to actually fight
earlier.
to be first,
yeah,
TCS and Infy. It's been so...
I mean, the other thing, Rima, is I know maybe we should take that break.
We should take that break.
And then, you know, I was in the studio in the morning and Lata was coming in and she was waiting for Mr. Puneet Chhatwal of Indian Hotels. And we sort of, you know, that brief moment that I was going on, she was coming in and we happened to talk and it just stayed with me. She was talking about this huge, you know, consumption boom still, which is pretty steady, right? I mean, everything said and done.
At the upper end of the K, Prashant.
Upper end of the K, but, you know, these IT jobs, I remember asking that question to TCS, you know, no hikes and hiring is very, very limited. These are lakhs and lakhs of net additions every year, which you used to see, which have just gone away. Maybe GCs are making up for some of it. Maybe there are other sectors, but which we can't see. I mean, journalists are typically a little, you know, we look at the negatives.
Co-working spaces which feed on jobs and the formalization of the workforce, and they are doing so well. You know, whether it was, you know, you hear Brookfield, whether it's SmartWorks, they had a very good listing. IndiCube is just opening its issue next week. So clearly, office spaces are getting added, particularly on this co-working and flexible managed office.
I think we can go on.
Yeah, no, I can see Prashant so stressed to take that break. He's like, I think.
No, I'm not stressed to take that break. I'm just thinking that, well, you know, but it's a topic.
No, but it's an
maybe...
interesting space you bring up, Prashant, because hotels have done really well.
Yeah.
I think if you looked at ITC hotels as well, I mean, and even Indian hotels to grow at 30%, I think obviously you'll probably have a bit of softness because of what has happened geopolitically, even at our borders and the unfortunate plane incident, but I think the hospitality sector, Alcobev, aviation, they're all doing really well. Premium two-wheelers like Aisha, just look at the growth that you're seeing. So I think the upper end of the K is all right. Yeah. I think it's still the lower.
I think media also is consumption.
Sorry?
Right? I'm saying media is also consumption.
Your own stock. I was listening to Rahul's interview, and while I was listening to Rahul's interview, the stock kept rising.
Have you subscribed to Prime or no?
Sorry?
Have you subscribed?
Yeah, I'm a Prime member.
Oh, you are?
Yeah.
Oh, lovely. I mean, just a disclaimer, CNBC, the channel you're watching, of course, is part of Network 18. Just standard disclaimer. We'll take a quick commercial break here. We're going to come back and continue this very interesting chat with Rahul. Stay with us.
Welcome back. You're watching Editors Roundtable. We're in the newsroom and Rahul is here with us. We spoke about consumer, we spoke about CEO change at banks, etc. But what about HUL? Like, that was a big news exactly a week back. Java out in 2 years. Leena Nair is in, and there was also one in Arvind Fashions this week.
Women,
Oh, yeah?
That's,
Yeah.
you know, a good thing to see.
And
I
she's
think,
turned around Levi's. She was at ex-McKinsey.
Absolutely. No, I think, of course, in Lever, it's a homegrown talent. And I think people were expecting that she would be the successor whenever Rohit would move out. Again, goes back to the point I was making. Lever is not a cheap stock at all for the kind of volume growth. I think the point here, Rima, is a lot of these guys will have to give up margins for growth. I don't think Lever today, if we're sitting and even looking 5 years out, can Lever's margins go from 24 to 30%? It's practically, it's not possible. But unfortunately, what's happening is Lever is mainly soaps, detergents, you know, those kind of things, where the penetration levels are so high. You're already at 90-95% penetration. You know, I mean, what are you going to grow? The only thing that you can possibly do is increase the frequency of that consumption. A. B. You premiumize. What has Colgate's biggest challenge been? That almost 80-85% of India still brushes once a day. You know, they don't even, so they can keep launching products, but, you know, they're like, and very few of them.
Brush twice a day campaign.
I mean, something
They've been
to that
campaigning
effect,
this for
right?
last 10 years now.
So you either increase the frequency of consumption, and which is why rural is so important, right?
Thrice a week, thrice a day, right?
The reason people talk about rural consumption so much
and some
is actually because of velocity of consumption, right? Like in urban India, when you get your salary, you save, you decide allocation. In rural, you know, yahan se aaya, yahan kharch ho gaya. You know, that
But you know,
velocity.
Rahul, for a lever, what we've heard in Priya Nair, also the incoming CEO, the focus has been beauty. And that is the
So
segment
then
which
it's
is
premiumization, right? That's the point.
But it's a newer segment in the sense. I mean, all this stuff for both men and women, which is, you know,
Agreed,
which is
but-
growing very fast.
See, the other thing also,
they acquired this brand, right, recently.
Yeah.
Minimalist.
Yes. So I see the entire story right now on consumption in India, if you want to play through a stock market perspective, is premiumization. And whether that is in auto, whether that is in real estate, whether that is in, you know, outright consumer staples. I think even if you look at alcohol players, the PNA, which is the prestige or, you know, the premium section, is far outperforming the mass. You can take a look at footwear as well. I mean, if you speak to a Bata, they'll tell you that their price points above 1,000, 2,000 are doing pretty well. They're struggling at 500 and below. So that's been the bit of a challenge. And I think till you don't have a situation where, if you're not going to choose, like if you don't give up on margins, I think growth is going to be very challenging. But I think Priya is the right person for the job. She's been homegrown. I don't know too much about the lady who's taken over at Arvind, but I think, you know, it was one of my darling stocks for the longest time.
I'll squeeze in one last question, completely unrelated. Sona BLW, do you cover it? Do you?
We used to.
You
We
used to,
yeah.
Because we reported, Vivek and Parishad reported that they're going to tie up with BYD.
Yes.
So they already have Tesla as a consumer. They've never, I think, acknowledged it, but I think Tesla is a customer. So two of the largest EV brands in the world. And probably down the line, apparently, they're going to set up a factory in China as well.
Wow.
So this seems like a pretty large deal in that sense.
Okay, no, we used to track it, not actively anymore. But I mean, I know Vivek is a fantastic entrepreneur, but you know, not so much of view on that, unfortunately.
Okay.
Okay, well, that brings us to a close in this edition of Editors Roundtable. Hope you enjoyed it. Stay tuned to CNBC TV 18 for more news and updates. Goodbye.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty fall for the third straight week. Financials and defense stocks lead the decline. Mid-cap index bucks the trend, gaining 1%. A leadership churn at Axis Bank. Senior executive Arjun Chaudhary resigns, marking the 6th top-level exit in the last 2 years. Neeraj Gambhir appointed whole-time director to replace Rajiv Anand, who retires in August. All of this comes as concerns mount over rising bad loans and slowing loan growth. Reliance Industries Q1 earnings today. The company is likely to report a 16% increase in the first quarter profits. Oils to chemical, digital and retail segments expected to see strong growth. Jio expected to see a 1% rise in the average revenue per user. The shortage of rare earth magnets draws the attention of the Prime Minister's office. Sources say the PMO is likely to hold a meeting with top officials from Commerce, Heavy Industries and Mines Ministries. India Inc. has been raising the alarm since China restricted the export of rare earths around 3 months ago. The much-awaited GST rate rationalization exercise is likely imminent, from cement to insurance, premium to telecom, two-wheelers and tractors. Brokerages are optimistic about significant changes in the tax rates when the council meets next time. Prime Minister Modi is likely to visit the United Kingdom next week to sign the free trade agreement. Government sources say Indian and British officials are completing the legal modalities of the deal, which needs to be ratified by the Union Cabinet, India and the British Parliament. The EU targets Russia's oil income in a fresh round of sanctions, imposes restrictions on Rosneft's refinery in India, also lowers the price limit on Russian crude oil. Facing a fierce backlash from his own supporters, President Trump orders the release of pertinent documents from the grand jury testimony related to the Jeffrey Epstein sex trafficking case. The decision follows a Wall Street Journal report which claims Trump gifted a letter featuring a drawing of a naked woman's silhouette and a personal note to Epstein on his 50th birthday. Well, straight to the day's market action. They continue to remain weak as quarterly results flowed in. Sensex falling over 500 points. The Nifty closing below the 25,000 mark, so down by about 0.5%. The Nifty Bank, by the way, lost about 1% this afternoon. Now, the markets have fallen for a third straight week, and financial stocks have dragged the markets lower. The Sensex, the Nifty Bank fell 1%. Mid-caps are closing in positive territory today, closing by about 462 points higher. Let's go across to Mangalam now. He joins us to wrap up the week that was and the week ahead. Mangalam.
But it was a down day this time. In fact, the Nifty closed below the 25,000 mark in the third week in a row where the Nifty ended lower. And today's weakness, this week's weakness, could be attributed to the weakness that we've seen in results so far. A large part of the weakness was led by the IT stocks, and finally we had the financials also lose. For instance, the top loser on the Nifty today was Axis Bank, down 5% after a weak asset quality that the company reported, and all eyes will now be on some of the heavyweight banks like ICICI Bank and HDFC Bank that report their numbers fairly shortly as well. Importantly, the IT stocks. Now, despite the weakness that we've seen through the course of the week, Wipro's results were fairly well received by the street. The stock was higher by 2% on an inline set of numbers, notwithstanding the weakness in other IT stocks. So the question now is a large part of the weakness in IT in the price or not? That's something we'll watch out for as the second rung of these companies report their numbers. The mid-caps, there also, the moves were a lot more result-oriented. We had stocks like Indian Hotels, HDFC AMC, Tata.com, even Nuvoco Vistas do well on the back of good performance, but by and large, there were two stocks that declined for every stock that was higher in today's trading session. We had some of the metals names which were outperforming in an otherwise bleak market. The defense stocks, they continued to see weakness. In fact, among the biggest losers this week, we had the likes of Bharat Dynamics and the others. We did see some weakness in a couple of these insurance names as well. The stock reactions versus the results have been in opposite directions. ICICI Lombard, the top loser this week.
Mangalam, many thanks. Now, Axis Bank faces top-level churn. Neeraj Gambhir has been appointed as the new whole-time director. He replaces Rajiv Anand, who's set to retire in August. Senior executive Arjun Chaudhary has resigned as well, marking the 6th senior-level exit from the bank in under 2 years. The bank's concerns have also mounted over management exits amidst bad loans and loan growth slowing. The bank's stock was down over 5% in trade today. This after it reported a disappointing set of Q1 numbers. Ritu is here with us. Ritu, Axis Bank's concerns escalating.
Escalating they are, Shireen, and it's not being helped by the top-level churn that is underway at Axis Bank. First, of course, Niraj Gambhir, who is the Group Head of Treasury, Markets and Wholesale Banking, he has been elevated to a whole-time director role, designated an ED for a 3-year term, and that's because Rajiv Anand, who's been the long-serving DMD and whole-time director, is stepping down. But, you know, this is not an isolated shift at all. In fact, in the past 2 years or less than 2 years, 6 top executives have exited or are on their way out of the bank. The latest, like you said, Arjun Chaudhary, the group executive for cards, payments and retail lending, he has put in his papers. Rajiv Anand, we know, is already going to retire in August. And even before them, you know, your key leaders heading retail banking, liabilities, audit, wholesale banking have all resigned from their positions. And these changes are really coming at a time when Axis is facing a lot of operational headwinds, particularly when it comes to asset quality. You know, in the numbers that the bank has just reported, that slippage shock of 8,200 crores of bad loans, even if you set aside the technical impact, is quite high, nearly double the 2-year average. Gross NPA is the highest in 6 quarters. Credit costs have remained higher than peers. In fact, more than twice of HDFC Bank and ICICI Bank, despite having a comparable sort of loan mix. Now, this is triggering some concerns on the street. You have analysts like Suresh Ganpati of Macquarie pointedly asking questions about, you know, these technical credit costs and adjustments have been done in the past. And if what the bank is doing now is truly a technical adjustment, where are the recoveries? Why now? Why not earlier? Could there be an underwriting issue in the retail book and so on? Now, even beyond asset quality, growth metrics have weakened. The loan and deposit growth have lagged the system average for many quarters now. In the first quarter, credit growth at just 8%, deposit at just over 9%, again underperforming the industry average. But perhaps the most dramatic reversal has been in retail lending, which has been the bank's key growth engine, from 27% in the third quarter of FY24 kind of peaks to just 6% in the first quarter now. But to be clear, there are industry-wide issues on credit and deposit growth slowdown. So this is not just an Axis Bank issue, but what's making it worse is this getting mixed in with the senior management exits as well. And that certainly puts the bank in an uncomfortable spot. So there are bound to be questions on what comes next.
All right, Ritu, appreciate you joining us. Axis Bank CEO, while responding to Ritu's questions at the management conference call, said that about 25% of slippages are from the agri portfolio. Here's that conversation. Listen in.
So roughly, if you look at what we do is quarter 1 and quarter 3 are cyclical. And the way I would request you to think about it is, in quarter 1 and quarter 3, about 25% or thereabouts of slippages are from the agri portfolio. So you could apply the maths to 5,400 crores, and roughly about 25% or thereabouts would be agri. The percentage would be broadly similar for last year's rupee crore number. The rest of the 75% is coming entirely from the unsecured business. We are very clear in making a call out saying we do not see stress in the secured part of our retail book as on date.
While Axis Bank was a stock under pressure, shares of Wipro surged in trade in response to the company's earnings. While the company met estimates in the first quarter, revenue contracted 2% on a constant currency basis. Margins also contracted sequentially, but all of this largely in line with estimates. In fact, speaking to CNBC-TV18, Wipro CEO Srini Pallia said there is a strong deal momentum and he expects FY26 to be better than FY25. Take a look.
So there is this very strong deal momentum that we have had in quarter 1, which we tend to carry to quarter 2. Of course, some of these deals will take its own time before we start ramping up. Second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
Metal giant JSW Steel reporting a strong set of earnings. Operating numbers fared better than estimates. EBITDA up 38%. Margins saw an expansion of 480 basis points. Moving on to a CNBC-TV18 exclusive, China's curbs on rare earth magnets continue and there's been no breakthrough yet. Sources have told CNBC-TV18 that the Prime Minister's office is holding a meeting today with top officials from Commerce, Heavy Industries and the Mines Ministries. The electronics industry separately has also been raising the alarm since China restricted the export of rare earths around 3 months ago. Ashmit is standing by now to take us through what industry's key concerns are and whether there is any breakthrough in sight. Ashmit, to be clear, there is nothing official about China's restrictions. What are you picking up from sources in terms of the impact on the electronic industry? Because the auto sector has already raised its concerns, saying that production has been impacted. What's the electronics industry's view and how worried are they today?
Well, that's in fact one of the aspects that have been flagged by the industry, that as far as these restrictions are concerned, including on rare earth, it is not unique to the auto industry. There are magnets, critical minerals also used by the electronics industry. It's impacting them as well. They're feeling the pain, and so much so that they're going on to say that there is a serious risk of losing out on the smartphone manufacturing momentum that we've seen in the country. In fact, the figures, the exports from smartphones in India for FY26 pegged at $32 billion. That's being put to risk. That's the assessment that the electronics industry has given to the government, saying that there are no formal restrictions, there are no notifications, directives to Chinese government officials, but there are oral directions, oral directives coming in from Beijing to Chinese companies, to Chinese officials on 3 critical choke points. The industry has identified 3 choke points, one of them being rare earth, critical minerals. Here again, the industry is saying it's not unique to the auto industry. We're experiencing pain as well. The other is recall of Chinese workers. This, the industry says, will directly impact transfer of technology. And number 3, capital equipment being imported from China, restrictions there as well. That, the industry says, is likely to impact production going forward. So on all of these aspects, the industry saying these are carefully calibrated sequential measures being taken by the Chinese administration, and thereby calling on the Indian government to respond, asking the Indian government for help in terms of resolving these issues, giving in a word of caution as well that if left unchecked, such measures, if left unaddressed, such measures by the Chinese government could have far-reaching consequences for electronic smartphone manufacturing in the country. What has been the response of the government? Well, the government is quite clear. It is seized of these issues. These issues are not new. The government is aware of them, but so far there has been no state-led approach in terms of resolving any one of these 3 issues. In fact, specifically speaking on the subject of recall of workers themselves, the unofficial view coming in from the government is that this is an issue affecting a private company, and it is for the management and shareholders of that private company to go about resolving this issue.
All right, Ashmit, many thanks for joining us. Now, the much-awaited GST rate rationalization exercise is likely imminent. Sources tell us that the GST Council will deliberate on moving to a 3-rate structure at its next meeting. Meanwhile, brokerages are optimistic about significant changes in the tax rates. Timsy standing by. Timsy, tell us more about what could be on the agenda in the next GST meeting and the expectations that the market is building in. What are brokerages saying?
Well, as hopes of GST rate rejig pick up pace, and sources indicate that deliberations have started on shifting items to new rates, also moving to a possible 3-slab structure by doing away with 12% rate under the GST regime. It is anticipated that the upcoming GST Council meeting may take up these proposals for consideration. Meanwhile, brokerages and experts are penciling in an opportunity for significant changes to not only the rates but also the GST structure itself. Brokerage firm Jefferies believes items such as cement can be brought down from current 28% to 18%. Similarly, two-wheelers less than 350cc is also at 28% and could be brought down to 18%. On health insurance premia too, the agency says that it can be brought down from 18% to 5%. For telecom services, Jefferies proposes a rate cut from current 18%, and on hybrid passenger vehicles too, they propose a rate cut from current 28% plus cess, and on processed foods, footwear and apparel, rates could change from current 12% to 5% or 18%, depending upon subcategories. Rating agency Nomura too proposes that term life insurance can be brought down from current 18% to 5%. Tractors can be brought down from 12% to 5%, and air conditioners too can be reduced from 28%. Expectations by Morgan Stanley is to include natural gas under the GST ambit to reduce a lot of costs for the industry and consumers. Brokerages have listed reasons and potential revenue impact on these proposals. To be seen now is whether any of these proposals can actually make it to the council, and yes, whether council will be able to take a decision or not, something that we'll have to wait and watch for.
Well, that certainly is the big question. All eyes on the GST Council meeting. Timsy, many thanks for joining us. Prime Minister Modi may go to the UK next week to ink the India-UK Free Trade Agreement. That's been in the works for quite some time, and it has officially been announced. This will be the formalization. Government sources tell CNBC-TV18 that officials of both nations are currently sealing the legal modalities of the deal. Abhimanyu here with the details. Abhimanyu, so the Prime Minister likely to head to the UK?
Government sources have indicated that the India-UK Free Trade Agreement is likely to be signed next week. Currently, legal scrubbing is underway for the FTA, and post-signing, the FTA will require approval from India's Union Cabinet and from the British Parliament to come into effect. Earlier, government sources had indicated that the FTA will eventually lead to an overall increase in exports from India, as well as double the volume of bilateral trade to $120 billion by 2030. Now, highlighting duty-free access to 99% of tariff lines for almost 100% of trade value in exports of IC engine vehicles. Sources had also added that the UK will levy zero duty on export of Indian goods on 95% tariff lines in agriculture, fruits, vegetables, processed foods and cereals. In reciprocation, India is likely to cut tariffs on 90% of imports from the UK. A bilateral investment treaty is also being negotiated separately by India's Department of Economic Affairs. Sources had earlier pointed out that a lot of work has already taken place on the bilateral investment treaty. It remains to be seen how early this FTA is going to be signed and what kind of bearing it's possibly going to have on overall trade between India and the UK, and subsequently on future FTAs being negotiated by India.
Abhimanyu, many thanks. The National Company Law Appellate Tribunal has granted a stay on the NCLT order that directed insolvency proceedings against Reliance Infrastructure. The case was initiated after IDBI trusteeship filed a plea and alleged default of around 90 crore rupees by the company. However, the company informed the court that all outstanding dues, including interest, has now been fully paid. We'll head into a break, but up next, President Trump orders the release of the pertinent documents from the grand jury testimony related to the Jeffrey Epstein sex trafficking case, facing a fierce backlash from its own supporters. That and more when we return. You're with Business 360. The big global headlines that we're tracking this hour. Israeli forces continue to bombard Gaza. At least 10 Palestinians have been killed in the last 24 hours. These include 5 people who were killed after Israeli forces attacked tents that were sheltering displaced Palestinians. Syrian forces have resumed fighting with Druze fighters and Bedouin tribes in the southern region of the country. This comes a day after Syrian troops pulled out of the area. A Syrian government spokesperson denied reports that government forces are being redeployed to the same region to stop the renewed tensions. Russian troops have claimed to have captured 3 villages in Ukraine. As fighting intensifies, Ukraine has disputed parts of the Russian account, particularly those concerning a key southeastern village. Russia said its air defenses destroyed 73 Ukrainian drones overnight, including several near Moscow. However, no casualties were reported. The European Union has targeted Russia's oil income in a fresh round of sanctions. The measures impose restrictions on Rosneft's refinery here in India. Now, the new measures also lower the price cap for buying Russian crude oil to $50 per barrel. Sonal is here to explain what this latest set of sanctions mean. Sonal.
Well, fresh sanctions coming in from the European Union. In a communique, they have spoken about how there are more sanctions coming in on Russia. The first one being fresh restrictions on companies which are linked to the Nord Stream gas pipeline, which is a very important pipeline for gas transportation. The second one is a lower cap on Russian crude sales, which has been reduced to $50 per barrel versus $60 per barrel earlier. The third one is they have cut off additional 22 Russian banking institutions from the SWIFT global payments. The fourth one is they've added 105 more vessels to the blacklist, in addition to 342 which were subject to sanctions, which were used for transporting Russian oil to different parts of the world. And the fifth one, restrictions on the export of equipment and materials that could be used in Russian defense industry. Now, just taking the crude oil point further, because it is very important for India, and what could the impact be of such sanctions on India? Now, this will also include restrictions on operations of Rosneft's 20 million tons per annum refinery in India, and it will impact both crude sourcing and refining in the country itself. Analysts are suggesting that there will be renewed hassles to secure vessels and insurance as well on crude which is imported from Russia right now. Remember, this particular sourcing has been continuously increasing. Right now, we source around 25% of our total crude from Russia. This would mean if there are sanctions, travel costs would increase, insurance costs would increase, and that will mean that the cost overall for all marketing companies would increase when it comes to sourcing crude from Russia. So it is a negative which has come back.
Sonal, many thanks. President Trump has directed U.S. Attorney General to seek the court's approval to release grand jury records related to the Jeffrey Epstein sex trafficking case. President Trump claimed that he took the decision because of the ridiculous amount of publicity around the case. This comes after a Wall Street Journal report claimed that the president gifted a letter featuring a drawing of a naked woman's silhouette and a personal note to Epstein on his 50th birthday. Trump has threatened to sue the Wall Street Journal for the report, calling it fake and defamatory. Here's a report.
U.S. President Donald Trump says he's asked Attorney General Pam Bondi to release grand jury testimony related to Jeffrey Epstein, the now deceased financier and sex offender, subject to court approval. Some of Trump's political base who were expecting lurid details about Epstein reacted in fury earlier this month after the Trump administration reversed a pledge to release documents it once suggested would offer major revelations about Epstein and his alleged clientele. A Justice Department report this month also concluded that there was no evidence to support a number of long-held conspiracy theories about his clients and 2019 death in prison. It's caused a rare fracture of support for Trump, who has called the matter a hoax. On Thursday, he wrote on his Truth Social platform that, quote, "Based on the ridiculous amount of publicity given to Jeffrey Epstein, I have asked Attorney General Pam Bondi to produce any and all pertinent grand jury testimony," before going on to blame Democrats for what he called a scam. Shortly after Trump's post, Bondi said on X that the Justice Department was ready to ask the court on Friday to unseal the grand jury transcripts. Allegations that Epstein had been sexually abusing girls became public in 2006, and he was arrested that year before accepting a plea deal. Epstein died in 2019 in jail after he was arrested a second time and charged with sex trafficking conspiracy.
The U.S. State Department has officially declared the Resistance Front as a foreign terrorist organization, a specially designated global terrorist. The TRF is a proxy outfit of the Pakistan-based terror group, the Lashkar-e-Toiba, that claimed responsibility for the Pahalgam terror attack in which 26 civilians were killed. Financing, supporting and advising a foreign terrorist organization is considered a criminal offense under American law. Reacting to the move, External Affairs Minister S. Jaishankar called it a strong affirmation of the India-US counter-terrorism cooperation. At least 40 schools across Bengaluru and 20 schools in Delhi have received similar bomb threats through email. The messages claim that explosive devices had been planted in classrooms. Delhi and Bengaluru police deployed multiple teams to the targeted institutions. No explosives have been found so far. The search operations continue. Justice Yashwant Verma has moved the Supreme Court challenging the legality of the process adopted by the CGI-appointed inquiry panel. Verma has sought for quashing of the committee's final report against him. The petition has stated that the report's unprecedented public disclosure led to a media trial and caused irreparable harm to Verma's personal reputation. The plea added that the final report provided no answers on the details of the case. With that, it is time for us to wrap up this edition of Business 360. There's plenty more coming up right here on CNBC-TV18. Stay tuned. We're back in a minute.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alek Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news,
Yeah.
and you don't know if tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every dip?
Sure. Yeah, so I think there's a little bit of concern that is there amongst investors as well, So they're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equities.
So there is fear of missing out, but there's also fear of participation. So
That's
it's like, twin fears working together.
Exactly.
But in generally, as a house call right now, when you talk about any broad portfolio advice, so I know it'll be different for different individuals, but generally, are you fully overweight on equity? Is it more equity skewed? Gold has done so well. So I think people are just asking themselves these questions: that where should I be? Where should my money be?
So we have been overweight gold for a while, for actually the last 2 years. Actually went overweight when Ukraine and Russia crisis broke out in 2022, and we've been overweight in gold since then. Now I think we're starting to book a little bit of profit because it's been a stellar rally for gold. So we're booking a little bit of profit. We're adding a little bit to equities. If you look at Indian markets, things have only improved. The macro environment has become better. The government is starting to spend. RBI has cut rates by more than 1%, and is also supporting liquidity by doing open market operations. So the overall macroeconomic environment in India is improving. On the other hand, the earnings sort of bottomed out in the last quarter. I think the expectation is that they will keep improving quarter on quarter, and the second half of this financial year should be a better year. And that's why we're saying that slowly, gradually add to equities and don't miss out on the rally. If there is correction for whatever reason, it is likely to emanate from global market risk. Use that opportunity to add to equities.
So equity would be the one big asset class that you're advising that investors should they should be putting in their money. What else, just in terms of asset classes?
Yeah, so that's one. Gold, we still have some allocation. We're not fully taking out. How much? Generally, our model portfolio allocation is about 10%. We were right now at closer to 12%, slightly overweight on gold. And on the debt side, we are saying that maybe it's time to book out money from duration and add to conservative debt like corporate bond funds, and using income plus arbitrage as tax efficient vehicles to take allocation to debt.
Okay, so that's the overall thought process with respect to where the money should be parked. That's the Sanctum view. But now I want to get to the exciting part, because the way Alek has done this is that he's going to encapsulate all the mistakes we end up making in a panch ka punch. So the 5 to avoid. Take it away, Alek.
Yeah. So I think the first one, that we typically see in client portfolios is over concentration or over diversification. So generally investors who have been investing for a long period of time, HNI investors who have a larger portfolio, they tend to end up accumulating too many mutual funds. We've seen in client portfolios with 40, 50 mutual funds as well. And as we know, each of these mutual funds have about 50, 60 stocks. So you overall end up owning like 1,000 odd stocks, almost the entire market. That's too much of diversification. On the other hand, newer investors who started new, they end up doing 2, 3 mutual funds, maybe 4, 5 mutual funds, and have a concentrated portfolio. There again, what happens is that, if there is a good experience with one fund, you got it at the right time, you end up owning 20, 30% in that one mutual fund. So that's too much concentration. Our ideal, this thing is anywhere between 5 to 15% allocation to one single mutual fund, which means around 8 to 12 mutual funds on the equity side is more than enough, and that should cover for you.
8 to 12 funds. So this is something that people always grapple with, and sometimes people have multiple advisors. So you have one portfolio with one and another with the other.
Exactly.
So you're saying no more than 8 to 15 funds.
Yes, that's right.
Okay, so that takes care of the over diversification part of it.
Yes.
If someone does have a big portfolio right now with like 20, 25 funds, and they need to basically clean it up and come down to what you're saying.
Sure.
How do you start? How do you prune it and get it all together?
Sure. So the second point comes in, which is the diversification across market cap as well as style. We'll talk about both of them. But here, what we should look at is that you should have funds in each category. Some flexi cap, some mid cap, some small cap. Some large cap mutual funds, and then diversification across style is also what you need, and we'll talk about that.
All right, so mistake number one to avoid, do not be over diversified in too many funds. That's number one. So what's the second mistake to avoid?
So second one is market cap, and that is very pertinent right now because we've seen a stellar run for mid and small caps. They've outperformed large caps almost, like small cap index has done double of large cap in the last 5 years. So and investors look at past returns while taking decisions. So one may be a little more skewed towards mid and small cap at this point of time. And we know mid and small caps also have their cycle. So that periods where they do extremely well and periods where they underperform as well. As a thumb rule, what you could look at is the overall market cap for India. If we were to break it in large cap, mid cap, small cap, about 70-75% would be large cap. 20-25% would be mid cap, and the balance 5-10% would be small cap. So that could be your guiding tool. And depending on if you're aggressive, then you could have, say, maybe 40% in mid and small cap, and if you're balanced in less.
But that's the thing, because the last couple of years, large caps have not been delivering great returns. Therefore, people have wanted to go to mid and small caps in search of better returns. So what do you say to that? Because it's a valid argument, right?
Sure.
Because foreign investors are not coming in, so you're not seeing big moves in big large cap stocks. So if you're stuck there, you're forever going to be underperforming.
Yes. So I think the right way to take that large cap allocation is through flexi cap funds. And flexi cap funds will have about 50-60%, 70% large cap exposure. They'll do their picking up of the right stock, which will add a little bit of alpha. And then they'll use the mid and small caps to also deliver good returns. And if you look at flexi cap funds, they've done really well. Some of them have done really well in the last 5 years. So that is, I think, the way to go ahead rather than just doing pure large cap mutual funds.
Okay, so maybe flexi cap funds could, give you that edge, because ultimately it's the portfolio manager, the fund manager, who's going to decide whether it's time to load up on some additional well-performing mid caps or not. So second mistake to avoid, don't get carried away by the market cap classification and design your portfolio only as per the particular class of stocks that's doing well at that point in time. So that's two. Mistake number three.
So the third one is style diversification. We just talked about that. And this is a little tricky because, it's not very intuitive. So I'll just briefly maybe take 1 minute to explain what these styles are. One is growth investing, which is basically investing in companies where earnings growth is very strong. Valuation is not as relevant because the earnings will make up for it. Other is the exact opposite, which is value-oriented investment, which means you invest in companies which are cheap in terms of valuation. Earnings growth may not be as important, so that's growth value. Then you have something in between, which is called growth at right price. That means you still buy growth, but at a reasonable valuation. And then you can have either a quality bias or a momentum bias as well. And there again, these styles also see cycles. So, there could be time periods where, like for example, last 3 years, quality has underperformed significantly, and investors may completely be away from quality. They may not pick any of these funds, but quality could come back. So having a little bit of allocation everywhere makes sense, but you can have a bias towards what is working right now at that point.
So, I mean, in the practical sense, how do you apply that? Because Indian mutual funds don't necessarily advertise themselves as, okay, I'm a growth fund or I'm a value fund. And that portfolio could have a mix. It could have certain high growth stocks. It could have certain underperformers, which the fund manager feels could turn around. So how do you practically implement this?
So the way to do that is having diversification across AMCs. AMCs generally have a style. For example, Axis as an AMC was doing really well up to one period of time because quality bias was helping them, and now they've underperformed because quality has underperformed. So having not being concentrated in one AMC can actually help you. And AMCs tend to have their own style. So if you, our thumb rule is that in any AMC, nothing more than 30% of the portfolio. And if you do that, then you will have
okay, give us, since you mentioned that some AMCs tend to have a certain style characteristics. So the ones where the style is pretty clear or evident, give us some examples.
So for example, HDFC, in their flexi cap and focused they are a little more value-oriented fund house.
They're like value stocks.
They're value stocks. Prashant, Prashant Jan was managing it.
Yeah.
It was completely value.
Totally
and
value, yeah.
with Roshi, it's a little more GARB, but still value-oriented. So they're on that side.
Okay.
Motilal, as a fund house, a little more momentum, a little more earnings growth-oriented.
Yeah.
And then you have Invesco, which is a little more balanced. It does a little bit of growth, a little bit of value in their funds.
Okay.
As we said, Axis, has a little quality biased. They've had quality bias historically. In UTI, while the fund house doesn't have a style, but something like a UTI FlexiCap has been a quality biased mutual fund throughout.
Okay, that helps. So we can keep that in mind. That's the inherent nature of some of these funds of the fund houses.
Yeah.
And then you can do a mix and match when it comes to your portfolio. So that covers the third point, three mistakes to avoid.
Yeah.
What's the fourth mistake to avoid?
Yeah, so the other thing is NFOs, new fund offers. So new fund offers, at new fund offers, you don't have a past track record. You don't have past portfolios that you can look at or the current portfolios that you can look at to take decisions. So the decision is based on themes or narratives that the AMC is talking about. And there you could, and so there one should be a little more selective. If it's a theme which is not there is no other investment option available in that theme, then you can go ahead and do the NFO still. But if it's a theme which is well played out, like a mid cap, small cap, there are multiple other options, then maybe it's best avoided, wait for some time, look at how the fund does, and then participate in that NFO.
Okay, so don't get carried away with NFOs. That could be mistake number 4. But let me ask you about this, because in the last year or 2 years, every time a sector has done really well, you'll definitely see AMCs coming out with funds.
Yes.
So defense, we saw that.
Yes.
Manufacturing, we saw that.
Yes.
Now, maybe the long-term narrative cannot be denied. Maybe there is a long-term opportunity
Exactly.
there. So for instance, on defense, what is your house call right now?
Yes.
To be in these defense funds or to completely steer clear?
Sure. So I think right now defense stocks have rallied a lot. The whole India-Pakistan issue also, sort of helped these stocks do well. Some of them have run ahead of their fundamentals. So our view right now is to sort of book profits from defense.
Okay.
Back when HDFC had launched the fund, I think it was a very good time. It's done well, since they launched.
Okay. Is there any thematic or sector fund that you like?
Sure. So right now we are a little more biased towards financials. I think banks right now are trading at valuations which are lower than historical averages. So any fund, funds which are biased towards banking and financial services, BFSI funds are funds that we are positive on right now.
Okay. All right. Otherwise, not getting too carried away with the hot sectors that are, the top trending, so to speak. Okay, so that's 4 mistakes to avoid. Which is the 5th one?
Yeah, so 5th one is similar. This is sector and thematic funds. Even if they're not NFOs, they are funds which are ongoing. Investors may be overexposed to thematic funds. Generally, when by the time it becomes popular, by the time it's there in the narrative, it's already run up, and that's probably not the best time to enter. So. Limiting your thematic exposure to maybe say 10 to 15% of the portfolio and keep the balanced in FlexiCap, whatever categories you want to invest in, is probably more prudent, and just have like 10-15% in sector thematic funds.
Okay, all right. So 5 rules to keep in mind when you're looking at your portfolio, evaluating your portfolio, either yourself or with your advisor. Let's quickly do a recap. 5 mistakes to avoid in your portfolio plan.
Yeah. So the first one is too much concentration or diversification. As we said, the right balance is between say 8 to 15 mutual funds. The second is market cap allocation, not being biased towards one market cap, having a balance between large, mid, small cap is the second point. The third point is style diversification across growth, value, and quality. The fourth point is NFOs and being selective about NFOs. And the final point is thematic and sectoral funds, being selective about thematic sector funds and limiting exposure there.
Okay, all right. So remember these 5 pointers when you're looking at your portfolio plan. We do have to take a very quick break on that note. On the other side, as promised, we're going to do a quick dipstick on hybrid funds. Why perhaps you may want to use these funds to diversify beyond equity as well. Are there some good funds out there that you should consider? We'll discuss this after the break.
Let's talk money. Let's Talk Money.
Welcome back. You're with us on Let's Talk Money, and we're discussing the portfolio mistakes to avoid with Alek Yadav of Sanctum Wealth. One of the mistakes to avoid, obviously, is being too skewed towards any one particular asset class and not have a well-balanced portfolio. Now, something that can perhaps help us stay away from this is the category of funds known as hybrids, where you have a mix and match of various asset classes, and all of them are offered by the mutual fund world. In fact, if you look at the returns of some of the hybrids, returns have been looking pretty decent in the last couple of years, though, of course, we must remember that past returns are not an indication of future performance. But nonetheless, I mean, look at that table. It's pretty self-explanatory. Double-digit returns coming in. And many of these funds, by the way, are fairly tax-efficient as well. They have better than FD taxation. And that's why, Alek, I wanted to, draw you in.
Yeah.
Which of these categories makes sense to you?
Sure. So for a conservative investor, two categories to look at. One is equity plus equity arbitrage, which is basically investing in stocks which are, you buy some in cash, you sell some in futures. Overall, you're hedged. You get debt-like returns and debt-like risk, but they are taxed as equity mutual funds, so you get a much healthier post-tax.
So that's the arbitrage category.
That's the arbitrage.
And that's been getting a fair amount of funds last
Exactly.
2-3 months. In fact, I've noticed this. The arbitrage category has been drawing in almost 15,000 crores from investors over the last two odd months or so.
Yeah.
So arbitrage is a category, something that you like.
That's right.
And what else?
Yeah, so that is the most safest one. Then slightly, if you can take a little more risk, then there is a category called equity savings, where the fund will take about, say, 30% odd exposure to equities. The balance, 30-35%, would be in arbitrage, and the rest would be in debt. That could be for somebody who can take a little bit of risk, has slightly a longer time horizon, say 1 year plus. You get slightly higher returns, as you can see here.
8%.
Yeah. And the taxation is again equity taxation, so that also helps in this case.
Now, this category of dynamic asset allocation, or the balanced advantage funds as they're called, this and the multi-asset allocation category, this has been getting a lot of flows. In fact, we'll just pull up the bars as well. I think we have the data as well. Over the last couple of months, systematically, there's a lot of money that's flowing into the balanced advantage fund category, as well as multi-asset funds. So yeah, arbitrage is what we were speaking of. So even like I said, last 2 months on arbitrage, the flows have really picked up. Look at other categories like balanced advantage, very steady sort of number of funds coming in. And multi-asset, look at that, about 3,000 crores, more than 3,000 crores in some months coming in this category as well. So they're clearly gaining in popularity.
Yeah.
Do they make sense to you?
Yeah. So especially for people who don't have access to advisors or wealth managers, for them, I think this is a beautiful category. What multi-asset and balanced advantage fund do is they move between equity and debt if it's a balanced advantage fund, depending on the fund manager's view on the market. In a multi-asset, the movement would be between equity, debt, gold and silver as one category. And that allows you to get exposure to all the three categories. They're tax efficient because most of them are taxed as equity mutual fund. And if like in current markets where you're uncertain, then the fund manager takes the call of deciding which asset class to.
Okay, so arbitrage, multi-asset, balanced advantage and equity savings. A couple of categories that perhaps one can consider. Within that, the choice of funds. Give us some names, some ideas, some AMCs that you like.
So I think in the arbitrage, the clear sort of preference that we have is for Kotak Equity Arbitrage Fund. That's the most consistent arbitrage funds that is out there. It generally does like 10-15 basis point higher, like 0.1, 0.2% higher than other arbitrage funds. The model, the technology that they've built in allows them to get a slightly higher premium than the rest of the funds. So that is the preference there. In the equity savings category, there is a fund by ICICI Pro Equity Savings Fund. They are a little more conservative fund manager. What they look to do is they look to buy only 20% equity, and that also mostly large cap, and the rest is arbitrage, and then there is a little bit of debt. They're more conservative compared to the other ones, and they've been fairly consistent. So you may not get the upside, but at least the downside is protected with ICICI Pro Equity Savings.
Okay, so that's the equity savings category.
Equity savings.
More conservative approach.
Yes.
What else do you like?
Yeah, so in the balanced advantage category, the dynamic asset allocation category, the HDFC balanced advantage fund is something that one can look at. It's a little more aggressive. What they look to do is they also take a little bit of mid cap and small cap exposure in their equity. The equity portion is managed very similar to the HDFC flexi cap focused strategy, which is a little more value oriented. And the debt is simple, plain vanilla debt. So I think that's one category that one can look at. A little more aggressive, but fairly consistent.
And what would be a fair return expectation from, let's say, an HDFC Balanced Advantage fund?
Yeah, so the fair return expectation there should be about, say, 11-12%, so
which is not bad.
Which is not bad, so you get maybe 1-2% lower than equity over a longer period of time. In the last 5 years, it's done 20% plus because markets have done well. But yeah, generally, I think that should be the expectation.
And what about multi-asset? Because they have to, by definition, invest at least 10% in every asset class, right?
Yeah.
So do you like anything here, or would you rather do it separately?
So for HNI investors that have access to advisory services, for them, it makes sense to do it separately. But for retail investors who don't have access to that, I think it makes sense to do multi-asset funds. There are, you could look at, say, like an ICICI multi-asset fund. They are very good. The model which selects funds between equity and debt is pro, and they've been following it for a very long time. They have a lot of.
And it's an old fund. It's not a new fund.
It's an old fund. It's one of the largest funds also in the category. So that's a fund that one can look at. And that's also done well in the last 5 years, 20% plus. But I think the expectation there again should be around, like, say, 10-11%.
Which is not bad. So, that makes me think and brings me to the close of this conversation. If some of these hybrid funds with lesser volatility can give you 10-11%, then isn't there a very strong case to have a greater part of your portfolio going into hybrids?
Yeah. Exactly. For retail investors who cannot do the asset allocation themselves, this is a powerful fund. You get the equity taxation, the movement of the asset allocations done by the fund manager. I think it makes a lot of sense. For HNI investors, where they can do other stuff, like in the deck, they can do not only debt mutual funds, but other funds. I think for them, there are other options that are available. For retail, it makes sense.
All right. So final word then, half the year is done, Alek. What's your advice for the second half of the year? How to make money?
So I think, just remaining invested is the most premium thing here. I think there are going to be some alpha generation possibility that mutual funds can have. So selecting the right mutual fund, being with people who have proven themselves in the past, I think will also help. This may be a time for active mutual funds than passive mutual funds.
Okay, all right. So keep your eye on the ball and eye on the stocks that perhaps can outperform. Got it. A very, very helpful conversation. Thank you very much for joining us on the show today. Thank you.
Thank you so much for having me.
All right. Well, folks, hopefully you found that interesting and engaging. I certainly did. Keep sending us your feedback, comments, and queries. As always, we'll see you with another conversation. Same time, same place next week.
Let's talk money. Ladies and gentlemen, thank you so much for being here. Over the last 5 years, we've seen crisis after crisis. It began with COVID-19, and Ambassador Saran, then we saw the semiconductor crisis that shook the world. You had the Ukraine-Russia war, which we're still grappling with. We've not found a solution. You've seen the Middle East crisis, the Israel-Hamas war, the Israel-Iran war, and the Middle East continues to be on the edge. Every day when we get up, there is some sort of upheaval or the other, and you have a president in the United States who wants to make sure that it's always America first and American interests are always benefiting. And India also is having a problem with the United States. We are managing our relationship. We have a strong strategic partnership for the future, but there are challenges when it comes to certain aspects of the trading partnership. Ladies and gentlemen, there's no one better to understand the current geopolitical situation, the geopolitical chaos that we see than Ambassador Shyam Saran, somebody who has been our foreign secretary. He has been the special envoy on the Indo-US nuclear deal, contributed a great deal to the civil nuclear agreement with the United States. And also, he was the special envoy to the Prime Minister on climate change. So, Ambassador Saran, without wasting more time, let me begin by asking you, is global chaos the new normal?
Well, it's a bit of a contradiction in terms, no? If it was normal, then we would not have chaos. So I think what we are facing is chaotic. I do not think that it is normal in the sense that this is what the future is going to be, and this is, the landscape that we will be, dealing with for the foreseeable future. So I think we have to focus attention on what are the drivers of this change which is taking place. There are some factors which are more fundamental, more seminal in character. Others may be just cyclical. The question that has been raised is what Trump is doing something that will last only for the 4 years of the presidential term, or is this something which will continue post-Trump as well? And the answer to that is that there are certain things which will continue even when Trump is not there, but there are other things which will perhaps be very different from what we are seeing today.
Right. Now, let me ask you about multipolarity. India has always believed in non-alignment. We believe in a multipolar world where we will stand for our interests. Is this working with Donald Trump?
Well, I don't think that we should look at multipolarity in terms of whether it is working for India in one relationship or not. Multipolarity is really a certain state. It's not a certain choice. Multipolarity exists because today you have a larger number of more substantial powers who have emerged in terms of their economic capabilities, in terms of their technological capabilities, in terms of their military capability. So the diffusion of power is a reality. So it's not that, in dealing with Trump, somehow or the other, we have to make a choice between multipolarity and unipolarity. I do not think that's the case. But I think it is certainly true. The question is raised whether or not we should succumb to the kind of pressures which we are facing from the United States, or should we really continue on a path which we determine is really in India's long-term interests. I think that should be the test of what we should be doing, rather than get caught in this debate about, you have to somehow ally with the United States if you want to save yourself, or you have to somehow or the other make up with China, even if it means that you have to give up or sacrifice some interest in doing that. I do not think that's the case here. I think India is in a good place today. Good place because if you look at something which has been mentioned again and again, that we are one of the few large economies, emerging economies, which are still growing at a reasonably rapid rate. Secondly, this is a very large country, 1.4 billion people. It is also a huge market. And very importantly, in a situation where we see a lot of political turmoil, a lot of political instability. Even in countries like, for example, in Europe, you have India, which you may not agree with the nature of the political dispensation here, but it has provided a long period of political stability. These are major assets which we can leverage.
Right. Ambassador Saran, keeping in mind current challenges, you know, when your relationships are getting challenged, we are getting caught up between US and China as well. Does India's foreign policy today need a reset?
No, I do not think that a reset is required. But, you know, when you are facing a dynamic situation, obviously you have to make adjustments in your policy. So if you want to call it a reset, maybe you can call it a reset. But I would say that, you know, in a changing environment, you have to be very agile. You know, you have to be very nimble-footed. So that while the guiding principle of your foreign policy is the search for strategic autonomy, the manner in which you pursue it will require different kinds of shifts, and those shifts you are seeing already. So if you have Mr. Trump putting pressure on India, you also see that there is a move by India and China to improve their relations. Because by improving their relations, the ability of other powers to exploit the differences between the two would be diminished. Not entirely removed, but diminished. So you have to keep making these adjustments all the time. But I think the North Star for you has to be the ability of India to make choices that are in line with its own vital interests.
Important point there. And I think a question that a lot of people in the audience would be trying to understand, especially our key business audience from India and around the world, Ambassador Saran, who are tuning in, is what's happening with the India-US trade deal. And Ambassador Saran, ladies and gentlemen, is someone who's worked very closely with the United States. You know, we were hearing right noises, and even now, there are positive messages coming from the White House that Donald Trump has gone on to say that, yes, we are close to a trade deal, we're working on it. The problem seems to be agriculture, problem seems to be dairy, there is a threat of BRICS tariffs, then you've got a threat of a 500% tariff due to our imports of energy from Russia. So what's taking so long as far as this deal is concerned?
Well, as you said, you know, we are not the only one. You also saw that there was an announcement that, you know, maybe Japan will have a deal very, very soon. Japan is nowhere near the deal at the moment. There are doubts being raised about the possibility of a deal with the European Union, which was also supposed to be very close. So I don't think we should be too much bothered about this so-called delay in coming to a deal, because, you know, this kind of, you know, trying to keep your trade partners off balance all the time so that you can get a better deal, this will take you only so far and no further. And I think you are already seeing that this kind of approach that Trump has adopted in terms of trade is already reaching a point of diminishing returns. Why do I say that? Look at the European Union, which has now started talking about, very clearly, about retaliation. Secondly, more importantly, it is looking for other partners to have some kind of a coordinated strategy towards the United States of America. Because what has Trump been doing? He's picking off one trade partner after another, all bilaterally. So the answer to that, I think, is coming, that, you know, trade partners, major trade partners, will perhaps have a better negotiating position if they were able to band together. And that particular trend is already there. So I feel that in terms of, you know, the efficacy of the kind of strategy that Trump has adopted, that will not continue to deliver as much as he thinks it would.
You know, considering that the US is wanting India to compromise on core national interests, we've not given in on agriculture and dairy in any trade deal for that matter. You want us to move out of BRICS as well. You want to compromise on our relationship with Russia. Do you think at some point it would be wise for India to say that, sorry, we'll have to walk away?
Well, you know, number one, I see no reason why we should, you know, succumb to any kind of demand which is being made by the United States of America if it is not in our interest. That is for us to determine whether or not our continuance in the BRICS is beneficial to us or it is not beneficial to us. Even when India was much weaker than it is today, when India's interests were at stake, it was ready to stand all alone. So you take, for example, in the late 60s, you had the Non-Proliferation Treaty. India was perhaps the only developing country which said, sorry, we will not sign this treaty, even though not only was there pressure on India from the US, much more powerful at that time, but also pressure on us from our partner, at that time, strategic partner, the Soviet Union. But yet, India stood its ground. So what I'm trying to put across is that if you look at Indian history, certainly as an independent country, whenever there has been a situation where our interests are being threatened, India has not backed away from taking a stand. So there may be some risk in doing that, but I think my understanding is that if it comes to that point, India will take a stand.
Right. That indeed is important, that India will take a stand. If we need to walk away, we will. Ambassador Saran, also to understand, in this current scenario, and we saw this during Operation Sindoor, and it's now publicly available. You've got the Defense Secretary who has said that, yes, China was helping Pakistan during Operation Sindoor. The Deputy Chief of Army Staff has also said so. So when your two adversaries, Pakistan and China, are working so closely together, your relationship with the United States is very strong. It is a futuristic relationship, but currently it's transactional because you've got a transactional president there. Russia is ironclad partners with China. What does India need to do? Do we need to establish some ironclad friendships for the future?
There are no partnerships which are ironclad. I mean, that is not something in my vocabulary as a diplomat, that, there are ironclad partnerships.
Because China and Pakistan always refer to each other like
they would describe it as an ironclad partnership. Don't forget, China and Russia have said that they have established a partnership of no limits. And yet, do they not have a history of, completely being opposed to each other? Despite being communist countries, both of them? So there is nothing written in stone as far as the relations between states are concerned. Ultimately, states have to decide their partnerships on the basis of what is in their country's interest. It is certainly true that from, say, 1960 to 1990, given the geopolitical situation that we were confronted with, a strategic partnership with the then Soviet Union made a lot of sense for us. It stood us in very good stead. When the Cold War ended, Soviet Union collapsed. At that time, India did have to make a shift, and it did make a shift. In 1990, it was faced with a twin crisis, not only a geopolitical crisis, but also an economic crisis. And yet it was able to successfully come through that crisis and adjust its foreign policy, which is what I was saying beforehand. So I think to think in terms of, we have to look at trusted friends, we have to look at, relationships which will, perennially sort of be very solid, no matter what changes are taking place in the world. That never happens. I mean, history tells you that never happens. So I think the best thing for us to do is look at the current geopolitical landscape, see what our interests are in this landscape. Today, I think most important objective for India is that its growth story should continue, should perhaps even accelerate. In that context, what are the relationships which will really stand us in good stead? And in that context, I would say that some of the changes that you see taking place already, take, for example, India's relationship with the European Union. You see a new energy in that. You see a certain willingness on the part of the European Union in terms of the trade agreement itself, making certain adjustments, positive adjustments from our point of view, which they were not ready to do before. Why? Geopolitics. So wherever there are, opportunities offered to you, you should try and grab those opportunities for the simple reason, when the geopolitical situation is frozen, like it was during the Cold War, there are very few places in which you can expand. When the global political situation is so much in flux, that is when opportunities arise for emerging countries like India to really expand into the opportunities which are offered.
Right. Thank you so much, Ambassador Saran. It was fantastic talking to you. It was indeed a masterclass in geopolitics.
Thank you very much, Mr. Yo, for joining us. At the outset, let me say, we have two Padma Bhushans in the room right now. Mr. Yo received the Padma Bhushan in 2012. I think Mr. Saran received the Padma Bhushan in 2011. So great to have both of you here with us in the audience. Of course, Mr. Yo, thank you for joining us because it's late for you in Singapore. But I just want to start by asking you, Mr. Yo, we've had discussions earlier as well about this. Can India maintain its strategic autonomy and still sort of do well? Because we need to grow at 6, 7, 8% growth rate for many years. It's a must, it's an imperative. But it's a very fractured world right now. How do you think about that question? It's a multipolar world, as has been described by many over the last 2 or 3 years, especially since President Trump took over late last year. So just opening thoughts, Mr. Yo.
Well, India is too big, too old to be anybody's satellite. And it already has the world's biggest population. It will quickly be the world's second or third biggest economy. And I don't see India as being aligned to anybody. It will be aligned to itself and be a pole unto itself in the multipolar world.
Just today, and I'm just using this example because it happened today, I mean, in the afternoon, we heard the sort of chief of NATO, Mr. Yeo, saying, and I mean, it came as a surprise to me, he said, in his conversations with President Trump, and he was talking, of course, about Russia and the 50-day deadline that he's given Russia to sort of, start talking peace. He said, New Delhi and China and Brazil better start making phone calls to Russia to urge President Putin to talk peace. Otherwise, I mean, we're going to be looking at very harsh tariffs. I mean, completely out of the blue. I mean, Russian crude, of course, is one thing, but this seems slightly different. And it kind of sort of goes to the heart of the question: can we maintain this strategic autonomy in this very fractured world, sir?
I think his remarks are a little laughable. I mean, the Western tide has crested in the world, but they're used to talking like that. I don't think India or China will. I mean, they will take it with some wry amusement, but I don't think they're intimidated at all.
Should we take this seriously, Mr. Yeo? I mean, these kind of comments, or?
No, he's echoing Trump. But, Trump changes his mind all the time. I mean, today he takes a tough position against Putin. Tomorrow he says, well, Zelensky should not strike Moscow. God knows tomorrow what he will say. We've got to take him seriously because he has power. But at the same time, we have to take a longer-term position and look after our own interests. I mean, for India, the key is your own economic development because it has a huge population. There will be growing surplus labor from the countryside, more and more graduates, and they need jobs. And manufacturing is critical to absorb this surplus labor. So India should concentrate on its own economic development and try not to get too embroiled in other people's affairs. I think that is his best strategy. And then by your own performance, by your own economic strength, others will have to have high regard of you.
Mr. Yeo, let's just talk about, the relationship with, our neighbor, China, in the context of this great sort of strategic competition which is underway on so many fronts between US and China. Where does it leave us? We've had academics and who've come on and said that, well, we must improve our relationship with China, and perhaps we should. But just in terms of trade, China is, the world's factory. They're not consuming, they're not looking to import stuff from elsewhere, but they're looking to export to the outside world. Is that a fundamental kind of a problem when you look at this relationship?
No, I don't see a natural antagonism between India and China. I know anti-Chinese sentiments in India now are quite strong, but I don't think this will continue for very long because there are no fundamental contradictions between India and China. Historically, they are not enemies. There was a border war, but which is largely forgotten in China, but still raw in India. But it will eventually be resolved. I mean, the way China and Russia have been able to demarcate a much longer border than the one between India and China. In the case of India and China, that border was never demarcated because in the east, you had the McMahon Line, which was demarcated with the local Tibetan government at a time when London recognized Beijing as suzerain, so it has no international validity. In the west, various lines were drawn by the British, which sometimes the Chinese were not even cognizant of. So this work has got to be done. When bilateral relations are good, then the problems can be easily resolved, as they were between China and Russia. Of course, following Gao 1, the US saw an opportunity to bring India on its side against China. And India saw an opportunity to make use of the US against China. But when it came to Ukraine, India supported Russia, would not condemn Russia. When it comes to Pakistan, the US will not condemn Pakistan. So it's an adult relationship. And yes, we maximize whatever cards are at play, but the long-term position is India must be autonomous and calculate in its own self-interest. And that self-interest should be stable, friendly, but not too friendly relations with China.
This is a question which many ask, but I don't think any of us will be wiser in hindsight in that sense. But is this fracture in the world that we're seeing, Mr. Yeo, as you see it, permanent, or this is a 4-year thing?
Oh no, I think we're in the great transition to a multipolar world. I mean, China will be much larger than the US economy. India will be its own pole. Brazil will be independent. Africa will have its own destiny. And Europe, Trump has succeeded in forcing NATO countries to spend much more. But once the Europeans are militarily stronger, they will assert their own policy with respect to Russia, the Middle East, China, Africa. So in a sense, Trump is helping to precipitate the future, a multipolar reality. I don't think it's just Trump. Trump is merely the product of an age which is in great transition.
Mr. Yeo, we'll leave it there, sir. Thank you so much for joining us. Wise words. You're being heard here in this audience, and I'm sure, across our platforms and perhaps, in New Delhi as well. Thank you very much for joining us on this special evening for us. Really appreciate it. Thank you.
Joining us in a special chat today, we have India's golden boy who's bringing glory to the nation at the global stage, one throw at a time. We have Neeraj Chopra joining us today along with Tushar Gokuldas, who is the MD of Underdog Athletics. Their campaign together that they worked out, Zid for More for Under Armour, has been a raging success which showcased Neeraj's relentless training sessions and his mindset. नीरज, सबसे पहले जिद फॉर मोर के बारे में ही बात करते हैं क्योंकि मुझे बहुत पसंद आई आपकी ये कैंपेन अंडर आर्मर के साथ। आपकी जो जिद वाली फिलॉसफी है वो किस तरह से दर्शाती है ये कैंपेन नीरज?
नहीं, बिल्कुल, सबसे पहले तो बहुत ही अच्छा लग रहा है आपके साथ, तुषार जी के साथ, और अंडर आर्मर स्टोर में हैं तो जिद फॉर मोर दर्शाती है। इसको हम जिद को मैंने अच्छे तरीके से बताया है कि अगर अच्छे तरीके की जिद हम करें तो वो बहुत ही अच्छी होती है। जैसे कई बार हम ट्रेनिंग कर रहे होते हैं और थक गए हैं, फिजिकली हम बहुत ज़्यादा थक गए हैं, लेकिन मेंटली हम अपने आप को पुश करते हैं और ज़्यादा, ये पता होते हुए कि हाँ हम और ज़्यादा कर सकते हैं और हमारे अंदर और कैपेबिलिटी है, हमको रुकना नहीं है। तो उस तरीके से, ऐसे नहीं कि भाई हम ख़राब फील कर रहे हैं, ऑलरेडी थके हुए हैं और फिर भी और हमें इंजरी होने के चांसेस और फिर हम जिद कर रहे हैं, तो वो अच्छे तरीके की जिद है कि भाई हमको और करना है। क्योंकि अगर हमको अलग दिखना है और अलग बनना है तो हमको और ज़्यादा ट्रेनिंग करनी पड़ेगी। तो जिद फॉर मोर, तो जिद करो और अच्छी जिद करो और ज़्यादा ऊपर जाने के लिए।
मिड मई में ही आपने वो 90 वाला मार्क क्रॉस किया, तो कैसा लगा? किस तरह के इमोशंस थे आपके वो 90 क्रॉस करते हुए, 90 मीटर को क्रॉस करते हुए?
बहुत ही स्पेशल था क्योंकि वही एक ऐसा बार बार एक अचीवमेंट ऐसा रुका हुआ था, क्योंकि सभी वर्ल्ड क्लास कॉम्पिटिशन्स है, ओलंपिक लगा लो या वर्ल्ड चैंपियनशिप, डायमंड लीग, एशियन गेम, कॉमनवेल्थ गेम्स, तो सभी में अपने पास जेवलिन में गोल्ड हो गया था, तो जेवलिन ऑलमोस्ट कंप्लीट हो गई थी। तो एक 90 मीटर का वो मेरे माइंड में नहीं था, लेकिन वो सब लोगों को ये था कि 90 मीटर क्रॉस करना है। और ये जो हर 10 मीटर का बैरियर है ये बहुत ही ज़्यादा होता है। 80 मीटर मैंने 2015 में क्रॉस कर दिया था, तो अभी 2025 चल रहा है, तो 10 साल लग गए ये 10 मीटर को बढ़ाने में। तो ये बहुत ही टफ था और ये मैं बिलीव कर रहा था 2018 से कि मैं कर सकता हूँ, क्योंकि मैंने बहुत ही क्लोज किया था, एशियन गेम्स में 88 मीटर थ्रो किया था, तो तब से मुझे लग रहा था कि मैं कर सकता हूँ। लेकिन फिर भी कंसिस्टेंट तो मैं बहुत था, लेकिन फाइनली एक रिलीफ मिला कि यार ये हो गया है। सबसे बड़ा रिलीफ ये था कि अब आप पूछ रहे हो कि कैसा लग रहा है 90 मीटर क्रॉस, पहले बोलते थे कब कर रहे हो 90 मीटर तो वो
तो रिलीफ वाली फीलिंग थी
और एक बिलीव बढ़ा है कि नहीं अब और अच्छा हो सकता है। क्योंकि मेरे हिसाब से वो बेस्ट टेक्निक या बेस्ट, मतलब मेरा बेस्ट नहीं था उस दिन जो मुझे फील हुआ, तो और अच्छा हो सकता है।
और अच्छा हो सकता है तो कितना अच्छा? अगला टारगेट क्या है? 10 साल लगे आपको 90 मीटर क्रॉस करने में, आपने बताया, तो अगला आपका टारगेट क्या है?
बस मुझे ये लगता है कि एक बार वो होता है ना कि आपको एक जिस चीज़ का एक वो बिलीव मिल जाता है। अब वो मुझे डिस्टेंस मिल गया 90 प्लस का, अब वो मेरे माइंड से हट गया है कि 90 मीटर क्रॉस करना है, अब वो हो चुका है। अब मैं यही कोशिश करूँगा कि स्टेप बाय स्टेप, मैं ये नहीं सोचूंगा कि अब मुझे वर्ल्ड रिकॉर्ड के लिए थ्रो करना है, अब मुझे 92 तक, 93 तक ऐसे थ्रो के लिए तैयारी करनी है। जब वो क्रॉस हो जाएगा तो स्टेप बाय स्टेप फिर अगले टारगेट के लिए सोचेंगे।
सो वन स्टेप एट अ टाइम, ये फिलॉसफी है। तुषार, Neeraj has been associated with Under Armour since 22. You mentioned how, it could have been much before that. So tell us, working with him, what has been one of your standout moments, working with Neeraj?
One thing that kind of really endeared me to him is his very caring and compassionate personality. ये सबका ख्याल रखते हैं। इनका स्पोर्ट ऐसा है जहाँ पे he is an individual athlete. There is no team, लेकिन he treats everybody as his team. बाकी javelin athletes भी, which I was surprised, पहली बार मैं यूजीन में जब मिला, I thought कि ये सारे competitor हैं, लेकिन इवेंट के बाद सब गले मिल रहे थे, हंसी खुशी से बात कर रहे थे। I was taken aback कि इतना intense competition जहाँ one on one हो रहा है। And even the other younger Indian athletes, he's very caring and compassionate and takes care, guides them, helps them, क्या खाना है, कैसे train करना है। I've seen this over the last 3 years multiple times. So that's something that really stood out for me as an exceptional part of his character, and which makes me really admire him and like him even more.
Yeah. Neeraj, because Under Armour focuses so much on performance gear and you're the topmost performing athlete in the country, तो किस तरह का feedback आपने दिया है Under Armour को gear को लेकर और किस तरह से लेते हैं ये feedback?
नहीं, बहुत ही डिटेल में लेते हैं और हर एक चीज़ हम बात करते हैं। हमने बहुत ही ज़्यादा काम किया है बीच में कि हम जेवलिन स्पाइक के ऊपर काम कर रहे थे और हमने काफ़ी अच्छे स्पाइक बनाए और बहुत ही डिटेल में हमने बातें की, प्लस गियर के बारे में, शूज़ के बारे में कि मुझे मकीना अच्छा लगता है और तुषार जी फिर उसके बारे में प्रॉपर बताते हैं कि अब हमने उसके ऊपर वाला वर्जन कर दिया है, अब मकीना का ये वर्जन आ गया है। तो बहुत डिटेल में बातें होती हैं, जो कि अब रखे हुए सब शूज़ ऐसे ही लग रहे हैं नॉर्मली, लेकिन वो प्रॉपर कि भाई अब ये वेलोसिटी है, फैंटम ने आया है, तो बहुत ही डिटेल में बातें होती हैं। प्लस मुझे गियर में बहुत ही अब मुझे काफ़ी सारे लाइफस्टाइल क्लोथ्स भी दिख रहे हैं कि भाई पहले हम ज़्यादातर परफॉर्मेंस में ज़्यादा काम कर रहे थे, जैसे प्रोजेक्ट रॉक भी परफॉर्मेंस के लिए था, लेकिन अभी लाइफस्टाइल भी काफ़ी ज़्यादा आने लगे हैं। तो वो काफ़ी अच्छा लग रहा है कि हाँ, कि इतने कंफर्ट हैं। और मुझे तो बहुत ज़्यादा शुरू से बहुत ज़्यादा पसंद था कि जब मैं बाहर जाता था तो अंडर आर्मर के टाइट्स और ये और कंप्रेशंस, ये इनके डिज़ाइन बिल्कुल यूनिक होते थे। तो मैं बहुत ज़्यादा खुश था जब हमने आपस में बात की और अंडर आर्मर के साथ एसोसिएट।
ग्रेट। एंड आपने बहुत अच्छी बात कही कि लाइफस्टाइल के कपड़े भी अभी स्पोर्ट्स परफॉर्मेंस स्पोर्ट्स वेयर की दुकान में मिलने लगे हैं। ऑन दैट नोट तुषार, आई वांट टू नो दैट the line between what qualifies as sportswear, athleisure, everything is blurring. So what does that mean for business for you?
See, many brands have taken this to a very different extreme level. Our focus as a brand is, of course, athletic performance. However, even athletes need something which is an intermediate product, garment, to wear when they are not in their intense training. So, before training, after training, there are opportunities to equip our athletes with product that looks great and also delivers a certain level of performance. So that's the kind of extent to which we are going. We are not anywhere close to going into fashion or complete lifestyle, but it's very comfortable, high performance gear that also looks great in whichever circumstance or situation you want to wear it.
Neeraj, जैसे मैंने शुरुआत में कहा कि you're truly the golden boy, not just for the Indian sport, but also in the world of brands these days. From Under Armour to digital payments to beverages, you seem to be endorsing every other brand. So how does it feel? How does this entire attention feel for you as a sports person?
नहीं, बिल्कुल, जब ये ज़्यादातर ये सब सारी चीज़ें मैंने टोक्यो ओलंपिक्स के बाद ही फील की और बस मेरा एक ही मन था कि परफॉर्मेंस और स्पोर्ट्स पे पूरा फोकस रखना है, क्योंकि इसी की वजह से सब कुछ है। और अगर सब कुछ मुझे और ज़्यादा आगे बढ़ाना है तो सबसे ज़्यादा फोकस मुझे अपनी परफॉर्मेंस पे और स्पोर्ट्स पे रखना है। तो बहुत ही अच्छा लगता है।
किसी दिन आप अपना खुद का ब्रांड लॉन्च करने के बारे में सोचेंगे, नहीं सोचेंगे? क्या ख्याल है इस चीज़ का?
बिल्कुल, काफ़ी सारे एथलीट्स एग्जाम्पल हैं, माइकल जॉर्डन और स्टेफ करी, या जो अंडर आर्मर के साथ एसोसिएट हैं, और मतलब बहुत सारे ऐसे एथलीट्स हैं। तो बिल्कुल ऐसा कुछ हम भी सोच सकते हैं। अब वो देखना पड़ेगा, वो प्रॉपर टीम लगेगी कि भाई कैसे हम इंडिया में उसको कर सकते हैं, पर बिल्कुल ऐसा हो सकता है और बिल्कुल पॉसिबल है।
बिल्कुल,
हाँ जी।
I have seen how Under Armour has stayed away from the Bollywood superstars or the cricketing superstars and focused on like phenomenal athletes like Neeraj Chopra. Is that going to be the strategy going forward? And if yes, who else is going to be under the Under Armour umbrella?
See, absolutely, we will continue with this approach. We want to focus on athletes who will bring glory to our nation. Some have already brought a lot of glory, such as Neeraj, and there are many other hidden talents. The next Neeraj could be a male or a female who is going to bring glory, maybe in LA or beyond. Those are the athletes that we would like to partner with, and those are actually our dream athletes. The next athlete that brings a gold, especially in an individual capacity for India. In fact, today, in addition to launching or relaunching this store in its new avatar, We're also introducing 4 new members in our athlete roster who are in Olympic disciplines. There are 2 fencers and 2 track and field athletes. So, you know, when we had the first press conference with Neeraj, he said something which was not clearly in my mind, but that stayed in my mind.
Which is?
He said कि हम आज जुड़े हैं अंडर आर्मर से, लेकिन हम एक टीम बनाएंगे. So वो बात मेरे दिमाग में तब से है. So we are slowly building more athletes or adding more athletes to Under Armour, which can be part of the team where Neeraj is a sort of a leader. Though they may be from different sports, but we would like to build that Olympic movement and get help and support athletes who can bring glory to our nation.
वही लोगों को साथ में लेके चलने की फिलॉसफी जिसके बारे में आपने शुरुआत में ही बात करी. लेकिन हाल फिलहाल नीरज चोपड़ा क्लासिक जस्ट कंक्लूडेड with close to 15,000 spectators, national and international athletes competing. आपके लिए एक पर्सनल माइलस्टोन की तरह लगा ये?
बिल्कुल, ये बहुत ही चैलेंजिंग था. खासकर ट्रैक एंड फील्ड, वो भी एक इवेंट में इतनी पब्लिक को लेके आना. पहले तो मैं बहुत ज़्यादा नर्वस था कि भाई इतना हो पाया कि नहीं, कि इतना बड़ा स्टेप लिया तो है. प्लस वर्ल्ड एथलेटिक्स ने हमको एक कैटेगरी का इवेंट दिया था, तो वो बहुत बड़ी अपॉर्चुनिटी थी अपने आप में. मुझे लगता नहीं कि सिंगल इवेंट को इतनी अटेंशन मिलती है. तो वो कहीं ना कहीं मुझे लगा कि यार ये तो अब और ज़्यादा प्रेशर आया कि इसको तो कामयाब करना ही है, इस कंपटीशन को. फिर काफ़ी सारे ब्रांड्स ने सपोर्ट किया, अंडर आर्मर ने सपोर्ट किया, तो सभी ने साथ मिलके फिर मुझे लगा कि यार हाँ, सब लोग साथ में हैं. प्लस गवर्नमेंट ने सपोर्ट किया, JSW टीम साथ में थी, तो लगने लगा कि हाँ. और मैं डायमंड लीग पेरिस और ओस्ट्रावा गोल्डन स्पाइक compete करके और काफ़ी सारा ट्रैवल करके आया ही था, और काफ़ी सारी चीज़ें चल रही थी. मैं शूट पे भी जा रहा था, कुछ वीडियो वगैरह बनानी पड़ रही थी. नॉर्मली मैं कंफर्ट नहीं होता इतना. मैं कंपटीशन से पहले मैं सोचता हूँ कि मुझे ट्रेनिंग करनी है और रेस्ट करना है बस, और माइंड को रिलैक्स रखना है. और प्लस ये इतना बड़ा प्रेशर था कि इंडिया में ही हो रहा है. यार यहाँ पे तो बहुत ज़्यादा ज़रूरी है, और इससे बड़ा प्रेशर है कि मेरे नाम से ही हो रहा है. तो काफ़ी ज़्यादा ऐसे बिल्कुल जो मैं प्रेशर फील करता हूँ बाकी कंपटीशन में, तो उनको तो संभाला जा सकता है, लेकिन ये कुछ अलग था. मेरी फैमिली भी सभी आए हुए थे. मैं यार इन सभी के सामने तो नहीं हार सकता मैं. एटलीस्ट फर्स्ट एडिशन तो हमको ही जीतना है.
यही मोटिवेशन था.
हाँ, तो काफ़ी सारा वो था. प्लस मैं ट्रेनिंग वगैरह से भी दूर था, और एक वीक में पूरा सब इन चीज़ों में था, तो माइंड बहुत ज़्यादा ऑलरेडी भरा हुआ था सब चीज़ों से. लेकिन स्टिल मैं जब ट्रैक पे था और वो चीज़ लगा कि नहीं यार करना ही है, और उस दिन कंडीशन भी इतने अच्छे नहीं थे, लेकिन स्टिल वो काफ़ी अच्छा कंपटीशन रहा, एक अलग एक्सपीरियंस रहा. और कंपटीशन ख़त्म होते ही जब वो ख़त्म हो गया और पता लग गया कि जीत गए हैं, तो एक रिलीफ मिला कि नहीं यार, और मुझे रियलाइज़ हुआ कि कितना बड़ा प्रेशर लेके घूम रहा था मैं. लेकिन हाँ, वो फर्स्ट टाइम था. अब अगली बार से थोड़ा सा लाइट हो जाएगा, क्योंकि मुझे लगता था कि ये ट्रॉफी सबसे पहले वाली तो अपने इंडिया में ही रहनी चाहिए.
बिल्कुल. और आपने जीत लिया. और जैसे आपने कहा कि डायमंड लीग पेरिस, उसके बाद ओस्ट्रावा, फिर क्लासिक, तो ये जो हाई प्रेशर इवेंट्स है, और इस बार तो आपकी फैमिली भी आई हुई थी, तो किस तरह से आप डील करते हैं इस प्रेशर के साथ?
नहीं, देखो, डायमंड लीग्स काफ़ी ज़्यादा हेल्प करते हैं हमको कम्पीट करने में और प्रेशर को हैंडल करने में, क्योंकि डायमंड लीग एक ऐसी इवेंट है वो साल में हमको 4-5 बार मौके मिलते हैं. और एथलीट्स सेम होते हैं, जो ओलंपिक्स, वर्ल्ड चैंपियनशिप या वहाँ पे जो टॉप एथलीट्स होते हैं, तो वो काफ़ी ज़्यादा हेल्प मिलती है. तो अब जब भी ओलंपिक्स में या कहीं पे खेलते हैं, तो बिल्कुल वो कंट्री की तरफ से खेलते हैं, वो अपना अलग प्रेशर है. लेकिन वो अंदर जब फील्ड पे होते हैं तो ऐसा महसूस नहीं होता कि हाँ हम ऐसा कुछ में, हाँ बस हम फिट होने चाहिए. कई बार एथलीट्स को छोटी मोटी इंजरी है, वो एक अलग बात है कि वो अलग प्रेशर है. लेकिन अब वो अच्छे से हैंडल हो जाता है. और काफ़ी टाइम बाद मुझे लगता है लास्ट टाइम डायमंड लीग विन हमने तब किया था जब लोजान में आप भी वहाँ पे, तो उसके बाद अब काफ़ी टाइम बाद मतलब सेकंड आ रहे थे, तो दोबारा से पेरिस डायमंड लीग में फर्स्ट आए. और फिर ओस्ट्रावा गोल्डन स्पाइक वन ऑफ द ग्रेट कंपटीशन है एथलेटिक्स का, काफ़ी पुराना है, और वहाँ पे पहली बार खेला और जीता. और फिर NC क्लासिक, तो एक अच्छी 3 कंपटीशन ये अच्छे सीरीज में रहे. तो अभी इस साल का सबसे बड़ा टारगेट अपना वर्ल्ड चैंपियनशिप का है, टोक्यो में.
responsibly.
Hosting a World Athletics Gold event in India, एक डिसिप्लिन से आपने शुरू किया
जी।
आपने हिंट किया था कि आने वाले दिनों में नए डिसिप्लिन जुड़ेंगे इसके साथ, तो कौन से डिसिप्लिन जोड़ रहे हैं आप?
वो कोशिश करेंगे कि हमारे जो एथलीट्स जिन इवेंट्स में स्ट्रॉन्ग होंगे कि भाई उनको मौका मिले, ऐसे इवेंट्स जोड़ेंगे। बट अभी तो जस्ट वो ख़त्म हुआ है और अभी बातें चलेंगी इस पे वर्ल्ड एथलेटिक्स और सभी से मिलके कि कौन से इवेंट्स जोड़े जा सकते हैं और फिर हम वो डिसिप्लिन ऐड कर सकते हैं।
Tushar, brands such as Decathlon coming into India in a big way and spreading their presence across different markets has also made, gear affordable to the masses. And then there are a lot of these D2C brands that you browse through Instagram, you browse through Twitter and different social media platforms and you get access to that. Are they growing the market for you? What are they doing for, the business?
We operate in a fairly premium segment. So in that sense, we are fairly unique in India. Most of our merchandise is based on innovation and high technology, which delivers benefits to the consumer. So at this point in time, so far, there's no immediate brand in our immediate vicinity which delivers this kind of product benefit. A lot of brands are tapping into the athleisure part of the sportswear space, right?
Okay.
Which is, I've heard brands say we are about wellness and lounge, etc. We are not at all in that space. We are in the athletic performance space, but extending to pre and post sport and a little bit of, how should I say, comfortable wear. So we are fairly unique in terms of our product technology, as well as the price points at which consumers are buying our brand. So I don't know if I mentioned it ever earlier, the average selling price of our shoes in retail is 16,200 rupees. This is probably more than double of even the rest of the international sportswear brands. So we are pretty much at that top of that pyramid and not directly, I would say, affected or impacted by some of the other developments that you're talking about.
Yeah, and then on that note, I would like to ask you, how do, Indian athletes bringing glory at global stage are driving inclination towards this premium high performance gear in the country?
There it's a very straightforward correlation and so many stories that I can tell you. One example is, we've been selling men's leggings. You can see those up there. And nobody would ever buy men's leggings in India, right? In 2022 July, Neeraj, started wearing our gear and then he started competing and then there was Eugene and many events after that. And suddenly the consumption or the purchase of men's leggings zoomed, which is a direct correlation, directly attributed to Neeraj wearing them. Otherwise, leggings were meant to be for women. Or thought to be for women, at least in India, but suddenly that category zoomed. Also, we are in a part of the country which is pretty much his home state, of course, and many of my team members who live here, they play various sports.
Yeah.
And when people get to know, and there are people who come in sports academies from nearby towns and villages to play, and when they get to know that these people are from Under Armour, first thing they say is, "वो नीरज भैया वाला T-shirt हमें दिला दो." It's very, very common. My merchandising head tells me this every week. He tells me कि 3-4 लड़कियाँ आए, they asked me नीरज भैया वाला T-shirt कहाँ मिलेगा, वो वाला जो उन्होंने उधर पहना था. So people see him as a role model, and they want to, copy and wear the same product that he's wearing, and they are willing to save up for it.
Correct. नहीं, आपने बिल्कुल सही कहा. नीरज तो रोल मॉडल है ही, लेकिन नीरज एज ए ह्यूमन बीइंग हमें अभी जानना है. तो कुछ सवाल है मेरे आपसे. सबसे पहली चीज कि किसी भी हाई प्रेशर गेम से पहले कुछ क्वर्की रूटीन है आपका, कुछ अटपटा सा रूटीन है जिसके बारे में बहुत से लोगों को नहीं पता जो आप करते हैं?
उस दिन मैं थोड़ा सा शांत रहता हूँ, चुप रहता हूँ, थोड़ा एनर्जी एक जगह पे ज़्यादा लगानी है क्योंकि कंपटीशन बहुत ही इंटेंस होता है. तो उस दिन थोड़ा सा मैं शांत रहता हूँ। नॉर्मली मैं थोड़ा फन में रहता हूँ, लेकिन कंपटीशन वाले दिन थोड़ा सा आपको शांत दिखूंगा। उसका मतलब ये नहीं कि मैं प्रेशर में हूँ, उसका मतलब ये है कि मैं थोड़ा और एक्स्ट्रा फोकस कर रहा हूँ अपने इवेंट के लिए। तो यही थोड़ा होता है, और जाने से पहले थोड़ा भगवान को याद करते हैं।
बिल्कुल, इसी नोट पर आपका फेवरेट ट्रैक कौन सा है?
ओह, टफ क्वेश्चन। काफ़ी सारे खेलने हैं और काफ़ी ज़्यूरिक में बहुत ज़्यादा मज़ा आता है फाइनल डायमंड लीग में। प्लस मुझे स्टॉकहोम बहुत अच्छा लगा था। स्टॉकहोम में मैंने नेशनल रिकॉर्ड किया था 2022 में, जिसकी तुषार जी बात कर रहे थे। मैंने लेगिंग्स डाली थी और उस टाइम पे, और मैं बताना चाहता हूँ कि बिल्कुल लड़के वाली नहीं होती है, बहुत कंफर्टेबल होती है। और माइकल फेल्प्स जैसे सभी एथलीट्स लेगिंग्स डालते हैं, और ये जिम के लिए आप इतना स्ट्रेच होते हैं और उसमें प्रॉब्लम नहीं आती।
स्टॉकहोम और ज्यूरिक दो ट्रैक्स के बारे में आपने कहा। अभी मुझे बताइए कि कौन सा मोमेंट आपके लिए सबसे ज्यादा सेटिस्फाइंग था? वाज इट द ओलंपिक गोल्ड या क्रॉसिंग द 90 मीटर बैरियर?
नहीं, ओलंपिक गोल्ड कुछ अलग था। बिल्कुल देखो, डिस्टेंस है, अच्छा है, 90 मीटर बहुत थ्रोवर्स ने लगा भी रखी है, बट वो बोलते हैं कि मेडल एक ऐसी चीज़ है जो आपसे कोई ले नहीं सकता। तो रिकॉर्ड तोड़े जा सकते हैं, लेकिन मेडल आपके पास है। तो 90 मीटर ऐसे बहुत सारे थ्रोवर्स हैं जिन्होंने 90 मीटर क्रॉस किए, लेकिन उनके पास ओलंपिक गोल्ड नहीं है।
हाँ।
तो ओलंपिक गोल्ड अपने आप में एक बहुत ही एक ऐसी अचीवमेंट है जो एक मुझे लगता है थ्रोज से काफ़ी बड़ी है, क्योंकि उस टाइम पे 4 साल में आपको एक थोड़ा सा टाइम मिलता है और आप टॉप एथलीट्स के बीच में कम्पीट कर रहे हैं। प्लस वहाँ पे बहुत सारे 90 प्लस के थ्रोअर होते हैं, और उस प्रेशर मोमेंट में आपको अपना बेस्ट परफॉर्मेंस देना है, उनको बीट करना है। तो मुझे लगता है ओलंपिक गोल्ड अपने आप में एक अलग परफॉर्मेंस है।
आपका सबसे मजेदार फैन मोमेंट क्या था? क्या चीज किसी फैन ने आपके लिए करी है, या फिर कुछ मजेदार चीज जो हुई है एक फैन के साथ?
नहीं, मुझे लगता है कि ज़्यादातर हमारे इस एरिया में, नॉर्थ में, दिल्ली, हरियाणा, पंजाब, राजस्थान, यूपी, यहाँ पे इतने मतलब ओपन होते हैं लोग, और वो ऐसा फील करते हैं कि जैसे हम ऑलरेडी बहुत साल से मिल रहे हैं और हम उनके दोस्त ही हैं। तो ऐसे वो ऐसे नहीं बात करते कि भाई फ़ोटो लेनी है या मिलना है, वो सीधा गले में हाथ डालते हैं ऐसे। तो ऐसे काफ़ी बार हुआ है कि वाह कैसे भाई, कैसे हो। तो वो कहीं ना कहीं मुझे लगता है कि यार देखो कितने मतलब वो कंफर्ट फील करते हैं ऐसे। वो फनी भी होता है थोड़ा कि इतना भी ओपन नहीं होना चाहिए, लेकिन ठीक है, वो मैं मैनेज कर लेता हूँ थोड़ा।
नीरज जी, फाइनली आपकी जो लाइफ स्टोरी है वो काफी इंस्पायरिंग रही है। अगर एक एक्टर जो आपके हिसाब से आपको लगता है कि आपका कैरेक्टर प्ले कर सकता है किसी भी फिल्म में, किसी भी मूवी में, तो वो कौन होना चाहिए?
पता नहीं, मैंने काफ़ी टाइम पहले 2016 में सेम क्वेश्चन पूछा था, तो उस टाइम मैंने बोला था कि शायद से, क्योंकि मैं हरियाणा से हूँ, उस टाइम रणदीप हुड्डा यंग थे, तो लेकिन अभी वो थोड़ा सोचना पड़ेगा। नहीं, काफ़ी लोग बोलते हैं कि शायद से शाहिद कपूर भी काफ़ी मतलब वो कर लेते हैं स्पोर्ट्स के रोल, या वो थोड़ा हेयर स्टाइल उन्होंने लंबे रखे हैं तो ऐसे लगते हैं। पर पता नहीं, पर्सनली मैंने मतलब इतना इसके बारे में सोचा नहीं है। तो जब इस बारे में बनना होगा मैं इसका जवाब तब दे सकता हूँ, क्योंकि मैं इसके बारे में प्रॉपर सोचूंगा और डिटेल में जाएंगे, और फिर इसका शायद सही जवाब मैं आपको दे पाऊंगा।
Great. Finally, before we go, Tushar, now you have like Neeraj and a series of high-performing athletes under your umbrella. What will it take for this market, India market, to strategically grow in significance when it comes to sportswear, and also like an important market for Under Armour globally?
See, look, this market, sportswear is already over-indexed in our fashion industry. So if you see the share of the sportswear segment in India, it's far higher than it is internationally. So the bigger challenge is the growth of the overall consumption in the economy. Sportswear is over-indexed. You will see the prominence of sportswear brands in India, in malls, in e-commerce, is far higher than what you will see internationally. So I think it is, along with the overall GDP growth and consumption growth of the economy, that will continue to grow. And it's a great advantage that we have, that we are over-indexed. So we have a larger share of mind and a larger share of consumers in India compared to what it is internationally. So that, I believe, is, if we are, as an industry or as an industry segment, we are on the right track. Specifically about Under Armour, we've reached a level that I couldn't have actually dreamt of when I was setting up the brand. Of course, these numbers were on an Excel sheet and a PowerPoint, but then when you actually reach those numbers, then it's a very different feeling. I mean, we have 49 stores across the country. In the year that we just ended, FY25, we reached a retail revenue of 500 crores, which was in some Excel sheet. But when I actually saw it in my financials, it was a very, very different feeling and emotion.
Thank you so much, both of you. Thanks for joining us and for this wonderful conversation.
Thank you, Shibani.
Thank you so much.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty fall for the third straight week. Financials and defense stocks lead the decline. Mid-cap index bucks the trend, gaining 1%. A leadership churn at Axis Bank. Senior executive Arjun Chaudhary resigns, marking the sixth top-level exit in the last 2 years. Neeraj Gambhir appointed whole-time director to replace Rajiv Anand, who retires in August. All of this comes as concerns mount over rising bad loans and slowing loan growth. Reliance Industries Q1 earnings today. The company is likely to report a 16% increase in the first quarter profits. Oils to chemical, digital and retail segments expected to see strong growth. Jio expected to see a 1% rise in the average revenue per user. The shortage of rare earth magnets draws the attention of the Prime Minister's office. Sources say the PMO is likely to hold a meeting with top officials from Commerce, Heavy Industries and Mines Ministries. India Inc. has been raising the alarm since China restricted the export of rare earths around 3 months ago. The much-awaited GST rate rationalization exercise is likely imminent, from cement to insurance, premium to telecom, two-wheelers and tractors. Brokerages are optimistic about significant changes in the tax rates when the council meets next time. Prime Minister Modi is likely to visit the United Kingdom next week to sign the free trade agreement. Government sources say Indian and British officials are completing the legal modalities of the deal, which needs to be ratified by the Union Cabinet, India and the British Parliament. The EU targets Russia's oil income in a fresh round of sanctions, imposes restrictions on Rosneft's refinery in India, also lowers the price limit on Russian crude oil. Facing a fierce backlash from his own supporters, President Trump orders the release of pertinent documents from the grand jury testimony related to the Jeffrey Epstein sex trafficking case. The decision follows a Wall Street Journal report which claims Trump gifted a letter featuring a drawing of a naked woman's silhouette and a personal note to Epstein on his 50th birthday. But straight to the day's market action. They continue to remain weak as quarterly results flowed in. Sensex falling over 500 points. The Nifty closing below the 25,000 mark, so down by about 0.5%. The Nifty Bank, by the way, lost about 1% this afternoon. Now, the markets have fallen for the third straight week, and financial stocks have dragged the markets lower. The Sensex, the Nifty Bank fell 1%. Mid-caps are closing in positive territory today, closing by about 462 points higher. Let's go across to Mangalam now. He joins us to wrap up the week that was and the week ahead. Mangalam.
But it was a down day this time. In fact, the Nifty closed below the 25,000 mark in the third week in a row where the Nifty ended lower. And today's weakness, this week's weakness, could be attributed to the weakness that we've seen in results so far. A large part of the weakness was led by the IT stocks, and finally we had the financials also lose. For instance, the top loser on the Nifty today was Axis Bank, down 5% after a weak asset quality that the company reported. And all eyes will now be on some of the heavyweight banks like ICICI Bank and HDFC Bank that report their numbers fairly shortly as well. Importantly, the IT stocks. Now, despite the weakness that we've seen through the course of the week, Wipro's results were fairly well received by the street. The stock was higher by 2% on an inline set of numbers, notwithstanding the weakness in other IT stocks. So the question now is a large part of the weakness in IT in the price or not? That's something we'll watch out for as the second rung of these companies report their numbers. The mid-caps, there also, the moves were a lot more result-oriented. We had stocks like Indian Hotels, HDFC AMC, Tata.com, even Nuvoco Vistas do well on the back of good performance. But by and large, there were two stocks that declined for every stock that was higher in today's trading session. We had some of the metals names which were outperforming in an otherwise bleak market. The defense stocks, they continued to see weakness. In fact, among the biggest losers this week, we had the likes of Bharat Dynamics and the others. We did see some weakness in a couple of these insurance names as well. The stock reactions versus the results have been in opposite directions. ICICI Lombard, the top loser this week.
Mangalam, many thanks. Now, Axis Bank faces top-level churn. Neeraj Gambhir has been appointed as the new whole-time director. He replaces Rajiv Anand, who's set to retire in August. Senior executive Arjun Chaudhary has resigned as well, marking the sixth senior-level exit from the bank in under 2 years. The bank's concerns have also mounted over management exits amidst bad loans and loan growth slowing. The bank's stock was down over 5% in trade today. This after it reported a disappointing set of Q1 numbers. Ritu's here with us. Ritu, Axis Bank's concerns escalating.
Escalating they are, Shireen, and it's not being helped by the top-level churn that is underway at Axis Bank. First, of course, Neeraj Gambhir, who is the Group Head of Treasury, Markets and Wholesale Banking, he has been elevated to a whole-time director role, designated an ED for a 3-year term. And that's because Rajiv Anand, who's been the long-serving DMD and whole-time director, is stepping down. But, you know, this is not an isolated shift at all. In fact, in the past 2 years or less than 2 years, 6 top executives have exited or are on their way out of the bank. The latest, like you said, Arjun Chaudhary, the group executive for cards, payments and retail lending, he has put in his papers. Rajiv Anand, we know, is already going to retire in August. And even before them, you know, your key leaders heading retail banking, liabilities, audit, wholesale banking have all resigned from their positions. And these changes are really coming at a time when Axis is facing a lot of operational headwinds, particularly when it comes to asset quality. You know, in the numbers that the bank has just reported, that slippage shock of 8,200 crores of bad loans, even if you set aside the technical impact, is quite high, nearly double the 2-year average. Gross NPA is the highest in 6 quarters. Credit costs have remained higher than peers. In fact, more than twice of HDFC Bank and ICICI Bank, despite having a comparable sort of loan mix. Now, this is triggering some concerns on the street. You have analysts like Suresh Ganpati of Macquarie pointedly asking questions about, these technical credit costs and adjustments have been done in the past. And if what the bank is doing now is truly a technical adjustment, where are the recoveries? Why now? Why not earlier? Could there be an underwriting issue in the retail book and so on? Now, even beyond asset quality, growth metrics have weakened. The loan and deposit growth have lagged the system average for many quarters now. In the first quarter, credit growth at just 8%, deposit at just over 9%, again underperforming the industry average. But perhaps the most dramatic reversal has been in retail lending, which has been the bank's key growth engine, from 27% in the third quarter of FY24 kind of peaks to just 6% in the first quarter now. But to be clear, there are industry-wide issues on credit and deposit growth slowdown. So this is not just an Axis Bank issue, but what's making it worse is this getting mixed in with senior management exits as well. And that certainly puts the bank in an uncomfortable spot. So there are bound to be questions on what comes next.
All right, Ritu, appreciate you joining us. Axis Bank CEO, while responding to Ritu's questions at the management conference call, said that about 25% of slippages are from the agri portfolio. Here's that conversation. Listen in.
So roughly, if you look at what we do is quarter one and quarter three are cyclical. And the way I would request you to think about it is, in quarter one and quarter three, about 25% or thereabouts of slippages are from the agri portfolio. So you could apply the maths to 5,400 crores, and roughly about 25% or thereabouts would be agri. The percentage would be broadly similar for last year's rupee crore number. The rest of the 75% is coming entirely from the unsecured business. We are very clear in making a call out saying we do not see stress in the secured part of our retail book as on date.
While Axis Bank was a stock under pressure, shares of Wipro surged in trade in response to the company's earnings. While the company met estimates in the first quarter, revenue contracted 2% on a constant currency basis. Margins also contracted sequentially, but all of this largely in line with estimates. In fact, speaking to CNBC-TV18, Wipro CEO Srini Pallia said there is a strong deal momentum and he expects FY26 to be better than FY25. Take a look.
So there is this very strong deal momentum that we have had in quarter one, which we tend to carry to quarter two. Of course, some of these deals will take its own time before we start ramping up. Second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
Metal giant JSW Steel reporting a strong set of earnings. Operating numbers fared better than estimates. EBITDA up 38%. Margins saw an expansion of 480 basis points. Moving on to a CNBC-TV18 exclusive, China's curbs on rare earth magnets continue and there's been no breakthrough yet. Sources have told CNBC-TV18 that the Prime Minister's office is holding a meeting today with top officials from Commerce, Heavy Industries and the Mines Ministries. The electronics industry separately has also been raising the alarm since China restricted the export of rare earths around 3 months ago. Ashmit is standing by now to take us through what industry's key concerns are and whether there is any breakthrough in sight. Ashmit, to be clear, there is nothing official about China's restrictions. What are you picking up from sources in terms of the impact on the electronic industry? Because the auto sector has already raised its concerns, saying that production has been impacted. What's the electronics industry's view and how worried are they today?
Well, that's in fact one of the aspects that have been flagged by the industry, that as far as these restrictions are concerned, including on rare earth, it is not unique to the auto industry. There are magnets, critical minerals also used by the electronics industry. It's impacting them as well. They're feeling the pain, and so much so that they're going on to say that there is a serious risk of losing out on the smartphone manufacturing momentum that we've seen in the country. In fact, the figures, the exports from smartphones in India for FY26 pegged at $32 billion. That's being put to risk. That's the assessment that the electronics industry has given to the government, saying that there are no formal restrictions, there are no notifications, directives to Chinese government officials, but there are oral directions, oral directives coming in from Beijing to Chinese companies, to Chinese officials on 3 critical choke points. The industry has identified identified 3 choke points, one of them being rare earth, critical minerals. Here again, the industry is saying it's not unique to the auto industry. We're experiencing pain as well. The other is recall of Chinese workers. This, the industry says, will directly impact transfer of technology. And number 3, capital equipment being imported from China, restrictions there as well. That, the industry says, is likely to impact production. Measures being taken by the Chinese administration and thereby calling on the Indian government to respond, asking the Indian government for help in terms of resolving these issues, giving in a word of caution as well that if left unchecked, such measures, if left unaddressed, such measures by the Chinese government could have far-reaching consequences for electronic smartphone manufacturing in the country. What has been the response of the government? Well, the government is quite clear. It has seized off these issues. These issues are not new. The government is aware of them, but so far there has been no state-led approach in terms of resolving any one of these 3 issues. In fact, specifically speaking on the subject of recall of workers themselves, the unofficial view coming in from the government is that this is an issue affecting a private company, and it is for the management and shareholders of that private company to go about resolving this issue.
All right, Ashmit, many thanks for joining us. Now, the much-awaited GST rate rationalization exercise is likely imminent. Sources tell us that the GST Council will deliberate on moving to a 3-rate structure at its next meeting. Meanwhile, brokerages are optimistic about significant changes in the tax rates. Timsy is standing by. Timsy, tell us more about what could be on the agenda in the next GST meeting and the expectations that the market is building in. What are brokerages saying?
Well, as hopes of GST rate rejig pick up pace and sources indicate that deliberations have started on shifting items to new rates, also moving to a possible 3-slab structure by doing away with 12% rate under the GST regime, it is anticipated that the upcoming GST Council meeting may take up these proposals for consideration. Meanwhile, brokerages and experts are penciling in an opportunity for significant changes to not only the rates but also the GST structure itself. Brokerage firm Jefferies believes items such as cement can be brought down from current 28% to 18%. Similarly, two-wheelers less than 350cc is also at 28% and could be brought down to 18%. On health insurance premium too, the agency says that it can be brought down from 18% to 5%. For telecom services, Jefferies proposes a rate cut from current 18%, and on hybrid passenger vehicles too, they propose a rate cut from current 28% plus cess, and on processed foods, footwear and apparel, rates could change from current 12% to 5% or 18%, depending upon subcategories. Rating agency Nomura too proposes that term life insurance can be brought down from current 18% to 5%. Tractors can be brought down from 12% to 5%, and air conditioners too can be reduced from 28%. Expectations by Morgan Stanley is to include natural gas under the GST ambit to reduce a lot of costs for the industry and consumers. Brokerages have listed reasons and potential revenue impact on these proposals. To be seen now is whether any of these proposals can actually make it to the council, and yes, whether council will be able to take a decision or not, something that we'll have to wait and watch for.
Well, that certainly is the big question. All eyes on the GST Council meeting. Timsy, many thanks for joining us. Prime Minister Modi may go to the UK next week to ink the India-UK free trade agreement. That's been in the works for quite some time, and it has officially been announced. This will be the formalization. Government sources tell CNBC-TV18 that officials of both nations are currently sealing the legal modalities of the deal. Abhimanyu here with the details. Abhimanyu, so the Prime Minister likely to head to the UK?
Government sources have indicated that the India-UK free trade agreement is likely to be signed next week. Currently, legal scrubbing is underway for the FTA, and post-signing, the FTA will require approval from India's Union Cabinet and from the British Parliament to come into effect. Earlier, government sources had indicated that the FTA will eventually lead to an overall increase in exports from India, as well as double the volume of bilateral trade to $120 billion by 2030. Now, highlighting duty-free access to 99% of tariff lines for almost almost 100% of trade value in exports of IC engine vehicles. Sources had also added that the UK will levy zero duty on export of Indian goods on 95% tariff lines in agriculture, fruits, vegetables, processed foods and cereals. In reciprocation, India is likely to cut tariffs on 90% of imports from the UK. A bilateral investment treaty is also being negotiated separately by India's Department of Economic Affairs. Sources had earlier pointed out that a lot of work has already taken place on the bilateral investment treaty. It remains to be seen how early this FTA is going to be signed and what kind of bearing it's possibly going to have on overall trade between India and the UK and subsequently on future FTAs being negotiated by India.
Abhimanyu, many thanks. The National Company Law Appellate Tribunal has granted a stay on the NCLT order that directed insolvency proceedings against Reliance Infrastructure. The case was initiated after IDBI trusteeship filed a plea and alleged default of around 90 crore rupees by the company. However, the company informed the court that all outstanding dues, including interest, has now been fully paid. We'll head into a break, but up next, President Trump orders the release of the pertinent documents from the grand jury testimony related to the Jeffrey Epstein sex trafficking case, facing a fierce backlash from his own supporters. That and more when we return. You're with Business 360, the big global headlines that we're tracking this hour. Israeli forces continue to bombard Gaza. At least 10 Palestinians have been killed in the last 24 hours. These include 5 people who were killed after Israeli forces attacked tents that were sheltering displaced Palestinians. Syrian forces have resumed fighting with Druze fighters and Bedouin tribes in the southern region of the country. This comes a day after Syrian troops pulled out of the area. A Syrian government spokesperson denied reports that government forces are being redeployed to the same region to stop the renewed tensions. Russian troops have claimed to have captured 3 villages in Ukraine. As fighting intensifies, Ukraine has disputed parts of the Russian account, particularly those concerning a key southeastern village. Russia said its air defenses destroyed 73 Ukrainian drones overnight, including several near Moscow. However, no casualties were reported. The European Union has targeted Russia's oil income in a fresh round of sanctions. The measure for buying Russian crude oil to $50 per barrel. Sonal is here to explain what this latest set of sanctions mean. Sonal.
Well, fresh sanctions coming in from the European Union. In a communique, they have spoken about how there are more sanctions coming in on Russia. The first one being fresh restrictions on companies which are linked to the Nord Stream gas pipeline, which is a very important pipeline for gas transportation. The second one is a lower cap on Russian crude sales, which has been reduced to $50 per barrel versus $60 per barrel earlier. The third one is they have cut off additional 22 Russian banking institutions from the SWIFT global payments. The fourth one is they've added 105 more vessels to the blacklist, in addition to 342 which were subject to sanctions, which were used for transporting Russian oil to different parts of the world. And the fifth one, restrictions on the export of equipment and materials that could be used in Russian defense industry. Now, just taking the crude oil point further, because it is very important for India, and what could the impact be of such sanctions on India? Now, this will also include restrictions on operations of Rosneft's 20 million tons per annum refinery in India, and it will impact both crude sourcing and refining in the country itself. Analysts are suggesting that there will be renewed hassles to secure vessels and insurance as well on crude which is imported from Russia right now. Remember, this particular sourcing has been continuously increasing. Right now, we source around 25% of our total crude from Russia. This would mean if there are sanctions, travel costs would increase, insurance costs would increase, and that will mean that the cost overall for all marketing companies would increase when it comes to sourcing crude from Russia. So it is a negative which has come back.
Sonal, many thanks. President Trump has directed U.S. Attorney General to seek the court's approval to release grand jury records related to the Jeffrey Epstein sex trafficking case. President Trump claimed that he took the decision because of the ridiculous amount of publicity around the case. This comes after a Wall Street Journal report claimed that the president gifted a letter featuring a drawing of a naked woman's silhouette and a personal note to Epstein on his 50th birthday. Trump has threatened to sue the Wall Street Journal for the report, calling it fake and defamatory. Here's a report.
U.S. President Donald Trump says he's asked Attorney General Pam Bondi to release grand jury testimony related to Jeffrey Epstein, the now deceased financier and sex offender, subject to court approval. Some of Trump's political base who were expecting lurid details about Epstein reacted in fury earlier this month after the Trump administration reversed a pledge to release documents it once suggested would offer major revelations about Epstein and his alleged clientele. A Justice Department report this month also concluded that there was no evidence to support a number of long-held conspiracy theories about his clients and 2019 death in prison. It's caused a rare fracture of support for Trump, who has called the matter a hoax. On Thursday, he wrote on his Truth Social platform that, quote, "Based on the ridiculous amount of publicity given to Jeffrey Epstein, I have asked Attorney General Pam Bondi to produce any and all pertinent grand jury testimony," before going on to blame Democrats for what he called a scam. Shortly after Trump's post, Bondi said on X that the Justice Department was ready to ask the court on Friday to unseal the grand jury transcripts. Allegations that Epstein had been sexually abusing girls became public in 2006, and he was arrested that year before accepting a plea deal. Epstein died in 2019 in jail after he was arrested a second time and charged with sex trafficking conspiracy.
The U.S. State Department has officially declared the Resistance Front as a foreign terrorist organization, a specially designated global terrorist. The TRF is a proxy outfit of the Pakistan-based terror group, the Lashkar-e-Toiba, that claimed responsibility for the Pahalgam terror attack in which 26 civilians were killed. Financing, supporting and advising a foreign terrorist organization is considered a criminal offense under American law. Reacting to the move, External Affairs Minister S. Jaishankar called it a strong affirmation of the India-US counter-terrorism cooperation. At least 40 schools across Bengaluru and 20 schools in Delhi have received similar bomb threats through email. The messages claim that explosive devices had been planted in classrooms. Delhi and Bengaluru police deployed multiple teams to the targeted institutions. No explosives have been found so far. The search operations continue. Justice Yashwant Verma has moved the Supreme Court challenging the legality of the process adopted by the CGI-appointed inquiry panel. Verma has sought for quashing of the committee's final report against him. The petition has stated that the report's unprecedented public disclosure led to a media trial and caused irreparable harm to Verma's personal reputation. The plea added that the final report provided no answers on the details of the case. With that, it is time for us to wrap up this edition of Business 360. There's plenty more coming up right here on CNBC-TV18. Stay tuned. We're back in a minute.
Welcome to Startup Street. I'm Shruti Mishra, and with me is Arundhati Ramanan. These are the top headlines from the startup space. IPO-bound B2B platform Udaan has acquired retail tech startup Shop Kirana in an all-stock deal, marking a strategic consolidation in the domestic eB2B space. The acquisition will complement the platform's leadership across core categories, including staples, FMCG, and hotel, restaurant, and catering.
Conversive, an AI-driven CRM engagement platform, has acquired voice technology startup Vox Genie in a bid to strengthen its offering in real-time voice automation. The deal integrates Vox Genie's conversational voice AI into Conversive's suite, which already spans SMS, WhatsApp, email, and chat.
Byju's founders, Byju Ravindran and Divya Gokulnath, are gearing up to file an over $2.5 billion lawsuit against Glass Trust and others for damage to their reputation and business. A statement from their counsel said the counsel termed the conduct of the edtech's term loan B lenders under Glass Trust as reprehensible and improper.
DCG Pack, a tech-enabled B2B packaging platform, has raised 15 crore rupees in its pre-Series A funding round led by GVFL with participation from Ox Anno Capital and promoters. This newly raised capital will be utilized to accelerate growth, enhance tech and expand international operations.
Amazon has cut at least hundreds of jobs in its Amazon Web Services cloud computing unit just a month after CEO Andy Jassy warned that adoption of generative AI tools would trigger a workforce reduction, Reuters reported. These decisions are necessary as we continue to invest, hire and optimize resources to deliver innovation for our customers, Amazon spokesperson said.
Those were the headlines that we're tracking for you this evening. But on the hot seat today, defense tech startup Armory has raised 13 crore rupees to supercharge its fight against rogue drones, a growing threat in modern warfare. Founded by IIT Bombay alumnus Amardeep Singh, Armory is building AI-powered counter-drone systems that can detect, deny and destroy. Backed by the likes of GrowX Ventures and Antler and already tested with army regiments, this homegrown startup is gunning to be a global defense force made in India for the world. Joining me now to discuss this further is Amardeep Singh, the founder and CEO of Armory. Amardeep, thank you so much for joining us here on Startup Street. You know, like I said, you are a defense tech startup and you started in 2024. You took your product from sketch to field ready in just 6 months, right? And that's quite impressive. What enabled Armory to move so fast? Take us through your key products.
Thank you so much for having me. This is not my first time that I'm in this domain of defense tech. Earlier, I was a founding member at IdeaForge, so I've already seen this journey of building a product and actually supplying to defense. So I think the major difference between a software and hardware is the gestation period and the iterations that we can do. So from the beginning, it was very clear for us that we want to do very, very quick iterations. And that means that pushing the vendors for components and everything. So from the beginning, we were very, very sure that we are not going to be bound by the timeline set by the vendors for components. And that led us to increase our iteration cycle. And my previous experience also helped a lot.
Absolutely. I mean, IdeaForge is huge in the drone space. But, what sort of sets your Samaritan OS apart from traditional defense systems? And how important is AI in modern warfare scenarios?
So just to clarify, Samaritan is our software layer. So there are two parts to it. Obviously, now everything has to be a hardware plus a software system. So Samaritan is the OS that we have built. Think of it as the command and control center, a modern command and control center. So right now, most of the hardware is controlled using some command and control center, but they're still sort of legacy systems. So this is where we are bringing AI to improve them. Another area where we are using AI is basically for radio frequency signal intelligence. So until now, it was done using classical methods, and we are bringing AI to get better signal intelligence, and that would help us, let's say, detect the position of radars of the enemy or the drones or any RF-based system. So we should be able to pinpoint the position and location of those systems using AI-powered Samaritan OS.
Sure. And you've raised this $1.5 million. What are your near-term priorities with this fundraise? More products, international expansion, or deeper R&D?
So there are two primary goals. One is R&D to build more advanced products. But I think a very important realization we had during Operation Sindoor was that I think having a good production capacity is very, very important. So when a conflict is going on, building a product is one thing, but being able to supply in good numbers to defense is a very important part. So a good amount of this funding is going to go to increase the production capacity so that we can supply those systems to our forces and they can be utilized in numbers. So we have a huge borderline. So we are going to need a lot of such systems. So that's our primary goal right now.
Sure. So that's your primary goal. Can you give us a sense of who your clients are and how large your client base is? Or if it is largely the government of India and the kind of use cases you provide with your technology?
So when I started this company, we started with as a defense first company only. So I do see maybe in the long run, there'll be commercial uses also. So you can imagine like airports or five-star hotels or factories, all of them are going to require defense against drone. But our first use case is defense itself, which is the border. So the good part is that, after what we have seen has happened in Ukraine and Russia and very close home, in India very recently, Indian defense forces and government have been very proactive to look out for such systems. So in the last 2 years, I think there have been a lot of RFIs and RFPs that have been coming for the counter-drone systems, and we are getting prepared for that. Having said that, primarily it is Indian Army, paramilitary forces, Air Force, and Navy, which are actively looking for such systems. So just to give a very quick overview, so our systems can detect drones at a few kilometers away, and then also neutralize them, soft kill solutions. So current product can do soft kill, but the goal later is to build hard kill solutions as well. And that's our next goal. Once we get to a production capacity of good numbers on this product, we'll move on to hard kill solutions.
Sure. And financially, how has Armory fared so far? I know you only started in 2024, but what kind of revenues and if any profits are you generating, and what are your projections for the coming year or so?
So in recent times, we have participated in several tenders. We have qualified in, technically among them. So the procurement is still going on. So we have not made any revenue yet. But that's how the defense and especially hardware works, that you spend some amount of time on the product development. But we are seeing, looking at next, in 6 months, we should be at a good level. I mean, that's the detail, something that I can't share right now, but we should be in a revenue-making position within 6 to 8 months.
So 6 to 8 months, you will be in a revenue-making position. If you could quickly tell us, we're running out of time. India's Operation Sindoor was a display of modern warfare, right? Post this, how have things evolved in the defense space, and how will the industry benefit with India mulling over hiking its defense budget going forward?
I think there were, I believe, a quick realization of the fact what we have been seeing in Ukraine and Russia. So people sort of had a sense that, okay, the warfare has changed, that they are going to use drones for the war, but it really hit home when this conflict happened. Till now, the defense forces, not just of India, for every country, has always been towards bigger threats like aircrafts and missiles. Drones are a relatively newer phenomena, and not many countries or nations have built defense systems against that. And sort of this is a wake-up call also, that we need to become better at that, because that is how the future war is going to be fought.
Absolutely. Yeah, absolutely. All right, Amardeep, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best with this venture going forward.
Thank you so much.
Moving on what's brewing today, Bangalore-based QPI-AI, leading developer of integrated AI and quantum solutions for enterprises, has announced the completion of its $32 million Series A funding round led by Avatar Ventures and the National Quantum Mission of the Department of Science and Technology in India. Now, QPI-AI is building full-stack quantum computers, combining proprietary hardware and software to solve real-world problems in material science, drug discovery, automotive, and more. The company is now focused on scaling utility-grade quantum systems and positioning India at the forefront of commercial quantum innovation. Joining us now to share more on the fundraise, the road ahead, and India's quantum ambitions is Nagendra Nagaraja, the founder and CEO of QPI-AI. Nagendra, welcome to Startup Street. Your Series A funding has a combination of private and public backing, with Avatar Ventures and India's National Quantum Mission coming together. Tell us, how did this partnership come about? And in fact, the National Quantum Mission has called QPI-AI one of its early success stories. What does this validation mean to you, and how do you see the venture contributing to India's larger quantum vision?
Yes, so NQM is a blessing for us as a company. Okay, so we are a deep tech company, deepest tech company. And then the mission, the India entering mission mode for quantum is really great. And they were the first, big investors, what we have after Rivernest, and then SIDBI that we closed 6 million. And then Avatar came about because we were scaling it rapidly, and we do require somebody like Avatar, which put around 16 million into this venture. And NQM support is, it's a very, very, very important for us. And then we thank PM Modi for Sri Modi that we had this kind of mission that was envisioned by PM. It's a fantastic thing for quantum ecosystem in India. And also we thank DST Secretary Dr. Abhay Karandikar and Dr. Ajay Chaudhary, who's the chairman, who helped us a lot. And the partnership is very unique because this is the first time we have a government taking a stake in the company, and then we have a big private investor investing. And we have a bigger, rounds also coming up. So it has been a very harmonious kind of a partnership that we have.
Okay.
And we have in a mission mode to make sure that we have a commercial grade quantum computer. And that's about how the partnership it is very, very, very harmonic.
All right. So you've built a full-stack quantum computer with both proprietary hardware and software, like I mentioned earlier, and you now plan to use this funding to accelerate delivery of a utility-scale quantum system.
Yes.
If you could walk us through what that means, the key milestones ahead, and how close we are to seeing commercial-grade quantum utility.
See, today what we have is a NIS qubits, the quantum, but we are working on superconducting devices, but we have a capability to manufacture anything solid state. So the quantum comes in many forms. The qubit comes in many forms. So we are focusing on solid state. That means you have superconducting, semiconductor-based spin qubits, and also photonics, and then of course Mariana. So these are all the chips that will be deployed as a quantum computer. And there are things on the neutral atom and ions, which people are doing as ion traps and neutral atom based, but we're not focusing on those things. What we have today is a superconducting based quantum computer, and we are in a NISQ era, noisy intermediate state quantum. Next year, we have our first logical qubit where error rates will be around 10 power minus 6. And this is a special type of qubits that we have designed, and that will actually pave way to the utility scale quantum computer. And we see, according to our roadmap, which is very public, 2029, 2030 is where you will have all these workloads on materials, pharma, banking, and all these things will be running on a quantum computer.
All right. All right, so 2030 it is. But Nagendra, very quickly, QPI operates across a range of sectors, from logistics and pharma to finance and advanced materials. Tell us, how does your integrated AI plus quantum approach create a competitive edge across these domains? And if you could share a specific example, perhaps, that highlights the kind of real-world impact you're already delivering.
Yes, if you look at one of the use cases is automotive simulation, simulating the car design, and also drug discovery, drug synthesis, retrosynthesis, where quantum and AI both are involved hand to hand, because we are using a quantum hardware as well as quantum software and also AI. AI is actually doing the front end work of heavy lifting and reducing the data space, and quantum is doing the hard work of actually churning the numbers. Okay, quantum is good for solving the hard problems. Hard problems goes to quantum, and then there are automation and there are problems which can be done by a little bit of intelligence like LLMs. Okay, that goes to AI. So combination of these two have resulted. See, for example, one of the thing what we did was we did discover the chemical for the cosmetics, which is which can be used in sunscreen, which protects the UV rays, and then it doesn't have any color. So that kind of material synthesis and discovery can happen when quantum and AI can go hand in hand. And other example is when we reduce the simulation of a trunk design in the car from 48 hours to 30 minutes. Okay, that again is example of AI and quantum combined.
Okay. Give us a sense of your current business momentum, the kind of growth you're seeing today, and are there any revenue or commercial targets that you can share going forward?
Yeah, I think for 3 out of 5 years, we are already profitable. From inception, we are profitable. And then we have revenue generating from beginning. So this year, we may cross around 50, 60 crores easily. We have order book of, pipeline of almost like 1,000 crores for the hardware. Okay, and for the software, we are growing on quantum software and AI software. So overall, in by 2030, I think we should be touching around $100 million. So that will be our target.
All right, a target of $100 million by 2030 is what you say. Thank you so much, Nagendra, for your time on Startup Street, and wish you the very best for all your growth targets.
Thanks a lot. You have a nice day. Thank you. Bye.
On that note, it is time for us to head into a short break. But coming up on the other side, software as a service major Zoho Corporation has launched a slew of AI tools and is preparing to unveil many more. We get to a special conversation with the company's CEO, Mani Vembu. On the other side, stay tuned.
Welcome back to Startup Street. Software as a service major Zoho Corporation has launched Zia LLM, its proprietary large language model tailored for enterprise use. It has also introduced several new AI-powered tools, including automatic speech recognition models in English and Hindi, a no-code AI agent builder, and a model context protocol server. My colleague Ritu Singh caught up with Zoho's CEO Mani Vembu on the sidelines of the company's annual user conference, Zoholics, held in Bangalore, to talk about the new launches. Take a look.
The Zia LLM is for business use cases. So it is specifically for our customers and our own software use cases. Like say wherever we provide some use cases, we thought we could do it with the smaller models. And that's why we launched it with 1.3 billion parameter, 2.6 and 7. And all three are separately trained. So with some public data and some private data. So the training, we didn't use our customer data. So so these models are used for specific business use cases where this could provide better results at a lesser cost.
So just to be clear, this Zia LLM offering from Zoho, it is going to be part of your overall Zoho stack for your enterprise customers and not really be a standalone app.
See, currently we are only offering it through our apps. So that means all the prompts, everything will be part of our apps.
Of your entire Zoho
stack.
Yeah.
And so right now we don't have any plans to go for consumers.
Not consumers, but as a standalone app, even for your enterprise customers.
Yeah.
That is not the plan.
Yeah, that is, see, it is anyway available through the functionalities. So there will be like say ChatGPT-like interface where conversational interfaces, but some of the responses will come from the Zia LLM, whichever use cases we have used it for.
Okay, what about the rollout timeline for this LLM that you've built? How soon will all of your customers, all of your enterprise customers be able to access this across the world? And also a word on the pricing structure that you built for this LLM.
Yeah, see, the rollout we are going to do gradually. So we are testing it out. We want to make sure that accuracy levels are there, the privacy is ensured, the governance is put in place, so that the rollout is going to happen gradually. So across customer base and on the pricing structure, see, we keep adding new functionalities, not just the AI functionalities, we keep adding new tools, new low-code tools for the existing platform. And every tool comes with a cost. It's either development cost or the infrastructure cost. Like how we don't increase price for every tool. So we just introduce it as...
But this is a big tool.
Yes, that's true. So there is a cost involved here. But that's why we are right-sizing it to reduce the cost on the infrastructure. And we don't want to pass on the cost to the customer, rather we want to actually take it within. So because we see it as like say how many more customers could we reach with this.
But over time, you would be inclined to increase the cost. Perhaps this is for the initial rollout?
Yes, at least for now we don't want to. And then generally, see, we don't increase price if there is no need for it, as long as we are able to optimize the cost. So we look for optimization first before increasing the cost. That also keeps us efficient.
What's the plan to scale Zia LLM's model size over time from what you have currently? And broadly, if you could take us through the use cases, industries, etc., that you've identified, from the first few customers that you rolled out to.
So the models, right, say up to 100 billion we want to go. So by
up to 100 billion, okay.
Yes. So so we are training those models there, and we want to take it there. And see, since it is included as part of some of the functionalities, say some summarization will come from Zia LLM. So we see wherever we see better results, those are all the features where we are enabling it. So even that rollout, we are gradually increasing. So from feature to feature. So we don't want to just roll it out for all the features. And we also give the option to customers. So through Zia Bridge, we allow customers to plug into their own open source LLM, or their own hosted LLMs or the public LLMs. So they can bring their own key. If they already have a licensing agreement with some of the models, then they can just plug into that.
Again, to the question of how will you really differentiate this, of course, I know that you built this LLM which is focused on enterprises more than customers, but how will you really compete with the big tech, giants that already have these LLMs that are being used by perhaps even some of your own enterprise customers?
See, it is very specific to business use cases. If you look at any public LLM, it is for consumer. Say if you take the search, so the search was available for consumers, but the business search was not solved because the data were siloed and all those. So we invested in search for our own tools, our own products. We have heavily invested on that, and we even give an actionable search That means from the search results, you can actually take an action, send an email or do all kind of actions. The same way, say we are looking at LLMs to power our own use cases. So it is not like a, right, say there is no comparison between what is available in the public large language models, because we are not trying to do what they are doing. So they are best at many things, but we want to be actually best at what we are solving for businesses.
You know, given that you've spent so much time, energy and money, building your own LLM, this is of course enterprise focused. Any plans to build one for consumers as well?
See, so far, because we see, like say, there is a lot of opportunity and a lot of work that is going on in terms of powering this for businesses. So we see that there is a lot of gaps there. So there is a lot of optimization that is possible. That's why we are investing here. And the future, as we move forward, we will decide on the future. So how best we are able to bring this.
You're not saying no to it yet.
Yes. Yeah.
Let's also talk about your other big launch today, the 2 proprietary ASR, or what you call the automatic speech recognition models. Right now, you've launched this for speech-to-text conversion for English and Hindi. What kind of partnerships enable this? And how soon will you be looking at launching it in other languages as well?
Yeah, so we are going to do other languages as we move forward. We started with Hindi and English. And see, in terms of partnership, we have built it ground up. So we partnered with, say, some institutions to provide us with the training data. So other than that, like, it's ground up.
These institutions would be?
IIT Madras and IIT Bombay.
All right, a quick final word on your overall business picture. US, your largest market. What is the sort of client feedback you're getting there? Because of the macro environment, are spends getting impacted? And back home in India, which is now your second largest market, do you expect to grow at a similar pace? You've done 32% revenue growth last year.
So if you take US, we are seeing a steady growth. So far we haven't seen, say, the customer growth is only increasing. And it's accelerating as more and more of our apps are getting adopted more widely. So we are seeing an increase in customer growth. And so we don't see an impact on this so far. And in terms of India growth, we are moving up market. That means we are serving larger customers. So we are seeing more and more interest from the larger customers. So we expect to see the same kind of growth going forward.
So a 30-odd% plus kind of a growth, or could you better that?
See, we want to definitely better that, but definitely, like, say, more than 30% is what we expect.
Now let's take a look at the deal activity this week. As per Venture Intelligence, 17 startups secured $111 million this week. Some of the notable deals were quantum tech startup QPI AI, which secured $32 million from Avatar Venture Partners, Your Nest and others. Meanwhile, telehealth platform TrueMeds and EV mobility player Transport Mobility landed an investment of $20 million each from different investors.
Well, that's not all. We also saw AI-based customer insight startup Grey Labs raise $9 million from Elevation Capital and Z47, while payment solutions provider FeeCommerce bagged $6 million from BNext. With this, the total number of deals for this year till date climbed to 487, and it is valued at $4.6 billion.
Quite a week there for the deals this week. But with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates continue right here on CNBC-TV18.
Welcome to Indianomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indianomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Center for Policy Research, more importantly, MPC member. Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarti, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, Lata, thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving very, in a very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers. Some pull up in inflation numbers, but given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it'll effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards repo rate, which basically means that, there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugata, I'm going to ask you 2 quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very clearly that it's not just the next couple of sprints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, this is not. You hear the argument that it's best to cut the policy rate before start with another easing, make another easing move before inflation starts moving upwards. I don't think that's a correct argument because obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack 2 quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? in the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, the growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's very, the amount of money that's been raised to the corporate bond market, I think is very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, I mean, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Welcome back to Internomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj Gambhir and Samiran Chakrabarti speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
So it boils down to how you are looking at credit growth, whether you are looking at it from the demand side or you are looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front, and that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Saugata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, et cetera, as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve, but we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12-13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity every day bankers forced to give money to the Reserve Bank at 5/4 or even maybe if there is a rate cut at 5% to RBI, would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samaran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between. And we will slowly inch up towards 12%. I still don't see it going significantly beyond 12-13% for this year because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4-5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember, between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth, we'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. There will be some impetus to bring the credit growth back towards 12-13% numbers by the end of this year.
Okay. A two-part question for you, Samir, and actually I'll put it in two separate questions. One, this 12-13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here. Okay. We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. It's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit. Fair. As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samaran, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down and whether the average tariffs settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. Our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports, have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat, and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1, if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut, but I think between August and October also we'll have some more data. So my guess is the Reserve Bank would likely wait until October, see data between July, August and October and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range-bound mode, around 6.25% to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. The government may rethink, or the RBI may advise it to bring it down. Then there is a bit of a rally perhaps at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile,
yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alek Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news,
Yeah.
and you don't know, tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every
Sure.
dip?
Sure. Yeah, so I think there's a little bit of concern that is there amongst investors as well, So they're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equity.
So there is fear of missing out, but there's also fear of participation. So
That's
it's
right.
like, twin fears working together.
Exactly.
But in generally, I mean, as a house call right now, when you talk about any broad portfolio
Yeah.
advice, so I know it'll be different for different individuals, but
Ladies and gentlemen, thank you so much for being here. Over the last 5 years, we've seen crisis after crisis. It began with COVID-19, and Ambassador Saran, then we saw the semiconductor crisis that shook the world. You had the Ukraine-Russia war, which we're still grappling with. We've not found a solution. You've seen the Middle East crisis, the Israel-Hamas war, the Israel-Iran war, and the Middle East continues to be on the edge. every day when we get up, there is some sort of upheaval or the other. And you have a president in the United States who wants to make sure that it's always America first and American interests are always benefiting. And India also is having a problem with the United States. We are managing our relationship. We have a strong strategic partnership for the future, but there are challenges when it comes to certain aspects of the trading partnership. Ladies and gentlemen, there's no one better to understand the current geopolitical situation, the geopolitical chaos that we see than Ambassador Shyam Saran, somebody who has been our foreign secretary. He has been the special envoy on the Indo-US nuclear deal, contributed a great deal to the civil nuclear agreement with the United States. And also, he was the special envoy to the Prime Minister on climate change. So, Ambassador Saran, without wasting more time, let me begin by asking you, is global chaos the new normal?
Well, it's a bit of a contradiction in terms, no? If it was normal, then we would not have chaos. So I think what we are facing is chaotic. I do not think that it is normal in the sense that this is what the future is going to be, and this is, the landscape that we will be, dealing with for the foreseeable future. So I think we have to focus attention on what are the drivers of this change which is taking place. There are some factors which are more fundamental, more seminal in character. Others may be just cyclical. The question that has been raised is what Trump is doing something that will last only for the 4 years of the presidential term, or is this something which will continue post-Trump as well? And the answer to that is that there are certain things which will continue even when Trump is not there, but there are other things which will perhaps be very different from what we are seeing today.
Right. Now, let me ask you about multipolarity. India has always believed in non-alignment. We believe in a multipolar world where we will stand for our interests. Is this working with Donald Trump?
Well, I don't think that we should look at multipolarity in terms of whether it is working for India in one relationship or not. Multipolarity is really a certain state. It's not a certain choice. Multipolarity exists because today you have a larger number of more substantial powers who have emerged in terms of their economic capabilities, in terms of their technological capabilities, in terms of their military capability. So the diffusion of power is a reality. So it's not that, in dealing with Trump, somehow or the other, we have to make a choice between multipolarity and unipolarity. I do not think that's the case. But I think it is certainly true. The question is raised whether or not we should succumb to the kind of pressures which we are facing from the United States, or should we really continue on a path which we determine is really in India's long-term interests. I think that should be the test of what we should be doing, rather than get caught in this debate about, you have to somehow ally with the United States if you want to save yourself, or you have to somehow or the other